Quick quiz: why do governments try to limit the use of common resources? Will the market protect me? Rev. 11:4. Conclusion: the importance of property rights. In this and the previous chapter, we have seen there are some goods that the market does not provide adequately. Markets do not ensure that the air we breathe is clean or that our country is defended from foreign aggressors. Instead, societies rely on the government to protect the environment and to provide for the national defense. The problems we considered in these chapters arise in many different markets, but they share a common theme. In all cases, the market fails to allocate resources efficiently because property rights are not well established. That is, some item of value does not have an owner with the legal authority to control it. For example, although no one doubts that the good of clean air or national defense is valuable, no one has the right to attach a price to it and profit from its use. A factory pollutes too much because no one charges the factory for the pollution it emits. The market does not provide for national defense because no one can charge those who are defended for the benefit they receive. When the absence of property rights causes a market failure, the government can potentially solve the problem. Sometimes, as in the sale of pollution permits, the solution is for the government to help define property rights and thereby unleash market forces. Other times, as in restricted hunting seasons, the solution is for the government to regulate private behavior. Still other times, as in the provision of national defense, the solution is for the government to use tax revenue to supply a good that the market fails to supply. In all cases, if the policy is well planned and well run, it can make the allocation of resources more efficient and thus raise economic well-being. Goods differ in whether they are excludable and whether they are rival in consumption. A good is excludable if it is possible to prevent someone from using it. A good is rival in consumption if one person's use of the good reduces others' ability to use the same unit of the good. Markets work best for private goods, which are both excludable and rival in consumption. Markets do not work as well for other types of goods. Public goods are neither rival in consumption nor excludable. Examples of public goods include fireworks displays, national defense, and the creation of fundamental knowledge. Because people are not charged for their use of the public good, they have an incentive to free ride, making private provision of the good untenable. Therefore, governments provide public goods, basing their decision about the quantity of each good on cost-benefit analysis. Common resources are rival in consumption but not excludable. Examples include common grazing land, clean air, and congested roads. Because people are not charged for their use of common resources, they tend to use them excessively. Therefore, governments use various methods to limit the use of common resources. Key concepts. 1. Explain what is meant by a good being excludable. Explain what is meant by a good being rival in consumption. Is a slice of pizza excludable? Is it rival in consumption? 2. Define and give an example of a public good. Can the private market provide this good on its own? Explain. 3. What is cost-benefit analysis of public goods? Why is it important? Why is it hard? 4. Define and give an example of a common resource. Without government intervention, will people use this good too much or too little? Why? Questions for review. 1. Which categories of goods are excludable? A. Private goods and club goods. B. Private goods and common resources. C. Public goods and club goods. D. Public goods and common resources. 2. Which categories of goods are rival in consumption? A. Private goods and club goods. B. Private goods and common resources. C. Public goods and club goods. D. Public goods and common resources. 3. Which of the following is an example of a public good? A. Residential housing. B. National defense. C. Restaurant meals. D. Fish in the ocean. 4. Which of the following is an example of a common resource? A. Residential housing. B. National defense. C. Restaurant meals. D. Fish in the ocean. 5. Public goods are A. Efficiently provided by market forces. B. Underprovided in the absence of government. C. Overused in the absence of government. D. A type of natural monopoly. 6 common resources are A. efficiently provided by market forces. B. underprovided in the absence of government. C. overused in the absence of government. D. a type of natural monopoly. Quick check multiple choice. 1. Think about the goods and services provided by your local government. A. Using the classification in Figure 1, explain which category each of the following goods falls into: police protection, snowplowing, education, rural roads, city streets. B. Why do you think the government provides items that are not public goods? 2. Both public goods and common resources involve externalities. A. Are the externalities associated with public goods generally positive or negative? Use examples in your answer. Is the free market quantity of public goods generally greater or less than the efficient quantity? B. Are the externalities associated with common resources generally positive or negative? Use examples in your answer. Is the free market use of common resources generally greater or less than the efficient use? Problems and applications. 230. 3. Charlie loves watching Downton Abbey on his local public TV station, but he never sends any money to support the station during its fundraising drives. A. What name do economists have for people like Charlie? B. How can the government solve the problem caused by people like Charlie? C. Can you think of ways the private market can solve this problem? How does the existence of cable TV alter the situation? 4. Wireless, high-speed internet is provided for free in the airport of the city of Communityville. A. At first, only a few people use the service. What type of a good is this and why? B. Eventually, as more people find out about the service and start using it, the speed of the connection begins to fall. Now, what type of a good is the wireless internet service? C. What problem might result and why? What is one possible way to correct this problem? 5. 4 roommates are planning to spend the weekend in their dorm room watching old movies, and they are debating how many to watch. Here is their willingness to pay for each film. Judd Joel Gust him. First film $7, $5, $3, $2. Second film $6,421. Third film $5,310. Fourth film $4,200. Fifth film $3,100. A. Within the dorm room, is the showing of a movie a public good? Why or why not? B. If it costs $8 to rent a movie, how many movies should the roommates rent to maximize total surplus? C. If they choose the optimal number from part and then split the cost of renting the movies equally, how much surplus does each person obtain from watching the movies? D. Is there any way to split the cost to ensure that everyone benefits? What practical problems does this solution raise? E. Suppose they agree in advance to choose the efficient number and to split the cost of the movies equally. When Judd is asked his willingness to pay, will he have an incentive to tell the truth? If so, why? If not, what will he be tempted to say? F. What does this example teach you about the optimal provision of public goods? 6. Some economists argue that private firms will not undertake the efficient amount of basic scientific research. A. Explain why this might be so. In your answer, classify basic research in one of the categories shown in Figure 1. B. What sort of policy has the United States adopted in response to this problem? C. It is often argued that this policy increases the technological capability of American producers relative to that of foreign firms. Is this argument consistent with your classification of basic research in part? 7. There is often litter along highways but rarely in people's yards. Provide an economic explanation for this fact. 8. The nation of Vietnam has 5 million residents whose only activities are producing and consuming fish. They produce fish in 2 ways. Each person who works on a fish farm raises 2 fish per day. Each person who goes fishing in one of the nation's many lakes catches X fish per day. X depends on N, the number of residents fishing in the lakes. In particular, if N million people fish in the lakes, Each catches X equals 6n fish. Each resident is attracted to the job that pays more fish, so in equilibrium the two jobs must offer equal pay. A. Why do you suppose that X, the productivity of each fisherman, falls as n, the number of fishermen, rises? What economic term would you use to describe the fish in the town lakes? Would the same description apply to the fish from the farms? Explain. B. The town's Freedom Party thinks every individual should have the right to choose between fishing in the lake and farming without government interference. Under its policy, how many of the residents would fish in the lakes and how many would work on fish farms? How many fish are produced? C. The town's Efficiency Party thinks Winam should produce as many fish as it can. To achieve this goal, how many of the residents should fish in the lakes and how many should work on the farms? D. The Efficiency Party proposes achieving its goal by taxing each person fishing in the lake by an amount equal to T fish per day. It will then distribute the proceeds equally among all Winam residents. Calculate the value of T that would yield the outcome you derived in part. Chapter 11, Public Goods and Common Resources 231. E. Compared with the Freedom Party's hands-off policy, who benefits and who loses from the imposition of the Efficiency Party's fishing tax? 9. Many transportation systems, such as the Washington, D.C. Metro, charge higher fares during rush hours than during the rest of the day. Why might they do this? 10. High-income people are willing to pay more than lower-income people to avoid the risk of death. For example, they are more likely to pay for safety features on cars. Do you think cost-benefit analysts should take this fact into account when evaluating public projects? Consider, for instance, a rich town and a poor town, both of which are considering the installation of a traffic light. Should the rich town use a higher dollar value for a human life in making this decision? Why or why not? Go to CEngageBrain.com to purchase access to the proven, critical study guide to accompany this text, which features additional notes and context, practice tests, and much more. 233. The design of the tax system. A. L. Scarface Capone, the notorious 1920s gangster and crime boss, was never convicted for his many violent crimes. Yet, eventually, he did go to jail for tax evasion. He had neglected to heed Ben Franklin's observation that in this world nothing is certain but death and taxes. When Franklin made this claim in 1789, the average American paid less than 5% of his income in taxes, and that remained true for the next 100 years. Over the course of the 20th century, however, taxes became ever more important in the life of the typical U.S. citizen. Today, all taxes taken together, including personal income taxes, corporate income taxes, payroll taxes, sales taxes, and property taxes, use up more than a quarter of the average American's income. In many European countries, the tax bite is even larger. Taxes are inevitable because we as citizens expect our government to provide us with various goods and services. The previous two chapters shed light on one of the 10 principles of economics from Chapter 1, the government can. Chapter 12. 234. Sometimes improve market outcomes. When the government remedies an externality, provides a public good, or regulates the use of a common resource, it can raise economic well-being. Yet these activities are costly. For the government to perform these and its many other functions, it needs to raise revenue through taxation. We began our study of taxation in earlier chapters, where we saw how a tax on a good affects supply and demand for that good. In Chapter 6, we saw that a tax reduces the quantity sold in a market, and we examined how the burden of a tax is shared by buyers and sellers depending on the elasticities of supply and demand. In Chapter 8, we examined how taxes affect economic well-being. We learned that taxes cause deadweight losses. The reduction in consumer and producer surplus resulting from a tax exceeds the revenue raised by the government. In this chapter, we build on these lessons to discuss the design of a tax system. We begin with a financial overview of the U.S. government. When thinking about the tax system, it is useful to know some basic facts about how the U.S. government raises and spends money. We then consider the fundamental principles of taxation. Most people agree that taxes should impose as small a cost on society as possible and that the burden of taxes should be distributed fairly. That is, the tax system should be both efficient and equitable. As we will see, however, stating these goals is easier than achieving them. 12:1 A financial overview of the U.S. government. How much of the nation's income does the government take as taxes? Figure 1 shows government revenue, including federal, state, and local governments, as a percentage of total income for the U.S. economy. It shows that the role of government has grown substantially over the past century. In 1902, the government collected 7% of total income. In recent years, government has collected almost 30%. In other words, as the economy's income has grown, the government's revenue from taxation has grown even more. Table 1 compares the tax burden for several major countries, as measured by the government's tax revenue as a percentage of the nation's total income. The United States has a low tax burden compared to most other advanced economies. Many European nations have much higher taxes, which finance a more generous social safety net, including more substantial income support for the poor and unemployed and universal government-provided health care. Receipts of the federal government, 2011. Table 2. Tax amount. Amount per person. Percent of receipts. Individual income taxes $1,075, $3,446, 43%. Social insurance taxes $906, $2,904, 36. Corporate income taxes $304, $974, 12. Other $235, $753, 9. Total $2,520, $8,077, 100%. Source: Bureau of Economic Analysis. Columns may not sum to total due to rounding. Total government tax revenue as a percentage of GDP. Table 1. Denmark 48%, Canada 31%. Sweden 45%, Greece 31%. France 44%, Japan 28%. Italy 43%, Australia 26%. Germany 37%, United States 25%. United Kingdom 36%, Chile 21%. Spain 32%, Mexico 20%. Source: OECD. Data are for 2011. The overall size of government tells only part of the story. Behind the total dollar figures lie thousands of individual decisions about taxes and spending. To understand the government's finances more fully, let's look at how the total breaks down into some broad categories. 12-1 of the federal government. The U.S. federal government collects about 2/3 of the taxes in our economy. It raises this money in a number of ways, and it finds even more ways to spend it. Receipts. Table 2 shows the receipts of the federal government in 2011. Total receipts that year were $2,520 billion, a number so large that it is hard to comprehend. To bring this astronomical number down to earth, we can divide it by the size of the U.S. population, which was about 312 million in 2011. We then find that the average American paid $8,077 to the federal government. 236. The largest source of revenue for the federal government is the individual income tax. As April 15 approaches each year, almost every American family fills out a tax form to determine how much income tax it owes the government. Each family is required to report its income from all sources: wages from working, interest on savings, dividends from corporations in which it owns shares, profits from any small businesses it operates, and so on. The family's tax liability is then based on its total income. A family's income tax liability is not simply proportional to its income. Instead, the law requires a more complicated calculation. Taxable income is computed as total income minus an amount based on the number of dependents and minus certain expenses that policymakers have deemed deductible. Then the tax liability is calculated from taxable income using a schedule such as the one shown in Table 3. This table presents the marginal tax rate, the tax rate applied to each additional dollar of income. Because the marginal tax rate rises as income rises, higher income families pay a larger percentage of their income in taxes. Note that each tax rate in the table applies only to income within the associated range, not to a person's entire income. For example, a person with an income of $1 million still pays only 10% of the first $8,925. Almost as important to the federal government as the individual income tax are payroll taxes. A payroll tax is a tax on the wages that a firm pays its workers. Table 2 calls this revenue social insurance taxes because the revenue from these taxes is earmarked to pay for Social Security and Medicare. Social Security is an income support program designed primarily to maintain the living standards of the elderly. Medicare is the government health program for the elderly. Table 2 shows that the average American paid $2,904 in social insurance taxes in 2011. Next in magnitude, but much smaller than either individual income taxes or social insurance taxes, is the corporate income tax. A corporation is a business set up to have its own legal existence, distinct and separate from its owners. The government taxes each corporation based on its profit, the amount the corporation receives for the goods or services it sells minus the costs of producing those goods or services. Notice that corporate profits are, in essence, taxed twice. They are taxed once by the corporate income tax when the corporation earns the profits. They are taxed a second time by the individual income tax when the corporation uses its profits to pay dividends to its shareholders. In part to compensate for this double taxation, policymakers have decided to tax dividend income at lower rates than other types of income. In 2013, the top marginal tax rate on dividend income was only 20%, compared with the top tax rate on ordinary income of 39.6%. The last category, labeled Other in Table 2, makes up 9% of receipts. This category includes excise taxes, which are taxes on specific goods like gasoline, cigarettes, and alcoholic beverages. It also includes various small items, such as estate taxes and customs duties. Spending Table 4 shows the spending of the federal government in 2011. Total spending was $3,757 billion, or $12,042 per person. This table also shows how the federal government's spending was divided among major categories. The largest category in Table 4 is for income security, a category that includes a variety of transfer payments. A transfer payment is a government payment not made in exchange for a good or service. Such payments include the Social Security income of the elderly and disabled, unemployment insurance payments made to workers who have lost their jobs, and welfare payments to the poor. This category made up about a third of spending by the federal government in 2011. The federal government pays some of this money to state and local governments, which administer the programs under federal guidelines. The second largest category of spending is on health programs. This category includes Medicare, Medicaid, and spending on medical research, such as that conducted through the National Institutes of Health. Total health spending makes up about a quarter of the federal budget. The next largest category of spending is national defense. This includes both the salaries of military personnel and the purchases of military equipment such as guns, fighter jets, and warships. Spending on national defense fluctuates over time as international tensions and the political climate change. Not surprisingly, spending on national defense rises substantially during wars. Next on the list is net interest. When a person borrows from a bank, the bank requires the borrower to pay interest for the loan. The same is true when the government borrows from the public. The more indebted the government, the larger the amount it must spend in interest payments. The other category in Table 4 consists of many less expensive functions of government. It includes, for example, the federal court system, the space program, farm support programs, housing credit programs, as well as the salaries of members of Congress and the President. You might have noticed that total receipts of the federal government shown in Table 2 fall short of total spending shown in Table 4 by more than $1 trillion. In such a situation, the government is said to run a budget deficit. When receipts exceed spending, the government is said to run a budget surplus. The government finances a budget deficit by borrowing from the public. That is, it sells government debt to the private sector, including both investors in the United States and those abroad. When the government runs a budget surplus, it uses the excess receipts to reduce its outstanding debts. Budget surplus in excess of government receipts over government spending. The fiscal challenge ahead. From 2009 to 2012, the U.S. federal government ran budget deficits that exceeded $1 trillion every year, the largest budget shortfalls since World War II. These large budget deficits were due primarily to the deep recession the economy was experiencing at the time. Recessions tend to increase government spending and reduce government revenue. Indeed, as the economy started to recover, the budget deficit started to shrink. Yet this short-term increase in the deficit is only the tip of an ominous iceberg. Long-term projections of the government's budget show that, under current law, the government will spend vastly more than it will receive in tax revenue in the decades ahead. As a percentage of gross domestic product, taxes are projected to be about constant. But government spending as a percentage of GDP is projected to rise substantially over the next several decades. One reason for the rise in government spending is that Social Security and Medicare provide significant benefits for the elderly, who are a growing percentage of the overall population. Over the past half-century, medical advances and lifestyle improvements have greatly increased life expectancy. In 1950, a 65-year-old man could expect to live for another 13 years, now he can expect to live another 17 years. The life expectancy of a 65-year-old woman has risen from 16 years in 1950 to 20 years today. At the same time, people are having fewer children. In 1950, the typical woman had 3 children. Today, the number is about 2. As a result of smaller families, the labor force is growing more slowly now than it has in the past. Panel of Figure 2 shows the demographic shift that is arising from the combination of longer life expectancy and lower fertility. In 1950, the elderly population equaled about 14% of the working age population. Now the elderly are about 21% of the working age population, and that figure will rise to about 40% over the next 50 years. Turning those numbers on their head, this means that in 1950 there were about 7 working age people for every elderly person, whereas in 2050 there will be only 2.5. As a result, there will be fewer workers paying taxes to support the government benefits that each elderly person receives. Government spending. The growing elderly population spending on Social Security and health programs. A second, related trend that will affect government spending in the decades ahead is the rising cost of health care. The federal government provides health care to the elderly through the Medicare system and to the poor through Medicaid. And once the health insurance reform passed in 2010 is fully implemented, the government will start providing subsidies for health insurance to many families with low to moderate incomes. As the cost of health care increases, government spending on these programs will increase as well. Policymakers have proposed various ways to stem the rise in healthcare costs, such as reducing the burden of lawsuits on the healthcare system, encouraging more competition among healthcare providers, promoting greater use of information technology, and providing better incentives to doctors to choose more cost-effective treatments. Many health economists, however, believe that such measures will have only a limited impact on reducing the government's healthcare expenditures. They argue that the main reason for rising healthcare costs is medical advances that provide new, better, but often expensive ways to extend and improve our lives. So even if these reforms are worth pursuing, spending on healthcare programs will nonetheless continue to rise. Panel of Figure 2 shows government spending on Social Security and health programs as a percentage of GDP. Spending on these programs has risen from less than 1% in 1950 to more than 10% today. The combination of a growing elderly population and rising healthcare costs is expected to continue the trend. How our society will handle these spending increases is an open question. Simply increasing the budget deficit is not feasible. A budget deficit just pushes the cost of government spending onto a future generation of taxpayers, who will 240. Inherit a government with greater debts. In the long run, the government needs to pay for what it spends. Some economists believe that to pay for these commitments, we will need to raise taxes substantially as a percentage of GDP. If so, the long-term trend we saw in Figure 1 will continue. Spending on Social Security and health programs is expected to rise by about 10 percentage points of GDP. Because taxes are now 30% of GDP, paying for these benefits would require approximately a net herd increase in all taxes. Other economists believe that such high tax rates would impose too great a cost on younger workers. They believe that policymakers should reduce the promises now being made to the elderly of the future and that, at the same time, people should be encouraged to take a greater role in caring for themselves as they age. This might entail raising the normal retirement age, while giving people more incentive to save during their working years to prepare for their own retirement and health costs. It is likely that the final resolution will involve a combination of measures. No one can dispute that resolving this debate is one of the great challenges ahead. 12-1B State and local governments. State and local governments collect about 40% of all taxes paid. Let's look at how they obtain tax revenue and how they spend it. Receipts Table 5 shows the receipts of U.S. state and local governments. Total receipts for 2011 were $2,064 billion, or $6,615 per person. The table also shows how this total is broken down into different kinds of taxes. The two most important taxes for state and local governments are sales taxes and property taxes. Sales taxes are levied as a percentage of the total amount spent at retail stores. Every time a customer buys something, he pays the storekeeper an extra amount that the storekeeper remits to the government. Property taxes are levied as a percentage of the estimated value of land and structures and are paid by property owners. Together, these two taxes make up more than 40% of all receipts of state and local governments. State and local governments also levy individual and corporate income taxes. In many cases, state and local income taxes are similar to federal income taxes. In other cases, they are quite different. For example, some states tax income from wages less heavily than income earned in the form of interest and dividends. Some states do not tax income at all. State and local governments also receive substantial funds from the federal government. To some extent, the federal government's policy of sharing its revenue with state governments redistributes funds from high-income states to low-income states. Often, these funds are tied to specific programs that the federal government wants to subsidize. Finally, state and local governments receive much of their receipts from various sources included in the other category in Table 5. These include fees for fishing and hunting licenses, tolls from roads and bridges, and fares for public buses and subways. Spending Table 6 shows the total spending of state and local governments in 2011 and its breakdown among the major categories. By far the biggest single expenditure for state and local governments is education. Local governments pay for the public schools, which educate most students from kindergarten through high school. State governments contribute to the support of public universities. In 2011, education accounted for about a third of the spending of state and local governments. The second largest category of spending is for health programs, such as Medicaid, followed by spending on public order and safety, which includes the police, firefighters, courts, and prisons. Next come income security programs, the building and maintenance of roads and highways, and interest on state and local government debt. The other category in Table 6 includes the many additional services provided by state and local governments, such as libraries, garbage and snow removal, and the maintenance of public parks and playgrounds. Quick quiz: what are the two most important sources of tax revenue for the federal government? What are the two most important sources of tax revenue for state and local governments? 242. 12-2 Taxes and efficiency. Now that we have seen how various levels of the U.S. government raise and spend money, let's consider how one might evaluate its tax policy and design a tax system. The primary aim of a tax system is to raise revenue for the government, but there are many ways to raise any given amount of money. When choosing among the many alternative tax systems, policymakers have two objectives: efficiency and equity. One tax system is more efficient than another if it raises the same amount of revenue at a smaller cost to taxpayers. What are the costs of taxes to taxpayers? The most obvious cost is the tax payment itself. This transfer of money from the taxpayer to the government is an inevitable feature of any tax system. Yet taxes also impose two other costs, which well-designed tax policy tries to avoid or, at least, minimize. The deadweight losses that result when taxes distort the decisions that people make, the administrative burdens that taxpayers bear as they comply with the tax laws. An efficient tax system is one that imposes small deadweight losses and small administrative burdens. 12-2 A deadweight losses. One of the 10 principles of economics is that people respond to incentives, and this includes incentives provided by the tax system. If the government taxes ice cream, people eat less ice cream and more frozen yogurt. If the government taxes housing, people live in smaller houses and spend more of their income on other things. If the government taxes labor earnings, people work less and enjoy more leisure. Because taxes distort incentives, they entail deadweight losses. As we first discussed in Chapter 8, the deadweight loss of a tax is the reduction in economic well-being of taxpayers in excess of the amount of revenue raised by the government. The deadweight loss is the inefficiency that a tax creates as people allocate resources according to the tax incentive rather than the true costs and benefits of the goods and services that they buy and sell. To recall how taxes cause deadweight losses, consider an example. Suppose that Joe places an $8 value on a pizza and Jane places a $6 value on it. If there is no tax on pizza, the price of pizza will reflect the cost of making it. Let's suppose that the price of pizza is $5, so both Joe and Jane choose to buy one. Both consumers get some surplus of value over the amount paid. Joe gets consumer surplus of $3, and Jane gets consumer surplus of $1. Total surplus is $4. Now suppose that the government levies a $2 tax on pizza and the price of pizza rises to $7. Joe still buys a pizza, but now he has consumer surplus of only $1. Jane now decides not to buy a pizza because its price is higher than its value to her. The government collects tax revenue of $2 on Joe's pizza. Total consumer surplus has fallen by $3. Because total surplus has fallen by more than the tax revenue, the tax has a deadweight loss. In this case, the deadweight loss is $1. Notice that the deadweight loss comes not from Joe, the person who pays the tax, but from Jane, the person who doesn't. The reduction of $2 in Joe's surplus exactly offsets the amount of revenue the government collects. The deadweight loss arises because the tax causes Jane to alter her behavior. When the tax raises the price of pizza, Jane is worse off, and yet there is no offsetting revenue to the government. This reduction in Jane's welfare is the deadweight loss of the tax. Should income or consumption be taxed? When taxes induce people to change their behavior, such as inducing Jane to buy less pizza, the taxes cause deadweight losses and make the allocation of resources less efficient. As we have already seen, much government revenue comes from the individual income tax. In a case study in Chapter 8, we discussed how this tax discourages people from working as hard as they otherwise might. Another inefficiency caused by this tax is that it discourages people from saving. Consider a person 25 years old who is considering saving $1,000. If he puts this money in a savings account that earns 8% and leaves it there, he will have $21,720 when he retires at age 65. Yet if the government taxes 1/4 of his interest income each year, the effective interest rate is only 6%. After 40 years of earning 6%, the $1,000 grows to only $10,290, less than half of what it would have been without taxation. Thus, because interest income is taxed, saving is much less attractive. Some economists advocate eliminating the current tax system's disincentive towards saving by changing the basis of taxation. Rather than taxing the amount of. Case study 244. 12-2b Administrative burden. If you ask the typical person on April 15 for an opinion about the tax system, you might get an earful about the headache of filling out tax forms. The administrative burden of any tax system is part of the inefficiency it creates. This burden includes not only the time spent in early April filling out forms but also the time spent throughout the year keeping records for tax purposes and the resources the government has to use to enforce the tax laws. Many taxpayers, especially those in higher tax brackets, hire tax lawyers and accountants to help them with their taxes. These experts in the complex tax laws fill out the tax forms for their clients and help them arrange their affairs in a way that reduces the amount of taxes owed. This behavior is legal tax avoidance, which is different from illegal tax evasion. Critics of our tax system say that these advisors help their clients avoid taxes by abusing some of the detailed provisions of the tax code, often dubbed loopholes. In some cases, loopholes are congressional mistakes. They arise from ambiguities or omissions in the tax laws. More often, they arise because Congress has chosen to give special treatment to specific types of behavior. For example, the U.S. federal tax code gives preferential treatment to investors in municipal bonds because Congress wanted to make it easier for state and local governments to borrow money. To some extent, this provision benefits states and localities, and to some extent, it benefits high-income taxpayers. Most loopholes are well known. Income that people earn, the government could tax the amount that people spend. Under this proposal, all income that is saved would not be taxed until the saving is later spent. This alternative system, called a consumption tax, would not distort people's saving decisions. Various provisions of current law already make the tax system a bit like a consumption tax. Taxpayers can put a limited amount of their income into special savings accounts, such as individual retirement accounts and 401 plans, and this income and the accumulated interest it earns escape taxation until the money is withdrawn at retirement. For people who do most of their saving through these retirement accounts, their tax bill is, in effect, based on their consumption rather than their income. European countries tend to rely more on consumption taxes than does the United States. Most of them raise a significant amount of government revenue through a value-added tax, or a VAT. A VAT is like the retail sales tax that many U.S. states use. But rather than collecting all of the tax at the retail level when the consumer buys the final good, the government collects the tax in stages as the good is being produced. Various U.S. policymakers have proposed that the tax code move further in the direction of taxing consumption rather than income. In 2005, economist Alan Greenspan, then chairman of the Federal Reserve, offered this advice to a presidential commission on tax reform. As you know, many economists believe that a consumption tax would be best from the perspective of promoting economic growth, particularly if one were designing a tax system from scratch, because a consumption tax is likely to encourage saving and capital formation. However, getting from the current tax system to a consumption tax raises a challenging set of transition issues. 245. By those in Congress who make tax policy, but what looks like a loophole to one taxpayer may look like a justifiable tax deduction to another. The resources devoted to complying with the tax laws are a type of deadweight loss. The government gets only the amount of taxes paid. By contrast, the taxpayer loses not only this amount but also the time and money spent documenting, computing, and avoiding taxes. The administrative burden of the tax system could be reduced by simplifying the tax laws. Yet simplification is often politically difficult. Most people are ready to simplify the tax code by eliminating the loopholes that benefit others, but few are eager to give up the loopholes that they benefit from themselves. In the end, the complexity of the tax law results from the political process as various taxpayers with their own special interests lobby for their causes. 12-2C Marginal tax rates versus average tax rates. When discussing the efficiency and equity of income taxes, economists distinguish between two notions of the tax rate, the average and the marginal. The average tax rate is total taxes paid divided by total income. The marginal tax rate is the amount that taxes increase from an additional dollar of income. For example, suppose that the government taxes 20% of the first $50,000 of income and 50% of all income above $50,000. Under this tax, a person who makes $60,000 pays a tax of $15,000, 20% of the first $50,000 plus 50% of the next $10,000. For this person, the average tax rate is $15,000/$60,000, or 25%. But the marginal tax rate is 50%. If the taxpayer earned an additional dollar of income, that dollar would be subject to the 50% tax rate, so the amount the taxpayer would owe to the government would rise by 50 cents. The marginal and average tax rates each contain a useful piece of information. If we are trying to gauge the sacrifice made by a taxpayer, the average tax rate is more appropriate because it measures the fraction of income paid in taxes. By contrast, if we are trying to gauge how much the tax system distorts incentives, the marginal tax rate is more meaningful. One of the 10 principles of economics in Chapter 1 is that rational people think at the margin. A corollary to this principle is that the marginal tax rate measures how much the tax system discourages people from working. If you are thinking of working an extra few hours, the marginal tax rate determines how much the government takes of your additional earnings. It is the marginal tax rate, therefore, that determines the deadweight loss of an income tax. 12-2D Lump sum taxes. Suppose the government imposes a tax of $4,000 on everyone. That is, everyone owes the same amount, regardless of earnings or any actions that a person might take. Such a tax is called a lump sum tax. A lump sum tax shows clearly the difference between average and marginal tax rates. For a taxpayer with income of $20,000, the average tax rate of a $4,000 lump sum tax is 20%. For a taxpayer with income of $40,000, the average tax rate is 10%. For both taxpayers, the marginal tax rate is 0 because no tax is owed on an additional dollar of income. A lump sum tax is the most efficient tax possible. Because a person's decisions do not alter the amount owed, the tax does not distort incentives and, therefore, does not cause deadweight losses. Because everyone can easily compute the amount owed and because there is no benefit to hiring tax lawyers and accountants, the lump sum tax imposes a minimal administrative burden on taxpayers. If lump sum taxes are so efficient, why do we rarely observe them in the real world? The reason is that efficiency is only one goal of the tax system. A lump sum tax would take the same amount from the poor and the rich, an outcome most people would view as unfair. To understand the tax systems that we observe, we must therefore consider the other major goal of tax policy, equity. Quick quiz: what is meant by the efficiency of a tax system? What can make a tax system inefficient? 12-3 Taxes and equity. Ever since American colonists dumped imported tea into Boston Harbor to protest high British taxes, tax policy has generated some of the most heated debates in American politics. The heat is rarely fueled by questions of efficiency. Instead, it arises from disagreements over how the tax burden should be distributed. Senator Russell Long once mimicked the public debate with this ditty: "Don't tax you. Don't tax me. Tax that fellow behind the tree." Of course, If we are to rely on the government to provide some of the goods and services we want, taxes must fall on someone. In this section, we consider the equity of a tax system. How should the burden of taxes be divided among the population? How do we evaluate whether a tax system is fair? Everyone agrees that the tax system should be equitable, but there is much disagreement about how to judge the equity of a tax system. 12-3 of the Benefits Principle. One principle of taxation, called the Benefits Principle, states that people should pay taxes based on the benefits they receive from government services. This principle tries to make public goods similar to private goods. It seems fair that a person who often goes to the movies pays more in total for movie tickets than a person who rarely goes. Similarly, a person who gets great benefit from a public good should pay more for it than a person who gets little benefit. The gasoline tax, for instance, is sometimes justified using the benefits principle. In some states, revenues from the gasoline tax are used to build and maintain roads. Because those who buy gasoline are the same people who use the roads, the gasoline tax might be viewed as a fair way to pay for this government service. The benefits principle can also be used to argue that wealthy citizens should pay higher taxes than poorer ones. Why? Simply because the wealthy benefit more from public services. Consider, for example, the benefits of police protection from theft. Citizens with much to protect benefit more from police than do those with less to protect. Therefore, according to the benefits principle, the wealthy should contribute more than the poor to the cost of maintaining the police force. The same argument can be used for many other public services, such as fire protection, national defense, and the court system. 247. It is even possible to use the benefits principle to argue for anti-poverty programs funded by taxes on the wealthy. As we discussed in Chapter 11, people may prefer living in a society without poverty, suggesting that anti-poverty programs are a public good. If the wealthy place a greater dollar value on this public good than members of the middle class do, perhaps just because the wealthy have more to spend, then according to the benefits principle, they should be taxed more heavily to pay for these programs. 12-3b The ability to pay principle. Another way to evaluate the equity of a tax system is called the ability to pay principle, which states that taxes should be levied on a person according to how well that person can shoulder the burden. This principle is sometimes justified by the claim that all citizens should make an equal sacrifice to support the government. The magnitude of a person's sacrifice, however, depends not only on the size of his tax payment but also on his income and other circumstances. A $1,000 tax paid by a poor person may require a larger sacrifice than a $10,000 tax paid by a rich one. The ability to pay principle leads to two corollary notions of equity: vertical equity and horizontal equity. Vertical equity states that taxpayers with a greater ability to pay should contribute a larger amount. Horizontal equity states that taxpayers with similar abilities to pay should contribute the same amount. These notions of equity are widely accepted, but applying them to evaluate a tax system is rarely straightforward. Vertical equity: if taxes are based on ability to pay, then richer taxpayers should pay more than poorer taxpayers. But how much more should the rich pay? Much of the debate over tax policy concerns this question. Consider the three tax systems in Table 7. In each case, taxpayers with higher incomes pay more. Yet the systems differ in how quickly taxes rise with income. The first system is called proportional because all taxpayers pay the same fraction of income. The second system is called regressive because high-income taxpayers pay a smaller fraction of their income, even though they pay a larger amount. The third system is called progressive because high-income taxpayers pay a larger fraction of their income. Which of these three tax systems is most fair? There is no obvious answer, and economic theory does not offer any help in trying to find one. Equity, like beauty, is in the eye of the beholder. How the tax burden is distributed. Much debate over tax policy concerns whether the wealthy pay their fair share. There is no objective way to make this judgment. In evaluating the issue for yourself, however, it is useful to know how much families with different incomes pay under the current tax system. Table 8 presents some data on how federal taxes are distributed among income classes. These figures are for 2009, the most recent year available as this book was going to press, and were tabulated by the Congressional Budget Office. They include all federal taxes, individual income taxes, payroll taxes, corporate income taxes, and excise taxes but not state and local taxes. When calculating a household's tax burden, the CBO allocates corporate income taxes to the owners of capital and payroll taxes to workers. To construct the table, households are ranked according to their income and placed into 5 groups of equal size, called quintiles. The table also presents data on the richest 1% of Americans. The second column of the table shows the average income of each group. Income includes both market income and transfer payments from government programs, such as Social Security and welfare. The poorest 1/5 of households had average income of $23,500, and the richest 1/5 had average income of $223,500. The richest 1% had average income of over $1.2 million. The third column of the table shows total taxes as a percentage of income. As you can see, the U.S. federal tax system is progressive. The poorest 1/5 of households paid 1% of their incomes in taxes, and the richest 1/5 paid 23.2%. The top 1% paid 28.9% of their incomes. The fourth and fifth columns compare the distribution of income and the distribution of taxes. The poorest quintile earned 5.1% of all income and paid 0.3% of all taxes. The richest quintile earned 50.8% of all income and paid 67.9% of all taxes. The richest 1% earned 13.4% of all income and paid 22.3% of all taxes. These numbers on taxes paid are a good starting point for understanding how the burden of government is distributed, but they give an incomplete picture. Money flows not only from households to the government in the form of taxes but also from the government back to households in the form of transfer payments. In some ways, transfer payments are the opposite of taxes. Including transfers as negative taxes substantially changes the distribution of the tax burden. The richest quintile of households still pays about 1/4 of its income to the government, even after transfers are subtracted, and the top 1% still pays almost 30%. By contrast, the average tax rate for the poorest quintile becomes a sizable negative number. That is, typical households in the bottom of the income distribution receive substantially more in transfers than they pay in taxes. The lesson is clear: to understand fully the progressivity of government policies, one must take account of both what people pay and what they receive. Finally, it is worth noting that the numbers in Table 8 are a bit out of date. In late 2012, the U.S. Congress passed and President Obama signed a tax bill that increased taxes significantly from those that prevailed previously, particularly for taxpayers at the top of the income distribution. For individuals earning taxable income more than $400,000 and couples earning more than $450,000, the marginal income tax rate was increased from 35 to 39.6%. As a result, the tax system in place for 2013 and beyond is more progressive than the one shown in the table. Horizontal equity: if taxes are based on ability to pay, then similar taxpayers should pay similar amounts of taxes. But what determines if two taxpayers are similar? Families differ in many ways. To evaluate whether a tax code is horizontally equitable, one must determine which differences are relevant for a family's ability to pay and which differences are not. Suppose the Smith and Jones families each have income of $100,000. The Smiths have no children, but Mr. Smith has an illness that results in medical expenses of $40,000. The Joneses are in good health, but they have 4 children. 2 of the Jones children are in college, generating tuition bills of $60,000. Would it be fair for these 2 families to pay the same tax because they have the same income? Would it be fair to give the Smiths a tax break to help them offset their high medical expenses? Would it be fair to give the Joneses a tax break to help them with their tuition expenses? There are no easy answers to these questions. In practice, the U.S. tax code is filled with special provisions that alter a family's tax obligations based on its specific circumstances. 12-3C Tax Incidence and Tax Equity. Tax incidence: the study of who bears the burden of taxes, is central to evaluating tax equity. As we first saw in Chapter 6, the person who bears the burden of a tax is not always the person who gets the tax bill from the government. Because taxes alter supply and demand, they alter equilibrium prices. As a result, they affect people beyond those who, according to statute, actually pay the tax. When evaluating the vertical and horizontal equity of any tax, it is important to take these indirect effects into account. Many discussions of tax equity ignore the indirect effects of taxes and are based on what economists mockingly call the flypaper theory of tax incidence. According to this theory, the burden of a tax, like a fly on flypaper, sticks wherever it first lands. This assumption, however, is rarely valid. For example, a person not trained in economics might argue that a tax on expensive fur coats is vertically equitable because most buyers of furs are wealthy. Yet if these buyers can easily substitute other luxuries for furs, then a tax on furs might only reduce the sale of furs. In the end, the burden of the tax will fall more on those who make and sell furs than on those who buy them. Because most workers who make furs are not wealthy, the equity of a fur tax could be quite different from what the flypaper theory indicates. The Blur Between Spending and Taxes. By N. Gregory. Mankiw. How the government cut spending or raise taxes to deal with its long-term fiscal imbalance. As President Obama's Deficit Commission rolls out its final report in the coming weeks, this issue will most likely divide the political right and left. But, in many ways, the question is the wrong one. The distinction between spending and taxation is often murky and sometimes meaningless. Imagine that there is some activity, say, snipe hunting, that members of Congress want to encourage. Senator Porkbelly proposes a government subsidy. America needs more snipe hunters, he says. I propose that every time an American bags a snipe, the federal government should pay him or her $100. No, no, says Congressman Blowhard. The Porkbelly plan would increase the size of an already bloated government. Let's instead reduce the burden of taxation. I propose that every time an American tracks down a snipe, the hunter should get a $100 credit to reduce his or her tax liabilities. To be sure, government accountants may treat the Porkbelly and Blowhard plans differently. They would likely deem the subsidy to be a spending increase and the credit to be a tax cut. Moreover, the rhetoric of the two politicians about spending and taxes may appeal to different political bases. But it hardly takes an economic genius to see how little difference there is between the two plans. Both policies enrich the nation's snipe hunters. And because the government must balance its books, at least in the long run, the gains of the snipe hunters must come at the cost of higher taxes or lower government benefits for the rest of us. Economists call the Blowhard plan a tax expenditure. The tax code is filled with them, although not yet one for snipe hunting. Every time a politician promises a targeted tax cut, he or she is probably offering up a form of government spending in disguise. Erskine B. Bowles and Alan K. Simpson, the chairman of President Obama's Deficit Reduction Commission, have taken a hard look at these tax expenditures, and they don't like what they see. In their draft proposal, released earlier this month, they proposed doing away with tax expenditures, which together cost the Treasury over $1 trillion a year. Such a drastic step would allow Mr. Bowles and Mr. Simpson to move the budget toward fiscal sustainability, while simultaneously reducing all income tax rates. Under their plan, the top tax rate would fall to 23% from the 35% in today's law. This approach has long been the basic recipe for tax reform. By broadening the tax base and lowering tax rates, we can increase government revenue and distort incentives less. That should command widespread applause across the ideological spectrum. Unfortunately, the reaction has been less enthusiastic. Pundits on the left are suspicious of any plan that reduces marginal tax rates on the rich. But, as Mr. Bowles and Mr. Simpson point out, tax expenditures disproportionately. Tax expenditures. Tax reformers and deficit hawks often suggest reducing the deductions, credits, and exclusions that narrow the tax base. In the news. Who pays the corporate income tax? The corporate income tax provides a good example of the importance of tax incidence for tax policy. The corporate tax is popular among voters. After all, corporations are not people. Voters are always eager to have their taxes reduced and have some impersonal corporation pick up the tab. But before deciding that the corporate income tax is a good way for the government to raise revenue, we should consider who bears the burden of the corporate tax. This is a difficult question on which economists disagree, but one thing is certain: people pay all taxes. When the government levies a tax on a corporation, the corporation is more like a tax collector than a taxpayer. The burden of the tax ultimately falls on people, the owners, customers, or workers of the corporation. Many economists believe that workers and customers bear much of the burden of the corporate income tax. To see why, consider an example. Suppose that the benefit those at the top of the economic ladder. According to their figures, tax expenditures increase the after-tax income of those in the bottom quintile by about 6%. Those in the top 1% of the income distribution enjoy about twice that gain. Progressives who are concerned about the gap between rich and poor should be eager to scale back tax expenditures. Pundits on the right, meanwhile, are suspicious of anything that increases government revenue. But they should recognize that tax expenditures are best viewed as a hidden form of spending. If we eliminate tax expenditures and reduce marginal tax rates, as Mr. Bowles and Mr. Simpson propose, we are essentially doing what economic conservatives have long advocated: cutting spending and taxes. Yet another political problem is that each tax expenditure has its own political constituency. If Congressman Blowhard ever got his way, the snipe hunters of the world would surely fight to keep their tax break. One major tax expenditure that the Bowles, Simpson plan would curtail or eliminate is the mortgage interest deduction. Without doubt, many homeowners and the real estate industry will object. But they won't have the merits on their side. This subsidy to homeownership is neither economically efficient nor particularly equitable. Economists have long pointed out that tax subsidies to housing, together with the high taxes on corporations, cause too much of the economy's capital stock to be tied up in residential structures and too little in corporate capital. This misallocation of resources results in lower productivity and reduced real wages. Moreover, there is nothing particularly ignoble about renting that deserves the scorn of the tax code. But let's face it, subsidizing homeowners is the same as penalizing renters. In the end, someone has to pick up the tab. There are certain tax expenditures that I like. My personal favorite is the deduction for charitable giving. It encourages philanthropy. And, thus, private rather than governmental solutions to society's problems. But I know that solving the long-term fiscal problem won't be easy. Everyone will have to give a little, and perhaps even more than a little. I am willing to give up my favorite tax expenditure if everyone else is willing to give up theirs. The Bowles, Simpson proposal is not perfect, but it is far better than the status quo. The question ahead is whether we can get Senator Porkbelly and Congressman Blowhard to agree. U.S. government decides to raise the tax on the income earned by car companies. At first, this tax hurts the owners of the car companies, who receive less profit. But over time, these owners will respond to the tax. Because producing cars is less profitable, they invest less in building new car factories. Instead, they invest their wealth in other ways, for example, by buying larger houses or by building factories in other industries or other countries. With fewer car factories, the supply of cars declines, as does the demand for auto workers. Thus, A tax on corporations making cars causes the price of cars to rise and the wages of auto workers to fall. The corporate income tax shows how dangerous the flypaper theory of tax incidence can be. The corporate income tax is popular in part because it appears to be paid by rich corporations. Yet those who bear the ultimate burden of the tax, the customers and workers of corporations, are often not rich. If the true incidence of the corporate tax were more widely known, this tax might be less popular among voters. This worker pays part of the corporate income tax. 12-4 Conclusion: the trade-off between equity and efficiency. Almost everyone agrees that equity and efficiency are the two most important goals of a tax system. But these two goals often conflict, especially when equity is judged by the progressivity of the tax system. People disagree about tax policy often because they attach different weights to these goals. The recent history of tax policy shows how political leaders differ in their views on equity and efficiency. When Ronald Reagan was elected president in 1980, the marginal tax rate on the earnings of the richest Americans was 50%. On interest income, the marginal tax rate was 70%. Reagan argued that such high tax rates greatly distorted economic incentives to work and save. In other words, he claimed that these high tax rates cost too much in terms of economic efficiency. Tax reform was, therefore, a high priority of his administration. Reagan signed into law large cuts in tax rates in 1981 and then again in 1986. When Reagan left office in 1989, the richest Americans faced a marginal tax rate of only 28%. The pendulum of political debate swings both ways. When Bill Clinton ran for president in 1992, he argued that the rich were not paying their fair share of taxes. In other words, the low tax rates on the rich violated his view of vertical equity. In 1993, President Clinton signed into law a bill that raised the tax rates on the Quick quiz: explain the benefits principle and the ability to pay principle. What are vertical equity and horizontal equity? Why is studying tax incidence important for determining the equity of a tax system? 253. Richest Americans to about 40%. When George W. Bush ran for president, he reprised many of Reagan's themes, and as president he reversed part of the Clinton tax increase, reducing the highest tax rate to 35%. Barack Obama pledged during the 2008 presidential campaign that he would raise taxes on high-income households, and starting in 2013 the top marginal tax rate was back at about 40%. Economics alone cannot determine the best way to balance the goals of efficiency and equity. This issue involves political philosophy as well as economics. But economists have an important role in this debate. They can shed light on the trade-offs that society inevitably faces when designing the tax system and can help us avoid policies that sacrifice efficiency without any benefit in terms of equity. The U.S. government raises revenue using various taxes. The most important taxes for the federal government are individual income taxes and payroll taxes for social insurance. The most important taxes for state and local governments are sales taxes and property taxes. The efficiency of a tax system refers to the costs it imposes on taxpayers. There are two costs of taxes beyond the transfer of resources from the taxpayer to the government. The first is the deadweight loss that arises as taxes alter incentives and distort the allocation of resources. The second is the administrative burden of complying with the tax laws. The equity of a tax system concerns whether the tax burden is distributed fairly among the population. According to the benefits principle, it is fair for people to pay taxes based on the benefits they receive from the government. According to the ability to pay principle, it is fair for people to pay taxes based on their capability to handle the financial burden. When evaluating the equity of a tax system, it is important to remember a lesson from the study of tax incidence: the distribution of tax burdens is not the same as the distribution of tax bills. When considering changes in the tax laws, policymakers often face a trade-off between efficiency and equity. Much of the debate over tax policy arises because people give different weights to these two goals. Key concepts. 1. Over the past century, has the government's tax revenue grown more or less slowly than the rest of the economy? 2. Explain how corporate profits are taxed twice. 3. Why is the burden of a tax to taxpayers greater than the revenue received by the government? 4. Why do some economists advocate taxing consumption rather than income? 5. What is the marginal tax rate on a lump sum tax? How is this related to the efficiency of the tax? 6. Give 2 arguments why wealthy taxpayers should pay more taxes than poor taxpayers. 7. What is the concept of horizontal equity and why is it hard to apply? Questions for review. 254. 1. The 2 largest sources of tax revenue for the U.S. federal government are A. Individual and corporate income taxes. B. Individual income taxes and payroll taxes for social insurance. C. Corporate income taxes and payroll taxes for social insurance. D. Payroll taxes for social insurance and property taxes. 2. Andy gives piano lessons. He has an opportunity cost of $50 per lesson and charges $60. He has 2 students, Bob, who has a willingness to pay of $70, and Carl, who has a willingness to pay of $90. When the government puts a $20 tax on piano lessons and Andy raises his price to $80, the deadweight loss is and the tax revenue is A. $10, $20 billion. $10, $40 C. $20, $20 D. $20, $40. 3. If the tax code exempts the first $20,000 of income from taxation and then taxes 25% of all income above that level, then a person who earns $50,000 has an average tax rate of and a marginal tax rate of percent. A 15, 25B 25, 15C 25, 30D 30, 25 4. A toll is a tax on those citizens who use toll roads. This policy can be viewed as an application of A. the benefits principle, B. horizontal equity, C. vertical equity, D. tax progressivity. 5. In the United States, taxpayers in the top 1% of the income distribution pay about percent of their income in federal taxes. A5 B10 C20 D36. If the corporate income tax induces businesses to reduce their capital investment, then A. the tax does not have any deadweight loss. B. Corporate shareholders benefit from the tax. C. Workers bear some of the burden of the tax. D. The tax achieves the goal of vertical equity. Quick check multiple choice. 1. In a published source or on the internet, find out whether the U.S. federal government had a budget deficit or surplus last year. What do policymakers expect to happen over the next few years? 2. The information in many of the tables in this chapter can be found in the Economic Report of the President, which appears annually. Using a recent issue of the report at your library or on the internet, answer the following questions and provide some numbers to support your answers. A. Figure 1 shows that government revenue as a percentage of total income has increased over time. Is this increase primarily attributable to changes in federal government revenue or in state and local government revenue? B. Looking at the combined revenue of the federal government and state and local governments, how has the composition of total revenue changed over time? Are personal income taxes more or less important? Social insurance taxes? Corporate profits taxes? C. Looking at the combined expenditures of the federal government and state and local governments, how have the relative shares of transfer payments and purchases of goods and services changed over time? 3. The chapter states that the elderly population in the United States is growing more rapidly than the total population. In particular, the number of workers is rising slowly, while the number of retirees is rising quickly. Concerned about the future of Social Security, some members of Congress propose a freeze on the program. A. If total expenditures were frozen, what would happen to benefits per retiree? To tax payments per worker? Problems and applications. 255. B. If benefits per retiree were frozen, what would happen to total expenditures? To tax payments per worker? C. If tax payments per worker were frozen, what would happen to total expenditures? To benefits per retiree? D. What do your answers to parts and imply about the difficult decisions faced by policymakers? 4. Suppose you are a typical person in the U.S. economy. You pay 4% of your income in a state income tax and 15.3% of your labor earnings in federal payroll taxes. You also pay federal income taxes as in Table 3. How much tax of each type do you pay if you earn $20,000 a year? Taking all taxes into account, what are your average and marginal tax rates? What happens to your tax bill and to your average and marginal tax rates if your income rises to $40,000? 5. Some states exclude necessities, such as food and clothing, from their sales tax. Other states do not. Discuss the merits of this exclusion. Consider both efficiency and equity. 6. When someone owns an asset that rises in value, he has an accrued capital gain. If he sells the asset, he realizes the gains that have previously accrued. Under the U.S. income tax system, realized capital gains are taxed, but accrued gains are not. A. Explain how individuals' behavior is affected by this rule. B. Some economists believe that cuts in capital gains tax rates, especially temporary ones, can raise tax revenue. How might this be so? C. Do you think it is a good rule to tax realized but not accrued capital gains? Why or why not? 7. Suppose that your state raises its sales tax from 5% to 6%. The State Revenue Commissioner forecasts a 20% increase in sales tax revenue. Is this plausible? Explain. 8. The Tax Reform Act of 1986 eliminated the deductibility of interest payments on consumer debt but maintained the deductibility of interest payments on mortgages and home equity loans. What do you think happened to the relative amounts of borrowing through consumer debt and home equity debt? 9. Categorize each of the following funding schemes as examples of the benefits principle or the ability to pay principle. A. Visitors to many national parks pay an entrance fee. B. Local property taxes support elementary and secondary schools. C. An airport trust fund collects a tax on each plane ticket sold and uses the money to improve airports and the air traffic control system. Go to CEngageBrain.com to purchase access to the proven, critical study guide to accompany this text, which features additional notes and context, practice tests, and much more. Part V. Firm behavior and the organization of industry. The economy is made up of thousands of firms that produce the goods and services you enjoy every day. General Motors produces automobiles, General Electric produces light bulbs, and General Mills produces breakfast cereals. Some firms, such as these three, are large. They employ thousands of workers and have thousands of stockholders who share in the firm's profits. Other firms, such as the local barbershop or cafe, are small. They employ only a few workers and are owned by a single person or family. In previous chapters, we used the supply curve to summarize firms' production decisions. According to the law of supply, firms are willing to produce and sell a greater quantity of a good when the price of the good is higher, and this response leads to a supply curve that slopes upward. For analyzing many questions, the law of supply is all you need to know about firm behavior. In this chapter and the ones that follow, we examine firm behavior in more detail. This topic will give you a better understanding of the decisions. Chapter 13. The costs of production. 260. Behind the supply curve. In addition, it will introduce you to a part of economics called industrial organization, the study of how firms' decisions about prices and quantities depend on the market conditions they face. The town in which you live, for instance, may have several pizzerias but only one cable television company. This raises a key question: how does the number of firms affect the prices in a market and the efficiency of the market outcome? The field of industrial organization addresses exactly this question. Before turning to these issues, we need to discuss the costs of production. All firms, from Delta Airlines to your local deli, incur costs as they make the goods and services that they sell. As we will see in the coming chapters, a firm's costs are a key determinant of its production and pricing decisions. In this chapter, we define some of the variables that economists use to measure a firm's costs, and we consider the relationships among these variables. A word of warning: this topic is dry and technical. To be honest, one might even call it boring. But this material provides a crucial foundation for the fascinating topics that follow. 13-1. What are costs? We begin our discussion of costs at Caroline's cookie factory. Caroline, the owner of the firm, buys flour, sugar, chocolate chips, and other cookie ingredients. She also buys the mixers and ovens and hires workers to run this equipment. She then sells the cookies to consumers. By examining some of the issues that Caroline faces in her business, we can learn some lessons about costs that apply to all firms in an economy. 13-1. At total revenue, total cost, and profit, we begin with the firm's objective. To understand the decisions a firm makes, we must understand what it is trying to do. It is conceivable that Caroline started her firm because of an altruistic desire to provide the world with cookies, or, perhaps, out of love for the cookie business. More likely, Caroline started her business to make money. Economists normally assume that the goal of a firm is to maximize profit, and they find that this assumption works well in most cases. What is a firm's profit? The amount that the firm receives for the sale of its output is called its total revenue. The amount that the firm pays to buy inputs is called its total cost. Caroline gets to keep any revenue that is not needed to cover costs. Profit is a firm's total revenue minus its total cost. Profit equals total revenue total cost. Caroline's objective is to make her firm's profit as large as possible. To see how a firm goes about maximizing profit, we must consider fully how to measure its total revenue and its total cost. Total revenue is the easy part. It equals the quantity of output the firm produces times the price at which it sells its output. If Caroline produces 10,000 cookies and sells them at $2 a cookie, her total revenue is $20,000. The measurement of a firm's total cost, however, is more subtle. 13-1b. Costs as opportunity costs. When measuring costs at Caroline's cookie factory or any other firm, it is important to keep in mind one of the 10 principles of economics from Chapter 1, the cost of something is what you give up to get it. Recall that the opportunity cost of an item refers to all those things that must be foregone to acquire that item. When economists speak of a firm's cost of production, they include all the opportunity costs of making its output of goods and services. While some of a firm's opportunity costs of production are obvious, others are less so. When Caroline pays $1,000 for flour, that $1,000 is an opportunity cost because Caroline can no longer use that $1,000 to buy something else. Similarly, when Caroline hires workers to make the cookies, the wages she pays are part of the firm's costs. Because these opportunity costs require the firm to pay out some money, they are called explicit costs. By contrast, some of a firm's opportunity costs, called implicit costs, do not require a cash outlay. Imagine that Caroline is skilled with computers and could earn $100 per hour working as a programmer. For every hour that Caroline works at her cookie factory, she gives up $100 in income, and this foregone income is also part of her costs. The total cost of Caroline's business is the sum of her explicit and implicit costs. The distinction between explicit and implicit costs highlights an important difference between how economists and accountants analyze a business. Economists are interested in studying how firms make production and pricing decisions. Because these decisions are based on both explicit and implicit costs, economists include both when measuring a firm's costs. By contrast, accountants have the job of keeping track of the money that flows into and out of firms. As a result, they measure the explicit costs but usually ignore the implicit costs. The difference between the methods of economists and accountants is easy to see in the case of Caroline's cookie factory. When Caroline gives up the opportunity to earn money as a computer programmer, her accountant will not count this as a cost of her cookie business. Because no money flows out of the business to pay for this cost, it never shows up on the accountant's financial statements. An economist, however, will count the foregone income as a cost because it will affect the decisions that Caroline makes in her cookie business. For example, if Caroline's wage as a computer programmer rises from $100 to $500 per hour, she might decide that running her cookie business is too costly and choose to shut down the factory to become a full-time computer programmer. 13-1 See the cost of capital as an opportunity cost. An important implicit cost of almost every business is the opportunity cost of the financial capital that has been invested in the business. Suppose, for instance, that Caroline used $300,000 of her savings to buy her cookie factory from its previous owner. If Caroline had instead left this money deposited in a savings account that pays an interest rate of 5%, she would have earned $15,000 per year. To own her cookie factory, therefore, Caroline has given up $15,000 a year in interest income. This foregone $15,000 is one of the implicit opportunity costs of Caroline's business. As we have already noted, economists and accountants treat costs differently, and this is especially true in their treatment of the cost of capital. An economist views the $15,000 in interest income that Caroline gives up every year as an implicit cost of her business. Caroline's accountant, however, will not show this $15,000 as a cost because no money flows out of the business to pay for it. To further explore the difference between the methods of economists and accountants, let's change the example slightly. Suppose now that Caroline did not have the entire $300,000 to buy the factory but, instead, used $100,000 of her own savings and borrowed $200,000 from a bank at an interest rate of 5%. Caroline's accountant, who only measures explicit costs, will now count the $10,000 interest paid on the bank loan every year as a cost because this amount of money now flows out of the firm. By contrast, according to an economist, the opportunity cost of owning the business is still $15,000. The opportunity cost equals the interest on the bank loan plus the foregone interest on savings. 13-1D Economic profit versus accounting profit. Now let's return to the firm's objective, profit. Because economists and accountants measure costs differently, they also measure profit differently. An economist measures a firm's economic profit as the firm's total revenue minus all the opportunity costs of producing the goods and services sold. An accountant measures the firm's accounting profit as the firm's total revenue minus only the firm's explicit costs. Figure 1 summarizes this difference. Notice that because the accountant ignores the implicit costs, accounting profit is usually larger than economic profit. For a business to be profitable from an economist's standpoint, total revenue must cover all the opportunity costs, both explicit and implicit. Economic profit is an important concept because it is what motivates the firms that supply goods and services. As we will see, a firm making positive economic profit will stay in business. It is covering all its opportunity costs and has some revenue left to reward the firm owners. When a firm is making economic losses, the business owners are failing to earn enough revenue to cover all the costs of production. Unless conditions change, the firm owners will eventually close down the business and exit the industry. To understand business decisions, we need to keep an eye on economic profit. Revenue. Quick quiz. Farmer McDonald gives banjo lessons for $20 an hour. One day, he spends 10 hours planting $100 worth of seeds on his farm. What opportunity cost has he incurred? What cost would his accountant measure? If these seeds yield $200 worth of crops, does McDonald earn an accounting profit? Does he earn an economic profit? 263. 13-2 Production and costs. Firms incur costs when they buy inputs to produce the goods and services that they plan to sell. In this section, we examine the link between a firm's production process and its total cost. Once again, we consider Caroline's cookie factory. In the analysis that follows, we make an important simplifying assumption. We assume that the size of Caroline's factory is fixed and that Caroline can vary the quantity of cookies produced only by changing the number of workers she employs. This assumption is realistic in the short run but not in the long run. That is, Caroline cannot build a larger factory overnight, but she can do so over the next year or two. This analysis, therefore, describes the production decisions that Caroline faces in the short run. We examine the relationship between costs and time horizon more fully later in the chapter. 13-2 of the production function. Table 1 shows how the quantity of cookies produced per hour at Caroline's factory depends on the number of workers. As you can see in the first two columns, if there are no workers in the factory, Caroline produces no cookies. When there is one worker, she produces 50 cookies. When there are two workers, she produces 90 cookies and so on. Panel of Figure 2 presents a graph of these two columns of numbers. The number of workers is on the horizontal axis, and the number of cookies produced is on the vertical axis. This relationship between the quantity of inputs and quantity of output is called the production function. One of the 10 principles of economics introduced in Chapter 1 is that rational people think at the margin. As we will see in future chapters, this idea is the key to understanding the decisions a firm makes about how many workers to hire and how much output to produce. To take a step toward understanding these decisions, the third column in the table gives the marginal product of a worker. The marginal product of any input in the production process is the increase in the quantity of output obtained from one additional unit of that input. When the number of workers goes from 1 to 2, cookie production increases from 50 to 90, so the marginal product of the second worker is 40 cookies. And when the number of workers goes from 2 to 3, cookie production increases from 90 to 120, so the marginal product of the third worker is 30 cookies. In the table, the marginal product is shown halfway between two rows because it represents the change in output as the number of workers increases from one level to another. Notice that as the number of workers increases, the marginal product declines. The second worker has a marginal product of 40 cookies, the third worker has a marginal product of 30 cookies, and the fourth worker has a marginal product of 20. Figure 2. The production function in panel shows the relationship between the number of workers hired and the quantity of output produced. Here the number of workers hired is from the first column in Table 1, and the quantity of output produced is from the second column. The production function gets flatter as the number of workers increases, reflecting diminishing marginal product. The total cost curve in panel shows the relationship between the quantity of output produced and total cost of production. Here the quantity of output produced is from the second column in Table 1, and the total cost is from the sixth column. The total cost curve gets steeper as the quantity of output increases because of diminishing marginal product. Cookies. This property is called diminishing marginal product. At first, when only a few workers are hired, they have easy access to Caroline's kitchen equipment. As the number of workers increases, additional workers have to share equipment and work in more crowded conditions. Eventually, the kitchen is so crowded that the workers start getting in each other's way. Hence, as more workers are hired, each additional worker contributes fewer additional cookies to total production. Diminishing marginal product is also apparent in Figure 2. The production function slope tells us the change in Caroline's output of cookies for each additional input of labor. That is, the slope of the production function measures the marginal product of a worker. As the number of workers increases, the marginal product declines, and the production function becomes flatter. 13-2b From the production function to the total cost curve. The last three columns of Table 1 show Caroline's cost of producing cookies. In this example, the cost of Caroline's factory is $30 per hour, and the cost of a worker is $10 per hour. If she hires one worker, her total cost is $40 per hour. If she hires two workers, her total cost is $50 per hour, and so on. With this information, the table now shows how the number of workers Caroline hires is related to the quantity of cookies she produces and to her total cost of production. Our goal in the next several chapters is to study firms' production and pricing decisions. For this purpose, the most important relationship in Table 1 is between quantity produced and total cost. Panel of Figure 2 graphs these two columns of data with the quantity produced on the horizontal axis and total cost on the vertical axis. This graph is called the total cost curve. Now compare the total cost curve in panel with the production function in panel. These two curves are opposite sides of the same coin. The total cost curve gets steeper as the amount produced rises, whereas the production function gets flatter as production rises. These changes in slope occur for the same reason. High production of cookies means that Caroline's kitchen is crowded with many workers. Because the kitchen is crowded, each additional worker adds less to production, reflecting diminishing marginal product. Therefore, the production function is relatively flat. But now turn this logic around. When the kitchen is crowded, producing an additional cookie requires a lot of additional labor and is thus very costly. Therefore, when the quantity produced is large, the total cost curve is relatively steep. Quick quiz: if Farmer Jones plants no seeds on his farm, he gets no harvest. If he plants 1 bag of seeds, he gets 3 bushels of wheat. If he plants 2 bags, he gets 5 bushels. If he plants 3 bags, he gets 6 bushels. A bag of seeds costs $100, and seeds are his only cost. Use these data to graph the farmer's production function and total cost curve. Explain their shapes. 13-3 The various measures of cost. Our analysis of Caroline's cookie factory demonstrated how a firm's total cost reflects its production function. From data on a firm's total cost, we can derive several related measures of cost, which will turn out to be useful when we analyze. 266. Production and pricing decisions in future chapters. To see how these related measures are derived, we consider the example in Table 2. This table presents cost data on Caroline's neighbor Conrad's coffee shop. The first column of the table shows the number of cups of coffee that Conrad might produce, ranging from 0 to 10 cups per hour. The second column shows Conrad's total cost of producing coffee. Figure 3 plots Conrad's total cost curve. The quantity of coffee is on the horizontal axis, and total cost is on the vertical axis. Conrad's total cost curve has a shape similar to Caroline's. In particular, it becomes steeper as the quantity produced rises, which reflects diminishing marginal product. 13-3 Of fixed and variable costs. Conrad's total cost can be divided into two types. Some costs, called fixed costs, do not vary with the quantity of output produced. They are incurred even if the firm produces nothing at all. Conrad's fixed costs include any rent he pays because this cost is the same regardless of how much coffee he produces. Similarly, if Conrad needs to hire a full-time bookkeeper to pay bills, regardless of the quantity of coffee produced, the bookkeeper's salary is a fixed cost. The third column in Table 2 shows Conrad's fixed cost, which in this example is $3. Some of the firm's costs, called variable costs, change as the firm alters the quantity of output produced. Conrad's variable costs include the cost of coffee beans, milk, sugar, and paper cups. The more cups of coffee Conrad makes, the more of these items he needs to buy. Similarly, if Conrad has to hire more workers to make more cups of coffee, the salaries of these workers are variable costs. The fourth column of the table shows Conrad's variable cost. The variable cost is 0 if he produces nothing, 30 cents if he produces 1 cup of coffee, 80 cents if he produces 2 cups, and so on. A firm's total cost is the sum of fixed and variable costs. In Table 2, total cost in the second column equals fixed cost in the third column plus variable cost in the fourth column. 13-3b Average and marginal cost. As the owner of his firm, Conrad has to decide how much to produce. One issue he will want to consider when making this decision is how the level of production affects his firm's costs. Conrad might ask his production supervisor the following 2 questions about the cost of producing coffee. How much does it cost to make the typical cup of coffee? How much does it cost to increase production of coffee by 1 cup? These 2 questions might seem to have the same answer, but they do not. Both answers are important for understanding how firms make production decisions. To find the cost of the typical unit produced, we divide the firm's costs by the quantity of output it produces. For example, if the firm produces 2 cups of coffee per hour, its total cost is $3.80, and the cost of the typical cup is $3.80/2, or $1.90. Total cost divided by the quantity of output is called average total cost. Because total cost is the sum of fixed and variable costs, average total cost can be expressed. Figure 3. Conrad's total cost curve. Here the quantity of output produced is from the first column in Table 2, and the total cost is from the second column. As in Figure 2, the total cost curve gets steeper as the quantity of output increases because of diminishing marginal product. As the sum of average fixed cost and average variable cost. Average fixed cost is the fixed cost divided by the quantity of output, and average variable cost is the variable cost divided by the quantity of output. Average total cost tells us the cost of the typical unit, but it does not tell us how much total cost will change as the firm alters its level of production. The last column in Table 2 shows the amount that total cost rises when the firm increases production by 1 unit of output. This number is called marginal cost. For example, if Conrad increases production from 2 to 3 cups, total cost rises from $3.80 to $4.50, so the marginal cost of the third cup of coffee is $4.50 minus $3.80, or 70 cents. In the table, the marginal cost appears halfway between any 2 rows because it represents the change in total cost as quantity of output increases from one level to another. It may be helpful to express these definitions mathematically. Average total cost equals total cost/quantity. ATC equals TC/Q. And marginal cost equals change in total cost/change in quantity. MC equals delta TC/delta Q. Here delta, the Greek letter delta, represents the change in a variable. These equations show how average total cost and marginal cost are derived from total cost. Average total cost tells us the cost of a typical unit of output if total cost is divided evenly over all the units produced. Marginal cost tells us the increase in total cost that arises from producing an additional unit of output. As we will see more fully in the next chapter, business managers like Conrad need to keep in mind the concepts of average total cost and marginal cost when deciding how much of their product to supply to the market. 13-3C Cost curves and their shapes. Just as in previous chapters we found graphs of supply and demand useful when analyzing the behavior of markets, we will find graphs of average and marginal cost useful when analyzing the behavior of firms. Figure 4 graphs Conrad's costs using the data from Table 2. The horizontal axis measures the quantity the firm produces, and the vertical axis measures marginal and average costs. The graph shows 4 curves: average total cost, average fixed cost, average variable cost, and marginal cost. The cost curves shown here for Conrad's coffee shop have some features that are common to the cost curves of many firms in the economy. Let's examine 3 features in particular: the shape of the marginal cost curve, the shape of the average total cost curve, and the relationship between marginal and average total cost. Rising marginal cost. Conrad's marginal cost rises as the quantity of output produced increases. This upward slope reflects the property of diminishing marginal product. When Conrad produces a small quantity of coffee, he has few workers, and much of his equipment is not used. Because he can easily put these idle resources to use, the marginal product of an extra worker is large, and the marginal cost of an extra cup of coffee is small. By contrast, when Conrad produces a large quantity of coffee, his shop is crowded with workers, and most of his equipment is fully utilized. Conrad can produce more coffee by adding workers, but these new workers have to work in crowded conditions and may have to wait to use the equipment. Therefore, when the quantity of coffee produced is already high, the marginal product of an extra worker is low, and the marginal cost of an extra cup of coffee is large. U-shaped average total cost. Conrad's average total cost curve is U-shaped, as shown in Figure 4. To understand why, remember that average total cost is the sum of average fixed cost and average variable cost. Average fixed cost always declines as output rises because the fixed cost is spread over a larger number of units. Average variable cost typically rises as output increases because of diminishing marginal product. Average total cost reflects the shapes of both average fixed cost and average variable cost. At very low levels of output, such as 1 or 2 cups per hour, average total cost is very high. Even though average variable cost is low, average fixed cost is high because the fixed cost is spread over only a few units. As output increases, the fixed cost is spread over more units. Average fixed cost declines, rapidly at first and then more slowly. As a result, average total cost also declines until the firm's output reaches 5 cups of coffee per hour, when average total cost is $1.30 per cup. When the firm produces more than 6 cups per hour, however, the increase in average variable cost becomes the dominant force, and average total cost starts rising. The tug-of-war between average fixed cost and average variable cost generates the U-shape in average total cost. The bottom of the U-shape occurs at the quantity that minimizes average total cost. This quantity is sometimes called the efficient scale of the firm. For Conrad, the efficient scale is 5 or 6 cups of coffee per hour. If he produces more or less than this amount, his average total cost rises above the minimum of $1.30. At lower levels of output, average total cost is higher than $1.30 because the fixed cost is spread over so few units. At higher levels of output, average total cost is higher than $1.30 because the marginal product of inputs has diminished significantly. At the efficient scale, these two forces are balanced to yield the lowest average total cost. The relationship between marginal cost and average total cost. If you look at Figure 4, you will see something that may be surprising at first. Whenever marginal cost is less than average total cost is falling. Whenever marginal cost is greater than average total cost is rising. This feature of Conrad's cost curves is not a coincidence from the particular numbers used in the example, it is true for all firms. To see why, consider an analogy. Average total cost is like your cumulative grade point average. Marginal cost is like the grade you get in the next course you take. If your grade in your next course is less than your grade point average, your grade point average will fall. If your grade in your next course is higher than your grade point average, your grade point average will rise. The mathematics of average and marginal costs is exactly the same as the mathematics of average and marginal grades. This relationship between average total cost and marginal cost has an important corollary: the marginal cost curve crosses the average total cost curve at its minimum. Why? At low levels of output, marginal cost is below average total cost, so average total cost is falling. But after the two curves cross, marginal cost rises above average total cost. For the reason we have just discussed, average total cost must start to rise at this level of output. Hence, this point of intersection is the minimum of average total cost. As you will see in the next chapter, minimum average total cost plays a key role in the analysis of competitive firms. 13-3D typical cost curves. In the examples we have studied so far, the firms have exhibited diminishing marginal product and, therefore, rising marginal cost at all levels of output. This simplifying assumption was useful because it allowed us to focus on the key features of cost curves that are useful in analyzing firm behavior. Yet actual firms are usually more complicated than this. In many firms, marginal product does not start to fall immediately after the first worker is hired. Depending on the production process, the second or third worker might have a higher marginal product than the first because a team of workers can divide tasks and work more productively than a single worker. Firms exhibiting this pattern would experience increasing marginal product for a while before diminishing marginal product set in. Figure 5 shows the cost curves for such a firm, including average total cost, average fixed cost, average variable cost, and marginal cost. At low levels of output, the firm experiences increasing marginal product, and the marginal cost curve falls. Eventually, the firm starts to experience diminishing marginal product, and the marginal cost curve starts to rise. This combination of increasing then diminishing marginal product also makes the average variable cost curve U-shaped. Despite these differences from our previous example, the cost curves shown in Figure 5 share the three properties that are most important to remember. Marginal cost eventually rises with the quantity of output. The average total cost curve is U-shaped. The marginal cost curve crosses the average total cost curve at the minimum of average total cost. Quick quiz. Suppose Honda's total cost of producing 4 cars is $225,000 and its total cost of producing 5 cars is $250,000. What is the average total cost of producing 5 cars? What is the marginal cost of the 5th car? Draw the marginal cost curve and the average total cost curve for a typical firm, and explain why these curves cross where they do. 13-4 Costs in the short run and in the long run. We noted earlier in this chapter that a firm's costs might depend on the time horizon under consideration. Let's examine more precisely why this might be the case. 13-4 The relationship between short-run and long-run average total cost. For many firms, the division of total costs between fixed and variable costs depends on the time horizon. Consider, for instance, a car manufacturer such as Ford Motor Company. Over a period of only a few months, Ford cannot adjust the number or sizes of its car factories. The only way it can produce additional cars is to hire more workers at the factories it already has. The cost of these factories is, therefore, a fixed cost in the short run. By contrast, over a period of several years, Ford can expand the size of its factories, build new factories, or close old ones. Thus, the cost of its factories is a variable cost in the long run. 272. Because many decisions are fixed in the short run but variable in the long run, a firm's long-run cost curves differ from its short-run cost curves. Figure 6 shows an example. The figure presents 3 short-run average total cost curves for a small, medium, and large factory. It also presents the long-run average total cost curve. As the firm moves along the long-run curve, it is adjusting the size of the factory to the quantity of production. This graph shows how short-run and long-run costs are related. The long-run average total cost curve is a much flatter U-shape than the short-run average total cost curve. In addition, all the short-run curves lie on or above the long-run curve. These properties arise because firms have greater flexibility in the long run. In essence, in the long run, the firm gets to choose which short-run curve it wants to use. But in the short run, it has to use whatever short-run curve it has, based on decisions it has made in the past. The figure shows an example of how a change in production alters costs over different time horizons. When Ford wants to increase production from 1,000 to 1,200 cars per day, it has no choice in the short run but to hire more workers at its existing medium-sized factory. Because of diminishing marginal product, average total cost rises from $10,000 to $12,000 per car. In the long run, however, Ford can expand both the size of the factory and its workforce, and average total cost returns to $10,000. How long does it take a firm to get to the long run? The answer depends on the firm. It can take a year or more for a major manufacturing firm, such as a car company, to build a larger factory. By contrast, a person running a coffee shop can buy another coffee maker within a few days. There is, therefore, no single answer to the question of how long it takes a firm to adjust its production facilities. 13-4b Economies and diseconomies of scale. The shape of the long-run average total cost curve conveys important information about the production processes that a firm has available for manufacturing a good. In particular, it tells us how costs vary with the scale, that is, the size of a firm's operations. When long-run average total cost declines as output increases, there are said to be economies of scale. When long-run average total cost rises as output increases, there are said to be diseconomies of scale. When long-run average total cost does not vary with the level of output, there are said to be constant returns to scale. As we can see in Figure 6, Ford has economies of scale at low levels of output, constant returns to scale at intermediate levels of output, and diseconomies of scale at high levels of output. What might cause economies or diseconomies of scale? Economies of scale often arise because higher production levels allow specialization among workers, which permits each worker to become better at a specific task. For instance, if Ford hires a large number of workers and produces a large number of cars, it can reduce costs using modern assembly line production. Diseconomies of scale can arise because of coordination problems that are inherent in any large organization. The more cars Ford produces, the more stretched the management team becomes, and the less effective the managers become at keeping costs down. This analysis shows why long-run average total cost curves are often U-shaped. At low levels of production, the firm benefits from increased size because it can take advantage of greater specialization. Coordination problems, meanwhile, are not yet acute. By contrast, at high levels of production, the benefits of specialization have already been realized, and coordination problems become more severe as the firm grows larger. Thus, long-run average total cost is falling at low levels of production because of increasing specialization and rising at high levels of production because of the increasing prevalence of coordination problems. Jack of all trades, master of none. This well-known adage sheds light on the nature of cost curves. A person who tries to do everything usually ends up doing nothing very well. If a firm wants its workers to be as productive as they can be, it is often best to give each worker a limited task that she can master. But this organization of work is possible only if a firm employs many workers and produces a large quantity of output. In his celebrated book An Inquiry into the Nature and Causes of the Wealth of Nations, Adam Smith described a visit he made to a pin factory. Smith was impressed by the specialization among the workers and the resulting economies of scale. He wrote, "One man draws out the wire, another straightens it, a third cuts it, a fourth points it, a fifth grinds it at the top for receiving the head. To make the head requires 2 or 3 distinct operations. To put it on is a peculiar business, to whiten it is another, it is even a trade by itself to put them into paper." Smith reported that because of this specialization, the pin factory produced thousands of pins per worker every day. He conjectured that if the workers had chosen to work separately, rather than as a team of specialists, they certainly could not each of them make 20, perhaps not 1 pin a day. In other words, because of specialization, a large pin factory could achieve higher output per worker and lower average cost per pin than a small pin factory. The specialization that Smith observed in the pin factory is prevalent in the modern economy. If you want to build a house, for instance, you could try to do all the work yourself. But most people turn to a builder, who in turn hires carpenters, plumbers, electricians, painters, and many other types of workers. These workers focus their training and experience in particular jobs, and as a result, they become better at their jobs than if they were generalists. Indeed, the use of specialization to achieve economies of scale is one reason modern societies are as prosperous as they are. FYI. Quick quiz: if Boeing produces 9 jets per month, its long-run total cost is $9.0 million per month. If it produces 10 jets per month, its long-run total cost is $9.5 million per month. Does Boeing exhibit economies or diseconomies of scale? 274. 13-5 Conclusion. The purpose of this chapter has been to develop some tools to study how firms make production and pricing decisions. You should now understand what economists mean by the term costs and how costs vary with the quantity of output a firm produces. To refresh your memory, Table 3 summarizes some of the definitions we have encountered. By themselves, a firm's cost curves do not tell us what decisions the firm will make. But they are a key component of that decision, as we will see in the next chapter. The goal of firms is to maximize profit, which equals total revenue minus total cost. When analyzing a firm's behavior, it is important to include all the opportunity costs of production. Some of the opportunity costs, such as the wages a firm pays its workers, are explicit. Other opportunity costs, such as the wages the firm owner gives up by working at the firm rather than taking another job, are implicit. Economic profit takes both explicit and implicit costs into account, whereas accounting profit considers only explicit costs. A firm's costs reflect its production process. A typical firm's production function gets flatter as the quantity of an input increases, displaying the property of diminishing marginal product. As a result, a firm's total cost curve gets steeper as the quantity produced rises. 1. What is the relationship between a firm's total revenue, profit, and total cost? 2. Give an example of an opportunity cost that an accountant might not count as a cost. Why would the accountant ignore this cost? 3. What is marginal product, and what does it mean if it is diminishing? 4. Draw a production function that exhibits diminishing marginal product of labor. Draw the associated total cost curve. Explain the shapes of the two curves you have drawn. 5. Define total cost, average total cost, and marginal cost. How are they related? 6. Draw the marginal cost and average total cost curves for a typical firm. Explain why the curves have the shapes that they do and why they cross where they do. 7. How and why does a firm's average total cost curve differ in the short run and in the long run? 8. Define economies of scale and explain why they might arise. Define diseconomies of scale and explain why they might arise. Questions for review. A firm's total costs can be divided between fixed costs and variable costs. Fixed costs are costs that do not change when the firm alters the quantity of output produced. Variable costs are costs that change when the firm alters the quantity of output produced. From a firm's total cost, two related measures of cost are derived. Average total cost is total cost divided by the quantity of output. Marginal cost is the amount by which total cost rises if output increases by 1 unit. When analyzing firm behavior, it is often useful to graph average total cost and marginal cost. For a typical firm, marginal cost rises with the quantity of output. Average total cost first falls as output increases and then rises as output increases further. The marginal cost curve always crosses the average total cost curve at the minimum of average total cost. A firm's costs often depend on the time horizon considered. In particular, many costs are fixed in the short run but variable in the long run. As a result, when the firm changes its level of production, average total cost may rise more in the short run than in the long run. Key concepts. 1. Raj opens up a lemonade stand for 2 hours. He spends $10 for ingredients and sells $60 worth of lemonade. In the same 2 hours, he could have mowed his neighbor's lawn for $40. Raj has an accounting profit of and an economic profit of A $50, $10 billion. $90, $50 C. $10, $50 D. $50, $90. 2. Diminishing marginal product explains why, as a firm's output increases, a. the production function and total cost curve both get steeper. B. the production function and total cost curve both get flatter. C. the production function gets steeper, while the total cost curve gets flatter. D. the production function gets flatter, while the total cost curve gets steeper. Quick check multiple choice. 276. 1. This chapter discusses many types of costs: opportunity cost, total cost, fixed cost, variable cost, average total cost, and marginal cost. Fill in the type of cost that best completes each sentence. A. What you give up for taking some action is called the underscore. B. Is falling when marginal cost is below it and rising when marginal cost is above it. C. A cost that does not depend on the quantity produced is A. D. In the ice cream industry in the short run, includes the cost of cream and sugar but not the cost of the factory. E. Profits equal total revenue minus F. The cost of producing an extra unit of output is the 2. Your aunt is thinking about opening a hardware store. She estimates that it would cost $500,000 per year to rent the location and buy the stock. In addition, she would have to quit her $50,000 per year job as an accountant. A. Define opportunity cost. B. What is your aunt's opportunity cost of running a hardware store for a year? If your aunt thinks she can sell $510,000 worth of merchandise in a year, should she open the store? Explain. 3. A commercial fisherman notices the following relationship between hours spent fishing and the quantity of fish caught. Hours. Quantity of fish. 00. 110. 218. 324. 428. 530. A. What is the marginal product of each hour spent fishing? B. Use these data to graph the fisherman's production function. Explain its shape. C. The fisherman has a fixed cost of $10. The opportunity cost of his time is $5 per hour. Graph the fisherman's total cost curve. Explain its shape. 4. Nimbus Incorporated makes brooms and then sells them door to door. Here is the relationship between the number of workers and Nimbus's output in a given day. Workers' output. Marginal. Product. Total. Cost. Average. Total. Cost. Marginal. Cost 00 underscore 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 underscore. Underscore 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 underscore. 120 underscore 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 underscore. Underscore 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 underscore. 250 underscore 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 underscore. Underscore 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 underscore. 390 underscore 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 underscore. Underscore 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 underscore. 4120 underscore 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 underscore. Underscore 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 underscore. 5140 underscore 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 underscore. Underscore 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 underscore. 6150 underscore 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 underscore. Underscore 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 underscore. 7155 underscore 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 underscore. A. Fill in the column of marginal products. What pattern do you see? How might you explain it? B. A worker costs $100 a day, and the firm has fixed costs of $200. Use this information to fill in the column for total cost. C. Fill in the column for average total cost. What pattern do you see? Problems and applications. 3. A firm is producing 1,000 units at a total cost of $5,000. If it were to increase production to 1,001 units, its total cost would rise to $5,008. What does this information tell you about the firm? A. Marginal cost is $5, and average variable cost is $8. B. Marginal cost is $8, and average variable cost is $5. C. Marginal cost is $5, and average total cost is $8. D. Marginal cost is $8, and average total cost is $5. 4. A firm is producing 20 units with an average total cost of $25 and marginal cost of $15. If it were to increase production to 21 units, which of the following must occur? A. Marginal cost would decrease. B. Marginal cost would increase. C. Average total cost would decrease. D. Average total cost would increase. 5. The government imposes a $1,000 per year license fee on all pizza restaurants. Which cost curves shift as a result? A. Average total cost and marginal cost. B. Average total cost and average fixed cost. C. Average variable cost and marginal cost. D. Average variable cost and average fixed cost. 6. If a higher level of production allows workers to specialize in particular tasks, a firm will likely exhibit of scale and of scale and average total cost. A. Economies, falling. B. Economies, rising. C. Diseconomies, falling. D. Diseconomies, rising. 277. D. Now fill in the column for marginal cost. What pattern do you see? E. Compare the column for marginal product and the column for marginal cost. Explain the relationship. F. Compare the column for average total cost and the column for marginal cost. Explain the relationship. 5. You are the chief financial officer for a firm that sells digital music players. Your firm has the following average total cost schedule. Quantity: average total cost 600 players, $300, 601, 301. Your current level of production is 600 devices, all of which have been sold. Someone calls, desperate to buy one of your music players. The caller offers you $550 for it. Should you accept the offer? Why or why not? 6. Consider the following cost information for a pizzeria. Quantity: total cost, variable cost 0 dozen pizzas $300, $0 1 350 52 390 93 420 124 450 155 490 196 540 240. A. What is the pizzeria's fixed cost? B. Construct a table in which you calculate the marginal cost per dozen pizzas using the information on total cost. Also, calculate the marginal cost per dozen pizzas using the information on variable cost. What is the relationship between these sets of numbers? Comment. 7. Your cousin Vinny owns a painting company with fixed costs of $200 and the following schedule for variable costs. Quantity of houses painted per month 1 2 3 4 5 6 7. Variable costs $10, $20, $40, $80, $160, $320, $640. Calculate average fixed cost, average variable cost, and average total cost for each quantity. What is the efficient scale of the painting company? 8. The city government is considering two tax proposals: a lump sum tax of $300 on each producer of hamburgers. A tax of $1 per burger, paid by producers of hamburgers. A. Which of the following curves average fixed cost, average variable cost, average total cost, and marginal cost would shift as a result of the lump sum tax? Why? Show this in a graph. Label the graph as precisely as possible. B. Which of these same four curves would shift as a result of the per burger tax? Why? Show this in a new graph. Label the graph as precisely as possible. 9. Jane's Juice Bar has the following cost schedules. Quantity variable cost total cost 0 vats of juice $0 $30 $110 42 25 55 345 75 470 105 100 136 135 165. A. Calculate average variable cost, average total cost, and marginal cost for each quantity. B. Graph all three curves. What is the relationship between the marginal cost curve and the average total cost curve? Between the marginal cost curve and the average variable cost curve? Explain. 10. Consider the following table of long-run total costs for three different firms. Quantity 1 2 3 4 5 6 7. Firm A $60 $70 $80 $90 $100 $110 $120. Firm B 11 24 39 56 75 96 119. Firm C 21 34 49 66 85 106 129. Does each of these firms experience economies of scale or diseconomies of scale? Go to CEngageBrain.com to purchase access to the proven, critical study guide to accompany this text, which features additional notes and context, practice tests, and much more. 279. Firms in competitive markets. If your local gas station raised its price for gasoline by 20%, it would see a large drop in the amount of gasoline it sold. Its customers would quickly switch to buying their gasoline at other gas stations. By contrast, if your local water company raised the price of water by 20%, it would see only a small decrease in the amount of water it sold. People might water their lawns less often and buy more water-efficient showerheads, but they would be hard-pressed to reduce water consumption greatly and would be unlikely to find another supplier. The difference between the gasoline market and the water market is that many firms supply gasoline to the local market, but only one firm supplies water. As you might expect, this difference in market structure shapes the pricing and production decisions of the firms that operate in these markets. In this chapter, we examine the behavior of competitive firms, such as your local gas station. You may recall that a market is competitive if each buyer and seller is small compared to the size of the market and, therefore, has little ability to influence market prices. By contrast, if a firm can influence the market price of the good it sells, it is said to have market power. Later in the book, we examine the behavior of firms with market power, such as your local water company. Our analysis of competitive firms in this chapter sheds light on the decisions that lie behind the supply curve in a competitive market. Not surprisingly, we find that a market supply curve is tightly linked to firms' costs of production. Less obvious, however, is the question of which among a firm's many types of cost fixed, variable, average, and marginal are most relevant for its supply decisions. We see that all these measures of cost play important and interrelated roles. 14:1 What is a competitive market? Our goal in this chapter is to examine how firms make production decisions in competitive markets. As a background for this analysis, we begin by reviewing what a competitive market is. 14-1 The meaning of competition. A competitive market, sometimes called a perfectly competitive market, has two characteristics. There are many buyers and many sellers in the market. The goods offered by the various sellers are largely the same. As a result of these conditions, the actions of any single buyer or seller in the market have a negligible impact on the market price. Each buyer and seller takes the market price as given. As an example, consider the market for milk. No single consumer of milk can influence the price of milk because each buys a small amount relative to the size of the market. Similarly, each dairy farmer has limited control over the price because many other sellers are offering milk that is essentially identical. Because each seller can sell all he wants at the going price, he has little reason to charge less, and if he charges more, buyers will go elsewhere. Buyers and sellers in competitive markets must accept the price the market determines and, therefore, are said to be price takers. In addition to the previous two conditions for competition, a third condition is sometimes thought to characterize perfectly competitive markets. Firms can freely enter or exit the market. If, for instance, anyone can decide to start a dairy farm, and if any existing dairy farmer can decide to leave the dairy business, then the dairy industry satisfies this condition. Much of the analysis of competitive firms does not need the assumption of free entry and exit because this condition is not necessary for firms to be price takers. Yet, as we see later in this chapter, when there is free entry and exit in a competitive market, it is a powerful force shaping the long-run equilibrium. 14-1b The revenue of a competitive firm. A firm in a competitive market, like most other firms in the economy, tries to maximize profit. To see how it does this, we first consider the revenue of a competitive firm. To keep matters concrete, let's consider a specific firm, the Vaca family dairy farm. The Vaca farm produces a quantity of milk, Q, and sells each unit at the market price, P. The farm's total revenue is P times Q. For example, if a gallon of milk sells for $6 and the farm sells 1,000 gallons, its total revenue is $6,000. Because the Vaca farm is small compared to the world market for milk, it takes the price as given by market conditions. This means, in particular, that the price of milk does not depend on the number of gallons that the Vaca farm produces and sells. If the Vacas double the amount of milk they produce to 2,000 gallons, the price of milk remains the same, and their total revenue doubles to $12,000. As a result, total revenue is proportional to the amount of output. Table 1 shows the revenue for the Vaca family dairy farm. The first two columns show the amount of output the farm produces and the price at which it sells its output. The third column is the farm's total revenue. The table assumes that the price of milk is $6 a gallon, so total revenue is $6 times the number of gallons. Just as the concepts of average and marginal were useful in the preceding chapter when analyzing costs, they are also useful when analyzing revenue. To see what these concepts tell us, consider these two questions. How much revenue does the farm receive for the typical gallon of milk? How much additional revenue does the farm receive if it increases production of milk by 1 gallon? The last two columns in Table 1 answer these questions. The fourth column in the table shows average revenue, which is total revenue divided by the amount of output. Average revenue tells us how much revenue a firm receives for the typical unit sold. In Table 1, you can see that average revenue equals $6, the price of a gallon of milk. This illustrates a general lesson that applies not only to competitive firms but to other firms as well. Average revenue is total revenue divided by the quantity. Therefore, for all types of firms, average revenue equals the price of the good. The fifth column shows marginal revenue, which is the change in total revenue from the sale of each additional unit of output. In Table 1, marginal revenue equals $6, the price of a gallon of milk. This result illustrates a lesson that applies only to competitive firms. Total revenue is P times Q, and P is fixed for a competitive firm. Therefore, when Q rises by 1 unit, total revenue rises by P dollars. For competitive firms, marginal revenue equals the price of the good. Quick quiz: when a competitive firm doubles the amount it sells, what happens to the price of its output and its total revenue? 14-2 Profit maximization and the competitive firm's supply curve. The goal of a firm is to maximize profit, which equals total revenue minus total cost. We have just discussed the competitive firm's revenue, and in the preceding chapter, we discussed the firm's costs. We are now ready to examine how a competitive firm maximizes profit and how that decision determines its supply curve. 14-2A A simple example of profit maximization. Let's begin our analysis of the firm's supply decision with the example in Table 2. In the first column of the table is the number of gallons of milk the Vaca family dairy farm produces. The second column shows the farm's total revenue, which is $6 times the number of gallons. The third column shows the farm's total cost. Total cost includes fixed costs, which are $3 in this example, and variable costs, which depend on the quantity produced. The fourth column shows the farm's profit, which is computed by subtracting total cost from total revenue. If the farm produces nothing, it has a loss of $3. If it produces 1 gallon, it has a profit of $1. If it produces 2 gallons, it has a profit of $4 and so on. Because the Vaca family's goal is to maximize profit, it chooses to produce the quantity of milk that makes profit as large as possible. In this example, profit is maximized when the farm produces either 4 or 5 gallons of milk, for a profit of $7. There is another way to look at the Vaca farm's decision. The Vacas can find the profit maximizing quantity by comparing the marginal revenue and marginal cost from each unit produced. The fifth and sixth columns in Table 2 compute marginal revenue and marginal cost from the changes in total revenue and total cost, and the last column shows the change in profit for each additional gallon produced. The first gallon of milk the farm produces has a marginal revenue of $6 and a marginal cost of $2, hence, producing that gallon increases profit by $4. The second gallon produced has a marginal revenue of $6 and a marginal cost of $3, so that gallon increases profit by $3. As long as marginal revenue exceeds marginal cost, increasing the quantity produced raises profit. Once the Vaca farm has reached 5 gallons of milk, however, the situation changes. The sixth gallon would have a marginal revenue of $6 and a marginal cost of $7, so producing it would reduce profit by $1. As a result, the Vacas would not produce beyond 5 gallons. One of the 10 principles of economics in Chapter 1 is that rational people think at the margin. We now see how the Vaca family dairy farm can apply this principle. If marginal revenue is greater than marginal cost as it is at 1, 2, or 3 gallons, the Vacas should increase the production of milk because it will put more money in their pockets than it takes out. If marginal revenue is less than marginal cost as it is at 6, 7, or 8 gallons, the Vacas should decrease production. If the Vacas think at the margin and make incremental adjustments to the level of production, they end up producing the profit maximizing quantity. 14-2B The marginal cost curve and the firm's supply decision. To extend this analysis of profit maximization, consider the cost curves in Figure 1. These cost curves have the 3 features that, as we discussed in the previous chapter, are thought to describe most firms. The marginal cost curve is upward sloping. The average total cost curve is U-shaped. And the marginal cost curve crosses the average total cost curve at the minimum of average total cost. The figure also shows a horizontal line at the market price. The price line is horizontal because a competitive firm is a price taker. The price of the firm's output is the same regardless of the quantity that the firm decides to produce. Keep in mind that, for a competitive firm, the firm's price equals both its average revenue and its marginal revenue. We can use Figure 1 to find the quantity of output that maximizes profit. Imagine that the firm is producing at Q1. At this level of output, the marginal revenue curve is above the marginal cost curve, showing that marginal revenue is greater than marginal cost. This means that if the firm were to raise production by 1 unit, the additional revenue would exceed the additional cost. Profit, which equals total revenue minus total cost, would increase. Hence, if marginal revenue is greater than marginal cost, as it is at Q1, the firm can increase profit by increasing production. A similar argument applies when output is at Q2. In this case, the marginal cost curve is above the marginal revenue curve, showing that marginal cost is greater than marginal revenue. If the firm were to reduce production by 1 unit, the cost saved would exceed the revenue lost. Therefore, if marginal revenue is less than marginal cost, as it is at Q2, the firm can increase profit by reducing production. Where do these marginal adjustments to production end? Regardless of whether the firm begins with production at a low level or at a high level, the firm will eventually adjust production until the quantity produced reaches Qmax. This analysis yields 3 general rules for profit maximization. If marginal revenue is greater than marginal cost, the firm should increase its output. If marginal cost is greater than marginal revenue, the firm should decrease its output. At the profit maximizing level of output, marginal revenue and marginal cost are exactly equal. These rules are the key to rational decision making by any profit maximizing firm. They apply not only to competitive firms but, as we will see in the next chapter, to other types of firms as well. We can now see how the competitive firm decides what quantity of its good to supply to the market. Because a competitive firm is a price taker, its marginal revenue equals the market price. For any given price, the competitive firms. This figure shows the marginal cost curve, the average total cost curve, and the average variable cost curve. It also shows the market price, which for a competitive firm equals both marginal revenue and average revenue. At the quantity Q1, marginal revenue MR1 exceeds marginal cost MC1, so raising production increases profit. At the quantity Q2, marginal cost MC2 is above marginal revenue MR2, so reducing production increases profit. The profit maximizing quantity Qmax is found where the horizontal line representing the price intersects the marginal cost curve. Profit maximizing quantity of output is found by looking at the intersection of the price with the marginal cost curve. In figure 1, that quantity of output is Qmax. Suppose that the price prevailing in this market rises, perhaps because of an increase in market demand. Figure 2 shows how a competitive firm responds to the price increase. When the price is P1, the firm produces quantity Q1, the quantity that equates marginal cost to the price. When the price rises to P2, the firm finds that marginal revenue is now higher than marginal cost at the previous level of output, so the firm increases production. The new profit maximizing quantity is Q2, at which marginal cost equals the new, higher price. In essence, because the firm's marginal cost curve determines the quantity of the good the firm is willing to supply at any price, the marginal cost curve is also the competitive firm's supply curve. There are, however, some caveats to that conclusion, which we examine next. 14-2 See the firm's short-run decision to shut down. So far, we have been analyzing the question of how much a competitive firm will produce. In certain circumstances, however, the firm will decide to shut down and not produce anything at all. Here we need to distinguish between a temporary shutdown of a firm and the permanent exit of a firm from the market. A shutdown refers to a short-run decision not to produce anything during a specific period of time because of current market conditions. Exit refers to a long-run decision to leave the market. The short-run and long-run decisions differ because most firms cannot avoid their fixed costs in the short run but can do so in the long run. That is, a firm that shuts down temporarily still has to pay its fixed costs, whereas a firm that exits the market does not have to pay any costs at all, fixed or variable. For example, consider the production decision that a farmer faces. The cost of the land is one of the farmer's fixed costs. If the farmer decides not to produce any crops one season, the land lies fallow, and he cannot recover this cost. When making the short-run decision of whether to shut down for a season, the fixed cost of land is said to be a sunk cost. By contrast, if the farmer decides to leave farming altogether, he can sell the land. When making the long-run decision of whether to exit the market, the cost of land is not sunk. Now let's consider what determines a firm's shutdown decision. If the firm shuts down, it loses all revenue from the sale of its product. At the same time, it saves the variable costs of making its product. Thus, the firm shuts down if the revenue that it would earn from producing is less than its variable costs of production. A bit of mathematics can make this shutdown rule more useful. If TR stands for total revenue and VC stands for variable cost, then the firm's decision can be written as shut down if TR, VC. The firm shuts down if total revenue is less than variable cost. By dividing both sides of this inequality by the quantity Q, we can write it as shut down if TR/Q, VC/Q. The left side of the inequality, TR/Q, is total revenue P times Q divided by quantity Q, which is average revenue, most simply expressed as the goods price, P. The right side of the inequality, VC/Q, is average variable cost, AVC. Therefore, the firm's shutdown rule can be restated as shut down if P, AVC. That is, a firm chooses to shut down if the price of the good is less than the average variable cost of production. This criterion is intuitive. When choosing to produce, the firm compares the price it receives for the typical unit to the average variable cost that it must incur to produce the typical unit. If the price doesn't cover the average variable cost, the firm is better off stopping production altogether. The firm still loses money, but it would lose even more money by staying open. The firm can reopen in the future if conditions change so that price exceeds average variable cost. We now have a full description of a competitive firm's profit maximizing strategy. If the firm produces anything, it produces the quantity at which marginal cost equals the goods price, which the firm takes as given. Yet if the price is less than average variable cost at that quantity, the firm is better off shutting down temporarily and not producing anything. These results are illustrated in Figure 3. The competitive firm's short-run supply curve is the portion of its marginal cost curve that lies above average variable cost. 14-2D Spilt milk and other sunk costs. Sometime in your life you may have been told, "Don't cry over spilt milk," or "let bygones be bygones." These adages hold a deep truth about rational decision-making. Economists say that a cost is a sunk cost when it has already been committed and cannot be recovered. Because nothing can be done about sunk costs, you should ignore them when making decisions about various aspects of life, including business strategy. Our analysis of the firm's shutdown decision is one example of the irrelevance of sunk costs. We assume that the firm cannot recover its fixed costs by temporarily stopping production. That is, regardless of the quantity of output supplied, the firm still has to pay its fixed costs. As a result, the fixed costs are sunk in the short run, and the firm should ignore them when deciding how much to produce. The firm's short-run supply curve is the part of the sunk cost, a cost that has already been committed and cannot be recovered. Chapter 14, Firms in Competitive Markets. 287. Marginal cost curve that lies above average variable cost, and the size of the fixed cost does not matter for this supply decision. The irrelevance of sunk costs is also important when making personal decisions. Imagine, for instance, that you place a $15 value on seeing a newly released movie. You buy a ticket for $10, but before entering the theater, you lose the ticket. Should you buy another ticket? Or should you now go home and refuse to pay a total of $20 to see the movie? The answer is that you should buy another ticket. The benefit of seeing the movie still exceeds the opportunity cost. The $10 you paid for the lost ticket is a sunk cost. As with spilt milk, there is no point in crying about it. Near empty restaurants and off-season miniature golf. Have you ever walked into a restaurant for lunch and found it almost empty? Why, you might have asked, does the restaurant even bother to stay open? It might seem that the revenue from so few customers could not possibly cover the cost of running the restaurant. In making the decision of whether to open for lunch, a restaurant owner must keep in mind the distinction between fixed and variable costs. Many of a restaurant's costs, the rent, kitchen equipment, tables, plates, silverware, and so on, are fixed. Shutting down during lunch would not reduce these costs. In other words, these costs are sunk in the short run. When the owner is deciding whether to serve lunch, only the variable costs, the price of the additional food and the wages of the extra staff are relevant. The owner shuts down the restaurant at lunchtime only if the revenue from the few lunchtime customers fails to cover the restaurant's variable costs. An operator of a miniature golf course in a summer resort community faces a similar decision. Because revenue varies substantially from season to season, the firm must decide when to open and when to close. Once again, the fixed costs, the costs of buying the land and building the course, are irrelevant in making this short-run decision. The miniature golf course should be open for business only during those times of year when its revenue exceeds its variable costs. 14-2E The firm's long-run decision to exit or enter a market. A firm's long-run decision to exit a market is similar to its shutdown decision. If the firm exits, it will again lose all revenue from the sale of its product, but now it will save not only its variable costs of production but also its fixed costs. Thus, the firm exits the market if the revenue it would get from producing is less than its total costs. We can again make this criterion more useful by writing it mathematically. If TR stands for total revenue, and TC stands for total cost, then the firm's exit rule can be written as exit if TR, TC. The firm exits if total revenue is less than total cost. By dividing both sides of this inequality by quantity Q, we can write it as exit if TR/Q, TC/Q. We can simplify this further by noting that TR/Q is average revenue, which equals the price P, and that TC/Q is average total cost, ATC. Therefore, the firm's exit rule is exit if P, ATC. That is, a firm chooses to exit if the price of its good is less than the average total cost of production. A parallel analysis applies to an entrepreneur who is considering starting a firm. He will enter the market if starting a firm would be profitable, which occurs if the price of the good exceeds the average total cost of production. The entry rule is enter if P, ATC. The rule for entry is exactly the opposite of the rule for exit. We can now describe a competitive firm's long-run profit maximizing strategy. If the firm produces anything, it chooses the quantity at which marginal cost equals the price of the good. Yet if the price is less than the average total cost at that quantity, the firm chooses to exit the market. These results are illustrated in Figure 4. The competitive firm's long-run supply curve is the portion of its marginal cost curve that lies above average total cost. 14-2F Measuring profit. In our graph for the competitive firm, as we study exit and entry, it is useful to analyze the firm's profit in more detail. Recall that profit equals total revenue minus total cost. Profit 5TR2TC. We can rewrite this definition by multiplying and dividing the right side by Q. Profit 5-3 Quetzales. Chapter 14 Firms in Competitive Markets 289. But note that TR/Q is average revenue, which is the price, P, and TC/Q is average total cost, ATC. Therefore, profit 5-3 Quetzales. This way of expressing the firm's profit allows us to measure profit in our graphs. Panel of Figure 5 shows a firm earning positive profit. As we have already discussed, the firm maximizes profit by producing the quantity at which price equals marginal cost. Now look at the shaded rectangle. The height of the rectangle is PATC, the difference between price and average total cost. The width of the rectangle is Q, the quantity produced. Therefore, the area of the rectangle is times Q, which is the firm's profit. Similarly, panel of Figure 5 shows a firm with losses. In this case, maximizing profit means minimizing losses, a task accomplished once again by producing the quantity at which price equals marginal cost. Now consider the shaded rectangle. The height of the rectangle is ATCP, and the width is Q. The area is times Q, which is the firm's loss. Because a firm in this situation is not making enough revenue on each unit to cover its average total cost, it would choose to exit the market in the long run. 1. In the long run, the RM produces on the MC curve if P, ATC. 2. but exits if P, etc. Quick quiz: how does a competitive firm determine its profit maximizing level of output? Explain. When does a profit maximizing competitive firm decide to shut down? When does it decide to exit a market? 14-3 The supply curve in a competitive market. Now that we have examined the supply decision of a single firm, we can discuss the supply curve for a market. There are two cases to consider. First, we examine a market with a fixed number of firms. Second, we examine a market in which 290. The number of firms can change as old firms exit the market and new firms enter. Both cases are important, for each applies to a specific time horizon. Over short periods of time, it is often difficult for firms to enter and exit, so the assumption of a fixed number of firms is appropriate. But over long periods of time, the number of firms can adjust to changing market conditions. 14-3 Of the short run, market supply with a fixed number of firms. Consider first a market with 1,000 identical firms. For any given price, each firm supplies a quantity of output so that its marginal cost equals the price, as shown in panel of figure 6. That is, as long as price is above average variable cost, each firm's marginal cost curve is its supply curve. The quantity of output supplied to the market equals the sum of the quantities supplied by each of the 1,000 individual firms. Thus, to derive the market supply curve, we add the quantity supplied by each firm in the market. As panel of figure 6 shows, because the firms are identical, the quantity supplied to the market is 1,000 times the quantity supplied by each firm. 14-3b The long run, market supply with entry and exit. Now consider what happens if firms are able to enter or exit the market. Let's suppose that everyone has access to the same technology for producing the good and access to the same markets to buy the inputs for production. Therefore, all current and potential firms have the same cost curves. Decisions about entry and exit in a market of this type depend on the incentives facing the owners of existing firms and the entrepreneurs who could start new firms. If firms already in the market are profitable, then new firms will have an incentive to enter the market. This entry will expand the number of firms, increase the quantity of the goods supplied, and drive down prices and profits. Conversely, if firms in the market are making losses, then some existing firms will exit the market. Their exit will reduce the number of firms, decrease the quantity of the goods supplied, and drive up prices and profits. At the end of this process of entry and exit, firms that remain in the market must be making zero economic profit. Recall that we can write a firm's profit as profit 5-3 quetzales. This equation shows that an operating firm has zero profit if and only if the price of the good equals the average total cost of producing that good. If price is above average total cost, profit is positive, which encourages new firms to enter. If price is less than average total cost, profit is negative, which encourages some firms to exit. The process of entry and exit ends only when price and average total cost are driven to equality. This analysis has a surprising implication. We noted earlier in the chapter that competitive firms maximize profits by choosing a quantity at which price equals marginal cost. We just noted that free entry and exit force price to equal average total cost. But if price is to equal both marginal cost and average total cost, these two measures of cost must equal each other. Marginal cost and average total cost are equal, however, only when the firm is operating at the minimum of average total cost. Recall from the preceding chapter that the level of production with lowest average total cost is called the firm's efficient scale. Therefore, in the long-run equilibrium of a competitive market with free entry and exit, firms must be operating at their efficient scale. Panel of figure 7 shows a firm in such a long-run equilibrium. In this figure, price P equals marginal cost MC, so the firm is maximizing profit. Price also equals average total cost ATC, so profit is zero. New firms have no incentive to enter the market, and existing firms have no incentive to leave the market. From this analysis of firm behavior, we can determine the long-run supply curve for the market. In a market with free entry and exit, there is only one price consistent with zero profit, the minimum of average total cost. As a result, the long-run market supply curve must be horizontal at this price, as illustrated by the perfectly elastic supply curve in panel of figure 7. Any price above this level would generate profit, leading to entry and an increase in the total quantity supplied. Any price below this level would generate losses, leading to exit and a decrease in the total quantity supplied. Eventually, the number of firms in the market adjusts so that price equals the minimum of average total cost, and there are enough firms to satisfy all the demand at this price. 14-3C Why do competitive firms stay in business if they make zero profit? At first, it might seem odd that competitive firms earn zero profit in the long run. After all, people start businesses to make a profit. If entry eventually drives profit to zero, there might seem to be little reason to stay in business. To understand the zero profit condition more fully, recall that profit equals total revenue minus total cost, and that total cost includes all the opportunity costs of the firm. In particular, total cost includes the time and money that the firm owners devote to the business. In the zero profit equilibrium, the firm's revenue must compensate the owners for these opportunity costs. Consider an example. Suppose that, to start his farm, a farmer had to invest $1 million, which otherwise he could have deposited in a bank and earned $50,000 a year in interest. In addition, he had to give up another job that would have paid him $30,000 a year. Then the farmer's opportunity cost of farming includes both the interest he could have earned and the foregone wages, a total of $80,000. Even if his profit is driven to zero, his revenue from farming compensates him for these opportunity costs. Keep in mind that accountants and economists measure costs differently. As we discussed in the previous chapter, accountants keep track of explicit costs but not implicit costs. That is, they measure costs that require an outflow of money from the firm, but they do not include the opportunity costs of production that do not involve an outflow of money. As a result, in the zero profit equilibrium, economic profit is zero, but accounting profit is positive. Our farmer's accountant, for instance, would conclude that the farmer earned an accounting profit of $80,000, which is enough to keep the farmer in business. 14-3D A shift in demand in the short run and long run. Now that we have a more complete understanding of how firms make supply decisions, we can better explain how markets respond to changes in demand. Because firms can enter and exit in the long run but not in the short run, the response of a market to a change in demand depends on the time horizon. To see this, let's trace the effects of a shift in demand over time. Suppose the market for milk begins in a long-run equilibrium. Firms are earning zero profit, so price equals the minimum of average total cost. Panel of figure 8 shows the situation. The long-run equilibrium is point A, the quantity sold in the market is Q1, and the price is P1. Now suppose scientists discover that milk has miraculous health benefits. As a result, the quantity of milk demanded at every price increases, and the demand curve for milk shifts outward from D1 to D2, as in panel of figure 8. The short-run equilibrium moves from point A to point B. As a result, the quantity rises from Q1 to Q2, and the price rises from P1 to P2. All of the existing firms respond to the higher price by raising the amount they produce. Because each firm's supply curve reflects its marginal cost curve, how much each firm increases production is determined by the marginal cost curve. In the new short-run equilibrium, the price of milk exceeds average total cost, so the firms are making positive profit. Over time, the profit generated in this market encourages new firms to enter. Some farmers may switch to producing milk instead of other farm products, for example. As the number of firms grows, the quantity supplied at every price increases. The short-run supply curve shifts to the right from S1 to S2, as in panel of figure 8, and this shift causes the price of milk to fall. Eventually, the price is driven back down to the minimum of average total cost, profits are zero, and firms stop entering. Thus, the market reaches a new long-run equilibrium, point C. The price of milk has returned to P1, but the quantity produced has risen to Q3. Each firm is again producing at its efficient scale, but because more firms are in the dairy business, the quantity of milk produced and sold is higher. 14-3 Why the long-run supply curve might slope upwards. So far, we have seen that entry and exit can cause the long-run market supply curve to be perfectly elastic. The essence of our analysis is that there are a large number of potential entrants, each of which faces the same costs. As a result, the long-run market supply curve is horizontal at the minimum of average total cost. When the demand for the good increases, the long-run result is an increase in the number of firms and in the total quantity supplied, without any change in the price. There are, however, two reasons that the long-run market supply curve might slope upward. The first is that some resources used in production may be available only in limited quantities. For example, consider the market for farm products. Anyone can choose to buy land and start a farm, but the quantity of land is limited. As more people become farmers, the price of farmland is bid up, which raises the costs of all farmers in the market. Thus, an increase in demand for farm products cannot induce an increase in quantity supplied without also inducing a rise in farmers' costs, which in turn means a rise in price. The result is a long-run market supply curve that is upward sloping, even with free entry into farming. A second reason for an upward sloping supply curve is that firms may have different costs. For example, consider the market for painters. Anyone can enter the market for painting services, but not everyone has the same costs. Costs vary in part because some people work faster than others and in part because some people have better alternative uses of their time than others. For any given price, those with lower costs are more likely to enter than those with higher costs. To increase the quantity of painting services supplied, additional entrants must be encouraged to enter the market. Because these new entrants have higher costs, the price must rise to make entry profitable for them. Thus, the long-run market supply curve for painting services slopes upward even with free entry into the market. Notice that if firms have different costs, some firms earn profit even in the long run. In this case, the price in the market reflects the average total cost of the marginal firm, the firm that would exit the market if the price were any lower. This firm earns zero profit, but firms with lower costs earn positive profit. Entry does not eliminate this profit because would-be entrants have higher costs than firms already in the market. Higher cost firms will enter only if the price rises, making the market profitable for them. Thus, for these two reasons, a higher price may be necessary to induce a larger quantity supplied, in which case the long-run supply curve is upward sloping rather than horizontal. Nonetheless, the basic lesson about entry and exit remains true. Because firms can enter and exit more easily in the long run than in the short run, the long-run supply curve is typically more elastic than the short-run supply curve. Quick quiz: in the long run with free entry and exit, is the price in a market equal to marginal cost, average total cost, both, or neither? Explain with a diagram. 14-4 Conclusion: behind the supply curve. We have been discussing the behavior of profit-maximizing firms that supply goods in perfectly competitive markets. You may recall from Chapter 1 that one of the 10 principles of economics is that rational people think at the margin. This chapter has applied this idea to the competitive firm. Marginal analysis has given us a theory of the supply curve in a competitive market and, as a result, a deeper understanding of market outcomes. We have learned that when you buy a good from a firm in a competitive market, you can be assured that the price you pay is close to the cost of producing that good. In particular, if firms are competitive and profit maximizing, the price of a good equals the marginal cost of making that good. In addition, if firms can freely enter and exit the market, the price also equals the lowest possible average total cost of production. Although we have assumed throughout this chapter that firms are price takers, many of the tools developed here are also useful for studying firms in less competitive markets. We now turn to examining the behavior of firms with market power. Marginal analysis will again be useful, but it will have quite different implications for a firm's production decisions and for the nature of market outcomes. 296. Questions for Review 1. What are the main characteristics of a competitive market? 2. Explain the difference between a firm's revenue and its profit. Which do firms maximize? 3. Draw the cost curves for a typical firm. Explain how a competitive firm chooses the level of output that maximizes profit. At that level of output, show on your graph the firm's total revenue and total costs. 4. Under what conditions will a firm shut down temporarily? Explain. 5. Under what conditions will a firm exit a market? Explain. 6. Does a competitive firm's price equal its marginal cost in the short run, in the long run, or both? Explain. 7. Does a competitive firm's price equal the minimum of its average total cost in the short run, in the long run, or both? Explain. 8. Are market supply curves typically more elastic in the short run or in the long run? Explain. Because a competitive firm is a price taker, its revenue is proportional to the amount of output it produces. The price of the good equals both the firm's average revenue and its marginal revenue. To maximize profit, a firm chooses a quantity of output such that marginal revenue equals marginal cost. Because marginal revenue for a competitive firm equals the market price, the firm chooses quantity so that price equals marginal cost. Thus, the firm's marginal cost curve is its supply curve. In the short run, when a firm cannot recover its fixed costs, the firm will choose to shut down temporarily if the price of the good is less than average variable cost. In the long run, when the firm can recover both fixed and variable costs, it will choose to exit if the price is less than average total cost. In a market with free entry and exit, profit is driven to zero in the long run. In this long-run equilibrium, all firms produce at the efficient scale, price equals the minimum of average total cost, and the number of firms adjusts to satisfy the quantity demanded at this price. Changes in demand have different effects over different time horizons. In the short run, an increase in demand raises prices and leads to profits, and a decrease in demand lowers prices and leads to losses. But if firms can freely enter and exit the market, then in the long run, the number of firms adjusts to drive the market back to the zero profit equilibrium. Summary. Competitive market, P280 average revenue, P281 marginal revenue, P282 sunk cost, P286 key concepts. 1. A perfectly competitive firm A chooses its price to maximize profits. B sets its price to undercut other firms selling similar products. C takes its price as given by market conditions. D picks the price that yields the largest market share. 2. A competitive firm maximizes profit by choosing the quantity at which A average total cost is at its minimum. B marginal cost equals the price. C average total cost equals the price. D marginal cost equals average total cost. 3. A competitive firm's short-run supply curve is its underscore 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 cost curve above its underscore 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 cost curve. A average total, marginal B. Average variable, marginal C. Marginal, average total D. Marginal, average variable 4. If a profit maximizing, competitive firm is producing a quantity at which marginal cost is between average variable cost and average total cost, it will A. Keep producing in the short run but exit the market in the long run. Quick check multiple choice. Chapter 14 Firms in Competitive Markets 297. 1. Many small boats are made of fiberglass, which is derived from crude oil. Suppose that the price of oil rises. A. Using diagrams, show what happens to the cost curves of an individual boat-making firm and to the market supply curve. B. What happens to the profits of boat makers in the short run? What happens to the number of boat makers in the long run? 2. You go out to the best restaurant in town and order a lobster dinner for $40. After eating half of the lobster, you realize that you are quite full. Your date wants you to finish your dinner because you can't take it home and because you've already paid for it. What should you do? Relate your answer to the material in this chapter. 3. Bob's lawn mowing service is a profit-maximizing, competitive firm. Bob mows lawns for $27 each. His total cost each day is $280, of which $30 is a fixed cost. He mows 10 lawns a day. What can you say about Bob's short-run decision regarding shutdown and his long-run decision regarding exit? 4. Consider total cost and total revenue given in the following table. Quantity 0, 1, 2, 3, 4, 5, 6, 7. Total cost $8, 9, 10, 11, 13, 19, 27, 37. Total revenue $0, 8, 16, 24, 32, 40, 48, 56. A. Calculate profit for each quantity. How much should the firm produce to maximize profit? B. Calculate marginal revenue and marginal cost for each quantity. Graph them. At what quantity do these curves cross? How does this relate to your answer to part C? Can you tell whether this firm is in a competitive industry? If so, can you tell whether the industry is in a long-run equilibrium? 5. Ball Bearings Incorporated faces costs of production as follows. Quantity. Total. Fixed. Costs. Total. Variable. Costs 0, $100, $0, 1, 152, 173, 194, 100, 145, 100, 206, 100, 360. A. Calculate the company's average fixed costs, average variable costs, average total costs, and marginal costs at each level of production. B. The price of a case of ball bearings is $50. Seeing that he can't make a profit, the chief executive officer decides to shut down operations. What is the firm's profit/loss? Was this a wise decision? Explain. C. Vaguely remembering his introductory economics course, the chief financial officer tells the CEO it is better to produce one case of ball bearings, because marginal revenue equals marginal cost at that quantity. What is the firm's profit/loss at that level of production? Was this the best decision? Explain. 6. Suppose the book printing industry is competitive and begins in a long-run equilibrium. A. Draw a diagram showing the average total cost, marginal revenue, and supply curve of the typical firm in the industry. B. High-tech printing company invents a new process that sharply reduces the cost of printing books. What happens to high-tech's profits and the price of books in the short run when high-tech's patent prevents other firms from using the new technology? C. What happens in the long run when the patent expires and other firms are free to use the technology? Problems and applications. B. Shut down in the short run but return to production in the long run. C. Shut down in the short run and exit the market in the long run. D. Keep producing both in the short run and in the long run. 5. In the long run equilibrium of a competitive market with identical firms, what is the relationship between price P, marginal cost MC, and average total cost ATC? A. PMC and PATC. B. PMC and P equals ATC. CP equals MC and PATC. DP equals MC and P equals ATC. 6. Pretzel stands in New York City are a perfectly competitive industry in long-run equilibrium. One day, the city starts imposing a $100 per month tax on each stand. How does this policy affect the number of pretzels consumed in the short run and in the long run? A. Down in the short run, no change in the long run. B. Up in the short run, no change in the long run. C. No change in the short run, down in the long run. D. No change in the short run, up in the long run. 298. 7. A firm in a competitive market receives $500 in total revenue and has marginal revenue of $10. What is the average revenue, and how many units were sold? 8. A profit-maximizing firm in a competitive market is currently producing 100 units of output. It has average revenue of $10, average total cost of $8, and fixed costs of $200. A. What is its profit? B. What is its marginal cost? C. What is its average variable cost? D. Is the efficient scale of the firm more than, less than, or exactly 100 units? 9. The market for fertilizer is perfectly competitive. Firms in the market are producing output but are currently incurring economic losses. A. How does the price of fertilizer compare to the average total cost, the average variable cost, and the marginal cost of producing fertilizer? B. Draw two graphs, side by side, illustrating the present situation for the typical firm and for the market. C. Assuming there is no change in either demand or the firm's cost curves, explain what will happen in the long run to the price of fertilizer, marginal cost, average total cost, the quantity supplied by each firm, and the total quantity supplied to the market. 10. The market for apple pies in the city of Actinia is competitive and has the following demand schedule. Price quantity demanded $1 1,200 pies to 1,103 1,000. 4 900. 5 800. 6 700. 7 600. 8 500. 9 400. 10 300. 11 200. 12 100. 13 0. Each producer in the market has fixed costs of $9 and the following marginal cost. Quantity marginal cost 1 pie $2. 2 4. 3 6. 4 8. 5 10. 6 12. A. Compute each producer's total cost and average total cost for 1 to 6 pies. B. The price of a pie is now $11. How many pies are sold? How many pies does each producer make? How many producers are there? How much profit does each producer earn? C. Is the situation described in part a long-run equilibrium? Why or why not? D. Suppose that in the long run there is free entry and exit. How much profit does each producer earn in the long-run equilibrium? What is the market price and number of pies each producer makes? How many pies are sold? How many pie producers are operating? 11. Suppose that the U.S. textile industry is competitive and there is no international trade in textiles. In long-run equilibrium, the price per unit of cloth is $30. A. Describe the equilibrium using graphs for the entire market and for an individual producer. Now suppose that textile producers in other countries are willing to sell large quantities of cloth in the United States for only $25 per unit. B. Assuming that U.S. textile producers have large fixed costs, what is the short-run effect of these imports on the quantity produced by an individual producer? What is the short-run effect on profits? Illustrate your answer with a graph. C. What is the long-run effect on the number of U.S. firms in the industry? 12. An industry currently has 100 firms, each of which has fixed costs of $16 and average variable costs as follows. Quantity average variable cost $1. 2 2. 3 3. 4 4. 5 5. 6 6. A. Compute a firm's marginal cost and average total cost for each quantity from 1 to 6. B. The equilibrium price is currently $10. How much does each firm produce? What is the total quantity supplied in the market? C. In the long run, firms can enter and exit the market, and all entrants have the same costs as above. As this market makes the transition to its long-run equilibrium, will the price rise or fall? Will the quantity demanded rise or fall? Will the quantity supplied by each firm rise or fall? Explain your answers. D. Graph the long-run supply curve for this market, with specific numbers on the axis as relevant. Go to CEngageBrain.com to purchase access to the proven, critical study guide to accompany this text, which features additional notes and context, practice tests, and much more. 299. If you own a personal computer, it probably uses some version of Windows, the operating system sold by the Microsoft Corporation. When Microsoft first designed Windows many years ago, it applied for and received a copyright from the government. The copyright gives Microsoft the exclusive right to make and sell copies of the Windows operating system. If a person wants to buy a copy of Windows, she has little choice but to give Microsoft the approximately $100 that the firm has decided to charge for its product. Microsoft is said to have a monopoly in the market for Windows. Microsoft's business decisions are not well described by the model of firm behavior we developed in the previous chapter. In that chapter, we analyzed competitive markets, in which many firms offer essentially identical products, so each firm has little influence over the price it receives. By contrast, a monopoly such as Microsoft has no close competitors and, therefore, has the Chapter 15. Monopoly. 300. Power to influence the market price of its product. Whereas a competitive firm is a price taker, a monopoly firm is a price maker. In this chapter, we examine the implications of this market power. We will see that market power alters the relationship between a firm's costs and the price at which it sells its product. A competitive firm takes the price of its output as given by the market and then chooses the quantity it will supply so that price equals marginal cost. By contrast, a monopoly charges a price that exceeds marginal cost. This result is clearly true in the case of Microsoft's Windows. The marginal cost of Windows, the extra cost that Microsoft incurs by printing one more copy of the program onto a CD, is only a few dollars. The market price of Windows is many times its marginal cost. It is not surprising that monopolies charge high prices for their products. Customers of monopolies might seem to have little choice but to pay whatever the monopoly charges. But if so, why does a copy of Windows not cost $1,000? Or $10,000? The reason is that if Microsoft were to set the price that high, fewer people would buy the product. People would buy fewer computers, switch to other operating systems, or make illegal copies. A monopoly firm can control the price of the good it sells, but because a high price reduces the quantity that its customers buy, the monopoly's profits are not unlimited. As we examine the production and pricing decisions of monopolies, we also consider the implications of monopoly for society as a whole. Monopoly firms, like competitive firms, aim to maximize profit. But this goal has very different ramifications for competitive and monopoly firms. In competitive markets, self-interested consumers and producers reach an equilibrium that promotes general economic well-being, as if guided by an invisible hand. By contrast, because monopoly firms are unchecked by competition, the outcome in a market with a monopoly is often not in the best interest of society. One of the 10 principles of economics in Chapter 1 is that governments can sometimes improve market outcomes. The analysis in this chapter sheds more light on this principle. As we examine the problems that monopolies raise for society, we discuss the various ways in which government policymakers might respond to these problems. The U.S. government, for example, keeps a close eye on Microsoft's business decisions. In 1994, it blocked Microsoft from buying Intuit, a leading seller of personal finance software, on the grounds that combining the two firms would concentrate too much market power. Similarly, in 1998, the U.S. Department of Justice objected when Microsoft started integrating its Internet browser into its Windows operating system, claiming that this addition would extend the firm's market power into new areas. In recent years, regulators in the United States and abroad have shifted their focus to firms with growing market power, such as Google and Samsung, but they also continue to monitor Microsoft's compliance with the antitrust laws. Monopoly: a firm that is the sole seller of a product without close substitutes. 15:1 Why monopolies arise. A firm is a monopoly if it is the sole seller of its product and if its product does not have close substitutes. The fundamental cause of monopoly is barriers to entry. A monopoly remains the only seller in its market because other firms cannot enter the market and compete with it. Barriers to entry, in turn, have three main sources. Monopoly resources: a key resource required for production is owned by a single firm. Chapter 15 Monopoly 301. Government regulation: the government gives a single firm the exclusive right to produce some good or service. The production process: a single firm can produce output at a lower cost than can a larger number of firms. Let's briefly discuss each of these. 15-1 A monopoly resources: the simplest way for a monopoly to arise is for a single firm to own a key resource. For example, consider the market for water in a small town in the Old West. If dozens of town residents have working wells, the competitive model discussed in the preceding chapter describes the behavior of sellers. As a result of the competition among water suppliers, the price of a gallon is driven to equal the marginal cost of pumping an extra gallon. But if there is only one well in town and it is impossible to get water from anywhere else, then the owner of the well has a monopoly on water. Not surprisingly, the monopolist has much greater market power than any single firm in a competitive market. In the case of a necessity like water, the monopolist can command quite a high price, even if the marginal cost of pumping an extra gallon is low. A classic example of market power arising from the ownership of a key resource is De Beers, the South African diamond company. Founded in 1888 by Cecil Rhodes, an English businessman, De Beers has at times controlled up to 80% of the production from the world's diamond mines. Because its market share is less than 100%, De Beers is not exactly a monopoly, but the company has nonetheless exerted substantial influence over the market price of diamonds. Although exclusive ownership of a key resource is a potential cause of monopoly, in practice monopolies rarely arise for this reason. Economies are large, and resources are owned by many people. Indeed, because many goods are traded internationally, the natural scope of their markets is often worldwide. There are, therefore, few examples of firms that own a resource for which there are no close substitutes. 15-1b Government-created monopolies: in many cases, monopolies arise because the government has given one person or firm the exclusive right to sell some good or service. Sometimes the monopoly arises from the sheer political clout of the would-be monopolist. Kings, for example, once granted exclusive business licenses to their friends and allies. At other times, the government grants a monopoly because doing so is viewed to be in the public interest. The patent and copyright laws are two important examples. When a pharmaceutical company discovers a new drug, it can apply to the government for a patent. If the government deems the drug to be truly original, it approves the patent, which gives the company the exclusive right to manufacture and sell the drug for 20 years. Similarly, when a novelist finishes a book, she can copyright it. The copyright is a government guarantee that no one can print and sell the work without the author's permission. The copyright makes the novelist a monopolist in the sale of her novel. The effects of patent and copyright laws are easy to see. Because these laws give one producer a monopoly, they lead to higher prices than would occur under competition. But by allowing these monopoly producers to charge higher prices and earn higher profits, the laws also encourage some desirable behavior. Drug companies are allowed to be monopolists in the drugs they discover to encourage research. Authors are allowed to be monopolists in the sale of their books to encourage them to write more and better books. Thus, the laws governing patents and copyrights have benefits and costs. The benefits of the patent and copyright laws are the increased incentives for creative activity. These benefits are offset, to some extent, by the costs of monopoly pricing, which we examine fully later in this chapter. 15-1c Natural monopolies. An industry is a natural monopoly when a single firm can supply a good or service to an entire market at a lower cost than could two or more firms. A natural monopoly arises when there are economies of scale over the relevant range of output. Figure 1 shows the average total costs of a firm with economies of scale. In this case, a single firm can produce any amount of output at the least cost. That is, for any given amount of output, a larger number of firms leads to less output per firm and higher average total cost. An example of a natural monopoly is the distribution of water. To provide water to residents of a town, a firm must build a network of pipes throughout the town. If two or more firms were to compete in the provision of this service, each firm would have to pay the fixed cost of building a network. Thus, the average total cost of water is lowest if a single firm serves the entire market. We saw other examples of natural monopolies when we discussed public goods and common resources in Chapter 11. We noted that club goods are excludable but not rival in consumption. An example is a bridge used so infrequently that it is never congested. The bridge is excludable because a toll collector can prevent someone from using it. The bridge is not rival in consumption because use of the bridge by one person does not diminish the ability of others to use it. Because there is a large fixed cost of building the bridge and a negligible marginal cost of additional users, the average total cost of a trip across the bridge falls as the number of trips rises. Hence, the bridge is a natural monopoly. When a firm is a natural monopoly, it is less concerned about new entrants eroding its monopoly power. Normally, a firm has trouble maintaining a monopoly. Natural monopoly: a monopoly that arises because a single firm can supply a good or service to an entire market at a smaller cost than could two or more firms. Position without ownership of a key resource or protection from the government. The monopolist's profit attracts entrants into the market, and these entrants make the market more competitive. By contrast, entering a market in which another firm has a natural monopoly is unattractive. Would-be entrants know that they cannot achieve the same low costs that the monopolist enjoys because, after entry, each firm would have a smaller piece of the market. In some cases, the size of the market is one determinant of whether an industry is a natural monopoly. Again, consider a bridge across a river. When the population is small, the bridge may be a natural monopoly. A single bridge can satisfy the entire demand for trips across the river at lowest cost. Yet as the population grows and the bridge becomes congested, satisfying the entire demand may require two or more bridges across the same river. Thus, as a market expands, a natural monopoly can evolve into a more competitive market. Quick quiz: what are the 3 reasons that a market might have a monopoly? Give 2 examples of monopolies and explain the reason for each. 15-2 How monopolies make production and pricing decisions. Now that we know how monopolies arise, we can consider how a monopoly firm decides how much of its product to make and what price to charge for it. The analysis of monopoly behavior in this section is the starting point for evaluating whether monopolies are desirable and what policies the government might pursue in monopoly markets. 15-2 A monopoly versus competition. The key difference between a competitive firm and a monopoly is the monopoly's ability to influence the price of its output. A competitive firm is small relative to the market in which it operates and, therefore, has no power to influence the price of its output. It takes the price as given by market conditions. By contrast, because a monopoly is the sole producer in its market, it can alter the price of its good by adjusting the quantity it supplies to the market. One way to view this difference between a competitive firm and a monopoly is to consider the demand curve that each firm faces. When we analyzed profit maximization by competitive firms in the preceding chapter, we drew the market price as a horizontal line. Because a competitive firm can sell as much or as little as it wants at this price, the competitive firm faces a horizontal demand curve, as in panel of figure 2. In effect, because the competitive firm sells a product with many perfect substitutes, the demand curve that any one firm faces is perfectly elastic. By contrast, because a monopoly is the sole producer in its market, its demand curve is the market demand curve. Thus, the monopolist's demand curve slopes downward for all the usual reasons, as in panel of figure 2. If the monopolist raises the price of its good, consumers buy less of it. Looked at another way, if the monopolist reduces the quantity of output it produces and sells, the price of its output increases. The market demand curve provides a constraint on a monopoly's ability to profit from its market power. A monopolist would prefer, if it were possible, to charge a high price and sell a large quantity at that high price. The market demand 304 curve makes that outcome impossible. In particular, the market demand curve describes the combinations of price and quantity that are available to a monopoly firm. By adjusting the quantity produced, the monopolist can choose any point on the demand curve, but it cannot choose a point off the demand curve. What price and quantity of output will the monopolist choose? As with competitive firms, we assume that the monopolist's goal is to maximize profit. Because the firm's profit is total revenue minus total costs, our next task in explaining monopoly behavior is to examine a monopolist's revenue. 15-2b A monopoly's revenue. Consider a town with a single producer of water. Table 1 shows how the monopoly's revenue might depend on the amount of water produced. The first two columns show the monopolist's demand schedule. If the monopolist produces 1 gallon of water, it can sell that gallon for $10. If it produces 2 gallons, it must lower the price to $9 to sell both gallons. If it produces 3 gallons, it must lower the price to $8. And so on. If you graphed these two columns of numbers, you would get a typical downward sloping demand curve. The third column of the table presents the monopolist's total revenue. It equals the quantity sold times the price. The fourth column computes the firm's average revenue, the amount of revenue the firm receives per unit sold. We compute average revenue by taking the number for total revenue in the third column and dividing it by the quantity of output in the first column. As we discussed in the previous chapter, average revenue always equals the price of the good. This is true for monopolists as well as for competitive firms. The last column of Table 1 computes the firm's marginal revenue, the amount of revenue that the firm receives for each additional unit of output. We compute marginal revenue by taking the change in total revenue when output increases by 1 unit. For example, when the firm is producing 3 gallons of water, it receives total revenue of $24. Raising production to 4 gallons increases total revenue to $28. Thus, marginal revenue from the sale of the 4th gallon is $28 minus $24, or $4. Table 1 shows a result that is important for understanding monopoly behavior. A monopolist's marginal revenue is always less than the price of its good. For example, if the firm raises production of water from 3 to 4 gallons, it will increase total revenue by only $4, even though it will be able to sell each gallon for $7. For a monopoly, marginal revenue is lower than price because a monopoly faces a downward sloping demand curve. To increase the amount sold, a monopoly firm must lower the price it charges to all customers. Hence, to sell the 4th gallon of water, the monopolist will get $1 less revenue for each of the first 3 gallons. This $3 loss accounts for the difference between the price of the 4th gallon and the marginal revenue of that 4th gallon. Marginal revenue for monopolies is very different from marginal revenue for competitive firms. When a monopoly increases the amount it sells, this action has two effects on total revenue. The output effect: more output is sold, so Q is higher, which tends to increase total revenue. The price effect: the price falls, so P is lower, which tends to decrease total revenue. Because a competitive firm can sell all it wants at the market price, there is no price effect. When it increases production by 1 unit, it receives the market price for that unit, and it does not receive any less for the units it was already selling. That is, because the competitive firm is a price taker, its marginal revenue equals the price of its good. By contrast, when a monopoly increases production by 1 unit, it must reduce the price it charges for every unit it sells, and this cut in price reduces revenue on the units it was already selling. As a result, a monopoly's marginal revenue is less than its price. Figure 3 graphs the demand curve and the marginal revenue curve for a monopoly firm. These two curves always start at the same point on the vertical axis because the marginal revenue of the first unit sold equals the price of the good. But for the reason we just discussed, the monopolist's marginal revenue on all units after the first is less than the price of the good. Thus, a monopoly's marginal revenue curve lies below its demand curve. You can see in figure 3 that marginal revenue can even become negative. Marginal revenue is negative when the price effect on revenue is greater than the output effect. In this case, when the firm produces an extra unit of output, the price falls by enough to cause the firm's total revenue to decline, even though the firm is selling more units. 15-2C Profit maximization. Now that we have considered the revenue of a monopoly firm, we are ready to examine how such a firm maximizes profit. Recall from Chapter 1 that one of the 10 principles of economics is that rational people think at the margin. This lesson is as true for monopolists as it is for competitive firms. Here we apply the logic of marginal analysis to the monopolist's decision about how much to produce. Figure 4 graphs the demand curve, the marginal revenue curve, and the cost curves for a monopoly firm. All these curves should seem familiar. The demand and marginal revenue curves are like those in Figure 3, and the cost curves are like those we encountered in the last two chapters. These curves contain all the information we need to determine the level of output that a profit-maximizing monopolist will choose. Suppose, first, that the firm is producing at a low level of output, such as Q1. In this case, marginal cost is less than marginal revenue. If the firm increased production by 1 unit, the additional revenue would exceed the additional costs, and profit would rise. Thus, when marginal cost is less than marginal revenue, the firm can increase profit by producing more units. A similar argument applies at high levels of output, such as Q2. In this case, marginal cost is greater than marginal revenue. If the firm reduced production by 1 unit, the cost saved would exceed the revenue lost. Thus, if marginal cost is greater than marginal revenue, the firm can raise profit by reducing production. In the end, the firm adjusts its level of production until the quantity reaches Qmax, at which marginal revenue equals marginal cost. Thus, the monopolist's profit-maximizing quantity of output is determined by the intersection of the marginal revenue curve and the marginal cost curve. In Figure 4, this intersection occurs at point A. You might recall from the previous chapter that competitive firms also choose the quantity of output at which marginal revenue equals marginal cost. In following this rule for profit maximization, competitive firms and monopolies are alike. But there is also an important difference between these types of firms. The marginal revenue of a competitive firm equals its price, whereas the marginal revenue of a monopoly is less than its price. That is, for a competitive firm, P equals MR equals MC. For a monopoly firm, PMR equals MC. The equality of marginal revenue and marginal cost determines the profit maximizing quantity for both types of firm. What differs is how the price is related to marginal revenue and marginal cost. How does the monopoly find the profit maximizing price for its product? The demand curve answers this question because the demand curve relates the amount that customers are willing to pay to the quantity sold. Thus, after the monopoly firm chooses the quantity of output that equates marginal revenue and marginal cost, it uses the demand curve to find the highest price it can charge for that quantity. In Figure 4, the profit maximizing price is found at point B. We can now see a key difference between markets with competitive firms and markets with a monopoly firm. In competitive markets, price equals marginal cost. In monopolized markets, price exceeds marginal cost. As we will see in a moment, this finding is crucial to understanding the social cost of monopoly. 15-2D A monopoly's profit. How much profit does a monopoly make? To see a monopoly firm's profit in a graph, recall that profit equals total revenue minus total costs. Profit equals TRTC. We can rewrite this as profit equals times Q. TR/Q is average revenue, which equals the price, P, and TC/Q is average total cost, ATC. Therefore, profit equals times Q. This equation for profit allows us to measure the monopolist's profit in our graph. Consider the shaded box in figure 5. The height of the box is price minus average total cost, PATC, which is the profit on the typical unit. Why a monopoly does not have a supply curve. You may have noticed that we have analyzed the price in a monopoly market using the market demand curve and the firm's cost curves. We have not made any mention of the market supply curve. By contrast, when we analyzed prices in competitive markets beginning in Chapter 4, the two most important words were always supply and demand. What happened to the supply curve? Although monopoly firms make decisions about what quantity to supply, a monopoly does not have a supply curve. A supply curve tells us the quantity that firms choose to supply at any given price. This concept makes sense when we are analyzing competitive firms, which are price takers. But a monopoly firm is a price maker, not a price taker. It is not meaningful to ask what amount such a firm would produce at any price because the firm sets the price at the same time as it chooses the quantity to supply. Indeed, the monopolist's decision about how much to supply is impossible to separate from the demand curve it faces. The shape of the demand curve determines the shape of the marginal revenue curve, which in turn determines the monopolist's profit maximizing quantity. In a competitive market, supply decisions can be analyzed without knowing the demand curve, but that is not true in a monopoly market. Therefore, we never talk about a monopoly's supply curve. Monopoly drugs versus generic drugs. According to our analysis, prices are determined differently in monopolized markets and competitive markets. A natural place to test this theory is the market for pharmaceutical drugs because this market takes on both market structures. When a firm discovers a new drug, patent laws give the firm a monopoly on the sale of that drug. But eventually, the firm's patent runs out, and any company can make and sell the drug. At that time, the market switches from being monopolistic to being competitive. What should happen to the price of a drug when the patent runs out? Figure 6 shows the market for a typical drug. In this figure, the marginal cost of producing the drug is constant. During the life of the patent, the monopoly firm maximizes profit by producing the quantity at which marginal revenue equals marginal cost and charging a price well above marginal cost. But when the patent runs out, the profit from making the drug should encourage new firms to enter the market. As the market becomes more competitive, the price should fall to equal marginal cost. Experience is, in fact, consistent with our theory. When the patent on a drug expires, other companies quickly enter and begin selling so-called generic products that are chemically identical to the former monopolist's brand name product. And just as our analysis predicts, the price of the competitively produced generic drug is well below the price that the monopolist was charging. The expiration of a patent, however, does not cause the monopolist to lose all its market power. Some consumers remain loyal to the brand name drug, perhaps out of fear that the new generic drugs are not actually the same as the drug they have been using for years. As a result, the former monopolist can continue to charge a price above the price charged by its new competitors. For example, one of the most widely used antidepressants is the drug fluoxetine, which is taken by millions of Americans. Because the patent on this drug expired in 2001, a consumer today has the choice between the original drug, sold under the brand name Prozac, and a generic version of the same medicine. Prozac sells for about 3 times the price of generic fluoxetine. This price differential can persist because some consumers are not convinced that the two pills are perfect substitutes. Quick quiz: explain how a monopolist chooses the quantity of output to produce and the price to charge. Is monopoly a good way to organize a market? We have seen that a monopoly, in contrast to a competitive firm, charges a price above marginal cost. From the standpoint of consumers, This high price makes monopoly undesirable. At the same time, however, the monopoly is earning profit from charging this high price. From the standpoint of the owners of the firm, the high price makes monopoly very desirable. Is it possible that the benefits to the firm's owners exceed the costs imposed on consumers, making monopoly desirable from the standpoint of society as a whole? We can answer this question using the tools of welfare economics. Recall from Chapter 7 that total surplus measures the economic well-being of buyers and sellers in a market. Total surplus is the sum of consumer surplus and producer surplus. Consumer surplus is consumers' willingness to pay for a good minus the amount they actually pay for it. Producer surplus is the amount producers receive for a good minus their costs of producing it. In this case, there is a single producer, the monopolist. You can probably guess the result of this analysis. In Chapter 7, we concluded that the equilibrium of supply and demand in a competitive market is not only a natural outcome but also a desirable one. The invisible hand of the market leads to an allocation of resources that makes total surplus as large as it can be. Because a monopoly leads to an allocation of resources different from that in a competitive market, the outcome must, in some way, fail to maximize total economic well-being. 15-3 of the deadweight loss. We begin by considering what the monopoly firm would do if it were run by a benevolent social planner. The social planner cares not only about the profit earned by the firm's owners but also about the benefits received by the firm's consumers. The planner tries to maximize total surplus, which equals producer surplus plus consumer surplus. Keep in mind that total surplus equals the value of the good to consumers minus the costs of making the good incurred by the monopoly producer. Figure 7 analyzes how a benevolent social planner would choose the monopoly's level of output. The demand curve reflects the value of the good to consumers, as measured by their willingness to pay for it. The marginal cost curve reflects the costs of the monopolist. Thus, the socially efficient quantity is found where the demand curve and the marginal cost curve intersect. Below this quantity, the value of an extra unit to consumers exceeds the cost of providing it, so increasing output would raise total surplus. Above this quantity, the cost of producing an extra unit exceeds the value of that unit to consumers, so decreasing output would raise total surplus. At the optimal quantity, the value of an extra unit to consumers exactly equals the marginal cost of production. If the social planner were running the monopoly, the firm could achieve this efficient outcome by charging the price found at the intersection of the demand and marginal cost curves. Thus, like a competitive firm and unlike a profit-maximizing monopoly, a social planner would charge a price equal to marginal cost. Because this price would give consumers an accurate signal about the cost of producing the good, consumers would buy the efficient quantity. We can evaluate the welfare effects of monopoly by comparing the level of output that the monopolist chooses to the level of output that a social planner would choose. As we have seen, the monopolist chooses to produce and sell the quantity of output at which the marginal revenue and marginal cost curves intersect. The social planner would choose the quantity at which the demand and marginal cost curves intersect. Figure 8 shows the comparison. The monopolist produces less than the socially efficient quantity of output. We can also view the inefficiency of monopoly in terms of the monopolist's price. Because the market demand curve describes a negative relationship between the price and quantity of the good, a quantity that is inefficiently low is equivalent to a price that is inefficiently high. When a monopolist charges a price above marginal cost, some potential consumers value the good at more than its marginal cost but less than the monopolist's price. These consumers do not buy the good. Because the value these consumers place on the good is greater than the cost of providing it to them, this result is inefficient. Thus, monopoly pricing prevents some mutually beneficial trades from taking place. The inefficiency of monopoly can be measured with a deadweight loss triangle, as illustrated in Figure 8. Because the demand curve reflects the value to consumers and the marginal cost curve reflects the costs to the monopoly producer. The area of the deadweight loss triangle between the demand curve and the marginal cost curve equals the total surplus lost because of monopoly pricing. It is the reduction in economic well-being that results from the monopoly's use of its market power. The deadweight loss caused by monopoly is similar to the deadweight loss caused by a tax. Indeed, a monopolist is like a private tax collector. As we saw in Chapter 8, a tax on a good places a wedge between consumers' willingness to pay and producers' costs. Because a monopoly exerts its market power by charging a price above marginal cost, it creates a similar wedge. In both cases, the wedge causes the quantity sold to fall short of the social optimum. The difference between the two cases is that the government gets the revenue from a tax, whereas a private firm gets the monopoly profit. 15-3b The monopoly's profit, a social cost? It is tempting to decry monopolies for profiteering at the expense of the public. And indeed, a monopoly firm does earn a profit by virtue of its market power. According to the economic analysis of monopoly, however, the firm's profit is not in itself necessarily a problem for society. Welfare in a monopolized market, like all markets, includes the welfare of both consumers and producers. Whenever a consumer pays an extra dollar to a producer because of a monopoly price, the consumer is worse off by $1 and the producer is better off by the same amount. This transfer from the consumers of the good to the owners of the monopoly does not affect the market's total surplus, the sum of consumer and producer surplus. In other words, the monopoly profit itself represents not a reduction in the size of the economic pie but merely a bigger slice for producers and a smaller slice for consumers. Unless consumers are for some reason more deserving than producers, a normative judgment about equity that goes beyond the realm of economic efficiency, the monopoly profit is not a social problem. The problem in a monopolized market arises because the firm produces and sells a quantity of output below the level that maximizes total surplus. The deadweight loss measures how much the economic pie shrinks as a result. This inefficiency is connected to the monopoly's high price. Consumers buy fewer units when the firm raises its price above marginal cost. But keep in mind that the profit earned on the units that continue to be sold is not the problem. The problem stems from the inefficiently low quantity of output. Put differently, if the high monopoly price did not discourage some consumers from buying the good, it would raise producer surplus by exactly the amount it reduced consumer surplus, leaving total surplus the same as could be achieved by a benevolent social planner. There is, however, a possible exception to this conclusion. Suppose that a monopoly firm has to incur additional costs to maintain its monopoly position. For example, a firm with a government-created monopoly might need to hire lobbyists to convince lawmakers to continue its monopoly. In this case, the monopoly may use up some of its monopoly profits paying for these additional costs. If so, the social loss from monopoly includes both these costs and the deadweight loss resulting from reduced output. Quick quiz: how does a monopolist's quantity of output compare to the quantity of output that maximizes total surplus? How does this difference relate to the concept of deadweight loss? So far, we have been assuming that the monopoly firm charges the same price to all customers. Yet in many cases, firms sell the same good to different customers for different prices, even though the costs of producing for the two customers are the same. This practice is called price discrimination. Before discussing the behavior of a price discriminating monopolist, we should note that price discrimination is not possible when a good is sold in a competitive market. In a competitive market, many firms are selling the same good at the market price. No firm is willing to charge a lower price to any customer because the firm can sell all it wants at the market price. And if any firm tried to charge a higher price to a customer, that customer would buy from another firm. For a firm to price discriminate, it must have some market power. 15-4a parable about pricing. To understand why a monopolist would price discriminate, let's consider an example. Imagine that you are the president of Read-A-Lot Publishing Company. Read-A-Lot's best-selling author has just written a new novel. To keep things simple, let's imagine that you pay the author a flat $2 million for the exclusive rights to publish the book. Let's also assume that the cost of printing the book is zero. Read-A-Lot's profit, therefore, is the revenue from selling the book minus the $2 million it has paid to the author. Given these assumptions, how would you, as Read-A-Lot's president, decide the book's price? Your first step is to estimate the demand for the book. Read-A-Lot's marketing department tells you that the book will attract two types of readers. The book will appeal to the author's 100,000 die-hard fans who are willing to pay as much as $30. In addition, the book will appeal to about 400,000 less enthusiastic readers who will pay up to $5. If Read-A-Lot charges a single price to all customers, what price maximizes profit? There are two natural prices to consider. $30 is the highest price Read-A-Lot can charge and still get the 100,000 die-hard fans, and $5 is the highest price it can charge and still get the entire market of 500,000 potential readers. Solving Read-A-Lot's problem is a matter of simple arithmetic. At a price of $30, Read-A-Lot sells 100,000 copies, has revenue of $3 million, and makes profit of $1 million. At a price of $5, it sells 500,000 copies, has revenue of $2.5 million, and makes profit of $500,000. Thus, Read-A-Lot maximizes profit by charging $30 and foregoing the opportunity to sell to the 400,000 less enthusiastic readers. Notice that Read-A-Lot's decision causes a deadweight loss. There are 400,000 readers willing to pay $5 for the book, and the marginal cost of providing it to them is zero. Thus, $2 million of total surplus is lost when Read-A-Lot charges the higher price. This deadweight loss is the inefficiency that arises whenever a monopolist charges a price above marginal cost. Now suppose that Read-A-Lot's marketing department makes a discovery: these two groups of readers are in separate markets. The die-hard fans live in Australia, and the other readers live in the United States. Moreover, it is hard for readers in one country to buy books in the other. In response to this discovery, Read-A-Lot can change its marketing strategy and increase profits. To the 100,000 Australian readers, it can charge $30 for the book. To the 400,000 American readers, it can charge $5 for the book. In this case, revenue is $3 million in Australia and $2 million in the United States, for a total of $5 million. Profit is then $3 million, which is substantially greater than the $1 million the company could earn charging the same $30 price to all customers. Not surprisingly, Read-A-Lot chooses to follow the strategy of price discrimination. The story of Read-A-Lot publishing is hypothetical, but it describes accurately the business practice of many publishing companies. Textbooks, for example, are often sold at a lower price in Europe than in the United States. Even more important is the price differential between hardcover books and paperbacks. When a publisher has a new novel, it initially releases an expensive hardcover edition and later releases a cheaper paperback edition. The difference in price between these two editions far exceeds the difference in printing costs. The publisher's goal is just as in our example. By selling the hardcover to die-hard fans and the paperback to less enthusiastic readers, the publisher price discriminates and raises its profit. 15-4b The moral of the story: like any parable, the story of Read-A-Lot publishing is stylized. Yet also, like any parable, it teaches some general lessons. In this case, 3 lessons can be learned about price discrimination. The first and most obvious lesson is that price discrimination is a rational strategy for a profit-maximizing monopolist. That is, by charging different prices to different customers, a monopolist can increase its profit. In essence, a price-discriminating monopolist charges each customer a price closer to her willingness to pay than is possible with a single price. The second lesson is that price discrimination requires the ability to separate customers according to their willingness to pay. In our example, customers were separated geographically. But sometimes monopolists choose other differences, such as age or income, to distinguish among customers. A corollary to this second lesson is that certain market forces can prevent firms from price discriminating. In particular, one such force is arbitrage, the process of buying a good in one market at a low price and selling it in another market at a higher price to profit from the price difference. In our example, if Australian bookstores could buy the book in the United States and resell it to Australian readers, the arbitrage would prevent Read-A-Lot from price discriminating, because no Australian would buy the book at the higher price. The third lesson from our parable is the most surprising: price discrimination can raise economic welfare. Recall that a deadweight loss arises when Read-A-Lot charges a single $30 price because the 400,000 less enthusiastic readers do not end up with the book, even though they value it at more than its marginal cost of production. By contrast, when Read-A-Lot price discriminates, all readers get the book, and the outcome is efficient. Thus, price discrimination can eliminate the inefficiency inherent in monopoly pricing. Note that in this example the increase in welfare from price discrimination shows up as higher producer surplus rather than higher consumer surplus. Consumers are no better off for having bought the book; the price they pay exactly equals the value they place on the book, so they receive no consumer surplus. The entire increase in total surplus from price discrimination accrues to Read-A-Lot Publishing in the form of higher profit. 15-4 The analytics of price discrimination. Let's consider a bit more formally how price discrimination affects economic welfare. We begin by assuming that the monopolist can price discriminate perfectly. Perfect price discrimination describes a situation in which the monopolist knows 316 exactly each customer's willingness to pay and can charge each customer a different price. In this case, the monopolist charges each customer exactly her willingness to pay, and the monopolist gets the entire surplus in every transaction. Figure 9 illustrates producer and consumer surplus with and without price discrimination. To keep things simple, this figure is drawn assuming constant per unit costs, that is, marginal cost and average total cost are constant and equal. Without price discrimination, the firm charges a single price above marginal cost, as shown in panel. Because some potential customers who value the good at more than marginal cost do not buy it at this high price, the monopoly causes a deadweight loss. Yet when a firm can perfectly price discriminate, as shown in panel, each customer who values the good at more than marginal cost buys the good and is charged her willingness to pay. All mutually beneficial trades take place, no deadweight loss occurs, and the entire surplus derived from the market goes to the monopoly producer in the form of profit. In reality, of course, price discrimination is not perfect. Customers do not walk into stores with signs displaying their willingness to pay. Instead, firms price discriminate by dividing customers into groups: young versus old, weekday versus weekend shoppers, Americans versus Australians, and so on. Unlike those in our parable of Read-A-Lot Publishing, customers within each group differ in their willingness to pay for the product, making perfect price discrimination impossible. How does this imperfect price discrimination affect welfare? The analysis of these pricing schemes is complicated, and it turns out that there is no general. Figure 9 panel shows a monopoly that charges the same price to all customers. Total surplus in this market equals the sum of profit and consumer surplus. Panel shows a monopoly that can perfectly price discriminate. Because consumer surplus equals 0, total surplus now equals the firm's profit. Comparing these two panels, you can see that perfect price discrimination raises profit, raises total surplus, and lowers consumer surplus. Answer to this question. Compared to the monopoly outcome with a single price, imperfect price discrimination can raise, lower, or leave unchanged total surplus in a market. The only certain conclusion is that price discrimination raises the monopoly's profit; otherwise, the firm would choose to charge all customers the same price. 15-4 Examples of price discrimination. Firms in our economy use various business strategies aimed at charging different prices to different customers. Now that we understand the economics of price discrimination, let's consider some examples. Movie tickets. Many movie theaters charge a lower price for children and senior citizens than for other patrons. This fact is hard to explain in a competitive market. In a competitive market, price equals marginal cost, and the marginal cost of providing a seat for a child or senior citizen is the same as the marginal cost of providing a seat for anyone else. Yet the differential pricing is easily explained if movie theaters have some local monopoly power and if children and senior citizens have a lower willingness to pay for a ticket. In this case, movie theaters raise their profit by price discriminating. Airline prices: seats on airplanes are sold at many different prices. Most airlines charge a lower price for a round-trip ticket between two cities if the traveler stays over a Saturday night. At first, this seems odd. Why should it matter to the airline whether a passenger stays over a Saturday night? The reason is that this rule provides a way to separate business travelers and leisure travelers. A passenger on a business trip has a high willingness to pay and, most likely, does not want to stay over a Saturday night. By contrast, a passenger traveling for personal reasons has a lower willingness to pay and is more likely to be willing to stay over a Saturday night. Thus, the airlines can successfully price discriminate by charging a lower price for passengers who stay over a Saturday night. Discount coupons: many companies offer discount coupons to the public in newspapers, magazines, or online. A buyer simply has to clip the coupon to get 50 cents off her next purchase. Why do companies offer these coupons? Why don't they just cut the price of the product by 50 cents? The answer is that coupons allow companies to price discriminate. Companies know that not all customers are willing to spend time clipping coupons. Moreover, the willingness to clip coupons is related to the customer's willingness to pay for the good. A rich and busy executive is unlikely to spend her time clipping discount coupons out of the newspaper, and she is probably willing to pay a higher price for many goods. A person who is unemployed is more likely to clip coupons and to have a lower willingness to pay. Thus, by charging a lower price only to those customers who clip coupons, firms can successfully price discriminate. Financial aid: many colleges and universities give financial aid to needy students. One can view this policy as a type of price discrimination. Wealthy students have greater financial resources and, therefore, a higher willingness to pay than needy students. By charging high tuition and selectively offering financial aid, schools in effect charge prices to customers based on the value they place on going to that school. This behavior is similar to that of any price discriminating monopolist. Quantity discounts: so far in our examples of price discrimination, the monopolist charges different prices to different customers. Sometimes, however, monopolists price discriminate by charging different prices to the same customer for different units that the customer buys. For example, many firms offer lower prices to customers who buy large quantities. A bakery might charge 50 cents for each donut but $5 for a dozen. This is a form of price discrimination because the customer pays a higher price for the first unit bought than for the 12th. Quantity discounts are often a successful way of price discriminating because a customer's willingness to pay for an additional unit declines as the customer buys more units. Misconceptions 101. Why college costs aren't soaring? By Evan Soltis. Conventional wisdom suggests that U.S. colleges and universities have become sharply more expensive in recent years. When kids do graduate, the most daunting challenge can be the cost of college, President Barack Obama said in his 2012 State of the Union address. We can't just keep subsidizing skyrocketing tuition, we'll run out of money. At first, the view that the cost of college is rising appears to have data on its side. Published tuition prices and fees at colleges have risen 3 times faster than the rate of consumer price index inflation since 1978, according to the Bureau of Labor Statistics. Real tuition and fees have increased, to be sure, but hardly as significantly as the media often report or the data suggest at face value. The inflation-adjusted net price of college has risen only modestly over the last 2 decades, according to data from the College Board's annual survey of colleges. What has happened is a shift toward price discrimination, offering multiple prices for the same product. Universities have offset the increase in sticker price for most families through an expansion of grant-based financial aid and scholarships. That has caused the BLS measure to rise without increasing the net cost. Wealthier families now pay more than ever to send their children to college. But for much of the middle class, the real net cost of college has not changed significantly. For much of the poor, the expansion of aid has increased the accessibility and affordability of a college education. The nation's most selective institutions are leading the trend toward income-based price discrimination. For example, at Harvard University, the majority of students receive financial aid. In 2012, 1 year of undergraduate education had a sticker price of $54,496 and came with an average grant of roughly $41,000. In other words, the cost burden of college has become significantly more progressive since the 1990s. Students from wealthier families not only now pay more for their own educations but also have come to heavily subsidize the costs of the less fortunate. Colleges and universities are increasingly charging different prices to different students, which makes data on the cost of education harder to interpret. 15-5 Public policy toward monopolies. We have seen that monopolies, in contrast to competitive markets, fail to allocate resources efficiently. Monopolies produce less than the socially desirable quantity of output and charge prices above marginal cost. Policymakers in the government can respond to the problem of monopoly in one of four ways. By trying to make monopolized industries more competitive. By regulating the behavior of the monopolies. By turning some private monopolies into public enterprises. By doing nothing at all. 15-5 Increasing competition with antitrust laws. If Coca-Cola and PepsiCo wanted to merge, the deal would be closely examined by the federal government before it went into effect. The lawyers and economists in the Department of Justice might well decide that a merger between these two large soft drink companies would make the U.S. soft drink market substantially less competitive and, as a result, would reduce the economic well-being of the country as a whole. If so, the Department of Justice would challenge the merger in court, and if the judge agreed, the two companies would not be allowed to merge. It is precisely this kind of challenge that prevented software giant Microsoft from buying Intuit in 1994. The government derives this power over private industry from the antitrust laws, a collection of statutes aimed at curbing monopoly power. The first and most important of these laws was the Sherman Antitrust Act, which Congress passed in 1890 to reduce the market power of the large and powerful trusts that were viewed as dominating the economy at the time. The Clayton Antitrust Act, passed in 1914, strengthened the government's powers and authorized private lawsuits. As the U.S. Supreme Court once put it, the antitrust laws are a comprehensive charter of economic liberty aimed at preserving free and unfettered competition as the rule of trade. The antitrust laws give the government various ways to promote competition. They allow the government to prevent mergers, such as our hypothetical merger between Coca-Cola and PepsiCo. They also allow the government to break up companies. For example, in 1984, the government split up AT&T, the large telecommunications company, into 8 smaller companies. Finally, the antitrust laws prevent companies from coordinating their activities in ways that make markets less competitive. Antitrust laws have costs as well as benefits. Sometimes companies merge not to reduce competition but to lower costs through more efficient joint production. These benefits from mergers are sometimes called synergies. For example, many U.S. banks have merged in recent years and, by combining operations, have been able to reduce administrative staff. If antitrust laws are to raise social welfare, the government must be able to determine which mergers are desirable and which are not. That is, it must be able to measure and compare the social benefit from synergies with the social costs of reduced competition. Critics of the antitrust laws are skeptical that the government can perform the necessary cost-benefit analysis with sufficient accuracy. 15-5B Regulation. Another way the government deals with the problem of monopoly is by regulating the behavior of monopolists. This solution is common in the case of natural. But if we do merge with amalgamated, we'll have enough resources to fight the antitrust violation caused by the merger. ScienceCartoonsPlus.com. 320. Monopolies, such as water and electric companies. These companies are not allowed to charge any price they want. Instead, government agencies regulate their prices. What price should the government set for a natural monopoly? This question is not as easy as it might at first appear. One might conclude that the price should equal the monopolist's marginal cost. If price equals marginal cost, customers will buy the quantity of the monopolist's output that maximizes total surplus and the allocation of resources will be efficient. There are, however, two practical problems with marginal cost pricing as a regulatory system. The first arises from the logic of cost curves. By definition, natural monopolies have declining average total cost. As we first discussed in Chapter 13, when average total cost is declining, marginal cost is less than average total cost. This situation is illustrated in Figure 10, which shows a firm with a large fixed cost and then constant marginal cost thereafter. If regulators were to set price equal to marginal cost, that price would be less than the firm's average total cost and the firm would lose money. Instead of charging such a low price, the monopoly firm would just exit the industry. Regulators can respond to this problem in various ways, none of which is perfect. One way is to subsidize the monopolist. In essence, the government picks up the losses inherent in marginal cost pricing. Yet to pay for the subsidy, the government needs to raise money through taxation, which involves its own deadweight losses. Alternatively, the regulators can allow the monopolist to charge a price higher than marginal cost. If the regulated price equals average total cost, the monopolist earns exactly zero economic profit. Yet average cost pricing leads to deadweight losses because the monopolist's price no longer reflects the marginal cost of producing the good. In essence, average cost pricing is like a tax on the good the monopolist is selling. The second problem with marginal cost pricing as a regulatory system is that it gives the monopolist no incentive to reduce costs. Each firm in a competitive market tries to reduce its costs because lower costs mean higher profits. But if a regulated monopolist knows that regulators will reduce prices whenever costs fall, the monopolist will not benefit from lower costs. In practice, regulators deal with this problem by allowing monopolists to keep some of the benefits from lower costs in the form of higher profit, a practice that requires some departure from marginal cost pricing. 15-5 Public ownership. The third policy used by the government to deal with monopoly is public ownership. That is, rather than regulating a natural monopoly that is run by a private firm, the government can run the monopoly itself. This solution is common in many European countries, where the government owns and operates utilities such as telephone, water, and electric companies. In the United States, the government runs the postal service. The delivery of ordinary first-class mail is often thought to be a natural monopoly. Economists usually prefer private to public ownership of natural monopolies. The key issue is how the ownership of the firm affects the costs of production. Private owners have an incentive to minimize costs as long as they reap part of the benefit in the form of higher profit. If the firm's managers are doing a bad job of keeping costs down, the firm's owners will fire them. By contrast, if the government bureaucrats who run a monopoly do a bad job, the losers are the customers and taxpayers, whose only recourse is the political system. The bureaucrats may become a special interest group and attempt to block cost-reducing reforms. Put simply, as a way of ensuring that firms are well run, the voting booth is less reliable than the profit motive. 15-5D Doing nothing. Each of the foregoing policies aimed at reducing the problem of monopoly has drawbacks. As a result, some economists argue that it is often best for the government not to try to remedy the inefficiencies of monopoly pricing. Here is the assessment of economist George Stigler, who won the Nobel Prize for his work in industrial organization. A famous theorem in economics states that a competitive enterprise economy will produce the largest possible income from a given stock of resources. No real economy meets the exact conditions of the theorem, and all real economies will fall short of the ideal economy, a difference called market failure. In my view, however, the degree of market failure for the American economy is much smaller than the political failure arising from the imperfections of economic policies found in real political systems. As this quotation makes clear, determining the proper role of the government in the economy requires judgments about politics as well as economics. Quick quiz: describe the ways policymakers can respond to the inefficiencies caused by monopolies. List a potential problem with each of these policy responses. 322. 15-6 Conclusion: the prevalence of monopolies. This chapter has discussed the behavior of firms that have control over the prices they charge. We have seen that these firms behave very differently from the competitive firms studied in the previous chapter. Table 2 summarizes some of the key similarities and differences between competitive and monopoly markets. From the standpoint of public policy, a crucial result is that a monopolist produces less than the socially efficient quantity and charges a price above marginal cost. As a result, a monopoly causes deadweight losses. In some cases, these inefficiencies can be mitigated through price discrimination by the monopolist, but other times, they call for policymakers to take an active role. How prevalent are the problems of monopoly? There are two answers to this question. In one sense, monopolies are common. Most firms have some control over the prices they charge. They are not forced to charge the market price for their goods because their goods are not exactly the same as those offered by other firms. A Ford Taurus is not the same as a Toyota Camry. Ben & Jerry's ice cream is not the same as Breyer's. Each of these goods has a downward sloping demand curve, which gives each producer some degree of monopoly power. Yet firms with substantial monopoly power are rare. Few goods are truly unique. Most have substitutes that, even if not exactly the same, are similar. Ben & Jerry can raise the price of their ice cream a little without losing all their sales, but if they raise it a lot, sales will fall substantially as their customers switch to other brands. In the end, monopoly power is a matter of degree. It is true that many firms have some monopoly power. It is also true that their monopoly power is usually limited. In such a situation, we will not go far wrong assuming that firms operate in competitive markets, even if that is not precisely the case. Competition versus monopoly, a summary. Comparison. Table 2. Competition monopoly. Similarities. Goal of firms: maximize profits. Rule for maximizing MR equals MC. MR equals MC can earn economic profits in the short run? Yes. Differences. Number of firms: many. 1. Marginal revenue: MR equals P. Mr. MC produces welfare. Maximizing level of output? Yes no. Entry in the long run? Yes no. Can earn economic profits in the long run? No yes. Price discrimination possible? No yes. A monopoly is a firm that is the sole seller in its market. A monopoly arises when a single firm owns a key resource, when the government gives a firm the exclusive right to produce a good, or when a single firm can supply the entire market at a lower cost than many firms could. Because a monopoly is the sole producer in its market, it faces a downward sloping demand curve for its product. When a monopoly increases production by 1 unit, it causes the price of its good to fall, which reduces the amount of revenue earned on all units produced. As a result, a monopoly's marginal revenue is always below the price of its good. Like a competitive firm, a monopoly firm maximizes profit by producing the quantity at which marginal revenue equals marginal cost. The monopoly then sets the price at which that quantity is demanded. Unlike a competitive firm, a monopoly firm's price exceeds its marginal revenue, so its price exceeds marginal cost. A monopolist's profit maximizing level of output is below the level that maximizes the sum of consumer and producer surplus. That is, when the monopoly charges a price above marginal cost, some consumers who value the good more than its cost of production do not buy it. As a result, monopoly causes deadweight losses similar to those caused by taxes. A monopolist can often increase profits by charging different prices for the same good based on a buyer's willingness to pay. This practice of price discrimination can raise economic welfare by getting the good to some consumers who otherwise would not buy it. In the extreme case of perfect price discrimination, the deadweight loss of monopoly is completely eliminated and the entire surplus in the market goes to the monopoly producer. More generally, when price discrimination is imperfect, it can either raise or lower welfare compared to the outcome with a single monopoly price. Policymakers can respond to the inefficiency of monopoly behavior in 4 ways. They can use the antitrust laws to try to make the industry more competitive. They can regulate the prices that the monopoly charges. They can turn the monopolist into a government-run enterprise. Or, if the market failure is deemed small compared to the inevitable imperfections of policies, they can do nothing at all. Summary. Monopoly, P300 Natural monopoly, P302 Price discrimination, P314 Key concepts. 1. Give an example of a government-created monopoly. Is creating this monopoly necessarily bad public policy? Explain. 2. Define natural monopoly. What does the size of a market have to do with whether an industry is a natural monopoly? 3. Why is a monopolist's marginal revenue less than the price of its good? Can marginal revenue ever be negative? Explain. 4. Draw the demand, marginal revenue, average total cost, and marginal cost curves for a monopolist. Show the profit maximizing level of output, the profit maximizing price, and the amount of profit. 5. In your diagram from the previous question, show the level of output that maximizes total surplus. Show the deadweight loss from the monopoly. Explain your answer. 6. Give 2 examples of price discrimination. In each case, explain why the monopolist chooses to follow this business strategy. 7. What gives the government the power to regulate mergers between firms? Give a good reason and a bad reason that 2 firms might want to merge. 8. Describe the 2 problems that arise when regulators tell a natural monopoly that it must set a price equal to marginal cost. Questions for review. 324. 1. A publisher faces the following demand schedule for the next novel from one of its popular authors. Price quantity demanded $100, 0 novels 90 100,000 80 200,000 70 300,000 60 400,000 50 500,000 40 600,000 30 700,000 20 800,000 10 900,000 0 1 million. The author is paid $2 million to write the book, and the marginal cost of publishing the book is a constant $10 per book. A. Compute total revenue, total cost, and profit at each quantity. What quantity would a profit-maximizing publisher choose? What price would it charge? B. Compute marginal revenue. How does marginal revenue compare to the price? Explain. C. Graph the marginal revenue, marginal cost, and demand curves. At what quantity do the marginal revenue and marginal cost curves cross? What does this signify? D. In your graph, shade in the deadweight loss. Explain in words what this means. E. If the author were paid $3 million instead of $2 million to write the book, how would this affect the publisher's decision regarding what price to charge? Explain. F. Suppose the publisher was not profit maximizing but was concerned with maximizing economic efficiency. What price would it charge for the book? How much profit would it make at this price? 2. A small town is served by many competing supermarkets, which have the same constant marginal cost. A. Using a diagram of the market for groceries, show the consumer surplus, producer surplus, and total surplus. Problems and applications. 1. A firm is a natural monopoly if it exhibits the following as its output increases: A. Decreasing marginal revenue, B. Increasing marginal cost, C. Decreasing average revenue, D. Decreasing average total cost. 2. For a profit-maximizing monopoly that charges the same price to all consumers, what is the relationship between price P, marginal revenue MR, and marginal cost MC? A. P equals MR and MR equals MCB. PMR and MR equals MCC. P equals MR and MR MCD. PMR and MR MC. 3. If a monopoly's fixed costs increase, its price will and its profit will A increase, decrease B decrease, increase C increase, stay the same D stay the same, decrease 4. Compared to the social optimum, a monopoly firm chooses A quantity that is too low and a price that is too high. B a quantity that is too high and a price that is too low. C a quantity and a price that are both too high. D a quantity and a price that are both too low. 5. The deadweight loss from monopoly arises because A the monopoly firm makes higher profits than a competitive firm would. B some potential consumers who forego buying the good value it more than its marginal cost. C consumers who buy the good have to pay more than marginal cost, reducing their consumer surplus. D the monopoly firm chooses a quantity that fails to equate price and average revenue. 6. When a monopolist switches from charging a single price to perfect price discrimination, it reduces A the quantity produced. B the firm's profit. C consumer surplus. D total surplus. Quick check multiple choice. Chapter 15 Monopoly 325. B. Now suppose that the independent supermarkets combine into one chain. Using a new diagram, show the new consumer surplus, producer surplus, and total surplus. Relative to the competitive market, what is the transfer from consumers to producers? What is the deadweight loss? 3. Johnny Rockabilly has just finished recording his latest CD. His record company's marketing department determines that the demand for the CD is as follows: price number of CDs $24, 10,000, 22, 20,000, 20, 30,000, 18, 40,000, 16, 50,000, 14, 60,000. The company can produce the CD with no fixed cost and a variable cost of $5 per CD. A. Find total revenue for quantity equal to 10,000, 20,000, and so on. What is the marginal revenue for each 10,000 increase in the quantity sold? B. What quantity of CDs would maximize profit? What would the price be? What would the profit be? C. If you were Johnny's agent, what recording fee would you advise Johnny to demand from the record company? Why? 4. A company is considering building a bridge across a river. The bridge would cost $2 million to build and nothing to maintain. The following table shows the company's anticipated demand over the lifetime of the bridge. Price per crossing. Number of crossings, in thousands: $8 0. 7 100. 6 200. 5 300. 4 400. 3 500. 2 600. 1 700. 0 800. A. If the company were to build the bridge, what would be its profit maximizing price? Would that be the efficient level of output? Why or why not? B. If the company is interested in maximizing profit, should it build the bridge? What would be its profit or loss? C. If the government were to build the bridge, what price should it charge? D. Should the government build the bridge? Explain. 5. Larry, Curly, and Mo run the only saloon in town. Larry wants to sell as many drinks as possible without losing money. Curly wants the saloon to bring in as much revenue as possible. Mo wants to make the largest possible profits. Using a single diagram of the saloon's demand curve and its cost curves, show the price and quantity combinations favored by each of the three partners. Explain. 6. The residents of the town Actinia all love economics, and the mayor proposes building an economics museum. The museum has a fixed cost of $2,400,000 and no variable costs. There are 100,000 town residents, and each has the same demand for museum visits. QD equals 10p, where P is the price of admission. A. Graph the museum's average total cost curve and its marginal cost curve. What kind of market would describe the museum? B. The mayor proposes financing the museum with a lump sum tax of $24 and then opening the museum to the public for free. How many times would each person visit? Calculate the benefit each person would get from the museum, measured as consumer surplus minus the new tax. C. The mayor's anti-tax opponent says the museum should finance itself by charging an admission fee. What is the lowest price the museum can charge without incurring losses? D. For the break-even price you found in part, calculate each resident's consumer surplus. Compared with the mayor's plan, who is better off with this admission fee, and who is worse off? Explain. E. What real-world considerations absent in the problem above might provide reasons to favor an admission fee? 7. Consider the relationship between monopoly pricing and price elasticity of demand. A. Explain why a monopolist will never produce a quantity at which the demand curve is inelastic. B. Draw a diagram for a monopolist, precisely labeling the portion of the demand curve that is inelastic. C. On your diagram, show the quantity and price that maximize total revenue. 8. You live in a town with 300 adults and 200 children, and you are thinking about putting on a play to 326. Entertain your neighbors and make some money. A play has a fixed cost of $2,000, but selling an extra ticket has zero marginal cost. Here are the demand schedules for your two types of customers. Price: adults, children $10, 009 100 08 200 07 300 06 300 05 300 104 300 200 3 300 200 2 300 200 1 300 200 0 300 200. A. To maximize profit, what price would you charge for an adult ticket? For a child's ticket? How much profit do you make? B. The city council passes a law prohibiting you from charging different prices to different customers. What price do you set for a ticket now? How much profit do you make? C. Who is worse off because of the law prohibiting price discrimination? Who is better off? D. If the fixed cost of the play were $2,500 rather than $2,000, how would your answers to parts and change? 9. Only one firm produces and sells soccer balls in the country of Vietnam, and as the story begins, international trade in soccer balls is prohibited. The following equations describe the monopolist's demand: marginal revenue, total cost, and marginal cost. Demand: P equals 10Q. Marginal revenue: MR equals 10-2Q. Total cost: TC equals 3 plus Q plus 0.5 Q2. Marginal cost: MC equals 1 plus Q. Where Q is quantity and P is the price measured in Vietnamese dollars. A. How many soccer balls does the monopolist produce? At what price are they sold? What is the monopolist's profit? B. One day, the King of Vietnam decrees that henceforth there will be free trade, either imports or exports of soccer balls at the world price of $6. The firm is now a price taker in a competitive market. What happens to domestic production of soccer balls? To domestic consumption? Does Vietnam export or import soccer balls? See in our analysis of international trade in Chapter 9, a country becomes an exporter when the price without trade is below the world price and an importer when the price without trade is above the world price. Does that conclusion hold in your answers to parts and? Explain. D. Suppose that the world price was not $6 but, instead, happened to be exactly the same as the domestic price without trade as determined in part. Would allowing trade have changed anything in the Vietnamian economy? Explain. How does the result here compare with the analysis in Chapter 9? 10. Based on market research, a film production company in Actenia obtains the following information about the demand and production costs of its new DVD. Demand, P equals 1010 Q. Total revenue, TR equals 1000 Q10 Q2. Marginal revenue, MR equals 1020 Q. Marginal cost, MC equals 100 plus 10 Q. Where Q indicates the number of copies sold and P is the price in Actenian dollars. A. Find the price and quantity that maximize the company's profit. B. Find the price and quantity that would maximize social welfare. C. Calculate the deadweight loss from monopoly. D. Suppose, in addition to the costs above, the director of the film has to be paid. The company is considering 4 options, I. A flat fee of 2,000 Actenian dollars. 2. 50% of the profits. 3. 150 Actenian dollars per unit sold. 4. 50% of the revenue. For each option, calculate the profit maximizing price and quantity. Which, if any, of these compensation schemes would alter the deadweight loss from monopoly? Explain. 11. Many schemes for price discriminating involve some cost. For example, discount coupons take up the time and resources of both the buyer and the seller. This question considers the implications of costly price discrimination. To keep things simple, let's assume that our monopolist's production costs are simply proportional to output so that average total cost and marginal cost are constant and equal to each other. A. Draw the cost, demand, and marginal revenue curves for the monopolist. Show the price the monopolist would charge without price discrimination. B. In your diagram, mark the area equal to the monopolist's profit and call it X. Mark the area equal to consumer surplus and call it Y. Mark the area equal to the deadweight loss and call it Z. Chapter 15 Monopoly 327. See now suppose that the monopolist can perfectly price discriminate. What is the monopolist's profit? D. What is the change in the monopolist's profit from price discrimination? What is the change in total surplus from price discrimination? Which change is larger? Explain. E. Now suppose that there is some cost of price discrimination. To model this cost, let's assume that the monopolist has to pay a fixed cost C to price discriminate. How would a monopolist make the decision whether to pay this fixed cost? F. How would a benevolent social planner, who cares about total surplus, decide whether the monopolist should price discriminate? G. Compare your answers to parts and. How does the monopolist's incentive to price discriminate differ from the social planner's? Is it possible that the monopolist will price discriminate even though doing so is not socially desirable? Go to CEngageBrain.com to purchase access to the proven, critical study guide to accompany this text, which features additional notes and context, practice tests, and much more. 329. Monopolistic competition. Why? Oh, you walk into a bookstore to buy a book to read during your next vacation. On the store's shelves you find a Sue Grafton mystery, a Stephen King thriller, a David McCullough history, a Stephanie Meyer vampire romance, and many other choices. When you pick out a book and buy it, what kind of market are you participating in? On the one hand, the market for books seems competitive. As you look over the shelves at your bookstore, you find many authors and many publishers vying for your attention. A buyer in this market has thousands of competing products from which to choose. And because anyone can enter the industry by writing and publishing a book, the book business is not very profitable. For every highly paid novelist, there are hundreds of struggling ones. On the other hand, the market for books seems monopolistic. Because each book is unique, publishers have some latitude in choosing what price to charge. The sellers in this market are price makers rather than price takers. Chapter 16. 330. And indeed, the price of books greatly exceeds marginal cost. The price of a typical hardcover novel, for instance, is about $25, whereas the cost of printing one additional copy of the novel is less than $5. The market for novels fits neither the competitive nor the monopoly model. Instead, it is best described by the model of monopolistic competition, the subject of this chapter. The term monopolistic competition might at first seem to be an oxymoron, like jumbo shrimp. But as we will see, monopolistically competitive industries are monopolistic in some ways and competitive in others. The model describes not only the publishing industry but also the market for many other goods and services. 16:1 between monopoly and perfect competition. The previous two chapters analyzed markets with many competitive firms and markets with a single monopoly firm. In chapter 14, we saw that the price in a perfectly competitive market always equals the marginal cost of production. We also saw that, in the long run, entry and exit drive economic profit to zero, so the price also equals average total cost. In chapter 15, we saw how monopoly firms can use their market power to keep prices above marginal cost, leading to a positive economic profit for the firm and a deadweight loss for society. Competition and monopoly are extreme forms of market structure. Competition occurs when there are many firms in a market offering essentially identical products. Monopoly occurs when there is only one firm in a market. Although the cases of perfect competition and monopoly illustrate some important ideas about how markets work, most markets in the economy include elements of both these cases and, therefore, are not completely described by either of them. The typical firm in the economy faces competition, but the competition is not so rigorous that it makes the firm a price taker like the firms analyzed in chapter 14. The typical firm also has some degree of market power, but its market power is not so great that the firm can be described exactly by the monopoly model presented in chapter 15. In other words, many industries fall somewhere between the polar cases of perfect competition and monopoly. Economists call this situation imperfect competition. One type of imperfectly competitive market is an oligopoly, a market with only a few sellers, each offering a product that is similar or identical to the products offered by other sellers in the market. Economists measure a market's domination by a small number of firms with a statistic called the concentration ratio, which is the percentage of total output in the market supplied by the four largest firms. In the U.S. economy, most industries have a four-firm concentration ratio under 50%, but in some industries, the biggest firms play a more dominant role. Highly concentrated industries include the market for electric lamp bulbs, breakfast cereal, aircraft manufacturing, household laundry equipment, and cigarettes. These industries are best described as oligopolies. In the next chapter we see that the small number of firms in oligopolies makes strategic interactions among them a key part of the analysis. That is, in choosing how much to produce and what price to charge, each firm in an oligopoly is concerned not only with what its competitors are doing but also with how its competitors would react to what it might do. A second type of imperfectly competitive market is called monopolistic competition. This describes a market structure in which there are many firms selling products that are similar but not identical. In a monopolistically competitive market, each firm has a monopoly over the product it makes, but many other firms make similar products that compete for the same customers. To be more precise, monopolistic competition describes a market with the following attributes. Many sellers, there are many firms competing for the same group of customers. Product differentiation, each firm produces a product that is at least slightly different from those of other firms. Thus, rather than being a price taker, each firm faces a downward sloping demand curve. Free entry and exit, firms can enter or exit the market without restriction. Thus, the number of firms in the market adjusts until economic profits are driven to zero. A moment's thought reveals a long list of markets with these attributes: books, DVDs, computer games, restaurants, piano lessons, cookies, clothing, and so on. Monopolistic competition, like oligopoly, is a market structure that lies between the extreme cases of perfect competition and monopoly. But oligopoly and monopolistic competition are quite different. Oligopoly departs from the perfectly competitive ideal of Chapter 14 because there are only a few sellers in the market. The small number of sellers makes rigorous competition less likely and strategic interactions among them vitally important. By contrast, a monopolistically competitive market has many sellers, each of which is small compared to the market. It departs from the perfectly competitive ideal because each of the sellers offers a somewhat different product. Figure 1 summarizes the 4 types of market structure. The first question to ask about any market is how many firms there are. If there is only one firm, the market is a monopoly. If there are only a few firms, the market is an oligopoly. If there are many firms, we need to ask another question: do the firms sell identical or differentiated products? If the many firms sell differentiated products, the market is monopolistically competitive. If the many firms sell identical products, the market is perfectly competitive. Because reality is never as clear-cut as theory, at times you may find it hard to decide what structure best describes a market. There is, for instance, no magic number that separates few from many when counting the number of firms. Similarly, there is no sure way to determine when products are differentiated and when they are identical. When analyzing actual markets, economists have to keep in mind the lessons learned from studying all types of market structure and then apply each lesson as it seems appropriate. Now that we understand how economists define the various types of market structure, we can continue our analysis of each of them. In this chapter we examine monopolistic competition. In the next chapter we analyze oligopoly. Quick quiz: define oligopoly and monopolistic competition and give an example of each. 16-2 Competition with differentiated products. To understand monopolistically competitive markets, we first consider the decisions facing an individual firm. We then examine what happens in the long run as firms enter and exit the industry. Next, we compare the equilibrium under monopolistic competition to the equilibrium under perfect competition that we examined in Chapter 14. Finally, we consider whether the outcome in a monopolistically competitive market is desirable from the standpoint of society as a whole. 16-2 Are the monopolistically competitive firm in the short run. Each firm in a monopolistically competitive market is, in many ways, like a monopoly. Because its product is different from those offered by other firms, it faces a downward sloping demand curve. Thus, the monopolistically competitive firm follows a monopolist's rule for profit maximization. It chooses to produce the quantity at which marginal revenue equals marginal cost and then uses its demand curve to find the price at which it can sell that quantity. Figure 2 shows the cost, demand, and marginal revenue curves for 2 typical firms, each in a different monopolistically competitive industry. In both panels of this figure, the profit-maximizing quantity is found at the intersection of the marginal revenue and marginal cost curves. The 2 panels in this figure show different outcomes for the firm's profit. In panel, price exceeds average total cost, so the firm makes a profit. In panel, price is below average total cost. In this case, the firm is unable to make a positive profit, so the best the firm can do is to minimize its losses. All this should seem familiar. A monopolistically competitive firm chooses its quantity and price just as a monopoly does. In the short run, these 2 types of market structure are similar. 16-2b The long-run equilibrium. The situations depicted in Figure 2 do not last long. When firms are making profits, as in panel, new firms have an incentive to enter the market. This entry. 333. Monopolistic competitors, like monopolists, maximize profit by producing the quantity at which marginal revenue equals marginal cost. The firm in panel makes a profit because, at this quantity, price is above average total cost. The firm in panel makes losses because, at this quantity, price is less than average total cost. Monopolistic competitors in the short run. Increases the number of products from which customers can choose and, therefore, reduces the demand faced by each firm already in the market. In other words, profit encourages entry, and entry shifts the demand curves faced by the incumbent firms to the left. As the demand for incumbent firms' products falls, these firms experience declining profit. Conversely, when firms are making losses, as in panel, firms in the market have an incentive to exit. As firms exit, customers have fewer products from which to choose. This decrease in the number of firms expands the demand faced by those firms that stay in the market. In other words, losses encourage exit, and exit shifts the demand curves of the remaining firms to the right. As the demand for the remaining firms' products rises, these firms experience rising profits. This process of entry and exit continues until the firms in the market are making exactly zero economic profit. Figure 3 depicts the long-run equilibrium. Once the market reaches this equilibrium, new firms have no incentive to enter, and existing firms have no incentive to exit. Notice that the demand curve in Figure 3 just barely touches the average total cost curve. Mathematically, we say the two curves are tangent to each other. These two curves must be tangent once entry and exit have driven profit to zero. Because profit per unit sold is the difference between price and average total cost, the maximum profit is zero only if these two curves touch each other without crossing. Also note that this point of tangency occurs at the same quantity where marginal revenue equals marginal cost. That these 2 points line up is not a coincidence, it is required because this particular quantity maximizes profit and the maximum profit is exactly zero in the long run. To sum up, two characteristics describe the long-run equilibrium in a monopolistically competitive market. As in a monopoly market, price exceeds marginal cost. This conclusion arises because profit maximization requires marginal revenue to equal marginal cost. And because the downward sloping demand curve makes marginal revenue less than the price. As in a competitive market, price equals average total cost. This conclusion arises because free entry and exit drive economic profit to zero. The second characteristic shows how monopolistic competition differs from monopoly. Because a monopoly is the sole seller of a product without close substitutes, it can earn positive economic profit, even in the long run. By contrast, because there is free entry into a monopolistically competitive market, the economic profit of a firm in this type of market is driven to zero. 16-2C Monopolistic versus perfect competition. Figure 4 compares the long-run equilibrium under monopolistic competition to the long-run equilibrium under perfect competition. There are two noteworthy differences between monopolistic and perfect competition: excess capacity and the markup. Excess capacity, as we have just seen, the process of entry and exit drives each firm in a monopolistically competitive market to a point of tangency between its demand and average total cost curves. Panel of Figure 4 shows that the quantity of output at this point is smaller than the quantity that minimizes average total cost. Thus, under monopolistic competition, firms produce on the downward sloping. Panel shows the long-run equilibrium in a monopolistically competitive market, and panel shows the long-run equilibrium in a perfectly competitive market. Two differences are notable. The perfectly competitive firm produces at the efficient scale, where average total cost is minimized. By contrast, the monopolistically competitive firm produces at less than the efficient scale. Price equals marginal cost under perfect competition, but price is above marginal cost under monopolistic competition. Portion of their average total cost curves. In this way, monopolistic competition contrasts starkly with perfect competition. As panel of Figure 4 shows, free entry in competitive markets drives firms to produce at the minimum of average total cost. The quantity that minimizes average total cost is called the efficient scale of the firm. In the long run, perfectly competitive firms produce at the efficient scale, whereas monopolistically competitive firms produce below this level. Firms are said to have excess capacity under monopolistic competition. In other words, a monopolistically competitive firm, unlike a perfectly competitive firm, could increase the quantity it produces and lower the average total cost of production. The firm forgoes this opportunity because it would need to cut its price to sell the additional output. It is more profitable for a monopolistic competitor to continue operating with excess capacity. Markup over marginal cost. A second difference between perfect competition and monopolistic competition is the relationship between price and marginal cost. For a perfectly competitive firm, such as the one shown in panel of figure 4, price equals marginal cost. For a monopolistically competitive firm, such as the one shown in panel, price exceeds marginal cost because the firm always has some market power. How is this markup over marginal cost consistent with free entry and zero profit? The zero profit condition ensures only that price equals average total cost. It does not ensure that price equals marginal cost. Indeed, in the long-run equilibrium, monopolistically competitive firms operate on the declining portion of their average total cost curves, so marginal cost is below average total cost. Thus, for price to equal average total cost, price must be above marginal cost. In this relationship between price and marginal cost, we see a key behavioral difference between perfect competitors and monopolistic competitors. Imagine that you were to ask a firm the following question: would you like to see another customer come through your door ready to buy from you at your current price? A perfectly competitive firm would answer that it didn't care. Because price exactly equals marginal cost, the profit from an extra unit sold is zero. By contrast, a monopolistically competitive firm is always eager to get another customer. Because its price exceeds marginal cost, an extra unit sold at the posted price means more profit. According to an old quip, monopolistically competitive markets are those in which sellers send Christmas cards to the buyers. Trying to attract more customers makes sense only if price exceeds marginal cost. 16-2D Monopolistic competition and the welfare of society. Is the outcome in a monopolistically competitive market desirable from the standpoint of society as a whole? Can policymakers improve on the market outcome? In previous chapters we evaluated markets from the standpoint of efficiency, that is, whether society is getting the most it can out of its scarce resources. We learned that competitive markets lead to efficient outcomes, unless there are externalities, whereas monopoly markets lead to deadweight losses. Monopolistically competitive markets are more complex than either of these polar cases, so evaluating welfare in these markets is a more subtle exercise. One source of inefficiency is the markup of price over marginal cost. Because of the markup, some consumers who value the good at more than the marginal 337 cost of production will be deterred from buying it. Thus, a monopolistically competitive market has the normal deadweight loss of monopoly pricing. This outcome is undesirable compared with the efficient quantity that arises when price equals marginal cost, but policymakers don't have an easy way to fix the problem. To enforce marginal cost pricing, they would need to regulate all firms that produce differentiated products. Because such products are so common in the economy, the administrative burden of such regulation would be overwhelming. Moreover, regulating monopolistic competitors entails all the problems of regulating natural monopolies. In particular, because monopolistic competitors are making zero profits already, requiring them to lower their prices to equal marginal cost would cause them to make losses. To keep these firms in business, the government would need to help them cover these losses. Rather than raise taxes to pay for these subsidies, policymakers often decide it is better to live with the inefficiency of monopolistic pricing. Another way in which monopolistic competition may be socially inefficient is that the number of firms in the market may not be ideal. That is, there may be too much or too little entry. One way to think about this problem is in terms of the externalities associated with entry. Whenever a new firm considers entering the market with a new product, it takes into account only the profit it would make. Yet its entry would also have the following two effects that are external to the firm. The product variety externality, because consumers get some consumer surplus from the introduction of a new product, entry of a new firm conveys a positive externality on consumers. The business stealing externality, because other firms lose customers and profits from the entry of a new competitor, entry of a new firm imposes a negative externality on existing firms. Thus, in a monopolistically competitive market, there are positive and negative externalities associated with the entry of new firms. Depending on which externality is larger, a monopolistically competitive market could have either too few or too many products. Both of these externalities are closely related to the conditions for monopolistic competition. The product variety externality arises because new firms offer products that differ from those of the existing firms. The business stealing externality arises because firms post a price above marginal cost and, therefore, are always eager to sell additional units. Conversely, because perfectly competitive firms produce identical goods and charge a price equal to marginal cost, neither of these externalities exists under perfect competition. In the end, we can conclude only that monopolistically competitive markets do not have all the desirable welfare properties of perfectly competitive markets. That is, the invisible hand does not ensure that total surplus is maximized under monopolistic competition. Yet because the inefficiencies are subtle, hard to measure, and hard to fix, there is no easy way for public policy to improve the market outcome. Quick quiz: list the 3 key attributes of monopolistic competition. Draw and explain a diagram to show the long-run equilibrium in a monopolistically competitive market. How does this equilibrium differ from that in a perfectly competitive market? In the news. If the shoe doesn't fit. By Joel Waldfogel. Last week, Nike unveiled a shoe designed specifically for American Indians. The sneaker has both a native theme design and, more importantly, a wider shape to accommodate the distinctly shaped feet of American Indians. With diabetes and related conditions near epidemic levels in some tribes, American Indian leaders were happy to welcome this comfortable product. If anything, what seems odd is that it took so long. After all, free market economists have told us for decades that we should rely on market decisions, not the government, to meet our needs, because it's the market that satisfies everyone's every desire. And yet it turns out that it's the Indians' long wait for a good sneaker that's typical. For small groups with preferences outside the norm, the market often fails to deliver, as I argue in my new book, The Tyranny of the Market, Why You Can't Always Get What You Want. John Stuart Mill pointed out that voting gives rise to a tyranny of the majority. If we vote on what color shirts to make or whether to make wide or narrow shoes, then the majority gets what it prefers, and the minority does not. The market, on the other hand, is supposed to work differently. As Milton Friedman eloquently put it in 1962, the characteristic feature of action through political channels is that it tends to require or enforce substantial conformity. The great advantage of the market is that it permits wide diversity. Each man can vote, as it were, for the color of tie he wants and get it. He does not have to see what color the majority wants and then, if he is in the minority, submit. This is a wonderful argument. Except that for many products and for many people, it's wrong. Two simple conditions that prevail in many markets mean that individual taste alone doesn't determine individual satisfaction. These conditions are big setup costs and preferences that differ across groups. When they're present, an individual's satisfaction is a function of how many people share his or her tastes. In other words, in these cases, markets share some of the objectionable features of government. They give bigger groups more and better options. In my research, I've discovered that this phenomenon is widespread. 10 years ago, I started studying radio station listening patterns. I noticed that people listen to the radio more in metro areas of the United States with relatively large populations. This is not terribly surprising. In larger cities, more stations can attract enough listeners and advertising revenue to cover their costs and stay on the air. With more to choose from on the dial, residents tune in more. So, in this situation of high fixed costs, people help one another by making more options viable. But who benefits whom? When I looked at black and white listeners separately, I noticed something surprising. Blacks listen more in cities. Insufficient variety as a market failure. In the presence of large fixed costs, the market may insufficiently serve customers with unusual preferences. 16:3 Advertising. It is nearly impossible to go through a typical day in a modern economy without being bombarded with advertising. Whether you are surfing the internet, posting on Facebook, reading a newspaper, watching television, or driving down the highway, some firm will try to convince you to buy its product. Such behavior is a natural feature of monopolistic competition. When firms sell differentiated products and charge prices above marginal cost, each firm has an incentive to advertise to attract more buyers to its particular product. The amount of advertising varies substantially across products. Firms that sell highly differentiated consumer goods, such as over-the-counter drugs, perfumes, soft drinks, razor blades, breakfast cereals, and dog food, typically spend between 10 and 20% of revenue on advertising. Firms that sell industrial products, such as drill presses and communications satellites, typically spend very little on advertising. And firms that sell homogeneous products, such as wheat, peanuts, and crude oil, spend nothing at all. 339. For the economy as a whole, about 2% of total firm revenue is spent on advertising. This spending takes many forms, including ads on websites, television, radio, and billboards, and in newspapers, magazines, the yellow pages, and direct mail. 16-3 of the debate over advertising: is society wasting the resources it devotes to advertising? Or does advertising serve a valuable purpose? Assessing the social value of advertising is difficult and often generates heated argument among economists. Let's consider both sides of the debate. The critique of advertising: critics of advertising argue that firms advertise to manipulate people's tastes. Much advertising is psychological rather than informational. Consider, for example, the typical television commercial for some brand of soft drink. The commercial most likely does not tell the viewer about the product's price or quality. Instead, it might show a group of happy people at a party on a beach on a beautiful sunny day. In their hands are cans of the soft drink. The goal of the commercial is to convey a subconscious message: you too can. AP. Photo/Don. Ryan. With larger black populations, and whites listen more in cities with larger white populations. Black listening does not increase where there's a higher white population, and white listening does not increase with a higher black population. Which means that while overall people help each other by increasing the number of stations on the dial, blacks do not help whites, and whites do not help blacks. Similar patterns arise for Hispanics and non-Hispanics. A closer look at the data, necessary only because I'm a middle-aged white economist, showed why this was happening. Blacks and whites don't listen to the same radio stations. The black targeted formats account for about 2/3 of black listening and only 3% of white listening. Similarly, the formats that attract the largest white audiences, like country, attract almost no blacks. This means that if you dropped Larry the Cable Guy and a few thousand of his friends from a helicopter into a metro area, you'd create more demand for country and perhaps album rock stations, which would be nice for white listeners. But the influx wouldn't help black listeners at all. In this example, different population groups don't help each other, but they don't hurt each other, either. Sometimes, though, the effect that groups have on each other through the market is actually negative. Industries like daily newspapers offer essentially one product per market. Because the paper can be pitched to appeal to one group or another, the larger one group is, the less the product is tailored to anyone else. This is the tyranny of the majority, translated almost literally from politics into markets. This brings us back to Nike's new shoe. Foot Locker is full of options that fit me and most other Americans. But American Indians make up just 1.5% of the US population, and with feet on average 3 sizes wider, they need different sized shoes. If we had all voted in a national election on whether the Ministry of Shoes should make wide or typical width shoes, we surely would have chosen the latter. That's why Friedman condemned government allocation. And yet the market made the same choice. If Nike's announcement looks like a solution to this problem of ignored minority preference, It really isn't. The company took too many years to bring the shoe online, and according to the Associated Press, the new sneaker represents less of a financial opportunity than a goodwill and branding effort. The tyranny of the market arises elsewhere. With drug development costs near $1 billion, if you are going to be sick, hope that your disease is common enough to attract the interest of drug makers. If you want to fly from your town to Chicago, hope that your city is big enough to fill a plane every day. When you're not so lucky, you benefit when the government steps in on your behalf, with subsidies for research on drugs for rare diseases or for air service to small locales. For a generation, influential economists have argued for letting the market decide a wide array of questions, to protect your freedom to choose whatever you want. This is true if everyone agrees with you. Mr. Waldfogel is a professor of economics at the University of Pennsylvania. 340. Have many friends and be happy, if you drink our product. Critics of advertising argue that such a commercial creates a desire that otherwise might not exist. Critics also argue that advertising impedes competition. Advertising often tries to convince consumers that products are more different than they truly are. By increasing the perception of product differentiation and fostering brand loyalty, advertising makes buyers less concerned with price differences among similar goods, thereby making the demand for a particular brand less elastic. When a firm faces a less elastic demand curve, it can increase its profits by charging a larger markup over marginal cost. The defense of advertising. Defenders of advertising argue that firms use advertising to provide information to customers. Advertising conveys the prices of the goods offered for sale, the existence of new products, and the locations of retail outlets. This information allows customers to make better choices about what to buy and, thus, enhances the ability of markets to allocate resources efficiently. Defenders also argue that advertising fosters competition. Because advertising allows customers to be more fully informed about all the firms in the market, customers can more easily take advantage of price differences. Thus, each firm has less market power. In addition, advertising allows new firms to enter more easily because it gives entrants a means to attract customers from existing firms. Over time, policymakers have come to accept the view that advertising can make markets more competitive. One important example is the regulation of advertising for certain professions, such as lawyers, doctors, and pharmacists. In the past, these groups succeeded in getting state governments to prohibit advertising in their fields on the grounds that advertising was unprofessional. In recent years, however, the courts have concluded that the primary effect of these restrictions on advertising was to curtail competition. They have, therefore, overturned many of the laws that prohibit advertising by members of these professions. Advertising and the price of eyeglasses. What effect does advertising have on the price of a good? On the one hand, advertising might make consumers view products as being more different than they otherwise would. If so, it would make markets less competitive and firms' demand curves less elastic, and this would lead firms to charge higher prices. On the other hand, advertising might make it easier for consumers to find the firms offering the best prices. In this case, it would make markets more competitive and firms' demand curves more elastic, which would lead to lower prices. In an article published in the Journal of Law and Economics in 1972, economist Lee Benham tested these two views of advertising. In the United States during the 1960s, the various state governments had vastly different rules about advertising by optometrists. Some states allowed advertising for eyeglasses and eye examinations. Many states, however, prohibited it. For example, the Florida law read as follows: "It is unlawful for any person, firm, or corporation to advertise either directly or indirectly by any means whatsoever any definite or indefinite price or credit terms on prescriptive or corrective lens, frames, complete prescriptive or corrective glasses, or any optometric service." This section is passed in the interest of public health, safety, and welfare, and its provisions shall be liberally construed to carry out its objects and purposes. Case study. 341. Professional optometrists enthusiastically endorsed these restrictions on advertising. Benham used the differences in state law as a natural experiment to test the two views of advertising. The results were striking. In those states that prohibited advertising, the average price paid for a pair of eyeglasses was $33, or $248 in 2012 dollars. In states that did not restrict advertising, the average price was $26, or $196 in 2012 dollars. Thus, advertising reduced average prices by more than 20%. In the market for eyeglasses, and probably in many other markets as well, advertising fosters competition and leads to lower prices for consumers. 16-3b Advertising as a signal of quality. Many types of advertising contain little apparent information about the product being advertised. Consider a firm introducing a new breakfast cereal. The firm might saturate the airwaves with advertisements showing some actor eating the cereal and exclaiming how wonderful it tastes. How much information does the advertisement really provide? The answer is more than you might think. Defenders of advertising argue that even advertising that appears to contain little hard information may in fact tell consumers something about product quality. The willingness of the firm to spend a large amount of money on advertising can itself be a signal to consumers about the quality of the product being offered. Consider the problem facing two firms, Post and Kellogg. Each company has just come up with a recipe for a new cereal, which it would sell for $3 a box. To keep things simple, let's assume that the marginal cost of making cereal is $0, so the $3 is all profit. Each company knows that if it spends $10 million on advertising, it will get 1 million consumers to try its new cereal. And each company knows that if consumers like the cereal, they will buy it not once but many times. First, consider Post's decision. Based on market research, Post knows that its cereal tastes like shredded newspaper with sugar on top. Advertising would sell one box to each of 1 million consumers, but consumers would quickly learn that the cereal is not very good and stop buying it. Post decides it is not worth spending $10 million on advertising to get only $3 million in sales. So it does not bother to advertise. It sends its cooks back to the test kitchen to develop another recipe. Kellogg, on the other hand, knows that its cereal is great. Each person who tries it will buy a box a month for the next year. Thus, the $10 million in advertising will bring in $36 million in sales. Advertising is profitable here because Kellogg has a good product that consumers will buy repeatedly. Thus, Kellogg chooses to advertise. Now that we have considered the behavior of the two firms, let's consider the behavior of consumers. We began by asserting that consumers are inclined to try a new cereal that they see advertised. But is this behavior rational? Should a consumer try a new cereal just because the seller has chosen to advertise it? In fact, it may be completely rational for consumers to try new products that they see advertised. In our story, consumers decide to try Kellogg's new cereal because Kellogg advertises. Kellogg chooses to advertise because it knows that its cereal is quite good, while Post chooses not to advertise because it knows that its cereal is not good at all. By its willingness to spend money on advertising, Kellogg signals to consumers the quality of its cereal. Each consumer thinks. 342. Quite sensibly, boy, if the Kellogg company is willing to spend so much money advertising this new cereal, it must be really good. What is most surprising about this theory of advertising is that the content of the advertisement is irrelevant. Kellogg signals the quality of its product by its willingness to spend money on advertising. What the advertisements say is not as important as the fact that consumers know ads are expensive. By contrast, cheap advertising cannot be effective at signaling quality to consumers. In our example, if an advertising campaign cost less than $3 million, both Post and Kellogg would use it to market their new cereals. Because both good and bad cereals would be advertised, consumers could not infer the quality of a new cereal from the fact that it is advertised. Over time, consumers would learn to ignore such cheap advertising. This theory can explain why firms pay famous actors large amounts of money to make advertisements that, on the surface, appear to convey no information at all. The information is not in the advertisement's content but simply in its existence and expense. 16-3C Brand names advertising is closely related to the existence of brand names. In many markets, there are two types of firms. Some firms sell products with widely recognized brand names, while other firms sell generic substitutes. For example, in a typical drugstore, you can find Bayer aspirin on the shelf next to generic aspirin. In a typical grocery store, you can find Pepsi next to less familiar colas. Most often, the firm with the brand name spends more on advertising and charges a higher price for its product. Just as there is disagreement about the economics of advertising, there is disagreement about the economics of brand names. Let's consider both sides of the debate. Critics argue that brand names cause consumers to perceive differences that do not really exist. In many cases, the generic good is almost indistinguishable from the brand name good. Consumers' willingness to pay more for the brand name good, these critics assert, is a form of irrationality fostered by advertising. Economist Edward Chamberlain, one of the early developers of the theory of monopolistic competition, concluded from this argument that brand names were bad for the economy. He proposed that the government discourage their use by refusing to enforce the exclusive trademarks that companies use to identify their products. More recently, economists have defended brand names as a useful way for consumers to ensure that the goods they buy are of high quality. There are two related arguments. First, brand names provide consumers with information about quality when quality cannot be easily judged in advance of purchase. Second, brand names give firms an incentive to maintain high quality because firms have a financial stake in maintaining the reputation of their brand names. To see how these arguments work in practice, consider a famous brand name, McDonald's hamburgers. Imagine that you are driving through an unfamiliar town and want to stop for lunch. You see a McDonald's and a local restaurant next to it. Which do you choose? The local restaurant may in fact offer better food at lower prices, but you have no way of knowing that. By contrast, McDonald's offers a consistent product across many cities. Its brand name is useful to you as a way of judging the quality of what you are about to buy. The McDonald's brand name also ensures that the company has an incentive to maintain quality. For example, if some customers were to become ill from bad food sold at a McDonald's, the news would be disastrous for the company. McDonald's would lose much of the valuable reputation that it has built up with years of expensive advertising. As a result, it would lose sales and profit not just in the outlet that sold the bad food but in its many outlets throughout the country. By contrast, if some customers were to become ill from bad food at a local restaurant, that restaurant might have to close down, but the lost profits would be much smaller. Hence, McDonald's has a greater incentive to ensure that its food is safe. The debate over brand names thus centers on the question of whether consumers are rational in preferring brand names to generic substitutes. Critics argue that brand names are the result of an irrational consumer response to advertising. Defenders argue that consumers have good reason to pay more for brand name products because they can be more confident in the quality of these products. ScienceCartoonsPlus.com. Quick quiz: how might advertising make markets less competitive? How might it make markets more competitive? Give the arguments for and against brand names. 16-4 Conclusion: monopolistic competition is true to its name, it is a hybrid of monopoly and competition. Like a monopoly, each monopolistic competitor faces a downward-sloping demand curve and, as a result, charges a price above marginal cost. As in a perfectly competitive market, there are many firms, and entry and exit drive the profit of each monopolistic competitor toward zero in the long run. Table 1 summarizes these lessons. Because monopolistically competitive firms produce differentiated products, Each firm advertises to attract customers to its own brand. To some extent, advertising manipulates consumers' tastes, promotes irrational brand loyalty, and impedes competition. To a larger extent, advertising provides information, establishes brand names of reliable quality, and fosters competition. The theory of monopolistic competition seems to describe many markets in the economy. It is somewhat disappointing, therefore, that the theory does not yield simple and compelling advice for public policy. From the standpoint of the economic theorist, the allocation of resources in monopolistically competitive markets is not perfect. Yet from the standpoint of a practical policymaker, there may be little that can be done to improve it. A monopolistically competitive market is characterized by three attributes: many firms, differentiated products, and free entry. The long-run equilibrium in a monopolistically competitive market differs from that in a perfectly competitive market in two related ways. First, each firm in a monopolistically competitive market has excess capacity. That is, it chooses a quantity that puts it on the downward sloping portion of the average total cost curve. Second, each firm charges a price above marginal cost. Monopolistic competition does not have all the desirable properties of perfect competition. There is the standard deadweight loss of monopoly caused by the markup of price over marginal cost. In addition, the number of firms can be too large or too small. In practice, the ability of policymakers to correct these inefficiencies is limited. The product differentiation inherent in monopolistic competition leads to the use of advertising and brand names. Critics of advertising and brand names argue that firms use them to manipulate consumers' tastes and to reduce competition. Defenders of advertising and brand names argue that firms use them to inform consumers and to compete more vigorously on price and product quality. Summary: oligopoly, p. 330; monopolistic competition, p. 330. Key concepts. 345. 1. Which of the following conditions does not describe a firm in a monopolistically competitive market? A. It makes a product different from its competitors. B. It takes its price as given by market conditions. C. It maximizes profit both in the short run and in the long run. D. It has the freedom to enter or exit in the long run. 2. Which of the following goods best fits the definition of monopolistic competition? A. Wheat. B. Tap water. C. Crude oil. D. Soft drinks. 3. A monopolistically competitive firm will increase its production if A. Marginal revenue is greater than marginal cost. B. Marginal revenue is greater than average total cost. C. Price is greater than marginal cost. D. Price is greater than average total cost. 4. New firms will enter a monopolistically competitive market if A. Marginal revenue is greater than marginal cost. B. Marginal revenue is greater than average total cost. C. Price is greater than marginal cost. D. Price is greater than average total cost. 5. What is true of a monopolistically competitive market in long-run equilibrium? A. Price is greater than marginal cost. B. Price is equal to marginal revenue. C. Firms make positive economic profits. D. Firms produce at the minimum of average total cost. 6. If advertising makes consumers more loyal to particular brands, it could underscore the elasticity of demand and underscore the markup of price over marginal cost. A. Increase, B. Increase, decrease, C. Decrease, increase, D. Decrease, decrease. Quick check multiple choice. 1. Describe the three attributes of monopolistic competition. How is monopolistic competition like monopoly? How is it like perfect competition? 2. Draw a diagram depicting a firm that is making a profit in a monopolistically competitive market. Now show what happens to this firm as new firms enter the industry. 3. Draw a diagram of the long-run equilibrium in a monopolistically competitive market. How is price related to average total cost? How is price related to marginal cost? 4. Does a monopolistic competitor produce too much or too little output compared to the most efficient level? What practical considerations make it difficult for policymakers to solve this problem? 5. How might advertising reduce economic well-being? How might advertising increase economic well-being? 6. How might advertising with no apparent informational content in fact convey information to consumers? 7. Explain 2 benefits that might arise from the existence of brand names. Questions for review. 1. Among monopoly, oligopoly, monopolistic competition, and perfect competition, how would you classify the markets for each of the following drinks? A. Tap water. B. Bottled water. C. Cola. D. Beer. 2. Classify the following markets as perfectly competitive, monopolistic, or monopolistically competitive, and explain your answers. A. Wooden. Number 2. Pencils. B. Copper. C. Local electricity service. D. Peanut butter. E. Lipstick. 3. For each of the following characteristics, say whether it describes a perfectly competitive firm, a monopolistically competitive firm, both, or neither. A. Sells a product differentiated from that of its competitors. B. Has marginal revenue less than price. C. Earns economic profit in the long run. D. Produces at the minimum of average total cost in the long run. E. Equates marginal revenue and marginal cost. F. Charges a price above marginal cost. Problems and applications. 346. 4. For each of the following characteristics, say whether it describes a monopoly firm, a monopolistically competitive firm, both, or neither. A. Faces a downward sloping demand curve. B. Has marginal revenue less than price. C. Faces the entry of new firms selling similar products. D. Earns economic profit in the long run. E. Equates marginal revenue and marginal cost. F. Produces the socially efficient quantity of output. 5. You are hired as the consultant to a monopolistically competitive firm. The firm reports the following information about its price, marginal cost, and average total cost. Can the firm possibly be maximizing profit? If not, what should it do to increase profit? If the firm is profit maximizing, is the firm in a long-run equilibrium? If not, what will happen to restore long-run equilibrium? A. PATCB. PMC, PATCC. P equals MC, PATCD. PMC, P equals ATC. 6. Sparkle is one firm of many in the market for toothpaste, which is in long-run equilibrium. A. Draw a diagram showing Sparkle's demand curve, marginal revenue curve, average total cost curve, and marginal cost curve. Label Sparkle's profit maximizing output and price. B. What is Sparkle's profit? Explain. C. On your diagram, show the consumer surplus derived from the purchase of Sparkle toothpaste. Also show the deadweight loss relative to the efficient level of output. D. If the government forced Sparkle to produce the efficient level of output, what would happen to the firm? What would happen to Sparkle's customers? 7. Consider a monopolistically competitive market with N firms. Each firm's business opportunities are described by the following equations. A. How does N, the number of firms in the market, affect each firm's demand curve? Y. B. How many units does each firm produce? C. What price does each firm charge? D. How much profit does each firm make? E. In the long run, how many firms will exist in this market? 8. The market for peanut butter in Nutville is monopolistically competitive and in long-run equilibrium. One day, consumer advocate Skippy Jiff discovers that all brands of peanut butter in Nutville are identical. Thereafter, the market becomes perfectly competitive and again reaches its long-run equilibrium. Using an appropriate diagram, explain whether each of the following variables increases, decreases, or stays the same for a typical firm in the market. A. Price. B. Quantity. C. Average total cost. D. Marginal cost. E. Profit. 9. For each of the following pairs of firms, explain which firm would be more likely to engage in advertising. A family-owned farm or a family-owned restaurant. B a manufacturer of forklifts or a manufacturer of cars. C a company that invented a very comfortable razor or a company that invented a less comfortable razor. 10. Sleek Sneakers Co. is one of many firms in the market for shoes. A. Assume that Sleek is currently earning short-run economic profit. On a correctly labeled diagram, show Sleek's profit maximizing output and price, as well as the area representing profit. B. What happens to Sleek's price, output, and profit in the long run? Explain this change in words, and show it on a new diagram. C. Suppose that over time consumers become more focused on stylistic differences among shoe brands. How would this change in attitudes affect each firm's price elasticity of demand? In the long run, how will this change in demand affect Sleek's price, output, and profit? D. At the profit maximizing price you identified in part, is Sleek's demand curve elastic or inelastic? Explain. Go to CEngageBrain.com to purchase access to the proven, critical study guide to accompany this text, which features additional notes and context, practice tests, and much more. Demand, Q equals 100/NP. Marginal revenue, MR equals 100/N2Q. Total cost, TC equals 50 plus Q2. Marginal cost, MC equals 2Q. Oligopoly. If you go to a store to buy tennis balls, you will probably come home with one of 4 brands: Wilson, Penn, Dunlop, or Spalding. These 4 companies make almost all the tennis balls sold in the United States. Together these firms determine the quantity of tennis balls produced and, given the market demand curve, the price at which tennis balls are sold. The market for tennis balls is an example of an oligopoly. The essence of an oligopolistic market is that there are only a few sellers. As a result, the actions of any one seller in the market can have a large impact on the profits of all the other sellers. Oligopolistic firms are interdependent in a way that competitive firms are not. Our goal in this chapter is to see how this interdependence shapes the firm's behavior and what problems it raises for public policy. The analysis of oligopoly offers an opportunity to introduce game theory, the study of how people behave in strategic situations. By strategic we mean a situation in which a person, when choosing among alternative courses of action, must consider how others might respond to the action she takes. Strategic thinking is crucial not only in checkers, chess, and tic-tac-toe but also in many business decisions. Because oligopolistic markets have only a small number of firms, each firm must act strategically. Each firm knows that its profit depends not only on how much it produces but also on how much the other firms produce. In making its production decision, each firm in an oligopoly should consider how its decision might affect the production decisions of all the other firms in the market. Game theory is not necessary for understanding competitive or monopoly markets. In a market that is either perfectly competitive or monopolistically competitive, each firm is so small compared to the market that strategic interactions with other firms are not important. In a monopolized market, strategic interactions are absent because the market has only one firm. But, as we will see, game theory is useful for understanding oligopolies and many other situations in which a small number of players interact with one another. Game theory helps explain the strategies that people choose, whether they are playing tennis or selling tennis balls. Game theory: the study of how people behave in strategic situations. 17-1 markets with only a few sellers. Because an oligopolistic market has only a small group of sellers, a key feature of oligopoly is the tension between cooperation and self-interest. The oligopolists are best off when they cooperate and act like a monopolist, producing a small quantity of output and charging a price above marginal cost. Yet because each oligopolist cares only about its own profit, there are powerful incentives at work that hinder a group of firms from maintaining the cooperative outcome. 17-1A duopoly example: to understand the behavior of oligopolies, let's consider an oligopoly with only 2 members, called a duopoly. Duopoly is the simplest type of oligopoly. Oligopolies with 3 or more members face the same problems as duopolies, so we do not lose much by starting with the simpler case. Imagine a town in which only 2 residents, Jack and Jill, own wells that produce water safe for drinking. Each Saturday, Jack and Jill decide how many gallons of water to pump, bring the water to town, and sell it for whatever price the market will bear. To keep things simple, suppose that Jack and Jill can pump as much water as they want without cost. That is, the marginal cost of water equals 0. Table 1 shows the town's demand schedule for water. The first column shows the total quantity demanded, and the second column shows the price. If the 2 well owners sell a total of 10 gallons of water, water goes for $110 a gallon. If they sell a total of 20 gallons, the price falls to $100 a gallon. And so on. If you graphed these 2 columns of numbers, you would get a standard downward sloping demand curve. The last column in Table 1 shows the total revenue from the sale of water. It equals the quantity sold times the price. Because there is no cost to pumping water, the total revenue of the 2 producers equals their total profit. 349. Let's now consider how the organization of the town's water industry affects the price of water and the quantity of water sold. 17-1b Competition, monopolies, and cartels. Before considering the price and quantity of water that would result from the duopoly of Jack and Jill, let's discuss briefly what the outcome would be if the water market were either perfectly competitive or monopolistic. These 2 polar cases are natural benchmarks. If the market for water were perfectly competitive, the production decisions of each firm would drive price equal to marginal cost. Because we have assumed that the marginal cost of pumping additional water is 0, the equilibrium price of water under perfect competition would be 0 as well. The equilibrium quantity would be 120 gallons. The price of water would reflect the cost of producing it, and the efficient quantity of water would be produced and consumed. Now consider how a monopoly would behave. Table 1 shows that total profit is maximized at a quantity of 60 gallons and a price of $60 a gallon. A profit-maximizing monopolist, therefore, would produce this quantity and charge this price. As is standard for monopolies, price would exceed marginal cost. The result would be inefficient, because the quantity of water produced and consumed would fall short of the socially efficient level of 120 gallons. What outcome should we expect from our duopolists? One possibility is that Jack and Jill get together and agree on the quantity of water to produce and the price to charge for it. Such an agreement among firms over production and price is called collusion, and the group of firms acting in unison is called a cartel. Once a cartel is formed, the market is in effect served by a monopoly, and we can apply our analysis from Chapter 15. That is, if Jack and Jill were to collude, they would agree on the monopoly outcome because that outcome maximizes the total profit that they can get from the market. Our 2 producers would produce a total of 60 gallons, which would be sold at a price of $60 a gallon. Once again, price exceeds marginal cost, and the outcome is socially inefficient. A cartel must agree not only on the total level of production but also on the amount produced by each member. In our case, Jack and Jill must agree on how to split the monopoly production of 60 gallons. Each member of the cartel will want a larger share of the market because a larger market share means larger profit. If Jack and Jill agreed to split the market equally, each would produce 30 gallons, the price would be $60 a gallon, and each would get a profit of $1,800. Market Talk. By Alistair Lindsay. Most companies have antitrust compliance policies. They typically and quite rightly identify a number of things that officers and employees should not do, on pain of criminal liability, eye-watering fines and unlimited damages actions. All make clear that companies must not agree with their competitors to fix prices. This is a bright-line rule. But it raises an important question: can companies coordinate price increases without infringing the cartel rules? In markets where competitors need to publish their prices to win business, for example, Many retail markets it is perfectly lawful to shadow a rival's increases, so long as each seller acts entirely independently in setting its charges. The very definition of an oligopoly is a market involving a small number of suppliers that set their own commercial strategies but take account of their competitors. One competitor may emerge as a leader, with others taking their cue on when to raise prices and by how much. When prices are privately negotiated, as in many industrials markets it is common for a customer to volunteer information about a rival's prices to obtain leverage. You've quoted £100 per ton, but X is offering £95 and I'm going to them unless you can do better. A company that receives this information obtains valuable intelligence about what its rivals are charging, but it does not infringe cartel rules. Companies also sometimes signal to one another in their communications with investors, whether deliberately or not. A competitor which informs the markets, say, that it expects a price war to end in February is providing relevant information to actual and potential owners of its stock. But of course its rivals read the same reports and can change their strategies accordingly. So a statement to the market can serve as just as much of a signal to competitors as a statement made during a cartel meeting. Signaling through investor communications raises difficult questions for cartel enforcement. The enforcers want to protect consumers from the adverse effects of blatant signaling, but not at the price of losing transparency in financial markets. For example, it is highly relevant to an investor to know an airline's predicted growth of per-mile passenger revenue for the next quarter. But a rival airline might use the announced figure as a benchmark when setting its own fares for the next quarter. As things stand, cartel authorities have focused their efforts in such situations on blocking mergers in markets where signaling is prevalent, arguing that consolidation in such markets can further dampen competition by making coordination easier or more successful. However, they have not taken high-profile action alleging cartel infringements against companies for announcements made to investors. If there is no justification for a particular announcement other than to signal to competitors, cartel authorities should seek to intervene. For in this case the public announcement is analytically the same as a private discussion directly with the rivals, and there is scope for consumers to be seriously harmed. But most announcements do serve legitimate purposes, such as keeping investors informed. In these cases, intervention by the cartel authorities seems too complex, given the disparate policy objectives in play. Source: reprinted with permission of the Wall Street Journal. Copyright 2007 Dow Jones and Company Incorporated. All rights reserved worldwide. Public price fixing in the news. If a group of producers coordinates their prices in secret meetings, they can be sent to jail for criminal violations of antitrust laws. But what if they discuss the same topic in public? 351. 17-1 See the equilibrium for an oligopoly. Oligopolists would like to form cartels and earn monopoly profits, but that is often impossible. Squabbling among cartel members over how to divide the profit in the market can make agreement among members difficult. In addition, antitrust laws prohibit explicit agreements among oligopolists as a matter of public policy. Even talking about pricing and production restrictions with competitors can be a criminal offense. Let's therefore consider what happens if Jack and Jill decide separately how much water to produce. At first, one might expect Jack and Jill to reach the monopoly outcome on their own, because this outcome maximizes their joint profit. In the absence of a binding agreement, however, the monopoly outcome is unlikely. To see why, imagine that Jack expects Jill to produce only 30 gallons. Jack would reason as follows: I could produce 30 gallons as well. In this case, a total of 60 gallons of water would be sold at a price of $60 a gallon. My profit would be $1,800. Alternatively, I could produce 40 gallons. In this case, a total of 70 gallons of water would be sold at a price of $50 a gallon. My profit would be $2,000. Even though total profit in the market would fall, my profit would be higher, because I would have a larger share of the market. Of course, Jill might reason the same way. If so, Jack and Jill would each bring 40 gallons to town. Total sales would be 80 gallons, and the price would fall to $40. Thus, if the duopolists individually pursue their own self-interest when deciding how much to produce, they produce a total quantity greater than the monopoly quantity, charge a price lower than the monopoly price, and earn total profit less than the monopoly profit. Although the logic of self-interest increases the duopolist's output above the monopoly level, it does not push the duopolists all the way to the competitive allocation. Consider what happens when each duopolist produces 40 gallons. The price is $40, and each duopolist makes a profit of $1,600. In this case, Jack's self-interested logic leads to a different conclusion. Right now, my profit is $1,600. Suppose I increase my production to 50 gallons. In this case, a total of 90 gallons of water would be sold, and the price would be $30 a gallon. Then my profit would be only $1,500. Rather than increasing production and driving down the price, I am better off keeping my production at 40 gallons. The outcome in which Jack and Jill each produce 40 gallons looks like some sort of equilibrium. In fact, this outcome is called a Nash equilibrium. A Nash equilibrium is a situation in which economic actors interacting with one another each choose their best strategy given the strategies the others have chosen. In this case, given that Jill is producing 40 gallons, the best strategy for Jack is to produce 40 gallons. Similarly, given that Jack is producing 40 gallons, the best strategy for Jill is to produce 40 gallons. Once they reach this Nash equilibrium, neither Jack nor Jill has an incentive to make a different decision. This example illustrates the tension between cooperation and self-interest. Oligopolists would be better off cooperating and reaching the monopoly outcome. Yet because they pursue their own self-interest, they do not end up reaching the monopoly outcome and maximizing their joint profit. Each oligopolist is tempted to raise production and capture a larger share of the market. As each of them tries to do this, total production rises, and the price falls. At the same time, self-interest does not drive the market all the way to the competitive outcome. Like monopolists, oligopolists are aware that increasing the amount they produce reduces the price of their product, which in turn affects profits. Therefore, they stop short of following the competitive firm's rule of producing up to the point where price equals marginal cost. In summary, when firms in an oligopoly individually choose production to maximize profit, they produce a quantity of output greater than the level produced by monopoly and less than the level produced by perfect competition. The oligopoly price is less than the monopoly price but greater than the competitive price. 17-1D How the size of an oligopoly affects the market outcome. We can use the insights from this analysis of duopoly to discuss how the size of an oligopoly is likely to affect the outcome in a market. Suppose, for instance, that John and Joan suddenly discover water sources on their property and join Jack and Jill in the water oligopoly. The demand schedule in Table 1 remains the same, but now more producers are available to satisfy this demand. How would an increase in the number of sellers from 2 to 4 affect the price and quantity of water in the town? If the sellers of water could form a cartel, they would once again try to maximize total profit by producing the monopoly quantity and charging the monopoly price. Just as when there were only 2 sellers, the members of the cartel would need to agree on production levels for each member and find some way to enforce the agreement. As the cartel grows larger, however, this outcome is less likely. Reaching and enforcing an agreement becomes more difficult as the size of the group increases. If the oligopolists do not form a cartel, perhaps because the antitrust laws prohibit it, they must each decide on their own how much water to produce. To see how the increase in the number of sellers affects the outcome, consider the decision facing each seller. At any time, each well owner has the option to raise production by 1 gallon. In making this decision, the well owner weighs the following 2 effects. The output effect, because price is above marginal cost, selling 1 more gallon of water at the going price will raise profit. The price effect, raising production will increase the total amount sold, which will lower the price of water and lower the profit on all the other gallons sold. If the output effect is larger than the price effect, the well owner will increase production. If the price effect is larger than the output effect, the owner will not raise production. Each oligopolist continues to increase production until these two marginal effects exactly balance, taking the other firm's production as given. Now consider how the number of firms in the industry affects the marginal analysis of each oligopolist. The larger the number of sellers, the less each seller is concerned about her own impact on the market price. That is, as the oligopoly grows in size, the magnitude of the price effect falls. When the oligopoly grows very large, the price effect disappears altogether. That is, the production decision of an individual firm no longer affects the market price. In this extreme case, each firm takes the market price as given when deciding how much to produce. It increases production as long as price is above marginal cost. 353. We can now see that a large oligopoly is essentially a group of competitive firms. A competitive firm considers only the output effect when deciding how much to produce. Because a competitive firm is a price taker, the price effect is absent. Thus, as the number of sellers in an oligopoly grows larger, an oligopolistic market looks more and more like a competitive market. The price approaches marginal cost, and the quantity produced approaches the socially efficient level. This analysis of oligopoly offers a new perspective on the effects of international trade. Imagine that Toyota and Honda are the only automakers in Japan, Volkswagen and BMW are the only automakers in Germany, and Ford and General Motors are the only automakers in the United States. If these nations prohibited international trade in autos, each would have an auto oligopoly with only two members, and the market outcome would likely depart substantially from the competitive ideal. With international trade, however, the car market is a world market, and the oligopoly in this example has 6 members. Allowing free trade increases the number of producers from which each consumer can choose, and this increased competition keeps prices closer to marginal cost. Thus, the theory of oligopoly provides another reason, in addition to the theory of comparative advantage discussed in Chapter 3, why all countries can benefit from free trade. Quick quiz: if the members of an oligopoly could agree on a total quantity to produce, what quantity would they choose? If the oligopolists do not act together but instead make production decisions individually, do they produce a total quantity more or less than in your answer to the previous question? Why? 17-2 The economics of cooperation. As we have seen, oligopolies would like to reach the monopoly outcome. Doing so, however, requires cooperation, which at times is difficult to establish and maintain. In this section we look more closely at the problems that arise when cooperation among actors is desirable but difficult. To analyze the economics of cooperation, we need to learn a little about game theory. In particular, we focus on a game called the prisoner's dilemma, which provides insight into why cooperation is difficult. Many times in life, people fail to cooperate with one another even when cooperation would make them all better off. An oligopoly is just one example. The story of the prisoner's dilemma contains a general lesson that applies to any group trying to maintain cooperation among its members. 17-2 The prisoner's dilemma. The prisoner's dilemma is a story about two criminals who have been captured by the police. Let's call them Bonnie and Clyde. The police have enough evidence to convict Bonnie and Clyde of the minor crime of carrying an unregistered gun, so that each would spend a year in jail. The police also suspect that the two criminals have committed a bank robbery together, but they lack hard evidence to convict them of this major crime. The police question Bonnie and Clyde in separate rooms and offer each of them the following deal. Right now, we can lock you up for 1 year. If you confess to the bank robbery and implicate your partner, however, we'll give you immunity and you can go free. Your partner will get 20 years in jail. But if you both confess to the crime, we won't need your testimony and we can avoid the cost of a trial, so you will each get an intermediate sentence of 8 years. If Bonnie and Clyde, Heartless bank robbers that they are, care only about their own sentences. What would you expect them to do? Figure 1 shows their choices. Each prisoner has 2 strategies: confess or remain silent. The sentence each prisoner gets depends on the strategy he or she chooses and the strategy chosen by his or her partner in crime. Consider first Bonnie's decision. She reasons as follows: I don't know what Clyde is going to do. If he remains silent, my best strategy is to confess, since then I'll go free rather than spending a year in jail. If he confesses, my best strategy is still to confess, since then I'll spend 8 years in jail rather than 20. So, regardless of what Clyde does, I am better off confessing. In the language of game theory, a strategy is called a dominant strategy if it is the best strategy for a player to follow regardless of the strategies pursued by other players. In this case, confessing is a dominant strategy for Bonnie. She spends less time in jail if she confesses, regardless of whether Clyde confesses or remains silent. Now consider Clyde's decision. He faces the same choices as Bonnie, and he reasons in much the same way. Regardless of what Bonnie does, Clyde can reduce his jail time by confessing. In other words, confessing is also a dominant strategy for Clyde. In the end, both Bonnie and Clyde confess, and both spend 8 years in jail. This outcome is a Nash equilibrium. Each criminal is choosing the best strategy available, given the strategy the other is following. Yet, from their standpoint, the outcome is terrible. If they had both remained silent, both of them would have been better off, spending only 1 year in jail on the gun charge. Because each pursues his or her own interests, the 2 prisoners together reach an outcome that is worse for each of them. You might have thought that Bonnie and Clyde would have foreseen this situation and planned ahead. But even with advanced planning, they would still run into problems. Imagine that, before the police captured Bonnie and Clyde, the 2 criminals had made a pact not to confess. Clearly, this agreement would make them both better off if they both lived up to it, because they would each spend only 1 year in jail. But would the 2 criminals in fact remain silent, simply because they had agreed to? Once they are being questioned separately, the logic of self-interest takes over and leads them to confess. Cooperation between the 2 prisoners is difficult to maintain, because cooperation is individually irrational. 17-2b Oligopolies as a prisoner's dilemma. What does the prisoner's dilemma have to do with markets and imperfect competition? It turns out that the game oligopolists play in trying to reach the monopoly outcome is similar to the game that the 2 prisoners play in the prisoner's dilemma. Consider again the choices facing Jack and Jill. After prolonged negotiation, the 2 suppliers of water agree to keep production at 30 gallons so that the price will be kept high and together they will earn the maximum profit. After they agree on production levels, however, each of them must decide whether to cooperate and live up to this agreement or to ignore it and produce at a higher level. Figure 2 shows how the profits of the 2 producers depend on the strategies they choose. Suppose you are Jack. You might reason as follows: I could keep production at 30 gallons as we agreed, or I could raise my production and sell 40 gallons. If Jill lives up to the agreement and keeps her production at 30 gallons, then I earn profit of $2,000 by selling 40 gallons and $1,800 by selling 30 gallons. In this case, I am better off with the higher level production. If Jill fails to live up to the agreement and produces 40 gallons, then I earn $1,600 by selling 40 gallons and $1,500 by selling 30 gallons. Once again, I am better off with higher production. So, regardless of what Jill chooses to do, I am better off reneging on our agreement and producing at the higher level. Producing 40 gallons is a dominant strategy for Jack. Of course, Jill reasons in exactly the same way, and so both produce at the higher level of 40 gallons. The result is the inferior outcome with low profits for each of the 2 producers. This example illustrates why oligopolies have trouble maintaining monopoly profits. The monopoly outcome is jointly rational, but each oligopolist has an incentive to cheat. Just as self-interest drives the prisoners in the prisoner's dilemma to confess, self-interest makes it difficult for the oligopolists to maintain the cooperative outcome with low production, high prices, and monopoly profits. OPEC and the world oil market. Our story about the town's market for water is fictional, but if we change water to crude oil, and Jack and Jill to Iran and Iraq, the story is close to being true. Much of the world's oil is produced by a few countries, mostly in the Middle East. These countries together make up an oligopoly. Their decisions about how much oil to pump are much the same as Jack and Jill's decisions about how much water to pump. The countries that produce most of the world's oil have formed a cartel, called the Organization of Petroleum Exporting Countries. As originally formed in 1960, OPEC included Iran, Iraq, Kuwait, Saudi Arabia, and Venezuela. By 1973, 8 other nations had joined: Qatar, Indonesia, Libya, the United Arab Emirates, Algeria, Nigeria, Ecuador, and Gabon. These countries control about 3/4 of the world's oil reserves. Like any cartel, OPEC tries to raise the price of its product through a coordinated reduction in quantity produced. OPEC tries to set production levels for each of the member countries. The problem that OPEC faces is much the same as the problem that Jack and Jill face in our story. The OPEC countries would like to maintain a high price for oil. But each member of the cartel is tempted to increase its production to get a larger share of the total profit. OPEC members frequently agree to reduce production but then cheat on their agreements. OPEC was most successful at maintaining cooperation and high prices in the period from 1973 to 1985. The price of crude oil rose from $3 a barrel in 1972 to $11 in 1974 and then to $35 in 1981. But in the mid-1980s, member countries began arguing about production levels, and OPEC became ineffective at maintaining cooperation. By 1986 the price of crude oil had fallen back to $13 a barrel. In recent years, the members of OPEC have continued to meet regularly, but they have been less successful at reaching and enforcing agreements. As a result, fluctuations in oil prices have been driven more by the natural forces of supply and demand than by the cartel's artificial restrictions on production. While this lack of cooperation among OPEC nations has reduced the profits of the oil-producing nations below what they might have been, it has benefited consumers around the world. Case study 17-2 See other examples of the prisoner's dilemma. We have seen how the prisoner's dilemma can be used to understand the problem facing oligopolies. The same logic applies to many other situations as well. Here we consider 2 examples in which self-interest prevents cooperation and leads to an inferior outcome for the parties involved. Arms races. In the decades after World War II, the world's 2 superpowers, the United States and the Soviet Union, were engaged in a prolonged competition over military power. This topic motivated some of the early work on game theory. The game theorists pointed out that an arms race is much like the prisoner's dilemma. To see why, consider the decisions of the United States and the Soviet Union about whether to build new weapons or to disarm. Each country prefers to have more arms than the other because a larger arsenal would give it more influence in world affairs. But each country also prefers to live in a world safe from the other country's weapons. 357. Figure 3 shows the deadly game. If the Soviet Union chooses to arm, the United States is better off doing the same to prevent the loss of power. If the Soviet Union chooses to disarm, the United States is better off arming because doing so would make it more powerful. For each country, arming is a dominant strategy. Thus, each country chooses to continue the arms race, resulting in the inferior outcome with both countries at risk. Throughout the Cold War era from about 1945 to 1991, the United States and the Soviet Union attempted to solve this problem through negotiation and agreements over arms control. The problems that the 2 countries faced were similar to those that oligopolists encounter in trying to maintain a cartel. Just as oligopolists argue over production levels, the United States and the Soviet Union argued over the amount of arms that each country would be allowed. And just as cartels have trouble enforcing production levels, the United States and the Soviet Union each feared that the other country would cheat on any agreement. In both arms races and oligopolies, the relentless logic of self-interest drives the participants toward the non-cooperative outcome, which is worse for both parties. Common resources. In Chapter 11 we saw that people tend to overuse common resources. One can view this problem as an example of the prisoner's dilemma. Imagine that two oil companies Exxon and Texaco own adjacent oil fields. Under the fields is a common pool of oil worth $12 million. Drilling a well to recover the oil costs $1 million. If each company drills one well, each will get half of the oil and earn a $5 million profit. Because the pool of oil is a common resource, the companies will not use it efficiently. Suppose that either company could drill a second well. If one company has two of the three wells, that company gets 2/3 of the oil, which yields a profit of $6 million. The other company gets 1/3 of the oil, for a profit of $3 million. Yet if each company drills a second well, the two companies again split the oil. In this case, each bears the cost of a second well, so profit is only $4 million for each company. 17-2D The Prisoner's Dilemma and the Welfare of Society. The Prisoner's Dilemma describes many of life's situations, and it shows that cooperation can be difficult to maintain, even when cooperation would make both players in the game better off. Clearly, this lack of cooperation is a problem for those involved in these situations. But is lack of cooperation a problem from the standpoint of society as a whole? The answer depends on the circumstances. In some cases, the non-cooperative equilibrium is bad for society as well as the players. In the arms race game in Figure 3, both the United States and the Soviet Union end up at risk. In the common resources game in Figure 4, the extra wells dug by Texaco and Exxon are pure waste. In both cases, society would be better off if the two players could reach the cooperative outcome. By contrast, in the case of oligopolists trying to maintain monopoly profits, lack of cooperation is desirable from the standpoint of society as a whole. The monopoly outcome is good for the oligopolists, but it is bad for the consumers of the product. As we first saw in Chapter 7, the competitive outcome is best for society because it maximizes total surplus. When oligopolists fail to cooperate, the quantity they produce is closer to this optimal level. Put differently, the invisible hand guides markets to allocate resources efficiently only when markets are competitive, and markets are competitive only when firms in the market fail to cooperate with one another. Similarly, consider the case of the police questioning two suspects. Lack of cooperation between the suspects is desirable, for it allows the police to convict more criminals. The prisoner's dilemma is a dilemma for the prisoners, but it can be a boon to everyone else. 17-2E Why people sometimes cooperate. The prisoner's dilemma shows that cooperation is difficult. But is it impossible? Not all prisoners, when questioned by the police, decide to turn in their partners in crime. Cartels sometimes manage to maintain collusive arrangements, despite the incentive for individual members to defect. Very often, players can solve the prisoner's dilemma because they play the game not once but many times. To see why cooperation is easier to enforce in repeated games, let's return to our duopolists, Jack and Jill, whose choices were given in Figure 2. Jack and Jill would like to agree to maintain the monopoly outcome in which each produces 30 gallons. Yet, if Jack and Jill are to play this game only once, neither has any incentive to live up to this agreement. Self-interest drives each of them to renege and choose the dominant strategy of 40 gallons. Now suppose that Jack and Jill know that they will play the same game every week. When they make their initial agreement to keep production low, they can also specify what happens if one party reneges. They might agree, for instance, that once one of them reneges and produces 40 gallons, both of them will produce 40 gallons forever after. This penalty is easy to enforce, for if one party is producing at a high level, the other has every reason to do the same. The threat of this penalty may be all that is needed to maintain cooperation. Each person knows that defecting would raise his or her profit from $1,800 to $2,000. But this benefit would last for only 1 week. Thereafter, profit would fall to $1,600 and stay there. As long as the players care enough about future profits, they will choose to forego the one-time gain from defection. Thus, in a game of repeated prisoner's dilemma, the two players may well be able to reach the cooperative outcome. The prisoner's dilemma tournament. Imagine that you are playing a game of prisoner's dilemma with a person being questioned in a separate room. Moreover, imagine that you are going to play not once but many times. Your score at the end of the game is the total number of years in jail. You would like to make this score as small as possible. What strategy would you play? Would you begin by confessing or remaining silent? How would the other player's actions affect your subsequent decisions about confessing? Repeated prisoner's dilemma is a complicated game. To encourage cooperation, players must penalize each other for not cooperating. Yet the strategy described earlier for Jack and Jill's water cartel defect forever as soon as the other player defects is not very forgiving. In a game repeated many times, a strategy that allows players to return to the cooperative outcome after a period of non-cooperation may be preferable. To see what strategies work best, political scientist Robert Axelrod held a tournament. People entered by sending computer programs designed to play repeated prisoner's dilemma. Each program then played the game against all the other programs. The winner was the program that received the fewest total years in jail. The winner turned out to be a simple strategy called tit for tat. According to tit for tat, a player should start by cooperating and then do whatever the other player did last time. Thus, a tit for tat player cooperates until the other player defects, then she defects until the other player cooperates again. In other words, this strategy starts out friendly, penalizes unfriendly players, and forgives them if warranted. To Axelrod's surprise, this simple strategy did better than all the more complicated strategies that people had sent in. The tit-for-tat strategy has a long history. It is essentially the biblical strategy of an eye for an eye, a tooth for a tooth. The prisoner's dilemma tournament suggests that this may be a good rule of thumb for playing some of the games of life. Case study 360. 17-3 Public Policy Toward Oligopolies. Quick quiz. Tell the story of the prisoner's dilemma. Write down a table showing the prisoner's choices and explain what outcome is likely. What does the prisoner's dilemma teach us about oligopolies? One of the 10 principles of economics in Chapter 1 is that governments can sometimes improve market outcomes. This principle applies directly to oligopolistic markets. As we have seen, cooperation among oligopolists is undesirable from the standpoint of society as a whole because it leads to production that is too low and prices that are too high. To move the allocation of resources closer to the social optimum, policymakers should try to induce firms in an oligopoly to compete rather than cooperate. Let's consider how policymakers do this and then examine the controversies that arise in this area of public policy. 17-3 A restraint of trade and the antitrust laws. One way that policy discourages cooperation is through the common law. Normally, freedom of contract is an essential part of a market economy. Businesses and households use contracts to arrange mutually advantageous trades. In doing this, they rely on the court system to enforce contracts. Yet, for many centuries, judges in England and the United States have deemed agreements among competitors to reduce quantities and raise prices to be contrary to the public good. They have therefore refused to enforce such agreements. The Sherman Antitrust Act of 1890 codified and reinforced this policy. Every contract, combination in the form of trust or otherwise, or conspiracy, in restraint of trade or commerce among the several states, or with foreign nations, is declared to be illegal. Every person who shall monopolize, or attempt to monopolize, or combine, or conspire with any person or persons to monopolize any part of the trade or commerce among the several states, or with foreign nations, shall be deemed guilty of a misdemeanor, and on conviction thereof, shall be punished by fine not exceeding $50,000, or by imprisonment not exceeding 1 year, or by both said punishments, in the discretion of the court. The Sherman Act elevated agreements among oligopolists from unenforceable contracts to criminal conspiracies. The Clayton Act of 1914 further strengthened the antitrust laws. According to this law, if a person could prove that she was damaged by an illegal arrangement to restrain trade, that person could sue and recover 3 times the damages she sustained. The purpose of this unusual rule of triple damages is to encourage private lawsuits against conspiring oligopolists. Today, both the U.S. Justice Department and private parties have the authority to bring legal suits to enforce the antitrust laws. As we discussed in Chapter 15, these laws are used to prevent mergers that would lead to excessive market power in any single firm. In addition, these laws are used to prevent oligopolists from acting together in ways that would make their markets less competitive. 361. An illegal phone call. Firms in oligopolies have a strong incentive to collude in order to reduce production, raise price, and increase profit. The great 18th century economist Adam Smith was well aware of this potential market failure. In The Wealth of Nations he wrote, "People of the same trade seldom meet together, but the conversation ends in a conspiracy against the public, or in some diversion to raise prices." To see a modern example of Smith's observation, consider the following excerpt of a phone conversation between 2 airline executives in the early 1980s. The call was reported in the New York Times on February 24, 1983. Robert Crandall was president of American Airlines, and Howard Putnam was president of Braniff Airways, a major airline at the time. Crandall: "I think it's dumb as hell. To sit here and pound the $% out of each other and neither one of us making a $% and dime." Putnam: "Do you have a suggestion for me?" Crandall: "Yes, I have a suggestion for you. Raise your $% and fares 20%. I'll raise mine the next morning." Putnam: "Robert, we." Crandall: "You'll make more money, and I will, too." Putnam: "We can't talk about pricing." Crandall: "Oh, at $%, Howard. We can talk about any and *at thing we want to talk about." Putnam was right. The Sherman Antitrust Act prohibits competing executives from even talking about fixing prices. When Putnam gave a tape of this conversation to the Justice Department, the Justice Department filed suit against Crandall. 2 years later, Crandall and the Justice Department reached a settlement in which Crandall agreed to various restrictions on his business activities, including his contacts with officials at other airlines. The Justice Department said that the terms of settlement would protect competition in the airline industry, by preventing American and Crandall from any further attempts to monopolize passenger airline service on any route through discussions with competitors about the prices of airline services. Case study 17-3B Controversies over antitrust policy. Over time, much controversy has centered on what kinds of behavior the antitrust laws should prohibit. Most commentators agree that price-fixing agreements among competing firms should be illegal. Yet the antitrust laws have been used to condemn some business practices whose effects are not obvious. Here we consider 3 examples. Resale price maintenance. One example of a controversial business practice is resale price maintenance. Imagine that SuperDuper Electronics sells Blu-ray disc players to retail stores for $100. If SuperDuper requires the retailers to charge customers $150, it is said to engage in resale price maintenance. Any retailer that charged less than $150 would violate its contract with SuperDuper. 362. At first, resale price maintenance might seem anti-competitive and, therefore, detrimental to society. Like an agreement among members of a cartel, it prevents the retailers from competing on price. For this reason, the courts have at times viewed resale price maintenance as a violation of the antitrust laws. Yet some economists defend resale price maintenance on 2 grounds. First, they deny that it is aimed at reducing competition. To the extent that super-duper electronics has any market power, it can exert that power through the wholesale price, rather than through resale price maintenance. Moreover, super-duper has no incentive to discourage competition among its retailers. Indeed, because a cartel of retailers sells less than a group of competitive retailers, super-duper would be worse off if its retailers were a cartel. Second, economists believe that resale price maintenance has a legitimate goal. Super-duper may want its retailers to provide customers a pleasant showroom and a knowledgeable sales force. Yet, without resale price maintenance, some customers would take advantage of one store's service to learn about the Blu-ray player's special features and then buy the item at a discount retailer that does not provide this service. To some extent, good service is a public good among the retailers that sell super-duper products. As we discussed in Chapter 11, when one person provides a public good, others are able to enjoy it without paying for it. In this case, discount retailers would free ride on the service provided by other retailers, leading to less service than is desirable. Resale price maintenance is one way for super-duper to solve this free rider problem. The example of resale price maintenance illustrates an important principle: business practices that appear to reduce competition may in fact have legitimate purposes. This principle makes the application of the antitrust laws all the more difficult. The economists, lawyers, and judges in charge of enforcing these laws must determine what kinds of behavior public policy should prohibit as impeding competition and reducing economic well-being. Often that job is not easy. Predatory pricing firms with market power normally use that power to raise prices above the competitive level. But should policymakers ever be concerned that firms with market power might charge prices that are too low? This question is at the heart of a second debate over antitrust policy. Imagine that a large airline, call it Coyote Air, has a monopoly on some route. Then Roadrunner Express enters and takes 20% of the market, leaving Coyote with 80%. In response to this competition, Coyote starts slashing its fares. Some antitrust analysts argue that Coyote's move could be anti-competitive. The price cuts may be intended to drive Roadrunner out of the market so Coyote can recapture its monopoly and raise prices again. Such behavior is called predatory pricing. Although predatory pricing is a common claim in antitrust suits, some economists are skeptical of this argument and believe that predatory pricing is rarely, if ever, a profitable business strategy. Why? For a price war to drive out a rival, prices have to be driven below cost. Yet if Coyote starts selling cheap tickets at a loss, it had better be ready to fly more planes, because low fares will attract more customers. Roadrunner, meanwhile, can respond to Coyote's predatory move by cutting back on flights. As a result, Coyote ends up bearing more than 80% of the losses, putting Roadrunner in a good position to survive the price war. As in the old Roadrunner, Coyote cartoons, the predator suffers more than the prey. 363. Economists continue to debate whether predatory pricing should be a concern for antitrust policymakers. Various questions remain unresolved. Is predatory pricing ever a profitable business strategy? If so, when? Are the courts capable of telling which price cuts are competitive and thus good for consumers and which are predatory? There are no simple answers. Tying. A third example of a controversial business practice is tying. Suppose that Make Money Movies produces two new films, The Avengers and Hamlet. If Make Money offers theaters the two films together at a single price, rather than separately, the studio is said to be tying its two products. When the practice of tying movies was challenged, the Supreme Court banned it. The court reasoned as follows: imagine that The Avengers is a blockbuster, whereas Hamlet is an unprofitable art film. Then the studio could use the high demand for The Avengers to force theaters to buy Hamlet. It seemed that the studio could use tying as a mechanism for expanding its market power. Many economists are skeptical of this argument. Imagine that theaters are willing to pay $20,000 for The Avengers and nothing for Hamlet. Then the most that a theater would pay for the two movies together is $20,000, the same as it would pay for the Avengers by itself. Forcing the theater to accept a worthless movie as part of the deal does not increase the theater's willingness to pay. Make Money cannot increase its market power simply by bundling the two movies together. Why, then, does tying exist? One possibility is that it is a form of price discrimination. Suppose there are two theaters. City Theater is willing to pay $15,000 for the Avengers and $5,000 for Hamlet. Country Theater is just the opposite, it is willing to pay $5,000 for the Avengers and $15,000 for Hamlet. If Make Money charges separate prices for the two films, its best strategy is to charge $15,000 for each film, and each theater chooses to show only one film. Yet if Make Money offers the two movies as a bundle, it can charge each theater $20,000 for the movies. Thus, if different theaters value the films differently, tying may allow the studio to increase profit by charging a combined price closer to the buyer's total willingness to pay. Tying remains a controversial business practice. The Supreme Court's argument that tying allows a firm to extend its market power to other goods is not well founded, at least in its simplest form. Yet economists have proposed more elaborate theories for how tying can impede competition. Given our current economic knowledge, it is unclear whether tying has adverse effects for society as a whole. The Microsoft case. The most important and controversial antitrust case in recent years has been the U.S. government's suit against the Microsoft Corporation, filed in 1998. Certainly, the case did not lack drama. It pitted one of the world's richest men against one of the world's most powerful regulatory agencies. Testifying for the government was a prominent economist. Testifying for Microsoft was an equally prominent economist. At stake was the future of one of the world's most valuable companies in one of the economy's fastest growing industries. A central issue in the Microsoft case involved tying, in particular, whether Microsoft should be allowed to integrate its Internet browser into its Windows. Case Study 364. Operating System. The government claimed that Microsoft was bundling these two products together to expand its market power in computer operating systems into the unrelated market of Internet browsers. Allowing Microsoft to incorporate such products into its operating system, the government argued, would deter other software companies from entering the market and offering new products. Microsoft responded by pointing out that putting new features into old products is a natural part of technological progress. Cars today include CD players and air conditioners, which were once sold separately, and cameras come with built-in flashes. The same is true with operating systems. Over time, Microsoft has added many features to Windows that were previously standalone products. This has made computers more reliable and easier to use because consumers can be confident that the pieces work together. The integration of Internet technology, Microsoft argued, was the natural next step. One point of disagreement concerned the extent of Microsoft's market power. Noting that more than 80% of new personal computers used a Microsoft operating system, the government argued that the company had substantial monopoly power, which it was trying to expand. Microsoft replied that the software market is always changing and that Microsoft's Windows was constantly being challenged by competitors, such as the Apple Mac and Linux operating systems. It also argued that the low price it charged for Windows, about $50, or only 3% of the price of a typical computer, was evidence that its market power was severely limited. Like many large antitrust suits, the Microsoft case became a legal morass. In November 1999, after a long trial, Judge Penfield Jackson ruled that Microsoft had great monopoly power and that it had illegally abused that power. In June 2000, after hearings on possible remedies, he ordered that Microsoft be broken up into two companies, one that sold the operating system and one that sold application software. A year later, an appeals court overturned Jackson's breakup order and handed the case to a new judge. In September 2001, the Justice Department announced that it no longer sought a breakup of the company and wanted to settle the case quickly. A settlement was finally reached in November 2002. Microsoft accepted some restrictions on its business practices, and the government accepted that a browser would remain part of the Windows operating system. But the settlement did not end Microsoft's antitrust troubles. In recent years, the company has contended with several private antitrust suits, as well as suits brought by the European Union alleging a variety of anti-competitive behaviors. Quick quiz: what kind of agreement is illegal for businesses to make? Why are the antitrust laws controversial? 17-4 Conclusion. Oligopolies would like to act like monopolies, but self-interest drives them toward competition. Where oligopolies end up on this spectrum depends on the number of firms in the oligopoly and how cooperative the firms are. The story of the prisoner's dilemma shows why oligopolies can fail to maintain cooperation, even when cooperation is in their best interest. 365. The College Sports Cartel. By Joe Nocera. Twice a year in Vienna, the members of the Organization of Petroleum Exporting Countries gather to decide on the short-term direction of oil prices. Sometimes, OPEC agrees to cut back on oil production, pushing up the price of oil. Other times, it decides to boost production. Always, the goal is to fix the price of oil, rather than allow it to be set by the competitive marketplace. Indeed, collusion and price fixing are the main reasons cartels exist and why they are illegal in America. Yet, in Indianapolis a few weeks from now, a homegrown cartel will hold its annual meeting, where it, too, will be working to collude and fix prices. This cartel is the National Collegiate Athletic Association. The NCAA would have you believe that it is the great protector of amateur athletics, preventing college athletes from being tainted by the river of money pouring over college sports. In fact, the N.C.A.'s real role is to oversee the collusion of university athletic departments, whose goal is to maximize revenue and suppress the wages of its captive labor force, aka the players. Sports leagues can't exist without at least some collusion. As Andy Swartz, an economist and litigation consultant, puts it, if steel companies got together to decide when and where to produce steel, that would violate the antitrust laws. But if sports teams in a league get together to decide when and where to play games, that's generally allowed. Major League Baseball has long had an antitrust exemption. Other professional leagues have salary caps, which are legal because they have been agreed to by the players. The NCAA has neither an antitrust exemption nor a players' union to negotiate with. In other words, it lacks some of the legal protections that shield professional sports from antitrust suits. What it has, instead, is a workforce full of young adults dreaming of becoming pros and willing to sign any document, no matter how onerous, if it will help them reach that goal. The document the NCAA forces them to sign completely stacks the deck against them. Recently, Mark Emmert, the president of the NCAA, tried to make the rules a tad less onerous. He got the NCAA board of directors to approve an optional $2,000 stipend, as well as a 4-year scholarship instead of the current 1-year deal for players. And how did the cartel react to these modest changes? It rose up in revolt. Enough universities signed an override petition to temporarily ice the new stipend. The same thing happened with the 4-year scholarship. A lawyer in Fort Worth, Christian Denny, who specializes in sports law, got a hold of an internal NCAA document outlining some of the objections. One is especially worth repeating. The new coach may have a completely different style of offense/defense that the student athlete no longer fits into, wrote Indiana State. 4-year scholarships might mean that the school would be stuck with someone that is of no athletic usefulness to the program. Thus, does at least one school show how it truly views its student athletes? How can it be that the NCAA can define amateurism in one moment as allowing a $2,000 stipend and in the next moment as forbidding such a stipend? How can it justify rolling back a change that would truly help student athletes, such as the 4-year scholarship, simply because coaches want to continue to have life or death power over their charges. How can the labor force that generates so much money for everyone else be kept in shackles by the NCAA? The NCAA claims it has the legal right to do all the above and more. And maybe it does. But it certainly would be worthwhile to see someone challenge its cartel behavior in court. The inevitable rollback of the $2,000 stipend and the 4-year scholarship would be an awfully good place to start. Colleges and universities regularly meet to discuss the deals they offer student athletes. This op-ed questions whether this coordination might violate the antitrust laws. Policymakers regulate the behavior of oligopolists through the antitrust laws. The proper scope of these laws is the subject of ongoing controversy. Although price fixing among competing firms clearly reduces economic welfare and should be illegal, some business practices that appear to reduce competition may have legitimate if subtle purposes. As a result, policymakers need to be careful when they use the substantial powers of the antitrust laws to place limits on firm behavior. Oligopolists maximize their total profits by forming a cartel and acting like a monopolist. Yet, if oligopolists make decisions about production levels individually, the result is a greater quantity and a lower price than under the monopoly outcome. The larger the number of firms in the oligopoly, the closer the quantity and price will be to the levels that would prevail under perfect competition. The prisoner's dilemma shows that self-interest can prevent people from maintaining cooperation, even when cooperation is in their mutual interest. The logic of the prisoner's dilemma applies in many situations, including arms races, common resource problems, and oligopolies. Policymakers use the antitrust laws to prevent oligopolies from engaging in behavior that reduces competition. The application of these laws can be controversial, because some behavior that can appear to reduce competition may in fact have legitimate business purposes. Summary: oligopoly, P347 game theory, P348 collusion, P349 cartel, P349 Nash equilibrium, P351 prisoner's dilemma, P353 dominant strategy, P354 key concepts. 1. If a group of sellers could form a cartel, what quantity and price would they try to set? 2. Compare the quantity and price of an oligopoly to those of a monopoly. 3. Compare the quantity and price of an oligopoly to those of a competitive market. 4. How does the number of firms in an oligopoly affect the outcome in its market? 5. What is the prisoner's dilemma, and what does it have to do with oligopoly? 6. Give 2 examples other than oligopoly that show how the prisoner's dilemma helps to explain behavior. 7. What kinds of behavior do the antitrust laws prohibit? Questions for review. 1. The key feature of an oligopolistic market is that each firm produces a different product from other firms. B. A single firm chooses a point on the market demand curve. C. Each firm takes the market price as given. D. A small number of firms are acting strategically. 2. If an oligopolistic industry organizes itself as a cooperative cartel, it will produce a quantity of output that is the competitive level and the monopoly level. A less than, more than B more than, less than C less than, equal to D equal to, more than. Quick check multiple choice. 367. 1. A large share of the world's supply of diamonds comes from Russia and South Africa. Suppose that the marginal cost of mining diamonds is constant at $1,000 per diamond and the demand for diamonds is described by the following schedule. Price quantity $8,000 5,000 diamonds 7,000 6,000 6,000 7,000 5,000 8,000 4,000 9,000 3,000 10,000 2,000 11,000 1,000 12,000. A. If there were many suppliers of diamonds, what would be the price and quantity? B. If there were only one supplier of diamonds, what would be the price and quantity? C. If Russia and South Africa formed a cartel, What would be the price and quantity? If the countries split the market evenly, what would be South Africa's production and profit? What would happen to South Africa's profit if it increased its production by $1,000 while Russia stuck to the cartel agreement? D. Use your answers to part to explain why cartel agreements are often not successful. 2. The New York Times reported that the inability of OPEC to agree last week to cut production has sent the oil market into turmoil. The lowest price for domestic crude oil since June 1998. Why were the members of OPEC trying to agree to cut production? B. Why do you suppose OPEC was unable to agree on cutting production? Why did the oil market go into turmoil as a result? C. The newspaper also noted OPEC's view that producing nations outside the organization, like Norway and Britain, should do their share and cut production. What does the phrase "do their share" suggest about OPEC's desired relationship with Norway and Britain? 3. This chapter discusses companies that are oligopolists in the market for the goods they sell. Many of the same ideas apply to companies that are oligopolists in the market for the inputs they buy. A. If sellers who are oligopolists try to increase the price of goods they sell, what is the goal of buyers who are oligopolists? B. Major League Baseball team owners have an oligopoly in the market for baseball players. What is the owner's goal regarding players' salaries? Why is this goal difficult to achieve? C. Baseball players went on strike in 1994 because they would not accept the salary cap that the owners wanted to impose. If the owners were already colluding over salaries, why did they feel the need for a salary cap? Problems and applications. 3. If an oligopoly does not cooperate and each firm chooses its own quantity, the industry will produce a quantity of output that is the competitive level and the monopoly level. A less than, more than B more than, less than C less than, equal to D equal to, more than. 4. As the number of firms in an oligopoly grows large, the industry approaches a level of output that is the competitive level and the monopoly level. A less than, more than B more than, less than C less than, equal to D equal to, more than. 5. The prisoner's dilemma is a two-person game illustrating that A. The cooperative outcome could be worse for both people than the Nash equilibrium. B. Even if the cooperative outcome is better than the Nash equilibrium for one person, it might be worse for the other. C. Even if cooperation is better than the Nash equilibrium, each person might have an incentive not to cooperate. D. Rational, self-interested individuals will naturally avoid the Nash equilibrium because it is worse for both of them. 6. The antitrust laws aim to facilitate cooperation among firms in oligopolistic industries. B. Encourage mergers to take advantage of economies of scale. C. Discourage firms from moving production facilities overseas. D. Prevent firms from acting in ways that reduce competition. 368. 4. Consider trade relations between the United States and Mexico. Assume that the leaders of the two countries believe the payoffs to alternative trade policies are as follows. United States decision. Low tariffs. Low tariffs. U.S. gains $25 billion. Mexico gains $25 billion. Mexico gains $10 billion. Mexico gains $30 billion. Mexico gains $20 billion. U.S. gains $30 billion. U.S. gains $10 billion. U.S. gains $20 billion. High tariffs. High tariffs. Mexico's decision. A. What is the dominant strategy for the United States? For Mexico? Explain. B. Define Nash equilibrium. What is the Nash equilibrium for trade policy? C. In 1993, The U.S. Congress ratified the North American Free Trade Agreement, in which the United States and Mexico agreed to reduce trade barriers simultaneously. Do the perceived payoffs shown here justify this approach to trade policy? Explain. D. Based on your understanding of the gains from trade, do you think that these payoffs actually reflect a nation's welfare under the four possible outcomes? 5. Synergy and Dynaco are the only two firms in a specific high-tech industry. They face the following payoff matrix as they decide upon the size of their research budget. Synergy's decision. Large budget. Large budget. Synergy gains $20 million. Dynaco gains $30 million. Dynaco gains $70 million. Dynaco gains 0. Dynaco gains $50 million. Synergy gains 0. Synergy gains $30 million. Synergy gains $40 million. Small budget. Small budget. Dynaco's decision. A. Does Synergy have a dominant strategy? Explain. B. Does Dynaco have a dominant strategy? Explain. C. Is there a Nash equilibrium for this scenario? Explain. 6. You and a classmate are assigned a project on which you will receive one combined grade. You each want to receive a good grade, but you also want to avoid hard work. In particular, here is the situation: if both of you work hard, you both get an A, which gives each of you 40 units of happiness. If only one of you works hard, you both get a B, which gives each of you 30 units of happiness. If neither of you works hard, you both get a D, which gives each of you 10 units of happiness. Working hard costs 25 units of happiness. A. Fill in the payoffs in the following decision box. B. What is the likely outcome? Explain your answer. C. If you get this classmate as your partner on a series of projects throughout the year, rather than only once, how might that change the outcome you predicted in part? D. Another classmate cares more about good grades, she gets 50 units of happiness for a B, and 80 units of happiness for an A. If this classmate were your partner, how would your answers to parts and change? Which of the two classmates would you prefer as a partner? Would she also want you as a partner? 7. A case study in the chapter describes a phone conversation between the presidents of American Airlines and Braniff Airways. Let's analyze the game between the two companies. Suppose that each company can charge either a high price for tickets or a low price. If one company charges $300, it earns low profit if the other company also charges $300 and high profit if the other company charges $600. On the other hand, if the company charges $600, it earns very low profit if the other company charges $300 and medium profit if the other company also charges $600. A. Draw the decision box for this game. B. What is the Nash equilibrium in this game? Explain. C. Is there an outcome that would be better than the Nash equilibrium for both airlines? How could it be achieved? Who would lose if it were achieved? 8. Two athletes of equal ability are competing for a prize of $10,000. Each is deciding whether to take a dangerous performance-enhancing drug. If one athlete takes the drug, and the other does not, the one who takes the drug wins the prize. If both or neither take the drug, they tie and split the prize. Taking the drug imposes health risks that are equivalent to a loss of X dollars. A. Draw a 2x2 payoff matrix describing the decisions the athletes face. 369. B. For what X is taking the drug the Nash equilibrium? C. Does making the drug safer make the athletes better or worse off? Explain. 9. Little Kona is a small coffee company that is considering entering a market dominated by Big Brew. Each company's profit depends on whether Little Kona enters and whether Big Brew sets a high price or a low price. Big Brew Enter. High price. Brew makes $3 million. Kona makes $2 million. Kona loses $1 million. Kona makes 0. Kona makes 0. Brew makes $1 million. Brew makes $7 million. Brew makes $2 million. Low price. Don't. Enter. Little. Kona. A. Does either player in this game have a dominant strategy? B. Does your answer to part help you figure out what the other player should do? What is the Nash equilibrium? Is there only one? C. Big Brew threatens Little Kona by saying, if you enter, we're going to set a low price, so you had better stay out. Do you think Little Kona should believe the threat? Why or why not? D. If the two firms could collude and agree on how to split the total profits, what outcome would they pick? Go to CEngageBrain.com to purchase access to the proven, critical study guide to accompany this text, which features additional notes and context, practice tests, and much more. The Economics of Labor Markets. Part 6. 373. W. When you finish school, your income will be determined largely by what kind of job you take. If you become a computer programmer, you will earn more than if you become a gas station attendant. This fact is not surprising, but it is not obvious why it is true. No law requires that computer programmers be paid more than gas station attendants. No ethical principle says that programmers are more deserving. What then determines which job will pay you the higher wage? Your income, of course, is a small piece of a larger economic picture. In 2012, the total income of all U.S. residents was about $15 trillion. People earned this income in various ways. Workers earned about 2/3 of it in the form of wages and fringe benefits. The rest went to landowners and to the owners of capital, the economy's stock of equipment and structures, in the form of rent, profit, and interest. What determines how much goes to workers? To landowners? To the owners of capital? Why do some workers earn higher wages than others, some landowners higher rental income than others, and Chapter 18. The markets for the factors of production. 374. Some capital owners greater profit than others. Why, in particular, do computer programmers earn more than gas station attendants? The answers to these questions, like most in economics, hinge on supply and demand. The supply and demand for labor, land, and capital determine the prices paid to workers, landowners, and capital owners. To understand why some people have higher incomes than others, therefore, we need to look more deeply at the markets for the services they provide. That is our job in this and the next two chapters. This chapter provides the basic theory for the analysis of factor markets. As you may recall from Chapter 2, the factors of production are the inputs used to produce goods and services. Labor, land, and capital are the three most important factors of production. When a computer firm produces a new software program, it uses programmers' time, the physical space on which its offices are located, and an office building and computer equipment. Similarly, when a gas station sells gas, it uses attendants' time, the physical space, and the gas tanks and pumps. In many ways, factor markets resemble the markets for goods and services we analyzed in previous chapters, but they are different in one important way: the demand for a factor of production is a derived demand. That is, a firm's demand for a factor of production is derived from its decision to supply a good in another market. The demand for computer programmers is inseparably linked to the supply of computer software, and the demand for gas station attendants is inseparably linked to the supply of gasoline. In this chapter, we analyze factor demand by considering how a competitive, profit-maximizing firm decides how much of any factor to buy. We begin our analysis by examining the demand for labor. Labor is the most important factor of production, because workers receive most of the total income earned in the U.S. economy. Later in the chapter, we will see that our analysis of the labor market also applies to the markets for the other factors of production. The basic theory of factor markets developed in this chapter takes a large step toward explaining how the income of the U.S. economy is distributed among workers, landowners, and owners of capital. Chapter 19 builds on this analysis to examine in more detail why some workers earn more than others. Chapter 20 examines how much income inequality results from the functioning of factor markets and then considers what role the government should and does play in altering the income distribution. 18:1 The demand for labor. Labor markets, like other markets in the economy, are governed by the forces of supply and demand. This is illustrated in Figure 1. In panel, the supply and demand for apples determine the price of apples. In panel, the supply and demand for apple pickers determine the price, or wage, of apple pickers. As we have already noted, labor markets are different from most other markets because labor demand is a derived demand. Most labor services, rather than being final goods ready to be enjoyed by consumers, are inputs into the production of other goods. To understand labor demand, we need to focus on the firms that hire the labor and use it to produce goods for sale. By examining the link between the production of goods and the demand for labor to make those goods, we gain insight into the determination of equilibrium wages. Factors of production: the inputs used to produce goods and services. 375. 18-1 of the competitive profit maximizing firm. Let's look at how a typical firm, such as an apple producer, decides what quantity of labor to demand. The firm owns an apple orchard and each week must decide how many apple pickers to hire to harvest its crop. After the firm makes its hiring decision, the workers pick as many apples as they can. The firm then sells the apples, pays the workers, and keeps what is left as profit. We make two assumptions about our firm. First, we assume that our firm is competitive both in the market for apples and in the market for apple pickers. A competitive firm is a price taker. Because there are many other firms selling apples and hiring apple pickers, a single firm has little influence over the price it gets for apples or the wage it pays apple pickers. The firm takes the price and the wage as given by market conditions. It only has to decide how many apples to sell and how many workers to hire. Second, we assume that the firm is profit maximizing. Thus, the firm does not directly care about the number of workers it has or the number of apples it produces. It cares only about profit, which equals the total revenue from the sale of apples minus the total cost of producing them. The firm's supply of apples and its demand for workers are derived from its primary goal of maximizing profit. 18-1b The production function and the marginal product of labor. To make its hiring decision, the firm must consider how the size of its workforce affects the amount of output produced. In other words, it must consider how the number of apple pickers affects the quantity of apples it can harvest and sell. Table 1 gives a numerical example. In the first column is the number of workers. In the second column is the quantity of apples the workers harvest each week. These two columns of numbers describe the firm's ability to produce. Recall that economists use the term production function to describe the relationship between the quantity of inputs used in production and the quantity of output from production. Here the input is the apple pickers and the output is the apples. The other inputs, the trees themselves, the land, the firm's trucks and tractors, and so on, are held fixed for now. This firm's production function shows that if the firm hires one worker, that worker will pick 100 bushels of apples per week. If the firm hires two workers, the two workers together will pick 180 bushels per week. And so on. Figure 2 graphs the data on labor and output presented in Table 1. The number of workers is on the horizontal axis, and the amount of output is on the vertical axis. This figure illustrates the production function. One of the 10 principles of economics introduced in Chapter 1 is that rational people think at the margin. This idea is the key to understanding how firms decide what quantity of labor to hire. To take a step toward this decision, the third column in Table 1 gives the marginal product of labor, the increase in the amount of output from an additional unit of labor. When the firm increases the number of workers from 1 to 2, for example, the amount of apples produced rises from 100 to 180 bushels. Therefore, the marginal product of the second worker is 80 bushels. Notice that as the number of workers increases, the marginal product of labor declines. That is, the production process exhibits diminishing marginal product. At first, when only a few workers are hired, they can pick the low-hanging fruit. As the number of workers increases, additional workers have to climb higher up the ladders to find apples to pick. Hence, as more and more workers are hired, each additional worker contributes less to the production of apples. For this reason, the production function in Figure 2 becomes flatter as the number of workers rises. 18-1 The value of the marginal product and the demand for labor. Our profit-maximizing firm is concerned not about apples themselves but rather about the money it can make by producing and selling them. As a result, when deciding how many workers to hire to pick apples, the firm considers how much profit each worker would bring in. Because profit is total revenue minus total cost, the profit from an additional worker is the worker's contribution to revenue minus the worker's wage. To find the worker's contribution to revenue, we must convert the marginal product of labor into the value of the marginal product. We do this using the price of apples. To continue our example, if a bushel of apples sells for $10 and if an additional worker produces 80 bushels of apples, then the worker produces $800 of revenue. The value of the marginal product of any input is the marginal product of that input multiplied by the market price of the output. The fourth column in Table 1 shows the value of the marginal product of labor in our example, assuming the price of apples is $10 per bushel. Because the market price is constant for a competitive firm while the marginal product declines with more workers, the value of the marginal product diminishes as the number of workers rises. Economists sometimes call this column of numbers the firm's marginal revenue product. It is the extra revenue the firm gets from hiring an additional unit of a factor of production. Now consider how many workers the firm will hire. Suppose that the market wage for apple pickers is $500 per week. In this case, as you can see in Table 1, the first worker that the firm hires is profitable. The first worker yields $1,000 in revenue, or $500 in profit. Similarly, the second worker yields $800 in additional revenue, or $300 in profit. The third worker produces $600 in additional revenue, or $100 in profit. After the third worker, however, hiring workers is unprofitable. The fourth worker would yield only $400 of additional revenue. Because the worker's wage is $500, hiring the fourth worker would mean a $100 reduction in profit. Thus, the firm hires only 3 workers. It is instructive to consider the firm's decision graphically. Figure 3 graphs the value of the marginal product. This curve slopes downward because the marginal product of labor diminishes as the number of workers rises. The figure also includes a horizontal line at the market wage. To maximize profit, the firm hires workers up to the point where these two curves cross. Below this level of employment, the value of the marginal product exceeds the wage, so hiring another worker would increase profit. Above this level of employment, the value of the marginal product is less than the wage, so the marginal worker is unprofitable. Thus, a competitive, profit-maximizing firm hires workers up to the point at which the value of the marginal product of labor equals the wage. Having explained the profit-maximizing hiring strategy for a competitive firm, we can now offer a theory of labor demand. Recall that a firm's labor demand curve tells us the quantity of labor that a firm demands at any given wage. We have just seen in Figure 3 that the firm makes that decision by choosing the quantity of labor at which the value of the marginal product equals the wage. As a result, the value of marginal product curve is the labor demand curve for a competitive, profit-maximizing firm. 18-1D What causes the labor demand curve to shift? We now understand that the labor demand curve reflects the value of the marginal product of labor. With this insight in mind, let's consider a few of the things that might cause the labor demand curve to shift. The output price, the value of the marginal product, is marginal product times the price of the firm's output. Thus, when the output price changes, the value of the marginal product changes, and the labor demand curve shifts. An increase in the price of apples, for instance, raises the value of the marginal product of each worker who picks apples and, therefore, increases labor demand from the firms that supply apples. Conversely, a decrease in the price of apples reduces the value of the marginal product and decreases labor demand. Technological change between 1960 and 2012, the output a typical U.S. worker produced in an hour rose by 192%. Why? The most important reason is technological progress. Scientists and engineers are constantly figuring out new and better ways of doing things. This has profound implications for the labor market. Technological advance typically raises the marginal product of labor, which in turn increases the demand for labor and shifts the labor demand curve to the right. It is also possible for technological change to reduce labor demand. The invention of a cheap industrial robot, for instance, could conceivably reduce the marginal product of labor, shifting the labor demand curve to the left. Economists call this labor-saving technological change. History suggests, however, that most technological progress is instead labor-augmenting. Such technological advance explains persistently rising employment in the face of rising wages, even though wages increased by 152% in the last half-century, firms nonetheless increased the amount of labor they employed by 88%. Input demand and output. Supply, two sides of the same coin. In Chapter 14, we saw how a competitive, profit-maximizing firm decides how much of its output to sell. It chooses the quantity of output at which the price of the good equals the marginal cost of production. We have just seen how such a firm decides how much labor to hire. It chooses the quantity of labor at which the wage equals the value of the marginal product. Because the production function links the quantity of inputs to the quantity of output, you should not be surprised to learn that the firm's decision about input demand is closely linked to its decision about output supply. In fact, these two decisions are two sides of the same coin. To see this relationship more fully, let's consider how the marginal product of labor and marginal cost are related. Suppose an additional worker costs $500 and has a marginal product of 50 bushels of apples. In this case, producing 50 more bushels costs $500, the marginal cost of a bushel is $500/50, or $10. More generally, if W is the wage, and an extra unit of labor produces MPL units of output, then the marginal cost of a unit of output is MC equals W/MPL. This analysis shows that diminishing marginal product is closely related to increasing marginal cost. When our apple orchard grows crowded with workers, each additional worker adds less to the production of apples. Similarly, when the apple firm is producing a large quantity of apples, the orchard is already crowded with workers. So it is more costly to produce an additional bushel of apples. Now consider our criterion for profit maximization. We determined earlier that a profit-maximizing firm chooses the quantity of labor so that the value of the marginal product equals the wage. We can write this mathematically as P times MPL equals W. If we divide both sides of this equation by MPL, we obtain P equals W/MPL. We just noted that W/MPL equals marginal cost, MC. Therefore, we can substitute to obtain P equals MC. This equation states that the price of the firm's output equals the marginal cost of producing a unit of output. Thus, when a competitive firm hires labor up to the point at which the value of the marginal product equals the wage, it also produces up to the point at which the price equals marginal cost. Our analysis of labor demand in this chapter is just another way of looking at the production decision we first saw in Chapter 14. FYI. 380. The supply of other factors. The quantity available of one factor of production can affect the marginal product of other factors. A fall in the supply of ladders, for instance, will reduce the marginal product of apple pickers and thus the demand for apple pickers. We consider this linkage among the factors of production more fully later in the chapter. Quick quiz: define marginal product of labor and value of the marginal product of labor. Describe how a competitive, profit-maximizing firm decides how many workers to hire. 18-2 The supply of labor. Having analyzed labor demand in detail, let's turn to the other side of the market and consider labor supply. A formal model of labor supply is included in Chapter 21, where we develop the theory of household decision-making. Here we discuss briefly and informally the decisions that lie behind the labor supply curve. 18-2 The trade-off between work and leisure. One of the 10 principles of economics in Chapter 1 is that people face trade-offs. Probably no trade-off is more obvious or more important in a person's life than the trade-off between work and leisure. The more hours you spend working, the fewer hours you have to watch TV, enjoy dinner with friends, or pursue your favorite hobby. The trade-off between labor and leisure lies behind the labor supply curve. Another of the 10 principles of economics is that the cost of something is what you give up to get it. What do you give up to get an hour of leisure? You give up an hour of work, which in turn means an hour of wages. Thus, if your wage is $15 per hour, the opportunity cost of an hour of leisure is $15. And when you get a raise to $20 per hour, the opportunity cost of enjoying leisure goes up. The labor supply curve reflects how workers' decisions about the labor-leisure trade-off respond to a change in that opportunity cost. An upward-sloping labor supply curve means that an increase in the wage induces workers to increase the quantity of labor they supply. Because time is limited, more work means less leisure. That is, workers respond to the increase in the opportunity cost of leisure by taking less of it. It is worth noting that the labor supply curve need not be upward sloping. Imagine you got that raise from $15 to $20 per hour. The opportunity cost of leisure is now greater, but you are also richer than you were before. You might decide that with your extra wealth you can now afford to enjoy more leisure. That is, at the higher wage, you might choose to work fewer hours. If so, your labor supply curve would slope backward. In Chapter 21, we discuss this possibility in terms of conflicting effects on your labor supply decision. For now, we ignore the possibility of backward-sloping labor supply and assume that the labor supply curve is upward-sloping. 18-2b What causes the labor supply curve to shift? The labor supply curve shifts whenever people change the amount they want to work at a given wage. Let's now consider some of the events that might cause such a shift. Changes in tastes. In 1950, 34% of women were employed at paid jobs or looking for work. In 2012, the number had risen to 58%. There are many explanations for this development, but one of them is changing tastes, or attitudes toward work. 60 years ago, it was the norm for women to stay at home and raise children. Today, the typical family size is smaller, and more mothers choose to work. The result is an increase in the supply of labor. Changes in alternative opportunities. The supply of labor in any one labor market depends on the opportunities available in other labor markets. If the wage earned by pear pickers suddenly rises, some apple pickers may choose to switch occupations, causing the supply of labor in the market for apple pickers to fall. Immigration movement of workers from region to region, or country to country, is another important source of shifts in labor supply. When immigrants come to the United States, for instance, the supply of labor in the United States increases, and the supply of labor in the immigrants' home countries falls. In fact, much of the policy debate about immigration centers on its effect on labor supply and, thereby, equilibrium wages in the labor market. Quick quiz: who has a greater opportunity cost of enjoying leisure, a janitor or a brain surgeon? Explain. Can this help explain why doctors work such long hours? 18-3 Equilibrium in the labor market. So far we have established two facts about how wages are determined in competitive labor markets. The wage adjusts to balance the supply and demand for labor. The wage equals the value of the marginal product of labor. At first, it might seem surprising that the wage can do both of these things at once. In fact, there is no real puzzle here, but understanding why there is no puzzle is an important step toward understanding wage determination. Figure 4 shows the labor market in equilibrium. The wage and the quantity of labor have adjusted to balance supply and demand. When the market is in this equilibrium, each firm has bought as much labor as it finds profitable at the equilibrium wage. That is, each firm has followed the rule for profit maximization. It has hired workers until the value of the marginal product equals the wage. Hence, the wage must equal the value of the marginal product of labor once it has brought supply and demand into equilibrium. This brings us to an important lesson: any event that changes the supply or demand for labor must change the equilibrium wage and the value of the marginal product by the same amount, because these must always be equal. To see how this works, let's consider some events that shift these curves. 18-3 As shifts in labor supply. Suppose that immigration increases the number of workers willing to pick apples. As figure 5 shows, the supply of labor shifts to the right from S1 to S2. At the initial wage W1, the quantity of labor supplied now exceeds the quantity demanded. 382. This surplus of labor puts downward pressure on the wage of apple pickers, and the fall in the wage from W1 to W2 in turn makes it profitable for firms to hire more workers. As the number of workers employed in each apple orchard rises, the marginal product of a worker falls, and so does the value of the marginal product. In the new equilibrium, both the wage and the value of the marginal product of labor are lower than they were before the influx of new workers. An episode from Israel, studied by MIT economist Joshua Angrist, illustrates how a shift in labor supply can alter the equilibrium in a labor market. During most of the 1980s, many thousands of Palestinians regularly commuted from their homes in the Israeli-occupied West Bank and Gaza Strip to jobs in Israel, primarily in the construction and agriculture industries. In 1988, however, political unrest in these occupied areas induced the Israeli government to take steps that, as a byproduct, reduced this supply of workers. Curfews were imposed, work permits were checked more thoroughly, and a ban on overnight stays of Palestinians in Israel was enforced more rigorously. The economic impact of these steps was exactly as theory predicts. The number of Palestinians with jobs in Israel fell by half, while those who continued to work in Israel enjoyed wage increases of about 50%. With a reduced number of Palestinian workers in Israel, the value of the marginal product of the remaining workers was much higher. 18-3b Shifts in labor demand. Now suppose that an increase in the popularity of apples causes their price to rise. This price increase does not change the marginal product of labor for any given number of workers, but it does raise the value of the marginal product. With a higher price for apples, hiring more apple pickers is now profitable. As figure 6 shows, when the demand for labor shifts to the right from D1 to D2, the equilibrium wage rises from W1 to W2, and equilibrium employment rises from L1 to L2. Once again, the wage and the value of the marginal product of labor move together. This analysis shows that prosperity for firms in an industry is often linked to prosperity for workers in that industry. When the price of apples rises, apple producers make greater profit, and apple pickers earn higher wages. When the price of apples falls, apple producers earn smaller profit, and apple pickers earn lower wages. This lesson is well known to workers in industries with highly volatile prices. Workers in oil fields, for instance, know from experience that their earnings are closely linked to the world price of crude oil. Q. What can you tell us about the size of the immigrant population in the United States? A. Immigrants make up about 13% of the overall population, which means about 40 million foreign-born live in the United States. The commonly accepted estimate for the undocumented portion of the foreign-born population is 11 million. Immigrants come from all parts of the world, but we've seen big changes in their origins. In the 1950s and 1960s, 75% of immigrants were from Europe. Today, about 80% are from Latin America and Asia. Inflows are also much larger today, with 1 million to 2 million newcomers entering each year. Still, 2010 to 2011 immigration was below the levels experienced prior to the Great Recession of 2007 to 2009, when the housing bust led to a significant decline in illegal immigration. What's interesting about the United States is how our economy has been able to absorb immigrants and put them to work. U.S. immigrants are much more likely to be working compared with immigrants in other developed countries. This is partly because we don't set high entry-level wages or have cumbersome hiring and firing rules. In this type of flexible system, there are more job openings. Workers have more opportunities. Of course, entry-level wages are also lower, but immigrants at least get their foot in the door. Being in the workforce allows immigrants to interact with the rest of society. They learn the language faster, pay taxes and become stakeholders. Q. Where do immigrants fit into the U.S. economy? A. U.S. immigrants are diverse in economic terms. We rely on them to fill both high and low-skilled jobs. Some immigrants do medium-skilled work, but more than anything else they're found on the low and the high ends of the education distribution. The economic effects of immigration are different depending on which group you're talking about. We have an extremely important group of high-skilled immigrants. We rely on them to fill high-level jobs in health, science, technology, and engineering. Each year, over one-third of PhDs in science and engineering is awarded to students who were. The economics of immigration. Here is an interview with Pia Orenius, a senior economist at the Federal Reserve Bank of Dallas who studies immigration. From these examples, you should now have a good understanding of how wages are set in competitive labor markets. Labor supply and labor demand together determine the equilibrium wage, and shifts in the supply or demand curve for labor cause the equilibrium wage to change. At the same time, profit maximization by the firms that demand labor ensures that the equilibrium wage always equals the value of the marginal product of labor. Productivity and wages. One of the 10 principles of economics in Chapter 1 is that our standard of living depends on our ability to produce goods and services. We can now see how this principle works in the market for labor. In particular, our analysis of labor demand shows that wages equal productivity as measured by the value of the marginal product of labor. Put simply, highly productive workers are highly paid, and less productive workers are less highly paid. This lesson is key to understanding why workers today are better off than workers in previous generations. Table 2 presents some data on growth in productivity. 385. Born abroad. Moreover, research shows that foreign-born workers in STEM fields are more innovative and entrepreneurial than their U.S.-born counterparts. High-skilled immigration has many economic benefits. It boosts productivity growth and contributes positively to government finances. People tend to focus on undocumented or low-skilled immigrants when discussing immigration and often do not recognize the tremendous contributions of high-skilled immigrants. Q. What about the low-skilled immigration? A. With low-skilled immigration, the economic benefits of the added labor, such as lower prices for consumers, have to be balanced against the fiscal impact, which is likely negative. The fiscal impact is the difference between what families contribute in taxes and what they use up in the form of publicly provided services. What makes the fiscal issue more difficult is the distribution of the burden. The federal government reaps much of the revenue from immigrants who work and pay employment taxes. State and local governments realize less of that benefit and have to pay more of the costs associated with low-skilled immigration, usually healthcare and educational expenses. Q. Does it matter whether the immigration is legal or not? A. Illegal immigration has helped fuel the U.S. economy for many years. 5% of the U.S. workforce is made up of unauthorized workers, the outcome of decades of robust labor demand and, until recently, lax enforcement. Nevertheless, from an economic perspective, it makes more sense to differentiate among immigrants of various skill levels than it does to focus on legal status. The economic benefits of low-skilled immigrants aren't typically going to depend on how they entered the United States. Illegal immigrants may pay less in taxes, but they're also ineligible for public programs. So being illegal doesn't mean these immigrants have a worse fiscal impact. In fact, a low-skilled illegal immigrant likely creates less fiscal burden than a low-skilled legal immigrant because the undocumented get almost no government benefits. Q. How does immigration affect jobs and earnings for the native-born population? A. Labor economists have looked long and hard at this question, namely how immigration has affected the wages of Americans, particularly the low-skilled who lack a high school degree. The reason we worry about this is that the real wages of less educated U.S. men have been falling since the late 1970s. The studies tend to show that little of the decline is due to immigration. The consensus seems to be that wages overall are about 1 to 3% lower today as a result of immigration, although some scholars find larger effects for low-skilled workers. Still, labor economists think it's a bit of a puzzle that they haven't been able to systematically identify larger adverse wage effects. The reason may be the way the economy is constantly adjusting to the inflow of immigrants. On a geographical basis, for example, a large influx of immigrants into an area tends to encourage an inflow of capital or a change in technology or production processes which puts new workers to use. So you have an increase in labor supply, but you also have an increase in labor demand, and the wage effects are ameliorated. And growth in real wages. From 1959 to 2012, productivity as measured by output per hour of work grew about 2.1% per year. Real wages grew at 1.8%, almost the same rate. With a growth rate of 2% per year, productivity and real wages double about every 35 years. Productivity growth varies over time. Table 2 also shows the data for 3 shorter periods that economists have identified as having very different productivity experiences. Around 1973, the U.S. economy experienced a significant slowdown in productivity growth that lasted until 1995. The cause of the productivity slowdown is not well understood, but the link between productivity and real wages is exactly as standard theory predicts. The slowdown in productivity growth from 2.8 to 1.4% per year coincided with a slowdown in real wage growth from 2.8 to 1.1% per year. Productivity growth picked up again around 1995, and many observers hailed the arrival of the new economy. This productivity acceleration is most often attributed to the spread of computers and information technology. As theory predicts, growth in real wages picked up as well. From 1995 to 2012, productivity grew by 2.3% per year, and real wages grew by 1.9% per year. The bottom line, both theory and history confirm the close connection between productivity and real wages. Quick quiz: how does an immigration of workers affect labor supply, labor demand, the marginal product of labor, and the equilibrium wage? Monopsony. In the preceding pages, we built our analysis of the labor market with the tools of supply and demand. In doing so, we assumed that the labor market was competitive. That is, we assumed that there were many buyers and sellers of labor, so each buyer or seller had a negligible effect on the wage. Yet imagine the labor market in a small town dominated by a single, large employer. That employer can exert a large influence on the going wage, and it may well use that market power to alter the outcome. Such a market in which there is a single buyer is called a monopsony. A monopsony is in many ways similar to a monopoly. Recall from Chapter 15 that a monopoly firm produces less of the good than would a competitive firm. By reducing the quantity offered for sale, the monopoly firm moves along the product's demand curve, raising the price and also its profits. Similarly, a monopsony firm in a labor market hires fewer workers than would a competitive firm. By reducing the number of jobs available, the monopsony firm moves along the labor supply curve, reducing the wage it pays and raising its profits. Thus, both monopolists and monopsonists reduce economic activity in a market below the socially optimal level. In both cases, the existence of market power distorts the outcome and causes deadweight losses. This book does not present the formal model of monopsony because monopsonies are rare. In most labor markets, workers have many possible employers, and firms compete with one another to attract workers. In this case, the model of supply and demand is the best one to use. FYI. 18-4 The other factors of production, land and capital. We have seen how firms decide how much labor to hire and how these decisions determine workers' wages. At the same time that firms are hiring workers, they are also deciding about other inputs to production. For example, R. 387. Apple producing firm might have to choose the size of its apple orchard and the number of ladders for its apple pickers. We can think of the firm's factors of production as falling into three categories: labor, land, and capital. The meaning of the terms labor and land is clear, but the definition of capital is somewhat tricky. Economists use the term capital to refer to the stock of equipment and structures used for production. That is, the economy's capital represents the accumulation of goods produced in the past that are being used in the present to produce new goods and services. For our Apple firm, the capital stock includes the ladders used to climb the trees, the trucks used to transport the apples, the buildings used to store the apples, and even the trees themselves. 18-4 Equilibrium in the markets for land and capital. What determines how much the owners of land and capital earn for their contribution to the production process? Before answering this question, we need to distinguish between two prices, the purchase price and the rental price. The purchase price of land or capital is the price a person pays to own that factor of production indefinitely. The rental price is the price a person pays to use that factor for a limited period of time. It is important to keep this distinction in mind because, as we will see, these prices are determined by somewhat different economic forces. Having defined these terms, we can now apply the theory of factor demand that we developed for the labor market to the markets for land and capital. Because the wage is the rental price of labor, much of what we have learned about wage determination applies also to the rental prices of land and capital. As Figure 7 illustrates, the rental price of land, shown in panel, and the rental price of capital, shown in panel, are determined by supply and demand. Moreover, the demand for land and capital is determined just like the demand for labor. That is, when our apple producing firm is deciding how much land and how many ladders to rent, it follows the same logic as when deciding how many workers to hire. For both land and capital, the firm increases the quantity hired until the value of the factor's marginal product equals the factor's price. Thus, the demand curve for each factor reflects the marginal productivity of that factor. We can now explain how much income goes to labor, how much goes to landowners, and how much goes to the owners of capital. As long as the firms using the factors of production are competitive and profit maximizing, each factor's rental price must equal the value of the marginal product for that factor. Labor, land, and capital each earn the value of their marginal contribution to the production process. Now consider the purchase price of land and capital. The rental price and the purchase price are related. Buyers are willing to pay more for a piece of land or capital if it produces a valuable stream of rental income. And as we have just seen, the equilibrium rental income at any point in time equals the value of that factor's marginal product. Therefore, the equilibrium purchase price of a piece of land or capital depends on both the current value of the marginal product and the value of the marginal product expected to prevail in the future. 18-4b Linkages among the factors of production. We have seen that the price paid for any factor of production, labor, land, or capital equals the value of the marginal product of that factor. The marginal product of any factor, in turn, depends on the quantity of that factor that is available. Because of diminishing marginal product, a factor in abundant supply has a low marginal product and thus a low price, and a factor in scarce supply has a. What is capital income? Labor income is an easy concept to understand. It is the paycheck that workers get from their employers. The income earned by capital, however, is less obvious. In our analysis, we have been implicitly assuming that households own the economy's stock of capital ladders, drill presses, warehouses, and so on, and rent it to the firms that use it. Capital income, in this case, is the rent that households receive for the use of their capital. This assumption simplified our analysis of how capital owners are compensated, but it is not entirely realistic. In fact, firms usually own the capital they use, and therefore, they receive the earnings from this capital. These earnings from capital, however, are paid to households eventually in a variety of forms. Some of the earnings are paid in the form of interest to those households that have lent money to firms. Bondholders and bank depositors are two examples of recipients of interest. Thus, when you receive interest on your bank account, that income is part of the economy's capital income. In addition, some of the earnings from capital are paid to households in the form of dividends. Dividends are payments by a firm to the firm's stockholders. A stockholder is a person who has bought a share in the ownership of the firm and, therefore, is entitled to share in the firm's profits. A firm does not have to pay out all its earnings to households in the form of interest and dividends. Instead, it can retain some earnings within the firm and use these earnings to buy additional capital. Unlike dividends, these retained earnings do not yield a direct cash payment to the firm's stockholders, but the stockholders benefit from them nonetheless. Because retained earnings increase the amount of capital the firm owns, they tend to increase future earnings and, thereby, the value of the firm's stock. These institutional details are interesting and important, but they do not alter our conclusion about the income earned by the owners of capital. Capital is paid according to the value of its marginal product, regardless of whether this income is transmitted to households in the form of interest or dividends or whether it is kept within firms as retained earnings. FYI. 389. High marginal product and a high price. As a result, when the supply of a factor falls, its equilibrium price rises. When the supply of any factor changes, however, the effects are not limited to the market for that factor. In most situations, factors of production are used together in a way that makes the productivity of each factor depend on the quantities of the other factors available for use in the production process. As a result, when some event changes the supply of any one factor of production, it will typically affect not only the earnings of that factor but also the earnings of all the factors as well. For example, suppose a hurricane destroys many of the ladders that workers use to pick apples from the orchards. What happens to the earnings of the various factors of production? Most obviously, when the supply of ladders falls, the equilibrium rental price of ladders rises. Those owners who were lucky enough to avoid damage to their ladders now earn a higher return when they rent out their ladders to the firms that produce apples. Yet the effects of this event do not stop at the ladder market. Because there are fewer ladders with which to work, the workers who pick apples have a smaller marginal product. Thus, the reduction in the supply of ladders reduces the demand for the labor of apple pickers, and this shift in demand causes the equilibrium wage to fall. This story shows a general lesson: an event that changes the supply of any factor of production can alter the earnings of all the factors. The change in earnings of any factor can be found by analyzing the impact of the event on the value of the marginal product of that factor. The economics of the Black Death. In 14th century Europe, the bubonic plague wiped out about 1/3 of the population within a few years. This event, called the Black Death, provides a grisly natural experiment to test the theory of factor markets that we have just developed. Consider the effects of the Black Death on those who were lucky enough to survive. What do you think happened to the wages earned by workers and the rents earned by landowners? To answer this question, let's examine the effects of a reduced population on the marginal product of labor and the marginal product of land. With a smaller supply of workers, the marginal product of labor rises. Thus, we would expect the Black Death to raise wages. Because land and labor are used together in production, a smaller supply of workers also affects the market for land, the other major factor of production in medieval Europe. With fewer workers available to farm the land, an additional unit of land produced less additional output. In other words, the marginal product of land fell. Thus, we would expect the Black Death to lower rents. In fact, both predictions are consistent with the historical evidence. Wages approximately doubled during this period, and rents declined 50% or more. The Black Death led to economic prosperity for the peasant classes and reduced incomes for the landed classes. Case study. Workers who survived the plague were lucky in more ways than one. Copyright Bettman/Corbis. Quick quiz: what determines the income of the owners of land and capital? How would an increase in the quantity of capital affect the incomes of those who already own capital? How would it affect the incomes of workers? 390. 18-5 Conclusion. This chapter explained how labor, land, and capital are compensated for the roles they play in the production process. The theory developed here is called the neoclassical theory of distribution. According to the neoclassical theory, the amount paid to each factor of production depends on the supply and demand for that factor. The demand, in turn, depends on that particular factor's marginal productivity. In equilibrium, each factor of production earns the value of its marginal contribution to the production of goods and services. The neoclassical theory of distribution is widely accepted. Most economists begin with the neoclassical theory when trying to explain how the U.S. economy's $15 trillion of income is distributed among the economy's various members. In the following two chapters, we consider the distribution of income in more detail. As you will see, the neoclassical theory provides the framework for this discussion. Even at this point, you can use the theory to answer the question that began this chapter: why are computer programmers paid more than gas station attendants? It is because programmers can produce a good of greater market value than can gas station attendants. People are willing to pay dearly for a good computer game, but they are willing to pay little to have their gas pumped and their windshield washed. The wages of these workers reflect the market prices of the goods they produce. If people suddenly got tired of using computers and decided to spend more time driving, the prices of these goods would change, and so would the equilibrium wages of these two groups of workers. The economy's income is distributed in the markets for the factors of production. The three most important factors of production are labor, land, and capital. The demand for factors, such as labor, is a derived demand that comes from firms that use the factors to produce goods and services. Competitive, profit-maximizing firms hire each factor up to the point at which the value of the factor's marginal product equals its price. The supply of labor arises from individuals' trade-off between work and leisure. An upward-sloping labor supply curve means that people respond to an increase in the wage by working more hours and enjoying less leisure. The price paid to each factor adjusts to balance the supply and demand for that factor. Because factor demand reflects the value of the marginal product of that factor, in equilibrium each factor is compensated according to its marginal contribution to the production of goods and services. Because factors of production are used together, the marginal product of any one factor depends on the quantities of all factors that are available. As a result, a change in the supply of one factor alters the equilibrium earnings of all the factors. Summary. Factors of production: P374 production function, P376 marginal product of labor, P376 diminishing marginal product, P376 value of the marginal product, P377 capital, P387. Key concepts. 391. 1. Suppose that the President proposes a new law aimed at reducing healthcare costs. All Americans are required to eat one apple daily. A. How would this apple a day law affect the demand and equilibrium price of apples? B. How would the law affect the marginal product and the value of the marginal product of apple pickers? C. How would the law affect the demand and equilibrium wage for apple pickers? 2. Show the effect of each of the following events on the market for labor in the computer manufacturing industry. A. Congress buys personal computers for all U.S. college students. B. More college students major in engineering and computer science. C. Computer firms build new manufacturing plants. Problems and applications. 1. Approximately what percentage of U.S. national income is paid to workers, as opposed to owners of capital and land? A. 30%, B. 50%, C. 70%, D. 90%. 2. If firms are competitive and profit maximizing, the demand curve for labor is determined by A. The opportunity cost of workers' time. B. The value of the marginal product of labor. C. Offsetting income and substitution effects. D. The value of the marginal product of capital. 3. A bakery operating in competitive markets sells its output for $20 per cake and hires labor at $10 per hour. To maximize profit, it should hire labor until the marginal product of labor is A. 1/2 cake per hour. B. 2 cakes per hour. C. 10 cakes per hour. D. 15 cakes per hour. 4. A technological advance that increases the marginal product of labor shifts the labor curve to the A. Demand, left. B. Demand, right. C. Supply, left. D. Supply, right. 5. Around 1973, the U.S. economy experienced a significant curve in productivity growth, coupled with A in the growth of real wages. A. Acceleration, B. Acceleration, slowdown. C. Slowdown, acceleration. D. Slowdown. 6. A storm destroys several factories, thereby reducing the stock of capital. What effect does this event have on factor markets? A. Wages and the rental price of capital both rise. B. Wages and the rental price of capital both fall. C. Wages rise, and the rental price of capital falls. D. Wages fall, and the rental price of capital rises. Quick check multiple choice. 1. Explain how a firm's production function is related to its marginal product of labor, how a firm's marginal product of labor is related to the value of its marginal product, and how a firm's value of marginal product is related to its demand for labor. 2. Give 2 examples of events that could shift the demand for labor, and explain why they do so. 3. Give 2 examples of events that could shift the supply of labor, and explain why they do so. 4. Explain how the wage can adjust to balance the supply and demand for labor while simultaneously equaling the value of the marginal product of labor. 5. If the population of the United States suddenly grew because of a large wave of immigration, what would happen to wages? What would happen to the rents earned by the owners of land and capital? Questions for review. 392. 3. Suppose that labor is the only input used by a perfectly competitive firm. The firm's production function is as follows. Days of labor, units of output, 0 days, 0 units. 17. 213. 319. 425. 528. 629. 729. A. Calculate the marginal product for each additional worker. B. Each unit of output sells for $10. Calculate the value of the marginal product of each worker. C. Compute the demand schedule showing the number of workers hired for all wages from $0 to $100 a day. D. Graph the firm's demand curve. E. What happens to this demand curve if the price of output rises from $10 to $12 per unit? 4. Smiling Cow Dairy can sell all the milk it wants for $4 a gallon, and it can rent all the robots it wants to milk the cows at a capital rental price of $100 a day. It faces the following production schedule. Number of robots, total product 0 gallons. 150. 285. 3 115. 4 140. 5 150. 6 155. A. In what kind of market structure does the firm sell its output? How can you tell? B. In what kind of market structure does the firm rent robots? How can you tell? C. Calculate the marginal product and the value of the marginal product for each additional robot. D. How many robots should the firm rent? Explain. 5. The nation of Actinia has 20 competitive apple orchards, which sell apples at the world price of $2 per apple. The following equations describe the production function and the marginal product of labor in each orchard. Q equals 100 LL2. MPL equals 102 L. Where Q is the number of apples produced in a day, L is the number of workers, and MPL is the marginal product of labor. A. What is each orchard's labor demand as a function of the daily wage W? What is the market's labor demand? B. Actinia has 200 workers who supply their labor inelastically. Solve for the wage W. How many workers does each orchard hire? How much profit does each orchard owner make? C. Calculate what happens to the income of workers and orchard owners if the world price of apples doubles to $4 per apple. D. Now suppose the price is back at $2 per apple, but a hurricane destroys half the orchards. Calculate how the hurricane affects the income of each worker and of each remaining orchard owner. What happens to the income of Actinia as a whole? 6. Your enterprising uncle opens a sandwich shop that employs 7 people. The employees are paid $6 per hour, and a sandwich sells for $3. If your uncle is maximizing his profit, what is the value of the marginal product of the last worker he hired? What is that worker's marginal product? 7. Leadbelly Co. sells pencils in a perfectly competitive product market and hires workers in a perfectly competitive labor market. Assume that the market wage rate for workers is $150 per day. A. What rule should Leadbelly follow to hire the profit-maximizing amount of labor? B. At the profit-maximizing level of output, the marginal product of the last worker hired is 30 boxes of pencils per day. Calculate the price of a box of pencils. C. Draw a diagram of the labor market for pencil workers next to a diagram of the labor supply and demand for Leadbelly Co. Label the equilibrium wage and quantity of labor for both the market and the firm. How are these diagrams related? D. Suppose some pencil workers switch to jobs in the growing computer industry. On the side-by-side diagrams from part, show how this change affects the equilibrium wage and quantity of labor for both the pencil market and for Leadbelly. How does this change affect the marginal product of labor at Leadbelly? 8. During the 1980s, 1990s, and the first decade of the 21st century, the United States experienced a significant inflow of capital from abroad. For example, Toyota, BMW, and other foreign car companies built auto plants in the United States. 393. A. Using a diagram of the U.S. capital market, show the effect of this inflow on the rental price of capital in the United States and on the quantity of capital in use. B. Using a diagram of the U.S. labor market, show the effect of the capital inflow on the average wage paid to U.S. workers. 9. Policymakers sometimes propose laws requiring firms to give workers certain fringe benefits, such as health insurance or paid parental leave. Let's consider the effects of such a policy on the labor market. A. Suppose that a law required firms to give each worker $3 of fringe benefits for every hour that the worker is employed by the firm. How does this law affect the marginal profit that a firm earns from each worker at a given cash wage? How does the law affect the demand curve for labor? Draw your answer on a graph with the cash wage on the vertical axis. B. If there is no change in labor supply, how would this law affect employment and wages? C. Why might the labor supply curve shift in response to this law? Would this shift in labor supply raise or lower the impact of the law on wages and employment? D. As discussed in Chapter 6, the wages of some workers, particularly the unskilled and inexperienced, are kept above the equilibrium level by minimum wage laws. What effect would a fringe benefit mandate have for these workers? Go to cEngageBrain.com to purchase access to the proven, critical study guide to accompany this text, which features additional notes and context, practice tests, and much more. 395. Earnings and discrimination. In the United States today, the typical physician earns about $200,000 a year, the typical police officer about $60,000, and the typical fast food cook about $20,000. These examples illustrate the large differences in earnings that are so common in our economy. The differences explain why some people live in mansions, ride in limousines, and vacation on the French Riviera, while other people live in small apartments, ride the bus, and vacation in their own backyards. Why do earnings vary so much from person to person? Chapter 18, which developed the basic neoclassical theory of the labor market, offers an answer to this question. There we saw that wages are governed by labor supply and labor demand. Labor demand, in turn, reflects the marginal productivity of labor. In equilibrium, each worker is paid the value of her marginal contribution to the economy's production of goods and services. This theory of the labor market, though widely accepted by economists, is only the beginning of the story. To understand the wide variation in earnings. Chapter 19. 396. That we observe, we must go beyond this general framework and examine more precisely what determines the supply and demand for different types of labor. That is our goal in this chapter. 19-1 Some determinants of equilibrium wages. Workers differ from one another in many ways. Jobs also have differing characteristics both in terms of the wages they pay and in terms of their non-monetary attributes. In this section, we consider how the characteristics of jobs and workers affect labor supply, labor demand, and equilibrium wages. 19-1 A compensating differentials. When a worker is deciding whether to take a job, the wage is only one of many job attributes that the worker takes into account. Some jobs are easy, fun, and safe, while others are hard, dull, and dangerous. The better the job as gauged by these non-monetary characteristics, the more people there are who are willing to do the job at any given wage. In other words, the supply of labor for easy, fun, and safe jobs is greater than the supply of labor for hard, dull, and dangerous jobs. As a result, good jobs will tend to have lower equilibrium wages than bad jobs. For example, imagine you are looking for a summer job in a local beach community. Two kinds of jobs are available. You can take a job as a beach badge checker, or you can take a job as a garbage collector. The beach badge checkers take leisurely strolls along the beach during the day and check to make sure the tourists have bought the required beach permits. The garbage collectors wake up before dawn to drive dirty, noisy trucks around town to pick up garbage. Which job would you want? Most people would prefer the beach job if the wages were the same. To induce people to become garbage collectors, the town has to offer higher wages to garbage collectors than to beach badge checkers. Economists use the term compensating differential to refer to a difference in wages that arises from non-monetary characteristics of different jobs. Compensating differentials are prevalent in the economy. Here are some examples. Coal miners are paid more than other workers with similar levels of education. Their higher wage compensates them for the dirty and dangerous nature of coal mining, as well as the long-term health problems that coal miners experience. Workers who work the night shift at factories are paid more than similar workers who work the day shift. The higher wage compensates them for having to work at night and sleep during the day, a lifestyle that most people find undesirable. Professors are paid less than lawyers and doctors, who have similar amounts of education. The higher wages of lawyers and doctors compensate them for missing out on the great intellectual and personal satisfaction that professors' jobs offer. 19-1b Human capital. As we discussed in the previous chapter, the word capital usually refers to an economy's stock of equipment and structures. The capital stock includes the farmer's tractor, the manufacturer's factory, and the teacher's chalkboard. The essence of capital is that it is a factor of production that itself has been produced. there is another type of capital that, while less tangible than physical capital, is just as important to the economy's production. Human capital is the accumulation of investments in people. The most important type of human capital is education. Like all forms of capital, education represents an expenditure of resources at one time to raise productivity in the future. But unlike an investment in other forms of capital, an investment in education is tied to a specific person, and this linkage is what makes it human capital. Not surprisingly, workers with more human capital earn more on average than those with less human capital. College graduates in the United States, for example, earn almost twice as much as those workers who end their education with a high school diploma. This large difference has been documented in many countries around the world. It tends to be even larger in less developed countries, where educated workers are in scarce supply. From the perspective of supply and demand, it is easy to see why education raises wages. Firms, the demanders of labor, are willing to pay more for highly educated workers because these workers have higher marginal products. Workers, the suppliers of labor, are willing to pay the cost of becoming educated only if there is a reward for doing so. In essence, the difference in wages between highly educated workers and less educated workers may be considered a compensating differential for the cost of becoming educated. Human capital, the accumulation of investments in people, such as education and on-the-job training. The increasing value of skills, the rich get richer, and the poor get poorer. Like many adages, this one is not always true, but it has been in recent years. Many studies have documented that the earnings gap between workers with high skills and workers with low skills has increased over the past several decades. Table 1 presents data on the average earnings of college graduates and of high school graduates without any additional education. These data show the increase in the financial reward from education. In 1975, a man on average earned 42% more with a college degree than without one. By 2011, this figure had risen to 75%. For a woman, the reward for attending college rose from a 35% increase in earnings in 1975 to an 81% increase in 2011. The incentive to stay in school is as great today as it has ever been. Why has the gap in earnings between skilled and unskilled workers widened in recent years? No one knows for sure, but economists have proposed two hypotheses to explain this trend. Both hypotheses suggest that the demand for skilled labor has risen over time relative to the demand for unskilled labor. The shift in demand has led to a corresponding change in the wages of both groups, which in turn has led to greater inequality. The first hypothesis is that international trade has altered the relative demand for skilled and unskilled labor. In recent years, the amount of trade with other countries has increased substantially. As a percentage of total U.S. production of goods and services, imports have risen from 5% in 1970 to 18% in 2011, and exports have risen from 6% in 1970 to 14% in 2011. Because unskilled labor is plentiful and cheap in many foreign countries, the United States tends to import goods produced with unskilled labor and export goods produced with skilled labor. Thus, when international trade expands, the domestic demand for skilled labor rises and the domestic demand for unskilled labor falls. Regardless of the cost, college still matters. By Michael Greenstone and Adam Looney. As America continues its recovery from the Great Recession, there is an ongoing debate in the media and among policymakers about the value of a college degree in today's economic climate. One issue that is receiving a significant amount of attention is the rising cost of college. Indeed, tuition has increased by almost 50% in the last 30 years, prompting some people to ask whether college is still worth the price of admission. In this month's analysis, the Hamilton Project confirms its previous findings that the returns to college attendance are much higher than other investments, such as stocks, bonds, and real estate. We also find that the returns to college have been largely constant over the last 35 years, indicating that the rising tuition costs have been offset by the increased earnings premium for college graduates. In most respects, a college degree has never been more valuable. Recent college graduates earn more money and have an easier time finding employment than their peers who only have a high school diploma. What may be less intuitive is that these gaps have been growing in recent years. A young college graduate earned about $4,000 more per year in the 1980s, adjusting for inflation, than someone of the same age who did not attend college. Over the last 3 decades, that figure has climbed to $12,000 per year. Differences in employment rates between college graduates and non-graduates have not demonstrated as clear of a trend over this period, with one key exception. In recent years, particularly in the aftermath of the Great Recession, college has become an increasingly important determinant of one's employment status. Today, a college graduate is almost 20 percentage points more likely to be employed than someone with only a high school diploma. This employment gap between college and high school graduates is the largest in our nation's history. While the evidence is clear about the lifelong value of more education, skeptics are increasingly pointing to rising tuition costs to claim that college is not as sound of an investment as it once was. And it is true that tuition has increased significantly over the past few decades. In 1980, it cost an average of about. Higher education as an investment. Is a college degree a good investment compared with, say, stocks and bonds? According to the Hamilton Project, a research effort run by a prominent Washington think tank, the answer is a resounding yes. In the news. 399. $56,000 to attend a university for 4 years. This figure includes tuition, fees, and the opportunity cost, or income one foregoes to attend school instead of holding a job. In 2010, 4 years of college cost more than $82,000, a nearly 50% increase over that 30-year period. This increase in tuition is based on calculations from the National Center for Education Statistics, but it may overstate the rise in the costs of college. First, this rise in tuition does not account for recent increases in financial aid. Thus, while the sticker price of college may have gone up, it is unclear to what extent the cost to students and their families has increased. Indeed, according to the College Board, the actual cost of a 4-year degree has remained relatively constant over the last 15 years. Regardless of the magnitude of the exact increase in tuition, a sole focus on the cost of college is misleading because it only tells half of the story. Specifically, the monetary benefits of a college degree have increased dramatically over the last few decades. An individual who entered college in 1980 could expect to earn about $260,000 more over the course of her life compared to someone who received only a high school diploma. In contrast, for someone starting college in 2010, the expected lifetime increase in earnings relative to a high school graduate was more than $450,000. These estimates are adjusted both for inflation and the fact that most of this additional income will come much later in a graduate's life. Even if we assume that all students actually pay tuition at the published rates, the bottom line is this: while college may be 50% more expensive now than it was 30 years ago, the increase to lifetime earnings that a college degree brings is 75% higher. In short, the cost of college is growing, but the benefits of college and, by extension, the cost of not going to college are growing even faster. The returns to an investment in a college education, therefore, are high. The Hamilton Project estimated that investing in a 4-year degree yields a return of above 15%. While this is down slightly from almost 18% in the late 90s, attending college remains one of the best ways one can invest her money. The return to college is more than double the average return over the last 60 years experienced in the stock market, and more than 5 times the return to investments in corporate bonds, gold, long-term government bonds, or housing. The cost of college can be daunting for many families, but it is precisely because college is such a sound investment that there is an important role for government to ensure that loan programs are plentiful and accessible. The nation and the economy are strengthened when college attendance is determined by students' abilities, not their family's financial background. Indeed, it is not just the direct recipients of these loans that benefit from the increased number of Americans who are able to go to college. One recent study showed that even individuals with only a high school diploma earn more when they live in cities populated with more college graduates. More education is not just good for individuals, it's a good investment for the broader community. The second hypothesis is that changes in technology have altered the relative demand for skilled and unskilled labor. Consider, for instance, the introduction of computers. Computers raise the demand for skilled workers who can use the new machines and reduce the demand for the unskilled workers whose jobs are replaced by the computers. For example, many companies now rely more on computer databases, and less on filing cabinets, to keep business records. This change raises the demand for computer programmers and reduces the demand for filing clerks. Thus, as more firms use computers, the demand for skilled labor rises and the demand for unskilled labor falls. Economists have found it difficult to gauge the validity of these two hypotheses. It is possible that both are true. Increasing international trade and technological change may share responsibility for the increasing income inequality we have observed in recent decades. In the next chapter, we discuss the issue of increasing inequality in more detail. 19-1C Ability, effort, and chance. Why do Major League Baseball players get paid more than minor league players? Certainly, the higher wage is not a compensating differential. Playing in the major leagues is not a less pleasant job than playing in the minor leagues. In fact, the opposite is true. The major leagues do not require more years of schooling or 400 more experience. To a large extent, players in the major leagues earn more just because they have greater natural ability. Natural ability is important for workers in all occupations. Because of heredity and upbringing, people differ in their physical and mental attributes. Some people are strong, others weak. Some people are smart, others less so. Some people are outgoing, others awkward in social situations. These and many other personal characteristics determine how productive workers are and, therefore, play a role in determining the wages they earn. Closely related to ability is effort. Some people work hard, others are lazy. We should not be surprised to find that those who work hard are more productive and earn higher wages. To some extent, firms reward workers directly by paying people based on what they produce. Salespeople, for instance, are often paid a percentage of the sales they make. At other times, hard work is rewarded less directly in the form of a higher annual salary or a bonus. Chance also plays a role in determining wages. If a person attended a trade school to learn how to repair televisions with vacuum tubes and then found the skill made obsolete by the invention of solid-state electronics, she would end up earning a low wage compared to others with similar years of training. The low wage of this worker is due to chance, a phenomenon that economists recognize but do not shed much light on. How important are ability, effort, and chance in determining wages? It is hard to say because these factors are difficult to measure. But indirect evidence suggests that they are very important. When labor economists study wages, they relate a worker's wage to those variables that can be measured, such as years of schooling, years of experience, age, and job characteristics. All these measured variables affect a worker's wage as theory predicts, but they account for less than half of the variation in wages in our economy. Because so much of the variation in wages is left unexplained, omitted variables, including ability, effort, and chance, must play an important role. The benefits of beauty. People differ in many ways, one of which is physical attractiveness. The actor Ryan Gosling, for instance, is a handsome man. In part for this reason, his movies attract large audiences. Not surprisingly, the large audiences mean a large income for Mr. Gosling. How prevalent are the economic benefits of beauty? Labor economists Daniel Hamermesh and Jeff Biddle tried to answer this question in a study published in the December 1994 issue of the American Economic Review. Hamermesh and Biddle examined data from surveys of individuals in the United States and Canada. The interviewers who conducted the survey were asked to rate each respondent's physical appearance. Hamermesh and Biddle then examined how much the wages of the respondents depended on the standard determinants education, experience, and so on, and how much they depended on physical appearance. Hamermesh and Biddle found that beauty pays. People who are deemed more attractive than average earn 5% more than people of average looks, and people of average looks earn 5 to 10% more than people considered less attractive than average. Similar results were found for men and women. What explains these differences in wages? There are several ways to interpret the beauty premium. Case study 401. 19-1D. An alternative view of education. Signaling. Earlier we discussed the human capital view of education, according to which schooling raises workers' wages because it makes them more productive. Although this view is widely accepted, some economists have proposed an alternative theory, which emphasizes that firms use educational attainment as a way of sorting between high-ability and low-ability workers. According to this alternative view, when people earn a college degree, for instance, they do not become more productive, but they do signal their high ability to prospective employers. Because it is easier for high-ability people to earn a college degree than it is for low-ability people, more high-ability people get college degrees. As a result, it is rational for firms to interpret a college degree as a signal of ability. The signaling theory of education is similar to the signaling theory of advertising discussed in Chapter 16. In the signaling theory of advertising, the advertisement itself contains no real information, but the firm signals the quality of its product to consumers by its willingness to spend money on advertising. In the signaling theory of education, schooling has no real productivity benefit, but the worker signals her innate productivity to employers by her willingness to spend years at school. In both cases, an action is being taken not for its intrinsic benefit but because the willingness to take that action conveys private information to someone observing it. Thus, we now have two views of education, the human capital theory and the signaling theory. Both views can explain why more educated workers tend to earn more than less educated workers. According to the human capital view, education makes workers more productive. According to the signaling view, education is correlated with natural ability. But the two views have radically different predictions for the effects of policies that aim to increase educational attainment. According to the human capital view, increasing educational levels for all workers would raise all workers' productivity and thereby their wages. According to the signaling view, education does not enhance productivity, so raising all workers' educational levels would not affect wages. Most likely, the truth lies somewhere between these two extremes. The benefits to education are probably a combination of the productivity-enhancing effects of human capital and the productivity-revealing effects of signaling. The relative size of these two effects is an open question. One interpretation is that good looks are themselves a type of innate ability determining productivity and wages. Some people are born with the physical attributes of a movie star, other people are not. Good looks are useful in any job in which workers present themselves to the public, such as acting, sales, and waiting on tables. In this case, an attractive worker is more valuable to the firm than an unattractive worker. The firm's willingness to pay more to attractive workers reflects its customers' preferences. A second interpretation is that reported beauty is an indirect measure of other types of ability. How attractive a person appears depends on more than just heredity. It also depends on dress, hairstyle, personal demeanor, and other attributes that a person can control. Perhaps a person who successfully projects an attractive image in a survey interview is more likely to be an intelligent person who succeeds at other tasks as well. A third interpretation is that the beauty premium is a type of discrimination, a topic to which we return later. Good looks pay. cinemafestival/shutterstock.com 402. 19-1E. The superstar phenomenon. Although most actors earn little and often take jobs as waiters to support themselves, Leonardo DiCaprio earns millions of dollars for each film he makes. Similarly, while most people who play tennis do it for free as a hobby, Maria Sharapova earns millions on the pro tour. DiCaprio and Sharapova are superstars in their fields, and their great public appeal is reflected in astronomical incomes. Why do DiCaprio and Sharapova earn so much? It is not surprising that incomes differ within occupations. Good carpenters earn more than mediocre carpenters, and good plumbers earn more than mediocre plumbers. People vary in ability and effort, and these differences lead to differences in income. Yet the best carpenters and plumbers do not earn the many millions that are common among the best actors and athletes. What explains the difference? To understand the tremendous incomes of DiCaprio and Sharapova, we must examine the special features of the markets in which they sell their services. Superstars arise in markets that have two characteristics. Every customer in the market wants to enjoy the good supplied by the best producer. The good is produced with a technology that makes it possible for the best producer to supply every customer at low cost. If Leonardo DiCaprio is the best actor around, then everyone will want to see his next movie. Seeing twice as many movies by an actor half as talented is not a good substitute. Moreover, it is possible for everyone to enjoy a performance by Leonardo DiCaprio. Because it is easy to make multiple copies of a film, DiCaprio can provide his service to millions of people simultaneously. Similarly, because tennis matches are broadcast on television, millions of fans can enjoy the extraordinary athletic skills of Maria Sharapova. We can now see why there are no superstar carpenters and plumbers. Other things being equal, everyone prefers to employ the best carpenter, but a carpenter, unlike a movie actor, can provide her services to only a limited number of customers. Although the best carpenter will be able to command a somewhat higher wage than the average carpenter will still be able to earn a good living. 19-1F Above equilibrium wages, minimum wage laws, unions, and efficiency wages. Most analyses of wage differences among workers are based on the equilibrium model of the labor market, that is, wages are assumed to adjust to balance labor supply and labor demand. But this assumption does not always apply. For some workers, wages are set above the level that brings supply and demand into equilibrium. Let's consider 3 reasons this might be so. One reason for above equilibrium wages is minimum wage laws, as we first saw in Chapter 6. Most workers in the economy are not affected by these laws because their equilibrium wages are well above the legal minimum. But for some workers, especially the least skilled and experienced, minimum wage laws raise wages above the level they would earn in an unregulated labor market. A second reason that wages might rise above their equilibrium level is the market power of labor unions. A union is a worker association that bargains with employers over wages and working conditions. Unions often raise wages above the level that would prevail in their absence, perhaps because they can threaten. Union, a worker association that bargains with employers over wages and working conditions. 403. To withhold labor from the firm by calling a strike. Studies suggest that union workers earn about 10 to 20% more than similar, non-union workers. A third reason for above equilibrium wages is suggested by the theory of efficiency wages. This theory holds that a firm can find it profitable to pay high wages because doing so increases the productivity of its workers. In particular, high wages may reduce worker turnover, increase worker effort, and raise the quality of workers who apply for jobs at the firm. If this theory is correct, then some firms may choose to pay their workers more than they would normally earn. Above equilibrium wages, whether caused by minimum wage laws, unions, or efficiency wages, have similar effects on the labor market. In particular, pushing a wage above the equilibrium level raises the quantity of labor supplied and reduces the quantity of labor demanded. The result is a surplus of labor, or unemployment. The study of unemployment and the public policies aimed to deal with it is usually considered a topic within macroeconomics, so it goes beyond the scope of this chapter. But it would be a mistake to ignore these issues completely when analyzing earnings. Although most wage differences can be understood while maintaining the assumption of equilibrium in the labor market, above equilibrium wages play a role in some cases. Quick quiz: define compensating differential and give an example. Give 2 reasons why more educated workers earn more than less educated workers. 19-2 The economics of discrimination. Another source of differences in wages is discrimination. Discrimination occurs when the marketplace offers different opportunities to similar individuals who differ only by race, ethnic group, sex, age, or other personal characteristics. Discrimination reflects some people's prejudice against certain groups in society. Discrimination is an emotionally charged topic that often generates heated debate, but economists try to study the topic objectively to separate myth from reality. 19-2 A measuring labor market discrimination. How much does discrimination in labor markets affect the earnings of different groups of workers? This question is important, but answering it is not easy. There is no doubt that different groups of workers earn substantially different wages, as Table 2 demonstrates. The median black man in the United States is paid 21% less than the median white man, and the median black woman is paid 11% less than the median white woman. The differences by sex are also significant. The median white woman is paid 25% less than the median white man, and the median black woman is paid 15% less than the median black man. Taken at face value, these differentials look like evidence that employers discriminate against blacks and women. Yet there is a potential problem with this inference. Even in a labor market free of discrimination, different people have different wages. People differ in the amount of human capital they have and in the kinds of work they are able and willing to do. The wage differences we observe in an economy are, to some extent, attributable to the determinants of equilibrium wages we discussed in the preceding section. Simply observing differences in wages among broad groups whites and blacks, men and women does not prove that employers discriminate. Consider, for example, the role of human capital. In 2011, among men aged 25 and older, 32% of the white population had a college degree, compared with 18% of the black population. Among women aged 25 and older, 31% of the white population had a college degree, compared with 21% of the black population. Thus, at least some of the difference between the wages of whites and the wages of blacks can be traced to differences in educational attainment. Moreover, human capital may be more important in explaining wage differentials than years of schooling suggest. Historically, public schools in predominantly black areas have been of lower quality as measured by expenditure, class size, and so on than public schools in predominantly white areas. If we could measure the quality as well as the quantity of education, the differences in human capital among these groups would seem even larger. Human capital acquired in the form of job experience can also help explain wage differences. In particular, women are more likely to interrupt their careers to raise children. Among the population aged 25 to 34, only 75% of women are in the labor force, compared to 90% of men. As a result, female workers, especially at older ages, tend to have less job experience than male workers. Yet another source of wage differences is compensating differentials. Men and women do not always choose the same type of work, and this fact may help explain some of the earnings differential between men and women. For example, women are more likely to be secretaries, and men are more likely to be truck drivers. The relative wages of secretaries and truck drivers depend in part on the working conditions of each job. Because these non-monetary aspects are hard to measure, it is difficult to gauge the practical importance of compensating differentials in explaining the wage differences that we observe. In the end, the study of wage differences among groups does not establish any clear conclusion about the prevalence of discrimination in U.S. labor markets. Most economists believe that some of the observed wage differentials are attributable to discrimination, but there is no consensus about how much. The only conclusion about which economists are in consensus is a negative one, because the differences in average wages among groups in part reflect differences in human capital and job characteristics. They do not by themselves say anything about how much discrimination there is in the labor market. Of course, differences in human capital among groups of workers may also reflect a kind of discrimination. The less rigorous curriculums historically offered to female students, for instance, can be considered a discriminatory practice. Similarly, the inferior schools historically available to black students may be 405. Traced to prejudice on the part of city councils and school boards. But this kind of discrimination occurs long before the worker enters the labor market. In this case, the disease is political, even if the symptom is economic. Is Emily more employable than Lakeisha? Although measuring the extent of discrimination from labor market outcomes is hard, some compelling evidence for the existence of such discrimination comes from a creative field experiment. Economists Marianne Bertrand and Senthil Mullainathan answered more than 1,300 help-wanted ads run in Boston and Chicago newspapers by sending in nearly 5,000 fake resumes. Half of the resumes had names that were common in the African American community, such as Lakeisha Washington or Jamal Jones. The other half had names that were more common among the white population, such as Emily Walsh and Greg Baker. Otherwise, the resumes were similar. The results of this experiment were published in the American Economic Review in September 2004. The researchers found large differences in how employers responded to the two groups of resumes. Job applicants with white names received about 50% more calls from interested employers than applicants with African American names. The study found that this discrimination occurred for all types of employers, including those who claimed to be an equal opportunity employer in their help-wanted ads. The researchers concluded that racial discrimination is still a prominent feature of the labor market. Case study 19-2b Discrimination by employers. Let's now turn from measurement to the economic forces that lie behind discrimination in labor markets. If one group in society receives a lower wage than another group, even after controlling for human capital and job characteristics, who is to blame for this differential? The answer is not obvious. It might seem natural to blame employers for discriminatory wage differences. After all, employers make the hiring decisions that determine labor demand and wages. If some groups of workers earn lower wages than they should, then it seems that employers are responsible. Yet many economists are skeptical of this easy answer. They believe that competitive, market economies provide a natural antidote to employer discrimination. That antidote is called the profit motive. Imagine an economy in which workers are differentiated by their hair color. Blondes and brunettes have the same skills, experience, and work ethic. Yet because of discrimination, employers prefer to hire workers with brunette hair. Thus, the demand for blondes is lower than it otherwise would be. As a result, blondes earn a lower wage than brunettes. How long can this wage differential persist? In this economy, there is an easy way for a firm to beat out its competitors: it can hire blonde workers. By hiring blondes, a firm pays lower wages and thus has lower costs than firms that hire brunettes. Over time, more and more blonde firms enter the market to take advantage of this cost advantage. The existing brunette firms have higher costs and, therefore, begin to lose money when faced with the new competitors. These losses induce the brunette firms to go out of business. Eventually, the entry of blonde firms and the exit of brunette firms cause the demand for blonde workers 406 to rise and the demand for brunette workers to fall. This process continues until the wage differential disappears. Put simply, business owners who care only about making money are at an advantage when competing against those who also care about discriminating. As a result, firms that do not discriminate tend to replace those that do. In this way, competitive markets have a natural remedy for employer discrimination. Segregated streetcars and the profit motive. In the early 20th century, streetcars in many southern cities were segregated by race. White passengers sat in the front of the streetcars, and black passengers sat in the back. What do you suppose caused and maintained this discriminatory practice? And how was this practice viewed by the firms that ran the streetcars? In a 1986 article in the Journal of Economic History, economic historian Jennifer Roback looked at these questions. Roback found that the segregation of races on streetcars was the result of laws that required such segregation. Before these laws were passed, racial discrimination in seating was rare. It was far more common to segregate smokers and non-smokers. Moreover, the firms that ran the streetcars often opposed the laws requiring racial segregation. Providing separate seating for different races raised the firm's costs and reduced their profits. One railroad company manager complained to the city council that, under the segregation laws, the company has to haul around a good deal of empty space. Here is how Roback describes the situation in one southern city. The railroad company did not initiate the segregation policy and was not at all eager to abide by it. State legislation, public agitation, and a threat to arrest the president of the railroad were all required to induce them to separate the races on their cars. There is no indication that the management was motivated by belief in civil rights or racial equality. The evidence indicates their primary motives were economic. Separation was costly. Officials of the company may or may not have disliked blacks, but they were not willing to forego the profits necessary to indulge such prejudice. The story of Southern streetcars illustrates a general lesson: business owners are usually more interested in making profits than in discriminating against a particular group. When firms engage in discriminatory practices, the ultimate source of the discrimination often lies not with the firms themselves but elsewhere. In this particular case, the streetcar companies segregated whites and blacks because discriminatory laws, which the companies opposed, required them to do so. Case study 19-2C Discrimination by customers and governments. The profit motive is a strong force acting to eliminate discriminatory wage differentials, but there are limits to its corrective abilities. Two important limiting factors are customer preferences and government policies. To see how customer preferences for discrimination can affect wages, consider again our imaginary economy with blondes and brunettes. Suppose that restaurant owners discriminate against blondes when hiring waiters. As a result, blonde waiters earn lower wages than brunette waiters. In this case, a restaurant can open up with blonde waiters and charge lower prices. If customers care only about the 407 quality and price of their meals, the discriminatory firms will be driven out of business, and the wage differential will disappear. On the other hand, it is possible that customers prefer being served by brunette waiters. If this discriminatory preference is strong, the entry of blonde restaurants need not succeed in eliminating the wage differential between brunettes and blondes. That is, if customers have discriminatory preferences, a competitive market is consistent with a discriminatory wage differential. An economy with such discrimination would contain two types of restaurants. Blonde restaurants hire blondes, have lower costs, and charge lower prices. Brunette restaurants hire brunettes, have higher costs, and charge higher prices. Customers who did not care about the hair color of their waiters would be attracted to the lower prices at the blonde restaurants. Bigoted customers would go to the brunette restaurants and would pay for their discriminatory preference in the form of higher prices. Another way for discrimination to persist in competitive markets is for the government to mandate discriminatory practices. If, for instance, the government passed a law stating that blondes could wash dishes in restaurants but could not work as waiters, then a wage differential could persist in a competitive market. The example of segregated streetcars in the previous case study is one example of government-mandated discrimination. Similarly, before South Africa abandoned its formal policy of racial segregation called apartheid in 1990, blacks were prohibited from working in some jobs. Discriminatory governments pass such laws to suppress the normal equalizing force of free and competitive markets. To sum up, competitive markets contain a natural remedy for employer discrimination. The entry of firms that care only about profit tends to eliminate discriminatory wage differentials. These wage differentials persist in competitive markets only when customers are willing to pay to maintain the discriminatory practice or when the government mandates it. Discrimination in sports. As we have seen, measuring discrimination is often difficult. To determine whether one group of workers is discriminated against, a researcher must correct for differences in the productivity between that group and other workers in the economy. Yet in most firms, it is difficult to measure a particular worker's contribution to the production of goods and services. One type of firm in which such measurements are easier is the sports team. Professional teams have many objective measures of productivity. In baseball, for instance, we can measure a player's batting average, the frequency of home runs, the number of stolen bases, and so on. Studies of sports teams suggest that racial discrimination has, in fact, been common and that much of the blame lies with customers. One study, published in the Journal of Labor Economics in 1988, examined the salaries of basketball players and found that black players earned 20% less than white players of comparable ability. The study also found that attendance at basketball games was larger for teams with a greater proportion of white players. One interpretation of these facts is that, at least at the time of the study, customer discrimination made black players less profitable than white players for team owners. In the presence of such customer discrimination, a discriminatory wage gap can persist, even if team owners care only about profit. A similar situation once existed for baseball players. A study using data from the late 1960s showed that black players earned less than comparable white. Case study. 408. Players. Moreover, fewer fans attended games pitched by blacks than games pitched by whites, even though black pitchers had better records than white pitchers. Studies of more recent salaries in baseball, however, have found no evidence of discriminatory wage differentials. Another study, published in the Quarterly Journal of Economics in 1990, examined the market prices of old baseball cards. This study found similar evidence of discrimination. The cards of black hitters sold for 10% less than the cards of comparable white hitters, and the cards of black pitchers sold for 13% less than the cards of comparable white pitchers. These results suggest customer discrimination among baseball fans. Quick quiz: why is it hard to establish whether a group of workers is being discriminated against? Explain how profit-maximizing firms tend to eliminate discriminatory wage differentials. How might a discriminatory wage differential persist? The difference between men and women, revisited, it's about competition. By Hal R. Varian. Gender differences are a topic of endless discussion for parents, teachers, and social scientists. A noteworthy case in point is a recent National Bureau of Economic Research working paper by a Stanford economist, Muriel Need-Orel, and Lisa Vesterlund, a University of Pittsburgh economist, titled, "Do Women Shy Away from Competition? Do Men Compete Too Much?" It is widely noted that women are not well represented in high-paying corporate jobs, or in mathematics, science, and engineering jobs. As the authors observe, the standard economic explanations for such occupational differences include preferences, ability, and discrimination. To this list the authors add a new factor: attitudes toward competitive environments. If men prefer more competitive environments than women, then there will be more men represented in areas where competition is intense. Of course, discussions of gender differences of any sort can only be statements about averages. It is clear that there are women who thrive in competitive environments and men who do not. Furthermore, attitudes toward competition may be ingrained or a result of factors like social stereotyping. Is there any evidence that the hypothesis is true? Do men really prefer more competitive environments than women? One could cite anecdote after anecdote, but the authors took a much more direct approach. They ran an experiment. By using an experiment, the authors were able to determine not only whether men and women differ in their willingness to compete, but more important, whether they differ in their willingness to compete conditioned on their actual performance. The economists asked 80 subjects, divided into groups of 2 women and 2 men, to add up sets of 5 two-digit gender differences. Economic research is shedding light on why men and women choose different career paths. In the news. 19-3 Conclusion: in competitive markets, workers earn a wage equal to the value of their marginal contribution to the production of goods and services. There are, however, many things that affect the value of the marginal product. Firms pay more for workers who are more talented, more diligent, more experienced, and more educated. Because these workers are more productive. Firms pay less to those workers against whom customers discriminate because these workers contribute less to revenue. The theory of the labor market we have developed in the last 2 chapters explains why some workers earn higher wages than other workers. The theory does not say that the resulting distribution of income is equal, fair, or desirable in any way. That is the topic we take up in Chapter 20. Workers earn different wages for many reasons. To some extent, wage differentials compensate workers for job attributes. Other things being equal, workers in hard, unpleasant jobs are paid more than workers in easy, pleasant jobs. Workers with more human capital are paid more than workers with less human capital. The return to accumulating human capital is high and has increased over the past several decades. Although years of education, experience, and job characteristics affect earnings as theory predicts, there is much variation in earnings that cannot be explained by things that economists can measure. The unexplained variation in earnings is largely attributable to natural ability, effort, and chance. Some economists have suggested that more educated workers earn higher wages not because education raises productivity but because workers with high natural ability use education as a way to signal their high ability to employers. If this signaling theory is correct, then increasing the educational attainment of all workers would not raise the overall level of wages. Summary 410. Questions for Review 1. Why are coal miners paid more than other workers with similar amounts of education? 2. In what sense is education a type of capital? 3. How might education raise a worker's wage without raising the worker's productivity? 4. What conditions lead to highly compensated superstars? Would you expect to see superstars in dentistry? In music? Explain. 5. Give 3 reasons a worker's wage might be above the level that balances supply and demand. 6. What difficulties arise in deciding whether a group of workers has a lower wage because of discrimination? 7. Do the forces of economic competition tend to exacerbate or ameliorate discrimination based on race? 8. Give an example of how discrimination might persist in a competitive market. Wages are sometimes pushed above the level that brings supply and demand into balance. 3 reasons for above equilibrium wages are minimum wage laws, unions, and efficiency wages. Some differences in earnings are attributable to discrimination based on race, sex, or other factors. Measuring the amount of discrimination is difficult, however, because one must correct for differences in human capital and job characteristics. Competitive markets tend to limit the impact of discrimination on wages. If the wages of a group of workers are lower than those of another group for reasons not related to marginal productivity, then non-discriminatory firms will be more profitable than discriminatory firms. Profit-maximizing behavior, therefore, can reduce discriminatory wage differentials. Discrimination persists in competitive markets, however, if customers are willing to pay more to discriminatory firms or if the government passes laws requiring firms to discriminate. Key concepts. 1. Ricky leaves his job as a high school math teacher and returns to school to study the latest developments in computer programming, after which he takes a higher paying job at a software firm. This is an example of a compensating differential. B. Human capital. C. Signaling. D. Efficiency wages. 2. Lucy and Ethel work at a local department store. Lucy, who greets customers as they arrive, is paid less than Ethel, who cleans the bathrooms. This is an example of a compensating differential. B. Human capital. C. Signaling. D. Efficiency wages. 3. Fred runs a small manufacturing company. He pays his employees about twice what other firms in the area pay, even though he could pay less and still recruit all the workers he wants. He believes that higher wages make his workers more loyal and hard-working. This is an example of A compensating differential. B. Human capital. C. Signaling. D. Efficiency wages. 4. A business consulting firm hires Vivian because she was a math major in college. Her new job does not require any of the mathematics she learned, but the firm believes that anyone who can graduate with a math degree must be very smart. This is an example of A compensating differential. B. Human capital. C. Signaling. D. Efficiency wages. 5. Measuring how much discrimination affects labor market outcomes is difficult because A. Data on wages are crucial but not readily available. B. Firms misreport the wages they pay to hide discriminatory practices. C. Workers differ in their attributes and the types of jobs they have. D. The same minimum wage law applies to workers in all groups. 6. The forces of competition in markets with free entry and exit tend to eliminate wage differentials that arise from discrimination by A. Employers. B. Customers. C. Government. D. All of the above. Quick check multiple choice. 411. 1. College students sometimes work as summer interns for private firms or the government. Many of these positions pay little or nothing. A. What is the opportunity cost of taking such a job? B. Explain why students are willing to take these jobs. C. If you were to compare the earnings later in life of workers who had worked as interns and those who had taken summer jobs that paid more, what would you expect to find? 2. As explained in Chapter 6, a minimum wage law distorts the market for low-wage labor. To reduce this distortion, some economists advocate a two-tiered minimum wage system, with a regular minimum wage for adult workers and a lower, sub-minimum wage for teenage workers. Give 2 reasons a single minimum wage might distort the labor market for teenage workers more than it would the market for adult workers. 3. A basic finding of labor economics is that workers who have more experience in the labor force are paid more than workers who have less experience. Why might this be so? Some studies have also found that experience at the same job has an extra positive influence on wages. Explain why this might occur. 4. At some colleges and universities, economics professors receive higher salaries than professors in some other fields. A. Why might this be true? B. Some other colleges and universities have a policy of paying equal salaries to professors in all fields. At some of these schools, economics professors have lighter teaching loads than professors in some other fields. What role do the differences in teaching loads play? 5. Imagine that someone offered you a choice. You could spend 4 years studying at the world's best university, but you would have to keep your attendance there a secret. Or you could be awarded an official degree from the world's best university, but you couldn't actually attend. Which choice do you think would enhance your future earnings more? What does your answer say about the debate over signaling versus human capital in the role of education? 6. When recording devices were first invented more than 100 years ago, musicians could suddenly supply their music to large audiences at low cost. How do you suppose this development affected the income of the best musicians? How do you suppose it affected the income of average musicians? 7. A current debate in education is whether teachers should be paid on a standard pay scale based solely upon their years of training and teaching experience, or whether part of their salary should be based upon their performance. A. Why might merit pay be desirable? B. Who might be opposed to a system of merit pay? C. What is a potential challenge of merit pay? D. A related issue, why might a school district decide to pay teachers significantly more than the salaries offered by surrounding districts? 8. When Alan Greenspan ran an economic consulting firm in the 1960s, he primarily hired female economists. He once told the New York Times, "I always valued men and women equally, and I found that because others did not, good women economists were cheaper than men." Is Greenspan's behavior profit maximizing? Is it admirable or despicable? If more employers were like Greenspan, what would happen to the wage differential between men and women? Why might other economic consulting firms at the time not have followed Greenspan's business strategy? 9. This chapter considers the economics of discrimination by employers, customers, and governments. Now consider discrimination by workers. Suppose that some brunette workers do not like working with blonde workers. Can this worker discrimination explain lower wages for blonde workers? If such a wage differential existed, what would a profit-maximizing entrepreneur do? If there were many such entrepreneurs, what would happen over time? Go to CEngageBrain.com to purchase access to the proven, critical study guide to accompany this text, which features additional notes and context, practice tests, and much more. Problems and applications. 413. Income inequality and poverty. Great British Prime Minister Winston Churchill once summarised alternative economic systems as follows: the inherent vice of capitalism is the unequal sharing of blessings. The inherent virtue of socialism is the equal sharing of miseries. Churchill's quip draws attention to two important facts. First, nations that use market mechanisms to allocate resources usually achieve greater prosperity than those that do not. This is the result of Adam Smith's invisible hand in action. Second, the prosperity that market economies produce is not shared equally. Incomes can differ greatly between those at the top and those at the bottom of the economic ladder. The gap between rich and poor is a fascinating and important topic of study for the comfortable rich, for the struggling poor, and for the aspiring and worried middle class. From the previous two chapters, you should have some understanding about why different people have different incomes. A person's earnings. Chapter 20. 414. Depend on the supply and demand for that person's labor, which in turn depend on natural ability, human capital, compensating differentials, discrimination, and so on. Because labor earnings make up about 2/3 of the total income in the U.S. economy, the factors that determine wages are also largely responsible for determining how the economy's total income is distributed among the various members of society. In other words, they determine who is rich and who is poor. In this chapter, we discuss the distribution of income, a topic that raises some fundamental questions about the role of economic policy. One of the 10 principles of economics in Chapter 1 is that governments can sometimes improve market outcomes. This possibility is particularly important when considering the distribution of income. The invisible hand of the marketplace acts to allocate resources efficiently, but it does not necessarily ensure that resources are allocated fairly. As a result, many economists, though not all, believe that the government should redistribute income to achieve greater equality. In doing so, however, the government runs into another of the 10 principles of economics: people face trade-offs. When the government enacts policies to make the distribution of income more equal, it distorts incentives, alters behavior, and makes the allocation of resources less efficient. Our discussion of the distribution of income proceeds in 3 steps. First, we assess how much inequality there is in our society. Second, we consider some different views about what role the government should play in altering the distribution of income. Third, we discuss various public policies aimed at helping society's poorest members. 20-1 The measurement of inequality. We begin our study of the distribution of income by addressing 4 questions of measurement. How much inequality is there in our society? How many people live in poverty? What problems arise in measuring the amount of inequality? How often do people move between income classes? These measurement questions are the natural starting point from which to discuss public policies aimed at changing the distribution of income. 20-1 A U.S. income inequality. Imagine that you lined up all the families in the economy according to their annual income. Then you divided the families into 5 equal groups: the bottom fifth, the second fifth, the middle fifth, the fourth fifth, and the top fifth. Table 1 shows the income ranges for each of these groups, as well as for the top 5%. You can use this table to find where your family lies in the income distribution. For examining differences in the income distribution over time, economists find it useful to present the income data as in Table 2. This table shows the share of total income that each group of families received in selected years. In 2011, the bottom fifth of all families received 3.8% of all income, and the top fifth of. As far as I'm concerned, they can do what they want with the minimum wage, just as long as they keep their hands off the maximum wage. 415. Income inequality in the United States. This table shows the percentage of total before-tax income received by families in each fifth of the income distribution and by those families in the top 5%. All families received 48.9% of all income. In other words, even though the top and bottom fifths include the same number of families, the top fifth has more than 12 times as much income as the bottom fifth. The last column in the table shows the share of total income received by the very richest families. In 2011, the top 5% of families received 21.3% of all income, which was greater than the total income of the poorest 40%. Table 2 also shows the distribution of income in various years beginning in 1935. At first glance, the distribution of income appears to have been remarkably stable over time. Throughout the past several decades, the bottom fifth of families has received about 4 to 5% of income, while the top fifth has received about 40 to 50% of income. Closer inspection of the table reveals some trends in the degree of inequality. From 1935 to 1970, the distribution gradually became more equal. The share of the bottom fifth rose from 4.1 to 5.5%, and the share of the top fifth fell from 51.7% to 40.9%. In more recent years, this trend has reversed itself. From 1970 to 2011, the share of the bottom fifth fell from 5.5% to 3.8% and the share of the top fifth rose from 40.9% to 48.9%. In Chapter 19, we discussed some explanations for this recent rise in inequality. Increases in international trade with low-wage countries and changes in technology have tended to reduce the demand for unskilled labor and raise the demand for skilled labor. As a result, the wages of unskilled workers have fallen relative to the wages of skilled workers, and this change in relative wages has increased inequality in family incomes. 20-1b Inequality around the world. How does the amount of inequality in the United States compare to that in other countries? This question is interesting, but answering it is problematic. For some countries, data are not available. Even when they are, not every country collects data in the same way. For example, some countries collect data on individual incomes, whereas other countries collect data on family incomes, and still others collect data on expenditure rather than income. As a result, whenever we find a difference between two countries, we can never be sure whether it reflects a true difference in the economies or merely a difference in the way data are collected. With this warning in mind, consider Figure 1, which compares inequality in the 25 most populous countries. The inequality measure is the ratio of the income received by the richest fifth of the population to the income of the poorest fifth. The most equality is found in Japan, where the top fifth receives 3.4 times as much income as the bottom fifth. The least equality is found in South Africa, where the top group receives 20.1 times as much income as the bottom group. All countries have significant disparities between rich and poor, but the degree of inequality varies substantially around the world. When countries are ranked by inequality, the United States ends up with a bit more inequality than the typical country. The United States has greater income disparity than most other economically advanced countries, such as Japan and Germany. But the United States has a more equal income distribution than some developing countries, such as South Africa and Brazil. 20-1c The poverty rate. A commonly used gauge of the distribution of income is the poverty rate. The poverty rate is the percentage of the population whose family income falls below an absolute level called the poverty line. The poverty line is set by the federal government at roughly 3 times the cost of providing an adequate diet. This line is adjusted every year to account for changes in the level of prices, and it depends on family size. To get some idea about what the poverty rate tells us, consider the data for 2011. In that year, the median family in the United States had an income of $60,974, and the poverty line for a family of 4 was $23,021. The poverty rate was 15%. In other words, 15% of the U.S. population were members of families with incomes below the poverty line for their family size. Figure 2 shows the poverty rate since 1959, when the official data begin. You can see that the poverty rate fell from 22.4% in 1959 to a low of 11.1% in 1973. This decline is not surprising, because average income in the economy rose more than 50% during this period. Because the poverty line is an absolute rather than a relative standard, more families are pushed above the poverty line as economic growth pushes the entire income distribution upward. As John F. Kennedy once put it, a rising tide lifts all boats. Since the early 1970s, however, the economy's rising tide has left some boats behind. Despite continued growth in average income, the poverty rate has not declined below the level reached in 1973. This lack of progress in reducing poverty in recent decades is closely related to the increasing inequality we saw in Table 2. Although economic growth has raised the income of the typical family, the increase in inequality has prevented the poorest families from sharing in this greater economic prosperity. Poverty is an economic malady that affects all groups within the population, but it does not affect all groups with equal frequency. Table 3 shows the poverty rates for several groups, and it reveals 3 striking facts. Poverty is correlated with race. Blacks and Hispanics are about 3 times more likely to live in poverty than are whites. Poverty is correlated with age. Children are more likely than average to be members of poor families, and the elderly are less likely than average to be poor. Poverty is correlated with family composition. Families headed by a female adult without a spouse present are about 5 times as likely to live in poverty as families headed by a married couple. These 3 facts have described American society for many years, and they show which people are most likely to be poor. These effects also work together. Among Black and Hispanic children in female-headed households, about half live in poverty. 20-1D problems in measuring inequality. Although data on the income distribution and the poverty rate give us some idea about the degree of inequality in our society, interpreting these data is not always straightforward. The data are based on households' annual incomes. What people care about, however, is not their incomes but their ability to maintain a good standard of living. For at least 3 reasons, data on the income distribution and the poverty rate give an incomplete picture of inequality in living standards. In-kind transfers measurements of the distribution of income and the poverty rate are based on families' money income. Through various government programs, however, the poor receive many non-monetary items, including food stamps, housing vouchers, and medical services. Transfers to the poor given in the form of goods and services rather than cash are called in-kind transfers. Standard measurements of the degree of inequality do not take account of these in-kind transfers. Because in-kind transfers are received mostly by the poorest members of society, the failure to include in-kind transfers as part of income greatly affects the measured poverty rate. According to a study by the Census Bureau, if in-kind transfers were included in income at their market value, the number of families in poverty would be about 10% lower than the standard data indicate. The economic life cycle incomes vary predictably over people's lives. A young worker, especially one in school, has a low income. Income rises as the worker gains maturity and experience, peaks at around age 50, and then falls sharply when the worker retires at around age 65. This regular pattern of income variation is called the life cycle. Because people can borrow and save to smooth out life cycle changes in income, their standard of living in any year depends more on lifetime income than on that year's income. The young often borrow, perhaps to go to school or to buy a house, and then repay these loans later when their incomes rise. People have their highest saving rates when they are middle-aged. Because people can save in anticipation of retirement, the large declines in incomes at retirement need not lead to similar declines in the standard of living. This normal life cycle pattern causes inequality in the distribution of annual income, but it does not necessarily represent true inequality in living standards. Transitory versus permanent incomes vary over people's lives not only because of predictable life cycle variation but also because of random and transitory forces. 1 year of frost kills off the Florida orange crop, and Florida orange growers see their incomes fall temporarily. At the same time, the Florida frost drives up the price of oranges, and California orange growers see their incomes temporarily rise. The next year the reverse might happen. Just as people can borrow and save to smooth out life cycle variation in income, they can also borrow and save to smooth out transitory variation in income. To the extent that a family saves in good years and borrows in bad years, transitory changes in income need not affect its standard of living. A family's ability to buy goods and services depends largely on its permanent income, which is its normal, or average, income. To gauge inequality of living standards, the distribution of permanent income is more relevant than the distribution of annual income. Many economists believe that people base their consumption on their permanent income. As a result, inequality in consumption is one gauge of inequality of permanent income. Because permanent income and consumption are less affected by transitory changes in income, they are more equally distributed than is current income. Alternative measures of inequality. A 2008 study by Michael Cox and Richard Alm of the Federal Reserve Bank of Dallas shows how different measures of inequality lead to dramatically different results. Cox and Alm compared American households in the top fifth of the income distribution to those in the bottom fifth to see how far apart they are. According to Cox and Alm, the richest fifth of U.S. households in 2006 had an average income of $149,963, while the poorest fifth had an average income of $9,974. Thus, the top group had about 15 times as much income as the bottom group. The gap between rich and poor shrinks a bit if taxes are taken into account. Because the tax system is progressive, the top group paid a higher percentage of its income in taxes than did the bottom group. Cox and Alm found that the richest fifth had 14 times as much after-tax income as the poorest fifth. The gap shrinks more substantially if one looks at consumption rather than income. Households having an unusually good year are more likely to be in the top group and are likely to save a high fraction out of their incomes. Households having an unusually bad year are more likely to be in the bottom group and are more likely to consume out of their savings. According to Cox and Alms, the consumption of the richest fifth was only 3.9 times as much as the consumption of the poorest fifth. The consumption gap becomes smaller still if one corrects for differences in the number of people in the household. Because larger families are more likely to have two earners, they are more likely to find themselves near the top of the income distribution. But they also have more mouths to feed. Cox and Alms reported that households in the top fifth had an average of 3.1 people, while those in the bottom fifth had an average of 1.7 people. As a result, consumption per person in the richest fifth of households was only 2.1 times consumption per person in the poorest fifth. These data show that inequality in material standards of living is much smaller than inequality in annual income. 20-1E Economic mobility. People sometimes speak of the rich and the poor as if these groups consisted of the same families year after year. In fact, this is not at all the case. Economic mobility, the movement of people between income classes, is significant in the U.S. economy. Movements up the income ladder can be due to good luck or hard work, and movements down the ladder can be due to bad luck or laziness. Some of this mobility reflects transitory variation in income, while some reflects more persistent changes in income. Because family income changes over time, temporary poverty is more common than the poverty rate suggests, but persistent poverty is less common. In a typical 10-year period, about 1 in 4 families falls below the poverty line in at least 1 year. Yet fewer than 3% of families are poor for 8 or more years. Because it is likely that the temporarily poor and the persistently poor face different problems, policies that aim to combat poverty need to distinguish between these groups. Another way to gauge economic mobility is the persistence of economic success from generation to generation. Economists who have studied this topic find that having an above-average income carries over from parents to children, but the persistence is far from perfect, indicating substantial mobility among income classes. If a father earns 20% above his generation's average income, his son will most likely earn 8% above his generation's average income. There is only a small correlation between the income of a grandfather and the income of his grandson. One result of this intergenerational economic mobility is that the U.S. economy is filled with self-made millionaires. According to one study, about 4 out of 5 millionaires made their money on their own, often by starting and building a business or by climbing the corporate ladder. Only 1 in 5 millionaires inherited his fortune. Quick quiz: what does the poverty rate measure? Describe 3 potential problems in interpreting the measured poverty rate. 20-2 The political philosophy of redistributing income. We have just seen how the economy's income is distributed and have considered some of the problems in interpreting measured inequality. This discussion was positive in the sense that it merely described the world as it is. We now turn to the normative question facing policymakers: what should the government do about economic inequality? This question is not just about economics. Economic analysis alone cannot tell us whether policymakers should try to make our society more egalitarian. Our views on this question are, to a large extent, a matter of political philosophy. Yet because the government's role in redistributing income is central to so many debates over economic policy, here we digress from economic science to consider a bit of political philosophy. 20-2 A Utilitarianism. A prominent school of thought in political philosophy is utilitarianism. The founders of utilitarianism are the English philosophers Jeremy Bentham and John Stuart Mill. To a large extent, the goal of utilitarians is to apply the logic of individual decision-making to questions concerning morality and public policy. The starting point of utilitarianism is the notion of utility, the level of happiness or satisfaction that a person receives from his circumstances. Utility is a measure of well-being and, according to utilitarians, is the ultimate objective of all public and private actions. The proper goal of the government, they claim, is to maximize the sum of utility achieved by everyone in society. The utilitarian case for redistributing income is based on the assumption of diminishing marginal utility. It seems reasonable that an extra dollar of income provides a poor person with more additional utility than an extra dollar would provide to a rich person. In other words, as a person's income rises, the extra well-being derived from an additional dollar of income falls. This plausible assumption, together with the utilitarian goal of maximizing total utility, implies that the government should try to achieve a more equal distribution of income. The argument is simple. Imagine that Peter and Paul are the same, except that Peter earns $80,000 and Paul earns $20,000. In this case, taking a dollar from Peter to pay Paul will reduce Peter's utility and raise Paul's utility. But because of diminishing marginal utility, Peter's utility falls by less than Paul's utility rises. Thus, this redistribution of income raises total utility, which is the utilitarian's objective. At first, this utilitarian argument might seem to imply that the government should continue to redistribute income until everyone in society has exactly the same income. Indeed, that would be the case if the total amount of income $100,000 in our example were fixed. But in fact, it is not. Utilitarians reject complete equalization of incomes because they accept one of the 10 principles of economics presented in Chapter 1, people respond to incentives. To take from Peter to pay Paul, the government must pursue policies that redistribute income. The U.S. federal income tax and welfare system are examples. Under these policies, people with high incomes pay high taxes, and people with low incomes receive income transfers. These income transfers are phased out, As a person earns more, he receives less from the government. Yet when the government uses higher income taxes and phased out transfers to take away additional income a person might earn, both Peter and Paul have less incentive to work hard. As they work less, society's income falls, and so does total utility. The utilitarian government has to balance the gains from greater equality against the losses from distorted incentives. To maximize total utility, therefore, the government stops short of making society fully egalitarian. A famous parable sheds light on the utilitarian's logic. Imagine that Peter and Paul are thirsty travelers trapped at different places in the desert. Peter's oasis has a lot of water, Paul's has only a little. If the government could transfer water from one oasis to the other without cost, it would maximize total utility from water by equalizing the amount in the two places. But suppose that the government has only a leaky bucket. As it tries to move water from one place to the other, some of the water is lost in transit. In this case, a utilitarian government might still try to move some water from Peter to Paul, depending on the size of Paul's thirst and the size of the bucket's leak. But with only a leaky bucket at its disposal, a utilitarian government will stop short of trying to reach complete equality. 20-2b Liberalism. A second way of thinking about inequality might be called liberalism. Philosopher John Rawls develops this view in his book A Theory of Justice. This book was first published in 1971, and it quickly became a classic in political philosophy. Rawls begins with the premise that a society's institutions, laws, and policies should be just. He then takes up the natural question, how can we, the members of society, ever agree on what justice means? It might seem that every person's point of view is inevitably based on his particular circumstances, whether he is talented or less talented, diligent or lazy, educated or less educated, born to a wealthy family or a poor one. Could we ever objectively determine what a just society would be? To answer this question, Rawls proposes the following thought experiment. Imagine that before any of us is born, we all get together in the before life for a meeting to design the rules that will govern society. At this point, we are all ignorant about the station in life each of us will end up filling. In Rawls's words, we are sitting in an original position behind a veil of ignorance. In this original position, Rawls argues, we can choose a just set of rules for society because we must consider how those rules will affect every person. As Rawls puts it, since all are similarly situated and no one is able to design principles to favor his particular conditions, the principles of justice are the result of fair agreement or bargain. Designing public policies and institutions in this way allows us to be objective about what policies are just. Rawls then considers what public policy designed behind this veil of ignorance would try to achieve. In particular, he considers what income distribution a person would consider fair if that person did not know whether he would end up at the top, bottom, or middle of the distribution. Rawls argues that a person in the original position would be especially concerned about the possibility of being at the bottom of the income distribution. In designing public policies, therefore, we should aim to raise the welfare of the worst-off person in society. That is, rather than maximizing the sum of everyone's utility, as a utilitarian would do, Rawls would maximize the minimum utility. Rawls's rule is called the maximum criterion. Because the maximum criterion emphasizes the least fortunate person in society, it justifies public policies aimed at equalizing the distribution of income. By transferring income from the rich to the poor, society raises the well-being of the least fortunate. The maximum criterion would not, however, lead to a completely egalitarian society. If the government promised to equalize incomes completely, people would have no incentive to work hard, society's total income would fall substantially, and the least fortunate person would be worse off. Thus, the maximum criterion still allows disparities in income because such disparities can improve incentives and thereby raise society's ability to help the poor. Nonetheless, because Rawls's philosophy puts weight on only the least fortunate members of society, it calls for more income redistribution than does utilitarianism. Rawls's views are controversial, but the thought experiment he proposes has much appeal. In particular, this thought experiment allows us to consider the redistribution of income as a form of social insurance. That is, from the perspective of the original position behind the veil of ignorance, income redistribution is like an insurance policy. Homeowners buy fire insurance to protect themselves from the risk of their house burning down. Similarly, when we as a society choose policies that tax the rich to supplement the incomes of the poor, we are all insuring ourselves against the possibility that we might have been members of poor families. Because people dislike risk, we should be happy to have been born into a society that provides us this insurance. It is not at all clear, however, that rational people behind the veil of ignorance would truly be so averse to risk as to follow the maximum criterion. Indeed, because a person in the original position might end up anywhere in the distribution of outcomes, he might treat all possible outcomes equally when designing public policies. In this case, the best policy behind the veil of ignorance would be to maximize the average utility of members of society, and the resulting notion of justice would be more utilitarian than Rawlsian. 20-2c Libertarianism. A third view of inequality is called libertarianism. The two views we have considered so far, utilitarianism and liberalism, both view the total income of society as a shared resource that a social planner can freely redistribute to achieve some social goal. By contrast, libertarians argue that society itself earns no income, only individual members of society earn income. According to libertarians, the government should not take from some individuals and give to others to achieve any particular distribution of income. For instance, philosopher Robert Nozick writes the following in his famous 1974 book Anarchy, State, and Utopia: "We are not in the position of children who have been given portions of pie by someone who now makes last-minute adjustments to rectify careless cutting. There is no central distribution, no person or group entitled to control all the resources, jointly deciding how they are to be doled out. What each person gets, he gets from others who give to him in exchange for something, or as a gift. In a free society, diverse persons control different resources, and new holdings arise out of the voluntary exchanges and actions of persons." Whereas utilitarians and liberals try to judge what amount of inequality is desirable in a society, Nozick denies the validity of this very question. The libertarian alternative to evaluating economic outcomes is to evaluate the process by which these outcomes arise. When the distribution of income is achieved unfairly, for instance, when one person steals from another, the government has the right and duty to remedy the problem. But as long as the process determining the distribution of income is just, the resulting distribution is fair, no matter how unequal. Nozick criticizes Rawls's liberalism by drawing an analogy between the distribution of income in society and the distribution of grades in a course. Suppose you were asked to judge the fairness of the grades in the economics course you are now taking. Would you imagine yourself behind a veil of ignorance and choose a grade distribution without knowing the talents and efforts of each student? Or would you ensure that the process of assigning grades to students is fair without regard for whether the resulting distribution is equal or unequal? For the case of grades at least, the libertarian emphasis on process over outcomes is compelling. Libertarians conclude that equality of opportunities is more important than equality of incomes. They believe that the government should enforce individual rights to ensure that everyone has the same opportunity to use his talents and achieve success. Once these rules of the game are established, the government has no reason to alter the resulting distribution of income. Quick quiz: Pam earns more than Pauline. Someone proposes taxing Pam to supplement Pauline's income. How would a utilitarian, a liberal, and a libertarian each evaluate this proposal? 20-3 Policies to reduce poverty. As we have just seen, political philosophers hold various views about what role the government should take in altering the distribution of income. Political debate among the larger population of voters reflects a similar disagreement. Despite these continuing debates, most people believe that, at the very least, the government should try to help those most in need. According to a popular metaphor, the government should provide a safety net to prevent any citizen from falling too far. Poverty is one of the most difficult problems that policymakers face. Poor families are more likely than the overall population to experience homelessness, drug dependence, health problems, teenage pregnancy, illiteracy, unemployment, and low educational attainment. Members of poor families are both more likely to commit crimes and more likely to be victims of crimes. Although it is hard to separate the causes of poverty from the effects, there is no doubt that poverty is associated with various economic and social ills. Suppose that you were a policymaker in the government and your goal was to reduce the number of people living in poverty. How would you achieve this goal? Here we examine some of the policy options that you might consider. Each of these options helps some people escape poverty, but none of them is perfect, and deciding upon the best combination to use is not easy. 20-3 A minimum wage laws. Laws setting a minimum wage that employers can pay workers are a perennial source of debate. Advocates view the minimum wage as a way of helping the working poor without any cost to the government. Critics view it as hurting those it is intended to help. The minimum wage is easily understood using the tools of supply and demand, as we first saw in Chapter 6. For workers with low levels of skill and experience, a high minimum wage forces the wage above the level that balances supply and demand. It therefore raises the cost of labor to firms and reduces the quantity of labor that those firms demand. The result is higher unemployment among those groups of workers affected by the minimum wage. Those workers who remain employed benefit from a higher wage, but those who might have been employed at a lower wage are worse off. The magnitude of these effects depends crucially on the elasticity of labor demand. Advocates of a high minimum wage argue that the demand for unskilled labor is relatively inelastic, so that a high minimum wage depresses employment only slightly. Critics of the minimum wage argue that labor demand is more elastic, especially in the long run when firms can adjust employment and production more fully. They also note that many minimum wage workers are teenagers from middle-class families, so that a high minimum wage is imperfectly targeted as a policy for helping the poor. 20-3b Welfare. One way for the government to raise the living standards of the poor is to supplement their incomes. The primary way the government does this is through the welfare system. Welfare is a broad term that encompasses various government programs. Temporary assistance for needy families is a program that assists families with children and no adult able to support the family. In a typical family receiving such assistance, the father is absent and the mother is at home raising small children. Another welfare program is supplemental security income, which provides assistance to the poor who are sick or disabled. Note that for both of these welfare programs, a poor person cannot qualify for assistance simply by having a low income. He must also establish some additional need, such as small children or a disability. A common criticism of welfare programs is that they create incentives for people to become needy. For example, these programs may encourage families to break up, for many families qualify for financial assistance only if the father is absent. The programs may also encourage illegitimate births, for many poor, single women qualify for assistance only if they have children. Because poor, single mothers are such a large part of the poverty problem, and because welfare programs seem to raise the number of poor, single mothers, critics of the welfare system assert that these policies exacerbate the very problems they are supposed to cure. As a result of these arguments, the welfare system was revised in a 1996 law that limited the amount of time recipients could stay on welfare. How severe are these potential problems with the welfare system? No one knows for sure. Proponents of the welfare system point out that being a poor, single mother on welfare is a difficult existence at best, and they are skeptical that many people would be encouraged to pursue such a life if it were not thrust upon them. Moreover, trends over time do not support the view that the decline of the two-parent family is largely a symptom of the welfare system, as the system's critics sometimes claim. Since the early 1970s, welfare benefits have declined, yet the percentage of children living with only one parent has risen. 20-3c Negative income tax. Whenever the government chooses a system to collect taxes, it affects the distribution of income. This is clearly true in the case of a progressive income tax, whereby high-income families pay a larger percentage of their income in taxes than do low-income families. As we discussed in Chapter 12, equity across income groups is an important criterion in the design of a tax system. Many economists have advocated supplementing the income of the poor using a negative income tax. According to this policy, every family would report its income to the government. High-income families would pay a tax based on their incomes. Low-income families would receive a subsidy. In other words, they would pay a negative tax. For example, suppose the government used the following formula to compute a family's tax liability. Taxes owed equals $10,000. In this case, a family that earned $60,000 would pay $10,000 in taxes and a family that earned $90,000 would pay $20,000 in taxes. A family that earned $30,000 would owe nothing. And a family that earned $15,000 would owe $5,000. In other words, the government would send this family a check for $5,000. Under a negative income tax, poor families would receive financial assistance without having to demonstrate need. The only qualification required to receive assistance would be a low income. Depending on one's point of view, this feature can be either an advantage or a disadvantage. On the one hand, a negative income tax does not encourage illegitimate births and the breakup of families, as critics of the welfare system believe current policy does. On the other hand, a negative income tax would subsidize not only the unfortunate but also those who are simply lazy and, in some people's eyes, undeserving of government support. One actual tax provision that works much like a negative income tax is the Earned Income Tax Credit. This credit allows poor working families to receive income tax refunds greater than the taxes they paid during the year. Because the EITC applies only to the working poor, it does not discourage recipients from working, as other anti-poverty programs may. For the same reason, however, it also does not help alleviate poverty due to unemployment, sickness, or other inability to work. 20-3D in-kind transfers. Another way to help the poor is to provide them directly with some of the goods and services they need to raise their living standards. For example, charities provide the needy with food, clothing, shelter, and toys at Christmas. The government gives poor families food stamps, which are government vouchers that can be used to buy food at stores. The stores then redeem the vouchers for money. The government also gives many poor people health care through a program called Medicaid. Is it better to help the poor with these in-kind transfers or with direct cash payments? There is no clear answer. Advocates of in-kind transfers argue that such transfers ensure that the poor get what they need most. Among the poorest members of society, alcohol and drug addiction is more common than it is in society as a whole. By providing the poor with food and shelter, society can be more confident that it is not helping to support such addictions. This is one reason in-kind transfers are more politically popular than cash payments to the poor. Advocates of cash payments, on the other hand, argue that in-kind transfers are inefficient and disrespectful. The government does not know what goods and services the poor need most. Many of the poor are ordinary people down on their luck. Despite their misfortune, they are in the best position to decide how to raise their own living standards. Rather than giving the poor in-kind transfers of goods and services that they may not want, it may be better to give them cash and allow them to buy what they think they need most. 427. 20-3E Anti-poverty programs and work incentives. Many policies aimed at helping the poor can have the unintended effect of discouraging the poor from escaping poverty on their own. To see why, consider the following example. Suppose that a family needs an income of $20,000 to maintain a reasonable standard of living. And suppose that, out of concern for the poor, the government promises to guarantee every family that income. Whatever a family earns, the government makes up the difference between that income and $20,000. What effect would you expect this policy to have? The incentive effects of this policy are obvious. Any person who would make under $20,000 by working has little incentive to find and keep a job. For every dollar that the person would earn, the government would reduce the income supplement by $1. In effect, the government taxes 100% of additional earnings. An effective marginal tax rate of 100% is surely a policy with a large deadweight loss. The adverse effects of this high effective tax rate can persist over time. A person discouraged from working loses the on-the-job training that a job might offer. In addition, his children miss the lessons learned by observing a parent with a full-time job, and this may adversely affect their own ability to find and hold a job. Although the anti-poverty program we have been discussing is hypothetical, it is not as unrealistic as might first appear. Welfare, Medicaid, food stamps, and the EITC are all programs aimed at helping the poor, and they are all tied to family income. As a family's income rises, the family becomes ineligible for these programs. When all these programs are taken together, it is common for families to face effective marginal tax rates that are very high. Sometimes the effective marginal tax rates even exceed 100%, so that poor families are worse off when they earn more. By trying to help the poor, the government discourages those families from working. According to critics of anti-poverty programs, these programs alter work attitudes and create a culture of poverty. It might seem that there is an easy solution to this problem: reduce benefits to poor families more gradually as their incomes rise. For example, if a poor family loses 30 cents of benefits for every dollar it earns, then it faces an effective marginal tax rate of 30%. This effective tax reduces work effort to some extent, but it does not eliminate the incentive to work completely. The problem with this solution is that it greatly increases the cost of programs to combat poverty. If benefits are phased out gradually as a poor family's income rises, then families just above the poverty level will also be eligible for substantial benefits. The more gradual the phase out, the more families are eligible, and the more the program costs. Thus, policymakers face a trade-off between burdening the poor with high effective marginal tax rates and burdening taxpayers with costly programs to reduce poverty. There are various other ways to reduce the work disincentive of anti-poverty programs. One is to require any person collecting benefits to accept a government-provided job, a system sometimes called workfare. Another possibility is to provide benefits for only a limited period of time. This route was taken in the 1996 Welfare Reform Bill, which imposed a 5-year lifetime limit on welfare recipients. When President Clinton signed the bill, he explained his policy as follows: welfare should be a second chance, not a way of life. Quick quiz: list 3 policies aimed at helping the poor, and discuss the pros and cons of each. 428. In the news. Combating inequality. May require broader tax. By Eduardo Porter. Rarely have we experienced such a confluence of arguments in favor of raising taxes on the rich. After a hard-won re-election fought mainly over taxes and spending, President Obama arguably has a mandate from voters to tap the wealthy to address our budget woes. What's more, raising more money from the wealthy might go a long way toward righting our lopsided economy, which delivered 93% of our income growth in the first 2 years of the economic recovery to the richest 1% of families, and only 7% to the rest of us. Yet while raising more taxes from the winners in the globalized economy is a start, and may help us dig out of our immediate fiscal hole, it is unlikely to be enough to address our long-term needs. The experience of many other developed countries suggests that paying for a government that could help the poor and the middle class cope in our brave new globalized world will require more money from the middle class itself. Many Americans may find this hard to believe, but the United States already has one of the most progressive tax systems in the developed world, according to several studies, raising proportionately more revenue from the wealthy than other advanced countries do. Taxes on American households do more to redistribute resources and reduce inequality than the tax codes of most other rich nations. But taxation provides only half the picture of public finance. Despite the progressivity of our taxes, according to a study of public finances across the industrial countries in the Organization for Economic Cooperation and Development, We also have one of the least effective governments at combating income inequality. There is one main reason: our tax code does not raise enough money. This paradox underscores two crucial lessons we could learn from the experience of our peers around the globe. The first is that the government's success at combating income inequality is determined less by the progressivity of either the tax code or the benefits than by the amount of tax revenue that the government can spend on programs that benefit the middle class and the poor. The second is that very progressive tax codes are not very effective at raising money. The corollary suggested by Peter Lindert of the University of California, Davis in his 2004 book Growing Public is that insisting on highly progressive taxes that draw most revenue from the rich may result in more inequality than if we relied on a flatter, more regressive tax schedule to raise money from everybody and pay for a government that could help every American family attain a decent standard of living. Consider government aid for families. According to the OECD study, our temporary assistance for needy families is the most progressive program of cash benefits for families among 22 advanced countries, accurately targeted to serve the poor. But American family cash benefits are the least effective at reducing inequality. The reason is that they are so meager. The entire budget for cash assistance for families in the United States amounts to 0.1% of the nation's economic output. The average across the OECD nations is 11 times bigger. Even including tax breaks and direct government services, we spend a much smaller share of our economic output. International differences in income redistribution. Many nations have more generous social safety nets than the United States, but they also have very different tax systems. 20-4 Conclusion. People have long reflected on the distribution of income in society. Plato, the ancient Greek philosopher, concluded that in an ideal society the income of the richest person would be no more than 4 times the income of the poorest person. Although the measurement of inequality is difficult, it is clear that our society has much more inequality than Plato recommended. One of the 10 principles of economics discussed in Chapter 1 is that governments can sometimes improve market outcomes. There is little consensus, however, about how this principle should be applied to the distribution of income. 429. On family assistance than almost any other advanced nation. The same pattern can be found across a range of government programs. The reason is always the same: their relatively small size. Overall, government cash benefits in the United States, including pensions, disability, unemployment insurance and the like, contribute about 10% to household income, on average, according to the study. The average across industrial nations is twice that. Our budget reveals a core philosophical difference with other advanced countries. In the big government social democracies like those of Western Europe, government is expected to guarantee a set of universal public services from health care to child care to pensions that are considered basic rights of citizenry. To pay for this minimum welfare package, everybody is expected to contribute proportionately into the pot. Government in the United States has a different goal. Benefits are narrower. Social Security and Medicare follow a universal service template, but only for older Americans. Other social spending is aimed carefully to benefit the poor. Financed through a more progressive tax code, it looks more like charity than a universal right. On top of that, our philosophical stance virtually ensures a small government. Progressive taxes make it hard to raise money because they distort people's behavior. They encourage taxpayers to reduce their tax liability rather than to increase their pre-tax income. High corporate taxes encourage companies to avoid them. High taxes on capital income also encourage avoidance and capital flight. High income tax rates on top earners can discourage work and investment, too. So trying to raise a lot of money with our progressive tax code would probably not achieve the goal and could damage economic growth. Big government social democracies, by contrast, rely on flatter taxes to finance their public spending, like gas taxes and value-added taxes on consumption. The Nordic countries, for instance, have very low tax rates on capital income relative to income from work. and they have relatively high taxes on consumption. In Denmark, consumption tax revenue amounts to about 11% of the nation's economy. In the United States, sales taxes and excise taxes on cigarettes and other items amount to roughly 4%. Liberal Democrats have long opposed them because they fall much more heavily on the poor, who spend a larger share of their incomes than the rich. But these taxes have one big positive feature: they are difficult to avoid and produce fewer disincentives to work or invest. That means they can be used to raise much more revenue. Public finances are under strain today on both sides of the Atlantic, as governments struggle to cope with our long global recession and the aging of the baby boom generation. In Southern Europe, the pressure to pare back universal welfare systems is intense. In the United States, political leaders on both sides of the partisan divide have realized that even our relatively meager package of social goods cannot be sustained with our slim tax take. But the United States has one option that most of Europe's flailing economies do not. Its tax revenue is so low, comparatively, that it has more space to raise it. A more efficient, flatter tax schedule would allow us to do so without hindering economic activity. Bruce Bartlett, a tax expert who served in the administrations of Ronald Reagan and George H.W. Bush, told me last week that he thought federal tax revenue could increase to 22% of the nation's economic output, well above its historical average of 18.5%, without causing economic harm. If President Obama tries to go down this road, however, he may have to build a flatter tax code. We should reform the tax system, no question, William Gale, a tax policy expert at the Brookings Institution and co-director of the Nonpartisan Tax Policy Center, wrote in an email. We are going to need to move beyond the current set of tax instruments to raise the needed revenues. A VAT and / or a carbon tax seem like the obvious ways to go, and Mr. Bartlett also pointed out, we can't get all the revenue we need from the rich eventually, everyone will have to pay more. Philosophers and policymakers today do not agree on how much income inequality is desirable, or even whether public policy should aim to alter the distribution of income. Much of public debate reflects this disagreement. Whenever taxes are raised, for instance, lawmakers argue over how much of the tax hike should fall on the rich, the middle class, and the poor. Another of the 10 principles of economics is that people face trade-offs. This principle is important to keep in mind when thinking about economic inequality. Policies that penalize the successful and reward the unsuccessful reduce the incentive to succeed. Thus, policymakers face a trade-off between equality and efficiency. The more equally the pie is divided, the smaller the pie becomes. This is the one lesson concerning the distribution of income about which almost everyone agrees. 430. Data on the distribution of income show a wide disparity in U.S. society. The richest fifth of families earns more than 12 times as much income as the poorest fifth. Because in-kind transfers, the economic life cycle, transitory income, and economic mobility are so important for understanding variation in income, it is difficult to gauge the degree of inequality in our society using data on the distribution of income in a single year. When these other factors are taken into account, they tend to suggest that economic well-being is more equally distributed than is annual income. Political philosophers differ in their views about the role of government in altering the distribution of income. Utilitarians would choose the distribution of income to maximize the sum of utility of everyone in society. Liberals would determine the distribution of income as if we were behind a veil of ignorance that prevented us from knowing our stations in life. Libertarians would have the government enforce individual rights to ensure a fair process but then not be concerned about inequality in the resulting distribution of income. Various policies aim to help the poor: minimum wage laws, welfare, negative income taxes, and in-kind transfers. While these policies help some families escape poverty, they also have unintended side effects. Because financial assistance declines as income rises, the poor often face very high effective marginal tax rates, which discourage poor families from escaping poverty on their own. Summary. Key concepts. 1. Does the richest fifth of the U.S. population earn closer to 3, 6, or 12 times the income of the poorest fifth? 2. What has happened to the income share of the richest fifth of the U.S. population over the past 40 years? 3. What groups in the U.S. population are most likely to live in poverty? 4. When gauging the amount of inequality, why do transitory and life cycle variations in income cause difficulties? 5. How would a utilitarian, a liberal, and a libertarian each determine how much income inequality is permissible? 6. What are the pros and cons of in-kind transfers to the poor? 7. Describe how anti-poverty programs can discourage the poor from working. How might you reduce this disincentive? What are the disadvantages of your proposed policy? Questions for review. 1. In the United States, the poorest fifth of the population earns about % of all income, while the richest fifth earns about %. A2, 65B4, 45C10, 35D15, 25. 2. When income inequality is compared across countries, one finds that the United States A is one of the most equal nations in the world. B is one of the least equal nations in the world. C has more equality than most advanced nations but less equality than many developing countries. D has less equality than most advanced nations but more equality than many developing countries. Quick check multiple choice. 3. A utilitarian believes that the redistribution of income from the rich to the poor is worthwhile as long as A. the worst off members of society benefit from it. B. Those contributing to the system are in favor of it. C. Each person's income, after taxes and transfers, reflects his marginal product. D. The distortionary effect on work incentives is not too large. 4. Rawls's thought experiment of the original position behind the veil of ignorance is meant to draw attention to the fact that A. Most of the poor do not know how to find better jobs and escape poverty. B. The station of life each of us was born into is largely a matter of luck. C. The rich have so much money that they don't know how to spend it all. D. Outcomes are efficient only if everyone begins with equal opportunity. 5. A negative income tax is a policy under which A. individuals with low income get transfers from the government. B. The government raises tax revenue without distorting incentives. C. Everyone pays less than under a conventional income tax. D. Some taxpayers are on the wrong side of the Laffer curve. 6. If the benefits from an anti-poverty program are phased out as an individual's income increases, then the program will A. encourage greater work effort from the poor. B. Lead to an excess supply of labor among unskilled workers. C. Increase the effective marginal tax rate that the poor face. D. Cost the government more than a program that benefits everyone. 1. Table 2 shows that income inequality in the United States has increased since 1970. Some factors contributing to this increase were discussed in Chapter 19. What are they? 2. Table 3 shows that the percentage of children in families with income below the poverty line far exceeds the percentage of the elderly in such families. How might the allocation of government money across different social programs have contributed to this phenomenon? 3. This chapter discusses the importance of economic mobility. A. What policies might the government pursue to increase economic mobility within a generation? B. What policies might the government pursue to increase economic mobility across generations? C. Do you think we should reduce spending on current welfare programs to increase spending on programs that enhance economic mobility? What are some of the advantages and disadvantages of doing so? 4. Consider two communities. In one community, 10 families have incomes of $100,000 each and 10 families have incomes of $20,000 each. In the other community, 10 families have incomes of $200,000 each and 10 families have incomes of $22,000 each. A. In which community is the distribution of income more unequal? In which community is the problem of poverty likely to be worse? B. Which distribution of income would Rawls prefer? Explain. C. Which distribution of income do you prefer? Explain. D. Why might someone have the opposite preference? 5. This chapter uses the analogy of a leaky bucket to explain one constraint on the redistribution of income. A. What elements of the U.S. system for redistributing income create the leaks in the bucket? Be specific. B. Do you think that Republicans or Democrats generally believe that the bucket used for redistributing income is leakier? How does that belief affect their views about the amount of income redistribution that the government should undertake? 6. Suppose there are two possible income distributions in a society of 10 people. In the first distribution, 9 people have incomes of $30,000 and one person has an income of $10,000. In the second distribution, all 10 people have incomes of $25,000. A. If the society had the first income distribution, what would be the utilitarian argument for redistributing income? B. Which income distribution would Rawls consider more equitable? Explain. C. Which income distribution would Nozick consider more equitable? Explain. 7. The poverty rate would be substantially lower if the market value of in-kind transfers were added to family income. The largest in-kind transfer is Problems and Applications 431. 432. Medicaid, the government health program for the poor. Let's say the program costs $10,000 per recipient family. A. If the government gave each recipient family a $10,000 check instead of enrolling them in the Medicaid program, do you think that most of these families would spend that money to purchase health insurance? Why? B. How does your answer to part affect your view about whether we should determine the poverty rate by valuing in-kind transfers at the price the government pays for them? Explain. C. How does your answer to part affect your view about whether we should provide assistance to the poor in the form of cash transfers or in-kind transfers? Explain. 8. Consider two of the income security programs in the United States, TANF and the EITC. A. When a woman with children and very low income earns an extra $1, she receives less in TANF benefits. What do you think is the effect of this feature of TANF on the labor supply of low-income women? Explain. B. The EITC provides greater benefits as low-income workers earn more income. What do you think is the effect of this program on the labor supply of low-income individuals? Explain. C. What are the disadvantages of eliminating TANF and allocating the savings to the EITC? Go to CEngageBrain.com to purchase access to the proven, critical study guide to accompany this text, which features additional notes and context, practice tests, and much more. Part 7. Topics 4. Further study. When you walk into a store, you are confronted with thousands of goods that you might buy. Because your financial resources are limited, however, you cannot buy everything that you want. You therefore consider the prices of the various goods offered for sale and buy a bundle of goods that, given your resources, best suits your needs and desires. In this chapter, we develop a theory that describes how consumers make decisions about what to buy. Thus far in this book, we have summarized consumers' decisions with the demand curve. As we have seen, the demand curve for a good reflects consumers' willingness to pay for it. When the price of a good rises, consumers are willing to pay for fewer units, so the quantity demanded falls. We now look more deeply at the decisions that lie behind the demand curve. The theory of consumer choice presented in this chapter provides a more complete understanding of demand, just as the theory of the competitive firm in Chapter 14 provides a more complete understanding of supply. Chapter 21. The theory of consumer choice. 436. One of the 10 principles of economics discussed in Chapter 1 is that people face trade-offs. The theory of consumer choice examines the trade-offs that people face in their role as consumers. When a consumer buys more of one good, she can afford less of other goods. When she spends more time enjoying leisure and less time working, she has lower income and can afford less consumption. When she spends more of her income in the present and saves less of it, she must accept a lower level of consumption in the future. The theory of consumer choice examines how consumers facing these trade-offs make decisions and how they respond to changes in their environment. After developing the basic theory of consumer choice, we apply it to 3 questions about household decisions. In particular, we ask: do all demand curves slope downward? How do wages affect labor supply? How do interest rates affect household saving? At first, these questions might seem unrelated. But as we will see, we can use the theory of consumer choice to address each of them. 21-1 The budget constraint, what the consumer can afford. Most people would like to increase the quantity or quality of the goods they consume to take longer vacations, drive fancier cars, or eat at better restaurants. People consume less than they desire because their spending is constrained, or limited, by their income. We begin our study of consumer choice by examining this link between income and spending. To keep things simple, we examine the decision facing a consumer who buys only 2 goods, pizza and Pepsi. Of course, real people buy thousands of different kinds of goods. Assuming there are only 2 goods greatly simplifies the problem without altering the basic insights about consumer choice. We first consider how the consumer's income constrains the amount she spends on pizza and Pepsi. Suppose the consumer has an income of $1,000 per month and she spends her entire income on pizza and Pepsi. The price of a pizza is $10, and the price of a liter of Pepsi is $2. The table in Figure 1 shows some of the many combinations of pizza and Pepsi that the consumer can buy. The first row in the table shows that if the consumer spends all her income on pizza, she can eat 100 pizzas during the month, but she would not be able to buy any Pepsi at all. The second row shows another possible consumption bundle, 90 pizzas and 50 liters of Pepsi. And so on. Each consumption bundle in the table costs exactly $1,000. The graph in Figure 1 illustrates the consumption bundles that the consumer can choose. The vertical axis measures the number of liters of Pepsi, and the horizontal axis measures the number of pizzas. 3 points are marked on this figure. At point A, the consumer buys no Pepsi and consumes 100 pizzas. At point B, the consumer buys no pizza and consumes 500 liters of Pepsi. At point C, the consumer buys 50 pizzas and 250 liters of Pepsi. Point C, which is exactly at the middle of the line from A to B, is the point at which the consumer spends an equal amount on pizza and Pepsi. These are only 3 of the many combinations of pizza and Pepsi that the consumer can choose. All the points on the line from A to B are possible. This line, called the budget constraint, shows the consumption bundles that the consumer can afford. In this case, it shows the trade-off between pizza and Pepsi that the consumer faces. The slope of the budget constraint measures the rate at which the consumer can trade one good for the other. Recall that the slope between 2 points is calculated as the change in the vertical distance divided by the change in the horizontal distance. From point A to point B, the vertical distance is 500 liters, and the horizontal distance is 100 pizzas. Thus, the slope is 5 liters per pizza. Notice that the slope of the budget constraint equals the relative price of the 2 goods, the price of one good compared to the price of the other. A pizza costs 5 times as much as a liter of Pepsi, so the opportunity cost of a pizza is 5 liters of Pepsi. The budget constraint slope of 5 reflects the trade-off the market is offering the consumer, 1 pizza for 5 liters of Pepsi. Consumer's budget constraint. Quick quiz: draw the budget constraint for a person with income of $1,000 if the price of Pepsi is $5 and the price of pizza is $10. What is the slope of this budget constraint? 21-2 Preferences, what the consumer wants. Our goal in this chapter is to see how consumers make choices. The budget constraint is one piece of the analysis. It shows the combinations of goods the consumer can afford given her income and the prices of the goods. The consumer's 438. Choices, however, depend not only on her budget constraint but also on her preferences regarding the two goods. Therefore, the consumer's preferences are the next piece of our analysis. 21-2 are representing preferences with indifference curves. The consumer's preferences allow her to choose among different bundles of pizza and Pepsi. If you offer the consumer two different bundles, she chooses the bundle that best suits her tastes. If the two bundles suit her tastes equally well, we say that the consumer is indifferent between the two bundles. Just as we have represented the consumer's budget constraint graphically, we can also represent her preferences graphically. We do this with indifference curves. An indifference curve shows the various bundles of consumption that make the consumer equally happy. In this case, the indifference curves show the combinations of pizza and Pepsi with which the consumer is equally satisfied. Figure 2 shows two of the consumer's many indifference curves. The consumer is indifferent among combinations A, B, and C because they are all on the same curve. Not surprisingly, if the consumer's consumption of pizza is reduced, say, from point A to point B, consumption of Pepsi must increase to keep her equally happy. If consumption of pizza is reduced again, from point B to point C, the amount of Pepsi consumed must increase yet again. The slope at any point on an indifference curve equals the rate at which the consumer is willing to substitute one good for the other. This rate is called the marginal rate of substitution. In this case, the marginal rate of substitution measures how much Pepsi the consumer requires to be compensated for a one-unit reduction in pizza consumption. Notice that because the indifference curves are not straight lines, the marginal rate of substitution is not the same at all points on a given indifference curve. The rate at which a consumer is willing to trade one good for the other depends on the amounts of the goods she is already consuming. That is, the rate at which a consumer is willing to trade pizza for Pepsi depends on whether she is hungrier or thirstier, which in turn depends on how much pizza and Pepsi she is consuming. The consumer is equally happy at all points on any given indifference curve, but she prefers some indifference curves to others. Because she prefers more consumption to less, higher indifference curves are preferred to lower ones. In Figure 2, any point on curve I2 is preferred to any point on curve I1. A consumer's set of indifference curves gives a complete ranking of the consumer's preferences. That is, we can use the indifference curves to rank any two bundles of goods. For example, the indifference curves tell us that point D is preferred to point A because point D is on a higher indifference curve than point A. The indifference curves also tell us that point D is preferred to point C because point D is on a higher indifference curve. Even though point D has less Pepsi than point C, it has more than enough extra pizza to make the consumer prefer it. By seeing which point is on the higher indifference curve, we can use the set of indifference curves to rank any combination of pizza and Pepsi. 21-2b 4 Properties of indifference curves. Because indifference curves represent a consumer's preferences, they have certain properties that reflect those preferences. Here we consider 4 properties that describe most indifference curves. Property 1, higher indifference curves are preferred to lower ones. People usually prefer to consume more goods rather than less. This preference for greater quantities is reflected in the indifference curves. As Figure 2 shows, higher indifference curves represent larger quantities of goods than lower indifference curves. Thus, the consumer prefers being on higher indifference curves. Property 2, indifference curves are downward sloping. The slope of an indifference curve reflects the rate at which the consumer is willing to substitute one good for the other. In most cases, the consumer likes both goods. Therefore, if the quantity of one good is reduced, the quantity of the other good must increase for the consumer to be equally happy. For this reason, most indifference curves slope downward. Property 3, indifference curves do not cross. To see why this is true, suppose that two indifference curves did cross, as in Figure 3. Then, because point A is on the same indifference curve as point B, the 2 points would make the consumer equally happy. In addition, because point B is on the same indifference curve as point C, These 2 points would make the consumer equally happy. But these conclusions imply that points A and C would also make the consumer equally happy, even though point C has more of both goods. This contradicts our assumption that the consumer always prefers more of both goods to less. Thus, indifference curves cannot cross. Property 4, indifference curves are bowed inward. The slope of an indifference curve is the marginal rate of substitution, the rate at which the consumer is willing to trade off one good for the other. The marginal rate of substitution usually depends on the amount of each good the consumer is currently consuming. In particular, because people are more willing to trade away goods that they have in abundance and less willing to trade away goods of which they have little, the indifference curves are bowed inward. As an example, consider figure 4. At point A, because the consumer has a lot of Pepsi and only a little pizza, she is very hungry but not very thirsty. To induce the consumer to give up one pizza, she has to be given 6 liters of Pepsi. The marginal rate of substitution is 6 liters per pizza. By contrast, at point B, the consumer has little Pepsi and a lot of pizza, so she is very thirsty but not very hungry. At this point, she would be willing to give up one pizza to get 1 liter of Pepsi. The marginal rate of substitution is 1 liter per pizza. Thus, the bowed shape of the indifference curve reflects the consumer's greater willingness to give up a good that she already has in large quantity. 21-2 See 2 extreme examples of indifference curves. The shape of an indifference curve tells us about the consumer's willingness to trade one good for the other. When the goods are easy to substitute for each other, the indifference curves are less bowed. When the goods are hard to substitute, the indifference curves are very bowed. To see why this is true, let's consider the extreme cases. Perfect substitutes. Suppose that someone offered you bundles of nickels and dimes. How would you rank the different bundles? Most likely, you would care only about the total monetary value of each bundle. If so, you would always be willing to trade 2 nickels for 1 dime, regardless of the number of nickels and dimes in the bundle. Your marginal rate of substitution between nickels and dimes would be a fixed number 2. We can represent your preferences over nickels and dimes with the indifference curves in panel of figure 5. Because the marginal rate of substitution is constant, the indifference curves are straight lines. In this extreme case of straight indifference curves, we say that the 2 goods are perfect substitutes. Perfect complements. Suppose now that someone offered you bundles of shoes. Some of the shoes fit your left foot, others your right foot. How would you rank these different bundles? In this case, you might care only about the number of pairs of shoes. In other words, you would judge a bundle based on the number of pairs you could assemble from it. A bundle of 5 left shoes and 7 right shoes yields only 5 pairs. Getting 1 more right shoe has no value if there is no left shoe to go with it. We can represent your preferences for right and left shoes with the indifference curves in panel of figure 5. In this case, a bundle with 5 left shoes and 5 right shoes is just as good as a bundle with 5 left shoes and 7 right shoes. It is also just as good as a bundle with 7 left shoes and 5 right shoes. The indifference curves, therefore, are right angles. In this extreme case of right angle indifference curves, we say that the 2 goods are perfect complements. In the real world, of course, most goods are neither perfect substitutes nor perfect complements. More typically, the indifference curves are bowed inward, but not so bowed that they become right angles. Quick quiz: draw some indifference curves for pizza and Pepsi. Explain the 4 properties of these indifference curves. The goal of this chapter is to understand how a consumer makes choices. We have the 2 pieces necessary for this analysis: the consumer's budget constraint and the consumer's preferences. Now we put these 2 pieces together and consider the consumer's decision about what to buy. 21-3 of the consumer's optimal choices. Consider once again our pizza and Pepsi example. The consumer would like to end up with the best possible combination of pizza and Pepsi for her, that is, the combination on her highest possible indifference curve. But the consumer must also end up on or below her budget constraint, which measures the total resources available to her. Figure 6 shows the consumer's budget constraint and 3 of her many indifference curves. The highest indifference curve that the consumer can reach is the one that just barely touches her budget constraint. The point at which this indifference curve and the budget constraint touch is called the optimum. The consumer would prefer point A, but she cannot afford that point because it lies above her budget constraint. The consumer can afford point B, but that point is on a lower indifference curve and, therefore, provides the consumer less satisfaction. The optimum represents the best combination of pizza and Pepsi available to the consumer. Notice that, at the optimum, the slope of the indifference curve equals the slope of the budget constraint. We say that the indifference curve is tangent to the budget constraint. The slope of the indifference curve is the marginal rate of substitution between pizza and Pepsi, and the slope of the budget constraint is the relative price of pizza and Pepsi. Thus, the consumer chooses consumption of the two goods so that the marginal rate of substitution equals the relative price. In Chapter 7, we saw how market prices reflect the marginal value that consumers place on goods. This analysis of consumer choice shows the same result in another way. In making her consumption choices, the consumer takes as given the relative price of the two goods and then chooses an optimum at which her marginal rate of substitution equals this relative price. The relative price is the rate at which the market is willing to trade one good for the other, whereas the marginal rate of substitution is the rate at which the consumer is willing to trade one good for the other. At the consumer's optimum, the consumer's valuation of the two goods equals the market's valuation. As a result of this consumer optimization, market prices of different goods reflect the value that consumers place on those goods. We have used indifference curves to represent the consumer's preferences. Another common way to represent preferences is with the concept of utility. Utility is an abstract measure of the satisfaction or happiness that a consumer receives from a bundle of goods. Economists say that a consumer prefers one bundle of goods to another if one provides more utility than the other. Indifference curves and utility are closely related. Because the consumer prefers points on higher indifference curves, bundles of goods on higher indifference curves provide higher utility. Because the consumer is equally happy with all points on the same indifference curve, all these bundles provide the same utility. You can think of an indifference curve as an equal utility curve. The marginal utility of any good is the increase in utility that the consumer gets from an additional unit of that good. Most goods are assumed to exhibit diminishing marginal utility. The more of the good the consumer already has, the lower the marginal utility provided by an extra unit of that good. The marginal rate of substitution between two goods depends on their marginal utilities. For example, if the marginal utility of good X is twice the marginal utility of good Y, then a person would need 2 units of good Y to compensate for losing 1 unit of good X, and the marginal rate of substitution equals 2. More generally, the marginal rate of substitution equals the marginal utility of one good divided by the marginal utility of the other good. Utility analysis provides another way to describe consumer optimization. Recall that, at the consumer's optimum, the marginal rate of substitution equals the ratio of prices. That is, MRS equals PX/pi. Because the marginal rate of substitution equals the ratio of marginal utilities, we can write this condition for optimization as MUX/μE equals PX/pi. Now rearrange this expression to become MUX/PX equals μE/pi. This equation has a simple interpretation. At the optimum, the marginal utility per dollar spent on good X equals the marginal utility per dollar spent on good Y. When economists discuss the theory of consumer choice, they sometimes express the theory using different words. One economist might say that the goal of the consumer is to maximize utility. Another economist might say that the goal of the consumer is to end up on the highest possible indifference curve. The first economist would conclude that at the consumer's optimum, the marginal utility per dollar is the same for all goods, whereas the second would conclude that the indifference curve is tangent to the budget constraint. In essence, these are two ways of saying the same thing. FYI. 444. 21-3b How changes in income affect the consumer's choices. Now that we have seen how the consumer makes a consumption decision, let's examine how this decision responds to changes in the consumer's income. To be specific, suppose that income increases. With higher income, the consumer can afford more of both goods. The increase in income, therefore, shifts the budget constraint outward, as in Figure 7. Because the relative price of the two goods has not changed, the slope of the new budget constraint is the same as the slope of the initial budget constraint. That is, an increase in income leads to a parallel shift in the budget constraint. The expanded budget constraint allows the consumer to choose a better combination of pizza and Pepsi, one that is on a higher indifference curve. Given the shift in the budget constraint and the consumer's preferences as represented by her indifference curves, the consumer's optimum moves from the point labeled initial optimum to the point labeled new optimum. Notice that, in Figure 7, the consumer chooses to consume more Pepsi and more pizza. The logic of the model does not require increased consumption of both goods in response to increased income, but this situation is the most common. As you may recall from Chapter 4, if a consumer wants more of a good when her income rises, economists call it a normal good. The indifference curves in Figure 7 are drawn under the assumption that both pizza and Pepsi are normal goods. Figure 8 shows an example in which an increase in income induces the consumer to buy more pizza but less Pepsi. If a consumer buys less of a good when her income rises, economists call it an inferior good. Figure 8 is drawn under the assumption that pizza is a normal good and Pepsi is an inferior good. Although most goods are normal goods, there are some inferior goods in the world. One example is bus rides. As income increases, consumers are more likely to own cars or take taxis and less likely to ride the bus. Bus rides, therefore, are an inferior good. 21-3 See how changes in prices affect the consumer's choices. Let's now use this model of consumer choice to consider how a change in the price of one of the goods alters the consumer's choices. Suppose, in particular, that the price of Pepsi falls from $2 to $1 per liter. It is no surprise that the lower price expands the consumer's set of buying opportunities. In other words, a fall in the price of any good shifts the budget constraint outward. Figure 9 considers more specifically how the fall in price affects the budget constraint. If the consumer spends her entire $1,000 income on pizza, then the price of Pepsi is irrelevant. Thus, point A in the figure stays the same. Yet if the consumer spends her entire income of $1,000 on Pepsi, she can now buy 1,000 rather than only 500 liters. Thus, the end point of the budget constraint moves from point B to point D. Notice that in this case the outward shift in the budget constraint changes its slope. As we have discussed, the slope of the budget constraint reflects the relative price of pizza and Pepsi. Because the price of Pepsi has fallen to $1 from $2, while the price of pizza has remained $10, the consumer can now trade a pizza for 10 rather than 5 liters of Pepsi. As a result, the new budget constraint has a steeper slope. How such a change in the budget constraint alters the consumption of both goods depends on the consumer's preferences. For the indifference curves drawn in this figure, the consumer buys more Pepsi and less pizza. 21-3D Income and substitution effects. The impact of a change in the price of a good on consumption can be decomposed into two effects, an income effect and a substitution effect. To see what these two effects are, consider how our consumer might respond when she learns that the price of Pepsi has fallen. She might reason in the following ways. Great news! Now that Pepsi is cheaper, my income has greater purchasing power. I am, in effect, richer than I was. Because I am richer, I can buy both more pizza and more Pepsi. Now that the price of Pepsi has fallen, I get more liters of Pepsi for every pizza that I give up. Because pizza is now relatively more expensive, I should buy less pizza and more Pepsi. Which statement do you find more compelling? In fact, both of these statements make sense. The decrease in the price of Pepsi makes the consumer better off. If pizza and Pepsi are both normal goods, the consumer will want to spread this improvement in her purchasing power over both goods. This income effect tends to make the consumer buy more pizza and more Pepsi. Yet at the same time, consumption of Pepsi has become less expensive relative to consumption of pizza. This substitution effect tends to make the consumer choose less pizza and more Pepsi. Now consider the result of these two effects working at the same time. The consumer certainly buys more Pepsi because the income and substitution effects both act to increase purchases of Pepsi. But it is ambiguous whether the consumer buys more pizza, because the income and substitution effects work in opposite directions. This conclusion is summarized in Table 1. We can interpret the income and substitution effects using indifference curves. The income effect is the change in consumption that results from the movement to a higher indifference curve. The substitution effect is the change in consumption that results from being at a point on an indifference curve with a different marginal rate of substitution. Figure 10 shows graphically how to decompose the change in the consumer's decision into the income effect and the substitution effect. When the price of Pepsi falls, the consumer moves from the initial optimum, point A, to the new optimum, point C. We can view this change as occurring in two steps. First, the consumer moves along the initial indifference curve, I1, from point A to point B. The consumer is equally happy at these 2 points, but at point B, the marginal rate of substitution reflects the new relative price. Next, the consumer shifts to the higher indifference curve, I2, by moving from point B to point C. Even though point B and point C are on different indifference curves, they have the same marginal rate of substitution. That is, the slope of the indifference curve I1 at point B equals the slope of the indifference curve I2 at point C. The consumer never actually chooses point B, but this hypothetical point is useful to clarify the two effects that determine the consumer's decision. Notice that the change from point A to point B represents a pure change in the marginal rate of substitution without any change in the consumer's welfare. Similarly, the change from point B to point C represents a pure change in welfare without any change in the marginal rate of substitution. Thus, the movement from A to B shows the substitution effect, and the movement from B to C shows the income effect. 21-3e Deriving the demand curve. We have just seen how changes in the price of a good alter the consumer's budget constraint and, therefore, the quantities of the two goods that she chooses to buy. The demand curve for any good reflects these consumption decisions. Recall that a demand curve shows the quantity demanded of a good for any given price. We can view a consumer's demand curve as a summary of the optimal decisions that arise from her budget constraint and indifference curves. For example, Figure 11 considers the demand for Pepsi. Panel shows that when the price of a liter falls from $2 to $1, the consumer's budget constraint shifts outward. Because of both income and substitution effects, the consumer increases her purchases of Pepsi from 250 to 750 liters. Panel shows the demand curve that results from this consumer's decisions. In this way, the theory of consumer choice provides the theoretical foundation for the consumer's demand curve. It may be comforting to know that the demand curve arises naturally from the theory of consumer choice, but this exercise by itself does not justify developing the theory. There is no need for a rigorous, analytic framework just to establish that people respond to changes in prices. The theory of consumer choice is, however, useful in studying various decisions that people make as they go about their lives, as we see in the next section. Quick quiz. Draw a budget constraint and indifference curves for pizza and Pepsi. Show what happens to the budget constraint and the consumer's optimum when the price of pizza rises. In your diagram, decompose the change into an income effect and a substitution effect. 21-4 applications. Now that we have developed the basic theory of consumer choice, let's use it to shed light on 3 questions about how the economy works. These 3 questions might at first seem unrelated. But because each question involves household decision-making, we can address it with the model of consumer behavior we have just developed. 21-4 Do all demand curves slope downward? Normally, when the price of a good rises, people buy less of it. This usual behavior, called the law of demand, is reflected in the downward slope of the demand curve. As a matter of economic theory, however, demand curves can sometimes slope upward. In other words, consumers can sometimes violate the law of demand and buy more of a good when the price rises. To see how this can happen, consider figure 12. In this example, the consumer buys two goods: meat and potatoes. Initially, the consumer's budget constraint is the line from point A to point B. The optimum is point C. When the price of potatoes rises, the budget constraint shifts inward and is now the line from point A to point D. The optimum is now point E. Notice that a rise in the price of potatoes has led the consumer to buy a larger quantity of potatoes. Why is the consumer responding in a seemingly perverse way? In this example, potatoes are a strongly inferior good. When the price of potatoes rises, the consumer is poorer. The income effect makes the consumer want to buy less meat and more potatoes. At the same time, because the potatoes have become more expensive relative to meat, the substitution effect makes the consumer want to buy more meat and fewer potatoes. In this particular case, however, the income effect is so strong that it exceeds the substitution effect. In the end, the consumer responds to the higher price of potatoes by buying less meat and more potatoes. Economists use the term giffen good to describe a good that violates the law of demand. In this example, potatoes are a giffen good. Giffen goods are inferior goods for which the income effect dominates the substitution effect. Therefore, they have demand curves that slope upward. The search for giffen goods. Have any actual giffen goods ever been observed? Some historians suggest that potatoes were a giffen good during the Irish potato famine of the 19th century. Potatoes were such a large part of people's diet that when the price of potatoes rose, it had a large income effect. People responded to their reduced living standard by cutting back on the luxury of meat and buying more of the staple food of potatoes. Thus, it is argued that a higher price of potatoes actually raised the quantity of potatoes demanded. A recent study by Robert Jensen and Nolan Miller has produced similar but more concrete evidence for the existence of giffen goods. These two economists conducted a field experiment for 5 months in the Chinese province of Hunan. They gave randomly selected households vouchers that subsidized the purchase of rice, a staple in local diets, and used surveys to measure how consumption of rice responded to changes in the price. They found strong evidence that poor households exhibited giffen behavior. Lowering the price of rice with the subsidy voucher caused households to reduce their consumption of rice, and removing the subsidy had the opposite effect. Jensen and Miller wrote, "To the best of our knowledge, this is the first rigorous empirical evidence of giffen behavior." Thus, the theory of consumer choice allows demand curves to slope upward, and sometimes that strange phenomenon actually occurs. As a result, the law of demand we first saw in Chapter 4 is not completely reliable. It is safe to say, however, that giffen goods are very rare. Case study 21-4b How do wages affect labor supply? So far, we have used the theory of consumer choice to analyze how a person allocates income between two goods. We can use the same theory to analyze how a person allocates time. People spend some of their time enjoying leisure and 451. Some of it working so they can afford to buy consumption goods. The essence of the time allocation problem is the trade-off between leisure and consumption. Consider the decision facing Carrie, a freelance software designer. Carrie is awake for 100 hours per week. She spends some of this time enjoying leisure, riding her bike, watching television, and studying economics. She spends the rest of this time at her computer developing software. For every hour she works developing software, she earns $50, which she spends on consumption goods, food, clothing, and music downloads. Her wage reflects the trade-off Carrie faces between leisure and consumption. For every hour of leisure she gives up, she works one more hour and gets $50 of consumption. Figure 13 shows Carrie's budget constraint. If she spends all 100 hours enjoying leisure, she has no consumption. If she spends all 100 hours working, she earns a weekly consumption of $5,000 but has no time for leisure. If she works a normal 40-hour week, she enjoys 60 hours of leisure and has weekly consumption of $2,000. Figure 13 uses indifference curves to represent Carrie's preferences for consumption and leisure. Here consumption and leisure are the two goods between which Carrie is choosing. Because Carrie always prefers more leisure and more consumption, she prefers points on higher indifference curves to points on lower ones. At a wage of $50 per hour, Carrie chooses a combination of consumption and leisure represented by the point labeled optimum. This is the point on the budget constraint that is on the highest possible indifference curve, I2. Now consider what happens when Carrie's wage increases from $50 to $60 per hour. Figure 14 shows two possible outcomes. In each case, the budget constraint, shown in the left graphs, shifts outward from BC1 to BC2. In the process, the budget constraint becomes steeper, reflecting the change in relative price. At the higher wage, Carrie earns more consumption for every hour of leisure that she gives up. Carrie's preferences, as represented by her indifference curves, determine how her choice regarding consumption and leisure responds to the higher wage. In both panels, consumption rises. Yet the response of leisure to the change in the wage is different in the two cases. In panel, Carrie responds to the higher wage by enjoying less leisure. In panel, Carrie responds by enjoying more leisure. Carrie's decision between leisure and consumption determines her supply of labor because the more leisure she enjoys, the less time she has left to work. In each panel of Figure 14, the right graph shows the labor supply curve implied by Carrie's decision. In panel, a higher wage induces Carrie to enjoy less leisure. 453. And work more, so the labor supply curve slopes upward. In panel, a higher wage induces Carrie to enjoy more leisure and work less, so the labor supply curve slopes backward. At first, the backward sloping labor supply curve is puzzling. Why would a person respond to a higher wage by working less? The answer comes from considering the income and substitution effects of a higher wage. Consider first the substitution effect. When Carrie's wage rises, leisure becomes more costly relative to consumption, and this encourages Carrie to substitute away from leisure and toward consumption. In other words, the substitution effect induces Carrie to work more in response to higher wages, which tends to make the labor supply curve slope upward. Now consider the income effect. When Carrie's wage rises, she moves to a higher indifference curve. She is now better off than she was. As long as consumption and leisure are both normal goods, she tends to want to use this increase in well-being to enjoy both higher consumption and greater leisure. In other words, the income effect induces her to work less, which tends to make the labor supply curve slope backward. In the end, economic theory does not give a clear prediction about whether an increase in the wage induces Carrie to work more or less. If the substitution effect is greater than the income effect for Carrie, she works more. If the income effect is greater than the substitution effect, she works less. The labor supply curve, therefore, could be either upward or backward sloping. Income effects on labor supply, historical trends, lottery winners, and the Carnegie conjecture. The idea of a backward sloping labor supply curve might at first seem like a mere theoretical curiosity, but in fact it is not. Evidence indicates that the labor supply curve, considered over long periods, does in fact slope backward. 100 years ago, many people work 6 days a week. Today, 5-day work weeks are the norm. At the same time that the length of the work week has been falling, the wage of the typical worker has been rising. Here is how economists explain this historical pattern. Over time, advances in technology raise workers' productivity and, thereby, the demand for labor. This increase in labor demand raises equilibrium wages. As wages rise, so does the reward for working. Yet rather than responding to this increased incentive by working more, most workers choose to take part of their greater prosperity in the form of more leisure. In other words, the income effect of higher wages dominates the substitution effect. Further evidence that the income effect on labor supply is strong comes from a very different kind of data: winners of lotteries. Winners of large prizes in the lottery see large increases in their incomes and, as a result, large outward shifts in their budget constraints. Because the winners' wages have not changed, however, the slopes of their budget constraints remain the same. There is, therefore, no substitution effect. By examining the behavior of lottery winners, we can isolate the income effect on labor supply. The results from studies of lottery winners are striking. Of those winners who win more than $50,000, almost 25% quit working within a year and another 9% reduce the number of hours they work. Of those winners who win more than $1 million, almost 40% stop working. The income effect on labor supply of winning such a large prize is substantial. Similar results were found in a 1993 study, published in the Quarterly Journal of Economics, of how receiving a bequest affects a person's labor supply. The study found that a single person who inherits more than $150,000 is 4 times as likely to stop working as a single person who inherits less than $25,000. This finding would not have surprised the 19th-century industrialist Andrew Carnegie. Carnegie warned that the parent who leaves his son enormous wealth generally deadens the talents and energies of the son, and tempts him to lead a less useful and less worthy life than he otherwise would. That is, Carnegie viewed the income effect on labor supply to be substantial and, from his paternalistic perspective, regrettable. During his life and at his death, Carnegie gave much of his vast fortune to charity. 21-4 See how do interest rates affect household saving? An important decision that every person faces is how much income to consume today and how much to save for the future. We can use the theory of consumer choice to analyze how people make this decision and how the amount they save depends on the interest rate their savings will earn. Consider the decision facing Saul, a worker planning for retirement. To keep things simple, let's divide Saul's life into 2 periods. In the first period, Saul is young and working. In the second period, he is old and retired. When young, Saul earns $100,000. He divides this income between current consumption and saving. When he is old, Saul will consume what he has saved, including the interest that his savings have earned. Suppose the interest rate is 10%. Then for every dollar that Saul saves when young, he can consume $1.10 when old. We can view consumption when young and consumption when old as the 2 goods that Saul must choose between. The interest rate determines the relative price of these 2 goods. Figure 15 shows Saul's budget constraint. If he saves nothing, he consumes $100,000 when young and nothing when old. If he saves everything, he consumes nothing when young and $110,000 when old. The budget constraint shows these and all the intermediate possibilities. Figure 15 uses indifference curves to represent Saul's preferences for consumption in the 2 periods. Because Saul prefers more consumption in both periods, he prefers points on higher indifference curves to points on lower ones. Given his preferences, Saul chooses the optimal combination of consumption in both periods of life, which is the point on the budget constraint that is on the highest possible indifference curve. At this optimum, Saul consumes $50,000 when young and $55,000 when old. Now consider what happens when the interest rate increases from 10% to 20%. Figure 16 shows 2 possible outcomes. In both cases, the budget constraint shifts outward and becomes steeper. At the new, higher interest rate, Saul gets more consumption when old for every dollar of consumption that he gives up when young. The 2 panels show the results given different preferences by Saul. In both cases, consumption when old rises. Yet the response of consumption when young to the change in the interest rate is different in the 2 cases. In panel Saul responds to the higher interest rate by consuming less when young. In panel, Saul responds by consuming more when young. Saul's saving is his income when young minus the amount he consumes when young. In panel, an increase in the interest rate reduces consumption when young, so saving must rise. In panel, an increase in the interest rate induces Saul to consume more when young, so saving must fall. The case shown in panel might at first seem odd. Saul responds to an increase in the return to saving by saving less. Yet this behavior is not as peculiar as it might seem. We can understand it by considering the income and substitution effects of a higher interest rate. Consider first the substitution effect. When the interest rate rises, consumption when old becomes less costly relative to consumption when young. Therefore, the substitution effect induces Saul to consume more when old and less when young. In other words, the substitution effect induces Saul to save more. Now consider the income effect. When the interest rate rises, Saul moves to a higher indifference curve. He is now better off than he was. As long as consumption in both periods consists of normal goods, he tends to want to use this increase in well-being to enjoy higher consumption in both periods. In other words, the income effect induces him to save less. The result depends on both the income and substitution effects. If the substitution effect of a higher interest rate is greater than the income effect, Saul saves more. If the income effect is greater than the substitution effect, Saul saves less. Thus, the theory of consumer choice says that an increase in the interest rate could either encourage or discourage saving. This ambiguous result is interesting from the standpoint of economic theory, but it is disappointing from the standpoint of economic policy. It turns out that an important issue in tax policy hinges in part on how saving responds to interest rates. Some economists have advocated reducing the taxation of interest and other capital income. They argue that such a policy change would raise the after-tax interest rate that savers can earn and thereby encourage people to save more. Other economists have argued that because of offsetting income and substitution effects, such a tax change might not increase saving and could even reduce it. Unfortunately, research has not led to a consensus about how interest rates affect saving. As a result, there remains disagreement among economists about whether changes in tax policy aimed to encourage saving would, in fact, have the intended effect. 21-5 Conclusion: do people really think this way? The theory of consumer choice describes how people make decisions. As we have seen, it has broad applicability. It can explain how a person chooses between pizza and Pepsi, work and leisure, consumption and saving, and so on. At this point, however, you might be tempted to treat the theory of consumer choice with some skepticism. After all, you are a consumer. You decide what to buy every time you walk into a store. And you know that you do not decide by writing down budget constraints and indifference curves. Doesn't this knowledge about your own decision-making provide evidence against the theory? The answer is no. The theory of consumer choice does not try to present a literal account of how people make decisions. It is a model. And as we first discussed in Chapter 2, models are not intended to be completely realistic. Quick quiz: explain how an increase in the wage can potentially decrease the amount that a person wants to work. 457. The best way to view the theory of consumer choice is as a metaphor for how consumers make decisions. No consumer goes through the explicit optimization envisioned in the theory. Yet consumers are aware that their choices are constrained by their financial resources. And given those constraints, they do the best they can to achieve the highest level of satisfaction. The theory of consumer choice tries to describe this implicit, psychological process in a way that permits explicit, economic analysis. Just as the proof of the pudding is in the eating, the test of a theory is in its applications. In the last section of this chapter, we applied the theory of consumer choice to 3 practical issues about the economy. If you take more advanced courses in economics, you will see that this theory provides the framework for much additional analysis. A consumer's budget constraint shows the possible combinations of different goods she can buy given her income and the prices of the goods. The slope of the budget constraint equals the relative price of the goods. The consumer's indifference curves represent her preferences. An indifference curve shows the various bundles of goods that make the consumer equally happy. Points on higher indifference curves are preferred to points on lower indifference curves. The slope of an indifference curve at any point is the consumer's marginal rate of substitution, the rate at which the consumer is willing to trade one good for the other. The consumer optimizes by choosing the point on her budget constraint that lies on the highest indifference curve. At this point, the slope of the indifference curve equals the slope of the budget constraint, and the consumer's valuation of the two goods equals the market's valuation. When the price of a good falls, the impact on the consumer's choices can be broken down into an income effect and a substitution effect. The income effect is the change in consumption that arises because a lower price makes the consumer better off. The substitution effect is the change in consumption that arises because a price change encourages greater consumption of the good that has become relatively cheaper. The income effect is reflected in the movement from a lower to a higher indifference curve, whereas the substitution effect is reflected by a movement along an indifference curve to a point with a different slope. The theory of consumer choice can be applied in many situations. It explains why demand curves can potentially slope upward, why higher wages could either increase or decrease the quantity of labor supplied, and why higher interest rates could either increase or decrease saving. Key concepts. 1. A consumer has income of $3,000. Wine costs $3 per glass, and cheese costs $6 per pound. Draw the consumer's budget constraint with wine on the vertical axis. What is the slope of this budget constraint? 2. Draw a consumer's indifference curves for wine and cheese. Describe and explain 4 properties of these indifference curves. Questions for review. 458. 1. Emilio buys pizza for $10 and soda for $2. He has income of $100. His budget constraint will experience a parallel outward shift if which of the following events occur? A. The price of pizza falls to $5, the price of soda falls to $1, and his income falls to $50. B. The price of pizza rises to $20, the price of soda rises to $4, and his income remains the same. C. The price of pizza falls to $8, the price of soda falls to $1, and his income rises to $120. D. The price of pizza rises to $20, the price of soda rises to $4, and his income rises to $400. 2. At any point on an indifference curve, the slope of the curve measures the consumer's A. income. B. Willingness to trade one good for the other. C. Perception of the two goods as substitutes or complements. D. Elasticity of demand. 3. Mankiw and Susan are both optimizing consumers in the markets for shirts and hats, where they pay $100 for a shirt and $50 for hat. Mankiw buys 4 shirts and 16 hats, while Susan buys 6 shirts and 12 hats. From this information, we can infer that Mankiw's marginal rate of substitution is ________ hats per shirt, while Susan's is ________. A2, 1B2, 2. C4, 1D4, 24. Charlie buys only milk and cereal. Milk is a normal good, while cereal is an inferior good. When the price of milk rises, Charlie buys A. less of both goods. B. More milk and less cereal. C. Less milk and more cereal. D. Less milk, but the impact on cereal is ambiguous. 5. If the price of pasta increases and a consumer buys more pasta, we can infer that A. Pasta is a normal good, and the income effect is greater than the substitution effect. B. Pasta is a normal good, and the substitution effect is greater than the income effect. C. Pasta is an inferior good, and the income effect is greater than the substitution effect. D. Pasta is an inferior good, and the substitution effect is greater than the income effect. 6. The labor supply curve slopes upward if A. Leisure is a normal good. B. Consumption is a normal good. C. The income effect on leisure is greater than the substitution effect. D. The substitution effect on leisure is greater than the income effect. Quick check multiple choice. 3. Pick a point on an indifference curve for wine and cheese and show the marginal rate of substitution. What does the marginal rate of substitution tell us? 4. Show a consumer's budget constraint and indifference curves for wine and cheese. Show the optimal consumption choice. If the price of wine is $3 per glass and the price of cheese is $6 per pound, what is the marginal rate of substitution at this optimum? 5. A person who consumes wine and cheese gets a raise, so her income increases from $3,000 to $4,000. Show what happens if both wine and cheese are normal goods. Now show what happens if cheese is an inferior good. 6. The price of cheese rises from $6 to $10 per pound, while the price of wine remains $3 per glass. For a consumer with a constant income of $3,000, show what happens to consumption of wine and cheese. Decompose the change into income and substitution effects. 7. Can an increase in the price of cheese possibly induce a consumer to buy more cheese? Explain. 1. Jennifer divides her income between coffee and croissants. An early frost in Brazil causes a large increase in the price of coffee in the United States. A. Show the effect of the frost on Jennifer's budget constraint. B. Show the effect of the frost on Jennifer's optimal consumption bundle assuming that the substitution effect outweighs the income effect for croissants. C. Show the effect of the frost on Jennifer's optimal consumption bundle assuming that the income effect outweighs the substitution effect for croissants. Problems and applications. 459. To compare the following two pairs of goods, Coke and Pepsi skis and ski bindings. A. In which case are the two goods complements? In which case are they substitutes? B. In which case do you expect the indifference curves to be fairly straight? In which case do you expect the indifference curves to be very bowed? C. In which case will the consumer respond more to a change in the relative price of the two goods? 3. You consume only soda and pizza. One day, the price of soda goes up, the price of pizza goes down, and you are just as happy as you were before the price changes. A. Illustrate this situation on a graph. B. How does your consumption of the two goods change? How does your response depend on income and substitution effects? C. Can you afford the bundle of soda and pizza you consumed before the price changes? 4. Mario consumes only cheese and crackers. A. Could cheese and crackers both be inferior goods for Mario? Explain. B. Suppose that cheese is a normal good for Mario while crackers are an inferior good. If the price of cheese falls, what happens to Mario's consumption of crackers? What happens to his consumption of cheese? Explain. 5. Jim buys only milk and cookies. A. In year 1, Jim earns $100, milk costs $2 per quart, and cookies cost $4 per dozen. Draw Jim's budget constraint. B. Now suppose that all prices increase by 10% in year 2 and that Jim's salary increases by 10% as well. Draw Jim's new budget constraint. How would Jim's optimal combination of milk and cookies in year 2 compare to his optimal combination in year 1? 6. State whether each of the following statements is true or false. Explain your answers. A. All Jiffin goods are inferior goods. B. All inferior goods are Jiffin goods. 7. A college student has two options for meals, eating at the dining hall for $6 per meal, or eating a cup of soup for $1.50 per meal. Her weekly food budget is $60. A. Draw the budget constraint showing the trade-off between dining hall meals and cups of soup. Assuming that she spends equal amounts on both goods, draw an indifference curve showing the optimum choice. Label the optimum as point A. B. Suppose the price of a cup of soup now rises to $2. Using your diagram from part, show the consequences of this change in price. Assume that our student now spends only 30% of her income on dining hall meals. Label the new optimum as point BC. What happened to the quantity of cups of soup consumed as a result of this price change? What does this result say about the income and substitution effects? Explain. D. Use points A and B to draw a demand curve for cup of soup. What is this type of good called? 8. Consider your decision about how many hours to work. A. Draw your budget constraint assuming that you pay no taxes on your income. On the same diagram, draw another budget constraint assuming that you pay 15% tax. B. Show how the tax might lead to more hours of work, fewer hours, or the same number of hours. Explain. 9. Sarah is awake for 100 hours per week. Using one diagram, show Sarah's budget constraints if she earns $6 per hour, $8 per hour, and $10 per hour. Now draw indifference curves such that Sarah's labor supply curve is upward sloping when the wage is between $6 and $8 per hour, and backward sloping when the wage is between $8 and $10 per hour. 10. Draw the indifference curve for someone deciding how to allocate time between work and leisure. Suppose the wage increases. Is it possible that the person's consumption would fall? Is this plausible? Discuss. 11. Consider a couple's decision about how many children to have. Assume that over a lifetime a couple has 200,000 hours of time to either work or raise children. The wage is $10 per hour. Raising a child takes 20,000 hours of time. A. Draw the budget constraint showing the trade-off between lifetime consumption and the number of children. Show indifference curves and an optimum choice. B. Suppose the wage increases to $12 per hour. Show how the budget constraint shifts. Using income and substitution effects, discuss the impact of the change on the number of children and lifetime consumption. C. We observe that, as societies get richer and wages rise, people typically have fewer children. Is this fact consistent with this model? Explain. 460. 12 economist George Stigler once wrote that, according to consumer theory, if consumers do not buy less of a commodity when their incomes rise, they will surely buy less when the price of the commodity rises. Explain this statement using the concepts of income and substitution effects. 13.5 Consumers have the following marginal utility of apples and pears: marginal utility of apples, marginal utility of pears. Claire 6:12, Phil 6:6, Haley 6:3, Alex 3:6, Luke 3:12. The price of an apple is $1, and the price of a pear is $2. Which, if any, of these consumers are optimizing over their choice of fruit? For those who are not, how should they change their spending? Go to ceengagebrain.com to purchase access to the proven, critical study guide to accompany this text, which features additional notes and context, practice tests, and much more. 461. Frontiers of Microeconomics. Economics is a study of the choices that people make and the resulting interactions they have with one another. This study has many facets, as we have seen in the preceding chapters. Yet it would be a mistake to think that all the facets we have seen make up a finished jewel, perfect and unchanging. Like all scientists, economists are always on the lookout for new areas to study and new phenomena to explain. This final chapter on microeconomics offers an assortment of 3 topics at the discipline's frontier to show how economists are trying to expand their understanding of human behavior and society. The first topic is the economics of asymmetric information. In many different situations, some people are better informed than others, and the imbalance in information affects the choices they make and how they deal with one another. Thinking about this asymmetry can shed light on many aspects of the world, from the market for used cars to the custom of gift giving. Chapter 22. 462 Part 7 Topics for further study. The second topic we examine in this chapter is political economy. Throughout this book, we have seen many examples in which markets fail and government policy can potentially improve matters. But potentially is a necessary qualifier. Whether this potential is realized depends on how well our political institutions work. The field of political economy uses the tools of economics to understand the functioning of government. The third topic in this chapter is behavioral economics. This field brings some of the insights from psychology into the study of economic issues. It offers a view of human behavior that is more subtle and complex than the one found in conventional economic theory, a view that may be more realistic. This chapter covers a lot of ground. To do so, it offers not full helpings of these three topics but, instead, a taste of each. One goal of this chapter is to show a few of the directions economists are heading in their effort to expand knowledge of how the economy works. Another is to whet your appetite for more courses in economics. 22:1 Asymmetric information. I know something you don't know. This statement is a common taunt among children, but it also conveys a deep truth about how people sometimes interact with one another. Many times in life, one person knows more about what is going on than another. A difference in access to knowledge that is relevant to an interaction is called an information asymmetry. Examples abound. A worker knows more than his employer about how much effort he puts into his job. A seller of a used car knows more than the buyer about the car's condition. The first is an example of a hidden action, whereas the second is an example of a hidden characteristic. In each case, the uninformed party would like to know the relevant information, but the informed party may have an incentive to conceal it. Because asymmetric information is so prevalent, economists have devoted much effort in recent decades to studying its effects. Let's discuss some of the insights that this study has revealed. 22-1 A hidden actions, principles, agents, and moral hazard. Moral hazard is a problem that arises when one person, called the agent, is performing some task on behalf of another person, called the principal. If the principal cannot perfectly monitor the agent's behavior, the agent tends to undertake less effort than the principal considers desirable. The phrase moral hazard refers to the risk, or hazard, of inappropriate or otherwise immoral behavior by the agent. In such a situation, the principal tries various ways to encourage the agent to act more responsibly. The employment relationship is the classic example. The employer is the principal, and the worker is the agent. The moral hazard problem is the temptation of imperfectly monitored workers to shirk their responsibilities. Employers can respond to this problem in various ways. Better monitoring. Employers may plant hidden video cameras to record workers' behavior. The aim is to catch irresponsible actions that might occur when supervisors are absent. High wages. According to efficiency wage theories, some employers may choose to pay their workers a wage above the level that balances supply and demand in the labor market. A worker who earns an above equilibrium wage is less likely to shirk because if he is caught and fired, he might not be able to find another high-paying job. Delayed payment. Firms can delay part of a worker's compensation, so if the worker is caught shirking and is fired, he suffers a larger penalty. One example of delayed compensation is the year-end bonus. Similarly, a firm may choose to pay its workers more later in their lives. Thus, the wage increases that workers get as they age may reflect not just the benefits of experience but also a response to moral hazard. Employers can use any combination of these various mechanisms to reduce the problem of moral hazard. There are also many examples of moral hazard beyond the workplace. A homeowner with fire insurance will likely buy too few fire extinguishers. Corporate management. Production in the modern economy takes place within corporations. Like other firms, corporations buy inputs in markets for the factors of production and sell their output in markets for goods and services. Also, like other firms, they are guided in their decisions by the objective of profit maximization. But a large corporation has to deal with some issues that do not arise in, say, A small family-owned business. What is distinctive about a corporation? From a legal standpoint, a corporation is an organization that is granted a charter recognizing it as a separate legal entity, with its own rights and responsibilities distinct from those of its owners and employees. From an economic standpoint, the most important feature of the corporate form of organization is the separation of ownership and control. One group of people, called the shareholders, own the corporation and share in its profits. Another group of people, called the managers, are employed by the corporation to make decisions about how to deploy the corporation's resources. The separation of ownership and control creates a principal-agent problem. In this case, the shareholders are the principals and the managers are the agents. The chief executive officer and other managers, who are in the best position to know the available business opportunities, are charged with the task of maximizing profits for the shareholders. But ensuring that they carry out this task is not always easy. The managers may have goals of their own, such as taking life easy, having a plush office and a private jet, throwing lavish parties, or presiding over a large business empire. The manager's goals may not always coincide with the shareholders' goal of profit maximization. The corporation's board of directors is responsible for hiring and firing the top management. The board monitors the managers' performance, and it designs their compensation packages. These packages often include incentives aimed at aligning the interests of shareholders with the interests of management. Managers might be given bonuses based on performance or options to buy the company's stock, which are more valuable if the company performs well. Note, however, that the directors are themselves agents of the shareholders. The existence of a board overseeing management only shifts the principal-agent problem. The issue then becomes how to ensure that the board of directors fulfills its own legal obligation of acting in the best interest of the shareholders. If the directors become too friendly with management, they may not provide the required oversight. The corporation's principal-agent problem became big news around 2005. The top managers of several prominent companies, such as Enron, Tyco, and WorldCom, were found to be engaging in activities that enriched themselves at the expense of their shareholders. In these cases, the actions were so extreme as to be criminal, and the corporate managers were not just fired but also sent to prison. Some shareholders sued directors for failing to monitor management sufficiently. Fortunately, criminal activity by corporate managers is rare. But in some ways, it is only the tip of the iceberg. Whenever ownership and control are separated, as they are in most large corporations, there is an inevitable tension between the interests of shareholders and the interests of management. FYI. 464 Part 7 Topics for further study. Because the homeowner bears the cost of the extinguisher while the insurance company receives much of the benefit. A family may live near a river with a high risk of flooding because the family enjoys the scenic views, while the government bears the cost of disaster relief after a flood. Many regulations are aimed at addressing the problem. An insurance company may require homeowners to buy fire extinguishers, and the government may prohibit building homes on land with high risk of flooding. But the insurance company does not have perfect information about how cautious homeowners are, and the government does not have perfect information about the risk that families undertake when choosing where to live. As a result, the problem of moral hazard persists. 22-1b Hidden characteristics, adverse selection and the lemons problem. Adverse selection is a problem that arises in markets in which the seller knows more about the attributes of the good being sold than the buyer does. In such a situation, the buyer runs the risk of being sold a good of low quality. That is, the selection of goods sold may be adverse from the standpoint of the uninformed buyer. The classic example of adverse selection is the market for used cars. Sellers of used cars know their vehicle's defects while buyers often do not. Because owners of the worst cars are more likely to sell them than are the owners of the best cars, buyers are apprehensive about getting a lemon. As a result, many people avoid buying vehicles in the used car market. This lemons problem can explain why a used car only a few weeks old sells for thousands of dollars less than a new car of the same type. A buyer of the used car might surmise that the seller is getting rid of the car quickly because the seller knows something about it that the buyer does not. A second example of adverse selection occurs in the labor market. According to another efficiency wage theory, workers vary in their abilities, and they may know their own abilities better than do the firms that hire them. When a firm cuts the wage it pays, the more talented workers are more likely to quit, knowing they are better able to find other employment. Conversely, a firm may choose to pay an above equilibrium wage to attract a better mix of workers. A third example of adverse selection occurs in markets for insurance. For example, buyers of health insurance know more about their own health problems than do insurance companies. Because people with greater hidden health problems are more likely to buy health insurance than are other people, the price of health insurance reflects the costs of a sicker than average person. As a result, people in average health may observe the high price of insurance and decide not to buy it. When markets suffer from adverse selection, the invisible hand does not necessarily work its magic. In the used car market, owners of good cars may choose to keep them rather than sell them at the low price that skeptical buyers are willing to pay. In the labor market, wages may be stuck above the level that balances supply and demand, resulting in unemployment. In insurance markets, buyers with low risk may choose to remain uninsured because the policies they are offered fail to reflect their true characteristics. Advocates of government-provided health insurance sometimes point to the problem of adverse selection as one reason not to trust the private market to provide the right amount of health insurance on its own. 22-1C Signaling to convey private information. Although asymmetric information is sometimes a motivation for public policy, it also motivates some individual behavior that otherwise might be hard to explain. Markets respond to problems of asymmetric information in many ways. One of them is signaling, which refers to actions taken by an informed party for the sole purpose of credibly revealing his private information. We have seen examples of signaling in previous chapters. As we saw in Chapter 16, firms may spend money on advertising to signal to potential customers that they have high-quality products. As we saw in Chapter 20, students may earn college degrees merely to signal to potential employers that they are high-ability individuals, rather than to increase their productivity. These two examples of signaling may seem very different, but below the surface, they are much the same. In both cases, the informed party uses the signal to convince the uninformed party that the informed party is offering something of high quality. What does it take for an action to be an effective signal? Obviously, it must be costly. If a signal were free, everyone would use it and it would convey no information. For the same reason, there is another requirement: the signal must be less costly, or more beneficial, to the person with the higher quality product. Otherwise, everyone would have the same incentive to use the signal and the signal would reveal nothing. Consider again our two examples. In the advertising case, a firm with a good product reaps a larger benefit from advertising because customers who try the product once are more likely to become repeat customers. Thus, it is rational for the firm with a good product to pay for the cost of the signal, and it is rational for the customer to use the signal as a piece of information about the product's quality. In the education case, a talented person can get through school more easily than a less talented one. Thus, it is rational for the talented person to pay for the cost of the signal, and it is rational for the employer to use the signal as a piece of information about the person's talent. The world is replete with instances of signaling. Magazine ads sometimes include the phrase "as seen on TV." Why does a firm selling a product in a magazine choose to stress this fact? One possibility is that the firm is trying to convey its willingness to pay for an expensive signal in the hope that you will infer that its product is of high quality. For the same reason, graduates of elite schools are always sure to put that fact on their resumes. Gifts as signals. A man is debating what to give his girlfriend for her birthday. "I know," he says to himself, "I'll give her cash. After all, I don't know her tastes as well as she does, and with cash, she can buy anything she wants." But when he hands her the money, she is offended. Convinced he doesn't really love her, she breaks off the relationship. What's the economics behind this story? In some ways, gift giving is a strange custom. As the man in our story suggests, people typically know their own preferences better than others do, so we might expect everyone to prefer cash to in-kind transfers. If your employer substituted merchandise of his choosing for your paycheck, you would likely object to this. 466 Part 7 Topics for further study. 22-1D Screening to uncover private information. When an informed party takes actions to reveal private information, the phenomenon is called signaling. When an uninformed party takes actions to induce the informed party to reveal private information, the phenomenon is called screening. Some screening is common sense. A person buying a used car may ask that it be checked by an auto mechanic before the sale. A seller who refuses this request reveals his private information that the car is a lemon. The buyer may decide to offer a lower price or to look for another car. Other examples of screening are more subtle. For example, consider a firm that sells car insurance. The firm would like to charge a low premium to safe drivers and a high premium to risky drivers. But how can it tell them apart? Drivers know whether they are safe or risky, but the risky ones won't admit it. A driver's history is one piece of information, but because of the intrinsic randomness of car accidents, history is an imperfect indicator of future risk. The insurance company might be able to sort out the two kinds of drivers by offering different insurance policies that would induce the drivers to separate themselves. One policy would have a high premium and cover the full cost of any accidents that occur. Another policy would have low premiums but would have, say, a $1,000 deductible. Notice that the deductible is more of a burden for risky drivers because they are more likely to have an accident. Thus, with a large enough deductible, the low premium policy with a deductible would attract the safe drivers, while the high premium policy without a deductible would attract the risky drivers. Faced with these two policies, the two kinds of drivers would reveal their private information by choosing different insurance policies. 22-1E Asymmetric Information and Public Policy. We have examined two kinds of asymmetric information, moral hazard and adverse selection. And we have seen how individuals may respond to the problem with signaling or screening. Now let's consider what the study of asymmetric information suggests about the proper scope of public policy. Means of payment. But your reaction is very different when someone who loves you does the same thing. One interpretation of gift giving is that it reflects asymmetric information and signaling. The man in our story has private information that the girlfriend would like to know. Does he really love her? Choosing a good gift for her is a signal of his love. Certainly, the act of picking out a gift, rather than giving cash, has the right characteristics to be a signal. It is costly, and its cost depends on private information. If he really loves her, choosing a good gift is easy because he is thinking about her all the time. If he doesn't love her, finding the right gift is more difficult. Thus, giving a gift that suits the girlfriend is one way for him to convey the private information of his love for her. Giving cash shows that he isn't even bothering to try. The signaling theory of gift giving is consistent with another observation: people care most about the custom when the strength of affection is most in question. Thus, giving cash to a girlfriend or boyfriend is usually a bad move. But when college students receive a check from their parents, they are less often offended. The parents' love is less likely to be in doubt, so the recipient probably won't interpret the cash gift as a signal of lack of affection. The tension between market success and market failure is central in microeconomics. We learned in Chapter 7 that the equilibrium of supply and demand is efficient in the sense that it maximizes the total surplus that society can obtain in a market. Adam Smith's invisible hand seemed to reign supreme. This conclusion was then tempered with the study of externalities, public goods, imperfect competition, and poverty. In those chapters, we saw that government can sometimes improve market outcomes. The study of asymmetric information gives us a new reason to be wary of markets. When some people know more than others, the market may fail to put resources to their best use. People with high-quality used cars may have trouble selling them because buyers will be afraid of getting a lemon. People with few health problems may have trouble getting low-cost health insurance because insurance companies lump them together with those who have significant health problems. Asymmetric information may call for government action in some cases, but three facts complicate the issue. First, as we have seen, the private market can sometimes deal with information asymmetries on its own using a combination of signaling and screening. Second, the government rarely has more information than the private parties. Even if the market's allocation of resources is not ideal, it may be the best that can be achieved. That is, when there are information asymmetries, policymakers may find it hard to improve upon the market's admittedly imperfect outcome. Third, the government is itself an imperfect institution, a topic we take up in the next section. 22-2 Political Economy. Quick quiz. A person who buys a life insurance policy pays a certain amount per year and receives for his family a much larger payment in the event of his death. Would you expect buyers of life insurance to have higher or lower death rates than the average person? How might this be an example of moral hazard? Of adverse selection? How might a life insurance company deal with these problems? As we have seen, markets left on their own do not always reach a desirable allocation of resources. When we judge the market's outcome to be either inefficient or inequitable, there may be a role for the government to step in and improve the situation. Yet before we embrace an activist government, we need to consider one more fact: the government is also an imperfect institution. The field of political economy uses the methods of economics to study how government works. 22-2 The Condorcet voting paradox. Most advanced societies rely on democratic principles to set government policy. When a city is deciding between two locations to build a new park, for example, we have a simple way to choose: the majority gets its way. Yet for most policy issues, the number of possible outcomes far exceeds two. A new park could be placed in many possible locations. In this case, as the 18th-century French political theorist Marquis de Condorcet famously noted, democracy might run into some problems trying to choose the best outcome. For example, suppose there are three possible outcomes, labeled A, B, and C, and there are three voter types with the preferences shown in Table 1. The mayor of our town wants to aggregate these individual preferences into preferences for society as a whole. How should he do it? At first, he might try some pairwise votes. If he asks voters to choose first between B and C, voter types 1 and 2 will vote for B, giving B the majority. If he then asks voters to choose between A and B, voter types 1 and 3 will vote for A, giving A the majority. Observing that A beats B, and B beats C, the mayor might conclude that A is the voter's clear choice. But wait, suppose the mayor then asks voters to choose between A and C. In this case, voter types 2 and 3 vote for C, giving C the majority. That is, under pairwise majority voting, A beats B, B beats C, and C beats A. Normally, we expect preferences to exhibit a property called transitivity. If A is preferred to B, and B is preferred to C, then we would expect A to be preferred to C. The Condorcet paradox is that democratic outcomes do not always obey this property. Pairwise voting might produce transitive preferences for society in some cases, but as our example in the table shows, it cannot be counted on to do so. One implication of the Condorcet paradox is that the order in which things are voted on can affect the result. If the mayor suggests choosing first between A and B and then comparing the winner to C, the town ends up choosing C. But if the voters choose first between B and C and then compare the winner to A, the town ends up with A. And if the voters choose first between A and C and then compare the winner to B, the town ends up with B. The Condorcet paradox teaches two lessons. The narrow lesson is that when there are more than two options, setting the agenda can have a powerful influence over the outcome of a democratic election. The broad lesson is that majority voting by itself does not tell us what outcome a society really wants. 22-2b Arrow's impossibility theorem. Since political theorists first noticed Condorcet's paradox, they have spent much energy studying existing voting systems and proposing new ones. For example, as an alternative to pairwise majority voting, the mayor of our town could ask each voter to rank the possible outcomes. For each voter, we could give 1 point for last place, 2 points for second to last, 3 points for third to last, and so on. The outcome that receives the most total points wins. With the preferences in Table 1, outcome B is the winner. This voting method is called a board account for the 18th century French mathematician and political theorist who devised it. It is often used in polls that rank sports teams. Is there a perfect voting system? Economist Kenneth Arrow took up this question in his 1951 book Social Choice and Individual Values. Arrow started by defining what a perfect voting system would be. He assumes that individuals in society have preferences over the various possible outcomes, A, B, C, and so on. He then assumes that society wants a voting system to choose among these outcomes that satisfies several properties. Unanimity: if everyone prefers A to B, then A should beat B. Transitivity: if A beats B, and B beats C, then A should beat C. Independence of irrelevant alternatives: the ranking between any two outcomes A and B should not depend on whether some third outcome C is also available. No dictators: there is no person who always gets his way, regardless of everyone else's preferences. These all seem like desirable properties of a voting system. Yet Arrow proved, mathematically and incontrovertibly, that no voting system can satisfy all these properties. This amazing result is called Arrow's impossibility theorem. The mathematics needed to prove Arrow's theorem is beyond the scope of this book, but we can get some sense of why the theorem is true from a couple of examples. We have already seen the problem with the method of majority rule. The Condorcet paradox shows that majority rule fails to produce a ranking of outcomes that always satisfies transitivity. As another example, the board account fails to satisfy the independence of irrelevant alternatives. Recall that, using the preferences in Table 1, outcome B wins with a board account. But suppose that suddenly C disappears as an alternative. If the board account method is applied only to outcomes A and B, then A wins. Thus, eliminating alternative C changes the ranking between A and B. This change occurs because the result of the board account depends on the number of points that A and B receive, and the number of points depends on whether the irrelevant alternative, C, is also available. Arrow's impossibility theorem is a deep and disturbing result. It doesn't say that we should abandon democracy as a form of government. But it does say that no matter what voting system society adopts for aggregating the preferences of its members, it will in some way be flawed as a mechanism for social choice. 22-2c The median voter is king. Despite Arrow's theorem, voting is how most societies choose their leaders and public policies, often by majority rule. The next step in studying government is to examine how governments run by majority rule work. That is, in a democratic society, who determines what policy is chosen. In some cases, the theory of democratic government yields a surprisingly simple answer. Let's consider an example. Imagine that society is deciding how much money to spend on some public good, such as the army or the national parks. Each voter has his own most preferred budget, and he always prefers outcomes closer to his most preferred value to outcomes farther away. Thus, we can line up voters from those who prefer the smallest budget to those who prefer the largest. Figure 1 is an example. Here there are 100 voters, and the budget size varies from $0 to $20 billion. Given these preferences, what outcome would you expect democracy to produce? According to a famous result called the median voter theorem, majority rule will produce the outcome most preferred by the median voter. The median voter is the voter exactly in the middle of the distribution. In this example, if you take the line of voters ordered by their preferred budgets and count 50 voters from either end of the line, you will find that the median voter wants a budget of $10 billion. By contrast, the average preferred outcome is $9 billion, and the modal outcome is $15 billion. The median voter rules the day because his preferred outcome beats any other proposal in a two-way race. In our example, more than half the voters want $10 billion or more, and more than half want $10 billion or less. If someone proposes, say, $8 billion instead of $10 billion, everyone who prefers $10 billion or more will vote with the median voter. Similarly, if someone proposes $12 billion instead of $10 billion, everyone who wants $10 billion or less will vote with the median voter. In either case, the median voter has more than half the voters on his side. What about the Condorcet voting paradox? It turns out that when the voters are picking a point along a line and each voter aims for his own most preferred point, the Condorcet paradox cannot arise. The median voter's most preferred outcome beats all challengers. One implication of the median voter theorem is that if two political parties are each trying to maximize their chance of election, they will both move their positions toward the median voter. Suppose, for example, that the Democratic Party advocates a budget of $15 billion, while the Republican Party advocates a budget of $10 billion. The Democratic position is more popular in the sense that $15 billion has more proponents than any other single choice. Nonetheless, the Republicans get more than 50% of the vote. They will attract the 20 voters who want $10 billion, the 15 voters who want $5 billion, and the 25 voters who want zero. If the Democrats want to win, they will move their platform toward the median voter. Thus, this theory can explain why the parties in a two-party system are similar to each other. They are both moving toward the median voter. Another implication of the median voter theorem is that minority views are not given much weight. Imagine that 40% of the population want a lot of money spent on the national parks and 60% want nothing spent. In this case, the median voter's preference is zero, regardless of the intensity of the minority's view. Such is the logic of democracy. Rather than reaching a compromise that takes into account everyone's preferences, majority rule looks only to the person in the exact middle of the distribution. 22-2D Politicians are people too. When economists study consumer behavior, they assume that consumers buy the bundle of goods and services that gives them the greatest level of satisfaction. When economists study firm behavior, they assume that firms produce the quantity of goods and services that yields the greatest level of profits. What should they assume when they study people involved in the practice of politics? Politicians also have objectives. It would be nice to assume that political leaders are always looking out for the well-being of society as a whole, that they are aiming for an optimal combination of efficiency and equality. Nice, perhaps, but not realistic. Self-interest is as powerful a motive for political actors as it is for consumers and firm owners. Some politicians, motivated by a desire for re-election, are willing to sacrifice the national interest to solidify their base of voters. Others are motivated by simple greed. If you have any doubt, you should look at the world's poor nations, where corruption among government officials is a common impediment to economic development. This book is not the place to develop a theory of political behavior. But when thinking about economic policy, remember that this policy is made not by a benevolent king but by real people with their own all-too-human desires. Sometimes they are motivated to further the national interest, but sometimes they are motivated by their own political and financial ambitions. We shouldn't be surprised when economic policy fails to resemble the ideals derived in economics textbooks. Quick quiz: a public school district is deciding on the school budget and the resulting student-teacher ratio. A poll finds that 20% of the voters want a ratio of 9:1, 25% want a ratio of 10:1, 15% want a ratio of 11:1, and 40% want a ratio of 12:1. If the district uses majority rule voting, what outcome would you expect the district to end up with? Explain. Economics is a study of human behavior, but it is not the only field that can make that claim. The social science of psychology also sheds light on the choices that people make in their lives. The fields of economics and psychology usually proceed independently, in part because they address a different range of questions. But recently, a field called behavioral economics